In this presentation, we will discuss audit and attestation engagements related to financial statements. This will be a long presentation. If you would like to go to relevant points within it, take a look at the description below, which will have links to those relevant points as well as a discussion of what will be included at them. If you would like to see this in a playlist format, there will also be a link to a playlist format as well. In this presentation, we will take a look at audit versus financial accounting. We'll also take a look at managerial assertions as we think about the creation of the financial statement with regards to an audit process taking place for them. When we think about financial accounting and audit, we usually study these in order. So if we're going to go into accounting, we typically start off with financial accounting, and then at some point we might move to audit, studying audit. One of the reasons we have this process in that way, one of the reasons we don't learn audit and then the financial accounting, is because the financial accounting is really where we learn to construct something. We start from nothing, transactions, concepts. We learn to then construct the financial statements, the end product with it. I would compare this in analogy to constructing something like a building. Now, you would think that constructing the building would be more difficult than going back to the building and testing it to see if the building was put together in a structurally sound way, which is similar to what is done in an audit. If we audit something, then we're taking a look at the end product, the financial statements, typically with financial accounting types of audits. But if we compare that to a building, we'd be taking the building, we're saying, is the building structurally sound? Similar type of process with an audit. You would think, of course, the construction of the building or the construction of the financial statement more difficult than going back and saying, okay, is the thing that has been constructed done well, done properly? And in many cases, it is in a lot of ways. The financial statement creation is more difficult in a lot of ways because we're actually building something from nothing. We're taking the financial statement transactions, we're putting them together, we are constructing the end result, those being the financial statements. However, as we put this information together, it's pretty well detailed how we're supposed to do each particular step. We could think about putting the Lego set together to put our building together, and the instructions are pretty straightforward. They're well defined. When we start to record the transactions, we say, I have a question about how to record this transaction, which account should be debited and credited, which account should be going up or down. We consult the regulations, we look at generally accepted accounting principles, we get the answer, we record the transaction in accordance with the rules, very specific rules. As we follow those rules in a very specific way, we construct our financial statements and get to that end result. So it's a long process, tedious process, takes a lot of work, but as we go through each step in the process, there usually are going to be a set of rules that we can go through and follow fairly closely. When we think about the audit side of things, now what we're doing is we're taking the end product, we could say the building or the financial statements, we're testing to see if it's going to be sound. Is the building structurally sound? Could it hold up, say, to an earthquake or something like that, or like it's supposed to? Are the financial statements structurally sound? Are they complete? Do they have everything that should be in it? Do they have an accurate representation or reflection of the financial condition and performance of the company over a certain time period? Now, you would think that would be easier to look into, but it's a little bit confusing to think about that. If we have the building, you can say, well, the building looks structurally sound, it's solid. How do I know it would stand up if you had an earthquake or something? It's supposed to stand up if you have a 7-point-some earthquake. How would I test for that? I don't know. It'd be a little bit difficult to go into that. And in order to test for that, we're learning a few different things. One, we're going to be learning the financial accounting principles much more clearly. Because oftentimes what we do is we memorize what we're doing. If I'm going to put something together like a building and you ask me why I put something together, I just say, hey, look, this is what the direction says, and I follow the direction and I got to the end product of the building. The directions, of course, have reasons for them. They follow the accrual principle and they have more reasons, but oftentimes as we follow the directions, we just follow the directions. And we can do that pretty clearly with financial accounting. When we get into the audit and we have to test whether or not something has been built in a structurally sound way, we not only have to follow the directions, we have to know the meaning of the direction. What are the actual principles being followed, such as the accrual principle, revenue recognition principle, the matching principle, or expense recognition principle. We have to know those well and then actually construct ways that we can test for soundness. If we're looking at the building, how could we test if this thing would fall over without actually having an earthquake to make it fall over? If we're testing the financial statements, how can we test that it's accurate, complete, without actually basically testing the whole thing or taking the whole thing apart, or in doing so in some type of time frame that's going to be easier to do? So learning audit will help us basically to better understand the concepts of financial accounting in a much more rigorous type of way. We're going to be deconstructing in some ways what's been put together in very strategic type of ways to do so in a way that's going to save the most amount of time. As we do so, we have to know what's been built and why it's been built, how it's been built. How can we then find ways to test the construction of it to see if it has been built in accordance with rules and regulations? And in order to know that, we need to know what the gist or why those rules and regulations have been put together. Therefore, the audit's going to be applying things over and above just normal principles to build the actual thing. We got to look at analytical type of skills. We got to think about what are the assertions behind the accrual principle, revenue recognition, and expense recognition or matching principle. How can we test for things? How can we put something together to test to those principles, apply out those tests, and then try to determine whether or not those tests are sufficient for us to be able to determine whether or not something has been put together accurately. So, for example, if we take a look at the management type of assertions, we'll recall that the financial statements are built by the company run by management. Management's responsible for putting together the financial statements. The auditor then is responsible for testing the financial statements in some way. So by the company putting together the financial statements, they are making assertions. There are assertions involved, basically things that the management is saying, hey, these financial statements represent these assertions within them. They have been constructed in accordance with these assertions. We as the auditor then want to take those financial statements, look at those assertions, and then determine whether or not that is indeed the case or not. As we go through these assertions, then we want to have an idea of them. We're not going to go through them in a lot of detail here, but we want to get them in our head as we go. So then when we start to create the audit, when we start to test these things, we really need to know exactly what assertion we're testing. Common test question that people miss all the time, common conceptual problem that people have within audits is that we have the same thing that we have within financial accounting. We know the rule, we read the rule book, we know we're supposed to, do this process here. We know we're supposed to do this audit test here. We don't know why, though. We don't know what the assertion is. We don't know what it is exactly that we are testing. That's where people often run into problems. So we want to basically list these assertions and then start to visualize in our mind and say, what kind of testing could we do to basically test for these types of assertions to see if this has been done in the correct way? Again, common types of test questions that people have problems with is matching up the actual assertion to the test that they know they have to create, but they don't really understand what the assertion is. So these are management assertions about classes of transactions and events and related disclosures. First assertion, occurrence. Occurrence, transactions and events that have been recorded or disclosed have occurred, and such transactions and events pertain to the entity. So we have to, obviously, if we have financial statements and they're representing the fact that a sale happened, we want to know, did that really happen, or are they trying to inflate the financial statements for some reason or the other? Is it a fictitious basic sale for one reason or another? We need to know that something actually did happen that's being represented on the financial statement. Completeness, all transactions and events that should have been recorded, and all related disclosures that should have been included in the financial statements have been included. So now we're looking at the other side of things. We're saying, well, these financial statements don't represent, some type of transaction that possibly should be there. Is that the case? Could it be the case that, say, a large expenditure that should be on the books somehow isn't there? Depreciation wasn't recorded, or something like that? Are the financial statements complete? Is everything that should have been recorded been recorded? Authorization, all transactions and events have been properly authorized. Accuracy, amounts and other data related to recorded transactions and events have been recorded appropriately, and related disclosures have been appropriately measured and described. Cutoff, transactions and events have been recorded in the correct accounting period. So some people might not be as familiar with the term cutoff. You can think of cutoff, that what should come to mind in terms of financial accounting are the adjusting entries at the end of the time period. When we're thinking about timing differences, is something recorded in the proper time period? Should it be recorded? Should revenue be included at, say, if it's a December year end in the current year, or should it be included in the following year? Oftentimes, errors within financial accounting as well as fraud could take place by having revenues and expenses recorded in the wrong time period. So we want to check the cutoffs at the beginning of the year and the end of the year to check whether or not they're in the correct time period. Classification, transactions and events have been recorded in the proper accounts, and presentation. Transactions and events are appropriately aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable in the context of the requirements of the applicable financial reporting framework. Now we're going to take a look at management assertions related to account balances and related disclosures. So we're looking at assertions related to account balances now. So when we're looking at the actual account, you can imagine basically going through the balance sheet, checking off these accounts. We can compare this to our building type of analogy. If we want to look at the structural soundness of the building, what are we going to do? We could find things and basically test those things. If we look at the financial statements, we could think about, well, one of the first places we start might be that we take the balance sheet, look at something like cash, check it out, see if we can test that. Look at something like the accounts receivable, check it out. We can take apart the financial statements, of course, by looking at those actual accounts and possibly testing for those actual accounts. So when we're looking at the account balances, then we're looking at things like existence. So is there existence of assets, liabilities, equity? Note when you're thinking about these things as well, we're usually skeptical about the financial statements being overstated. And so we're usually skeptical about, basically, if I was thinking about existence, you want to think, well, I might be more skeptical towards cash than liabilities, because it's more likely that they might put something like cash or an asset on the books in order to look good, as opposed to putting a liability on the books that doesn't exist that would make them look worse. So as you look through these types of assertions, keep in your mind, as an auditor, you're probably looking to be skeptical towards the financial statements looking better rather than worse. Now, it's possible that they actually put something together to look worse. When would you want to look worse? There's a lot of times that a company might want to look worse, or there's one time in particular where companies would want to look worse and may take actions, fraudulent actions possibly, to deceive in order to look worse, and that would of course be related to taxes. So those two things are always going the opposite direction. If someone's trying to look bad or trying to put something together just for tax purposes, they're often more likely to look worse, because if they look worse, then they pay less taxes. You don't go to the tax collector driving up in the couple $100,000 car or anything like that. Typically, people try to look worse. But any other time, then companies usually try to look better. And if you're talking about publicly traded companies, or a company looking for a loan, or a company trying to get equity investments, typical type of things companies do, everything other than taxes, then the company will typically be trying to look better than they may look. And so that's usually the perspective that we're looking at, because we're usually not representing just the IRS. That's not the main user possibly of the financial statements. The main users of the financials and the reader for the audit might be for investors. For publicly traded companies, we're typically looking out for investors. We're typically looking out in terms of the audit, for people that might do business, such as people that might give a loan, banks, and things like that. And therefore, again, skeptical usually on the financial statements being overstated, looking better. And therefore, as you look at these assertions and think about testing, you're probably going to have that kind of skeptical slant towards your perspective on how to put together the procedures. Rights and obligations. The entity holds or controls the rights to assets and liabilities, and are the obligations of the entity. So they actually have the rights and obligations to the assets and liabilities being reported. Then we have completeness. All assets, liabilities, and equity interests that should have been recorded, and all related disclosures that should have been included in the financial statements have been included in the financial statements. Then we have accuracy, valuation, and allocation. Assets, liabilities, and equity interests have been included in the financial statement at appropriate amounts, and any resulting valuation or allocation adjustments have been appropriately recorded, and related disclosures have been appropriately measured and described. Classification. Assets, liabilities, and equity have been recorded in the proper accounts. And then, of course, presentation. Assets, liabilities, and equity are appropriately aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable in the context of the requirements of the applicable financial reporting framework, typically being something like Generally Accepted Accounting Principles, GAAP. In this presentation, we will take a look at a few different terms, a few different definitions, those of auditing, attest, and assurance services. As we look at these terms, we see that there's going to be some overlap between these terms, and this is often the case when we think about items related to public accounting, often related to the services of public accounting. And that being the case, then we often hear different terms that are being used in different contexts in a similar way. We may start to think, well, these are basically the same thing. And that's because, of course, there's some overlap, but they aren't the same thing. So what we want to do then is be able to know what that overlap is. So when we hear these terms being used in different areas, or when we use them in different areas, we use them properly. We know when we can use them in interchangeable ways. We know when we have to be more specific. When we want to talk about something specifically, we know exactly how to talk to it specifically, and we know when we can basically use those interchangeable terms. So we can think about it in this way. The audit, then, the auditing being most specific of these terms, fitting within the attest, and the attest engagements fitting within assurance type items. So if we consider that, then again, we could think about the audit then being the most specific. So when we're talking about an audit, we're actually talking about a very specific thing. If we're a public accounting firm and we're talking about an audit, we're talking about a specific thing. That audit then can be referred to as something that would be like an attest engagement. In other words, the audit is going to be a type of attest engagement, but attest engagements are going to be a larger type of grouping. So if we think about this, we'd say that, well, all audits are attest engagements, but not all attest engagements are audits. So when we think about how we're going to phrase this or word things, we want to keep that in mind. All audits are a type of attest engagement, but not all attest engagements are audits. And the same goes with assurance. So we have the same type of relationship with audit and attest engagements, assurance being a broader type of category. So all attest engagements are components of assurance services. However, all assurance services are not attest engagements. And so when we start to think about, especially what is provided by, say, publicly accounting firms, what do they do? We could start to think of this hierarchy. The audit is often kind of the thing we think about first. It's the most prized type of thing. It's usually the biggest moneymaker type of thing because it takes the most work to do an audit. But that's not the only thing that is done. We might have attest engagements that are not audits. They don't have the same scope typically as audit being the most intense in scope. And we may have other assurance type services that aren't attest insurances that are done as well. So if we think about these, then we're going to say the audit. What is an audit then? Systematic process of obtaining and evaluating evidence related to assertions about economic conditions and events to determine the degree of correspondence between those assertions and an established criteria, and communicating the results to users. So an audit then is going to be usually the most specific type of service that we're going to have. When we think about audits, we're often thinking about audits of financial statements. We could do other things to financial statements, including, say, reviews of financial statements, possibly compilation of financial statements, but the audit's going to be the biggest or the most big money maker. Typically for a public accounting firm, it's going to be where we do the most work to see if the audit is in compliance. And what are we doing with the audit? We're doing exactly this. Systematic process of evaluating evidence. So we're going to look for evidence to assert about economic actions and events to determine the degree of correspondence. We're looking for the correspondence between those assertions and an established criteria. And basically the established criteria is usually generally accepted accounting principles. So we're trying to say, look at the financial statements, the assertions being that the financial statements have been created in accordance with criteria, that criteria, generally accepted accounting principles. We're looking for evidence for that to indeed be the case or not. And once we do the audit, then we're going to communicate that information to the users of the result of the audit, the resulting of our audit, what we believe to be the case. We then communicate that information, basically usually on the fairness of the financial statements. How about attest? What are the attest actions in the attest engagement? Practitioner is engaged to issue a report on subject matter or on assertions about subject matter. So now we're talking about subject matter and assertions about the subject matter that is the responsibility of another party. So notice what we're not doing as much here. We're not getting into as much of the evaluating of the evidence. So you notice the attest engagements then could include auditing, because we could have the evaluation, auditing being a type of attest engagement. But we might do far less than that, because that's not going to be a requirement of attest engagements in general. For example, we might do a review as opposed to an audit. Still is under this definition, practitioner is engaged in issue a report on subject matter or on assertions about subject matter that is the responsibility of another party. Still the responsibility of another party. We're still issuing a report. However, we're not doing as much detail in terms of gathering evidence as we would in the case of an audit, and we might do that again in something like a review. How about assurance? Assurance service, independent professional services that improve the quality of information or its context for a set of decision makers. So notice this is a broader type of definition. We're talking about assurance services in general. We're not doing the attest, you're not necessarily restricting ourselves to just the attest engagements, and we're certainly not in this broad definition restricting ourselves to just audits. We have here independent professional services that improve the quality of information. So that's going to be the criteria. They improve the quality. Now, does an audit improve the quality of the information? Hopefully it does, because it gives an outside professional assurance that the information is indeed accurate or materially accurate with regards to some degree of risk with regards to the auditing risk. So that's going to be providing services that's going to improve the quality, but the audit is not the only thing that can have a service that's going to be improving the quality of information. In this presentation, we will take a look at an overview of the financial statement auditing process. First, we'll take a look at the activities of management, and then we'll take a look and compare and contrast the activity of the audit or the activities performed within the audit. You'll recall that management, of course, is responsible for compiling the information into financial statements, that being the thing that we as the auditors are then going to go in and audit, see if it is in compliance, is in conformity with a set of principles that it should be constructed in accordance with, those typically being GAAP or generally accepted accounting principles. So management implements internal controls. Now note, internal controls are going to be a huge topic. When we think about audit, oftentimes, especially when we're thinking about a smaller type of company, we often want to go in and we just say, I want to just jump right in there and take a look at the balance sheet, give me the balance sheet, and I'm just going to dig in, start testing things out. There was a time period where that basically is more similar to what we used to do. We used to say, hey, give us the balance sheet, we're going to go in and we're going to start digging in and testing things out. As we start looking at larger companies, however, the larger the company is, the more internal controls we're going to need. We're going to need a system that's going to be set up, and you can think of this similar to as a system set up for, say, a government that's very large, where you have the checks and balances. That's in essence what internal controls are. The larger the company, the more internal checks and balances that need to be in place, and the more we need to rely on them both in the construction of the accounting system and the business system, as well as within the auditing process. So more and more with the growing size of companies, they are becoming more reliant on internal controls. And we as the auditor, if we want to have an accurate audit in a time frame that's reasonable, must also look into these internal controls, especially when we're talking about larger companies. Now, if you're talking about small companies, note that the internal controls are going to be less, because you need less internal controls when we're talking about a smaller type of company. And we as the auditor then, seeing that there are less internal controls, will make adjustments for that if that's the case as well, and do more testing of them. But really key, really important are the internal controls. Then the management is going to have conducts the actual transactions, the financial transactions that are going to happen. The year's going to go by, they're going to have financial transactions all year long. They're going to conduct those, and they're going to record and compile the information. Debits and credits are going to be recorded here to compile the information, accumulate transactions into account balances. They're, of course, going to take that. We can imagine this is what the company's doing. This is general ledger accounting. The company, the management responsible for this, taking those transactions, compiling them into balances, say a trial balance. We can imagine trial balance being put together. Then they're going to take that information and prepare financial statements, which, of course, is the end result that they would then be processing and use. If we're talking about a publicly traded company, they're required to have the financial statements that are going to be put together. If they're not publicly traded, they want them for internal use and possibly to get a loan or something like that. So the end result representing what something has been done in terms of financial accounting, according to generally accepted accounting principles, are, of course, financial statements, balance sheet, income statement, statement of cash flows, and then the financial statements are issued to users. Who are the users? If it's a publicly traded company, we're typically thinking about the end users being potential investors, because they're the people that are investing in these things in terms of their pension plans or something like that, stock trading. If they're getting money on a public exchange for investments into their publicly traded company, then we're typically thinking about the end user being the investors. Now note, we might be doing an audit for some other reason. The end user may be, say, the bank who required an audit so that they can trust the financial statements and see if they want to do business with a particular company. That's another common scenario for smaller types of companies. That could be a more common type of scenario. Publicly traded companies, required audit. We're usually thinking about investors. Smaller companies might have specific need for a full audit, and therefore we're thinking the end user might be something more likely a bank or something like that. All right, well, what does the audit do? Now, when you think about the audit coming into play, you're thinking about this having already happened. Management has done these things, the time period has passed or is close to passing when we start to think about what the audit engagement will be doing. In other words, when we start to plan the audit engagement, the financial statements, in essence, we could think of at this point being created at this point. And now the auditor, of course, is going to be looking into the accuracy of those financial statements. Have they been put together in accordance with a set of rules? That's what the audit is designed to do. Those set of rules we can imagine oftentimes being generally accepted accounting principles in a U.S. audit. So they're going to obtain evidence. We're going to obtain evidence, and that's how we're going to determine this. And again, remember the end goal is, are these financial statements represented correctly in accordance with generally accepted accounting principles? Our goal is not to say, are these financial statements, is this company doing well or not, or something like that. We want to see if they're a going concern. Are they going to go out of business that's going to violate some of the assumptions that we typically make. But other than that, we're not making those type of value judgments. What we're trying to do is say, hey, this is what happened. Let's see what did happen. Are you reflecting what is happening in accordance with the set of rules that you're claiming to, given the assertions that you've told us that you've put them together in accordance with, typically being generally accepted accounting principles? Then we're going to go in and judge that based on evidence. We'll put together tests to see whether or not these items have been indeed put together in accordance with generally accepted accounting principles. Test management's assertions against criteria, that being the generally accepted accounting principles, oftentimes determines overall fairness of financial statements. We're going to make a determination. That's our point. Is that, what's the determination after we've gotten the evidence? Once we make that determination, we're going to issue audit reports to accompany financial statements. So we're actually going to then, of course, issue our opinion on the financial statement. So obviously, we're going to have terms of engagement between the management and the auditor at the get-go. So when we think about the process, of course, we're going to have some kind of planning of the process. The person that hires the auditor, and this is going to be a problem in some ways, because you would think that there would be an independence type of problem happening here, is going to be the company. The company, for some reason, needs an audit to judge the fairness of the work that they did, and they're paying the auditor. So note there's kind of an issue there with regards to the person that's getting paid to do the job to judge the person who's paying them is a bit of a problem. That's going to be one of the reasons we focus in on things like independence at a later time. So first we're going to have this engagement. Management needs an audit. Why? Possibly they're a publicly traded company and they have to have an audit. And so the company actually has to pay for an audit because they're publicly traded. But they might need an audit because they're a bank or something like that. And then they need to get an audit because the bank wants an audit, so they need to hire an auditor. The bank doesn't hire the auditor. The management hires the auditor. The company hires the auditor to audit. But the auditors, being independent in nature, CPA firms regulated, then they have more assurance or reliability in the eyes of the bank, in the eyes of investors. So we have to have that engagement agreement of terms. What are the terms of agreement on? The management saying that I have created these in accordance with a set of rules. compiled everything together, all the assertions we've seen in a prior presentation, and the auditor then saying, hey, you provide me with this information so that I can do the tests necessary for me to gather the evidence necessary for me to determine whether or not you have indeed put these in accordance with that engagement or with the criteria. So we're going to gather evidence. So the evidence is going to be on the internal controls, the transactions, and the accumulation transactions into the balances. That's what we're going to test. And note that internal controls is important here because we're not just going to test the transactions, we're going to test the controls. And hopefully, if we're looking at a large company, those controls need to be strong because we're not going to be able to test enough transactions in many conditions in order to have enough evidence all the time without relying to some extent on the internal controls on the checks and balances of the system. Then we have the assertions, which is related to the preparation of the financial statements in accordance with the assertions, generally accepted accounting principles. We're going to test management's assertions against the criteria, that being generally accepted accounting principles. And then, of course, we're going to determine overall fairness of the financial statements. We then, having made our opinion, are going to issue our audit report to the users of the financial statements. Key concepts in conducting an audit. We have the concept of materiality, audit risk, and evidence. These are going to come up all the time. We want to have a firm grasp of these type of items. Materiality, audit risk, evidence. What are those items? Let's start with materiality. The size of an omission or misstatement of accounting information that makes it probable that the judgment of a reasonable person relying on the information would have been changed or influenced by the omission or misstatement. So that's a lot of information right there. Let's kind of break that down. We could think about it intuitively. We'll break it down by the definition. We'll think about it intuitively. Now, the reason materiality is going to be really important is because one, that we're talking about often a lot of information. If you're talking about a publicly traded company, you're talking about a lot of information. So it's not going to be the case that we can eliminate all errors or say, hey, anytime any kind of test question happens all the time, which says that we guarantee this, we guarantee that there's no errors in the financial statement, or no, we guarantee there's been no fraud, we guarantee that there's no, any guarantee is not something an auditor would say. Just like that's not something a lawyer would say. It's you just can't ever guarantee anything because it's factually inaccurate, and it would be liability-wise, not wise type of wording to say. So any test question that says that the auditor is guaranteeing anything is probably false. That's just not going to be the case. So we're always going to be seeing this term materiality. And when we think about the financial statements, materiality, you'll hear the same kind of idea as a reasonable person type of idea. Remember what the end result is. The users were typically thinking possibly investors. We want to make sure that there's not a material misstatement, or we're looking to reduce the likelihood of a material misstatement being present, which would result in something like investors making decisions to, say, invest when they would not have made that decision had that mistake not been there. So that's, in essence, what we're thinking about with materiality. We're saying, hey, we audited the financial statement. We have a degree of risk that we didn't catch the material misstatement, but we're giving some degree of assurance that the audit would then have picked up a material error. And therefore, there's a higher degree of assurance for the users of the financial statement to depend on the numbers that actually have been provided, and therefore a higher likelihood that business will be conducted, transactions will happen due to a higher degree of trust. So given that, let's go through this definition one more time. So materiality, the size of an omission or misstatement. So either something was misstated, stated incorrectly, or it wasn't stated and it should have been stated, also a mistake, of course, of accounting information that it makes it probable. So obviously probable, we have this term again that's not specific, it's kind of a judgment term, that the judgment of a reasonable person. So now we have this reasonable person term. So we're taking common sense, logic kind of concept into play, relying on the information. So they're going to be relying on the financial statements, would have been changed or influenced by the omission. So we're imagining they're relying on the information for something such as investment. If there was an omission or some kind of change that was material, they then would change their decision. Now, If you're talking about a publicly traded company that's making, millions to billions of dollars a year, you can have an omission, that a problem, an error that could be, $100,000 of revenue that wasn't stated or was stated. And given the size of the company, you may still say that that was immaterial, which seems amazing, but it could be possible because if you're looking at financial statements, these big numbers, even up to $1 million, if you're talking about really multi-million dollar companies, you could have $1 million error that if you were thinking about investing probably wouldn't be something that would influence your decision. So when we start to think about these big numbers, just realize that you could talk about big dollar terms that could be immaterial because we're looking at relationships with the other numbers being involved, and what we would think in terms of an investment decision with regards to very large numbers could result in an omission that's quite large that would still not influence a reasonable person's decision-making process. So we'll get into more ideas later on in terms of when materiality applies. How do we know what a material number is? How do we come up with that number? These are types of things we'll talk about later. At this point in time, we want to talk about the definition or the concept or the term of audit risk. Audit risk. Risk of auditor expressing a clean audit opinion when the financial statements are materially misstated. So the audit risk then is something that's always going to be present. We always want to note that there is going to be audit risk, and we're always going to say that. If they ask us, it comes down to this guarantee again. Is there a guarantee that you have eliminated all even material misstatements? No, because there is some audit risk. What's the audit risk? Risk of an auditor expressing a clean audit, good opinion. The audit basically clean, meaning there's no problem with it. The financial statements are clean. The management has indeed reported them in accordance with what they said they were reporting them. They have expressed the assertions that they said they were going to express in accordance with whatever format they have said they were going to express it in accordance with, say, generally accepted accounting principles. So that would be the auditor, the risk of the auditor expressing that clean opinion when financial statements are materially misstated. That means they could indeed be misstated to the point at which a reasonable person might make a decision that would be influenced by the error that has been in essence missed. So there is still going to be audit risk related to that. Of course, our goal within the audit is to get that audit risk as low as possible. But again, auditors never going to say that there's no audit risk. All we can do is reduce the audit risk to reasonable levels. An audit provides reasonable assurance that the financial statements do not contain material misstatements. So notice again the terminology. What are we doing in an audit? Are we eliminating audit risk? Not at all. We're not eliminating audit risk. There could still be a material misstatement. What we're doing is providing reasonable assurance. Again, lawyerly type of term, but that's what you're going to basically expect. There are no guarantees within these types of things. It's always going to have some type of reasonability type of term. Here, reasonable assurance. Reasonable assurance means that there is some risk that a material misstatement could be present in the financial statements and not be detected by a competent auditor. So notice what that's saying. It's saying, hey, the audit could have been done in a competent way, and it's still possible that a material misstatement, one that would influence someone's decision and be a mistake, is there even though the auditor was competent. Again, the risk is going to be low. We're going to try to keep that down to a reasonable level, but we're never going to say it has been removed. There's always going to be some audit risk. In this presentation, we will take a look at the concepts of audit evidence and sampling. In other words, what is audit evidence? How is it used? How is it accumulated? And how is sampling involved within the gathering or the process of gathering audit evidence? We'll start off with audit evidence. What is audit evidence? It's going to be evidence that helps the auditor evaluate management's financial statement assertions. So you'll recall the process here, of course, being management put together the financial statements. Management is responsible for the financial statements. Management is asserting within the audit, within the engagement of the audit, that they have put together the financial statements in accordance with some set of principles, generally accepted accounting principles, and therefore in accordance with these assertions. Now, we want to go in and dig into the evidence to see whether or not they have indeed put the financial statements together in accordance with those assertions. How we gather evidence. We call that evidence audit evidence. So yes, it is going to be similar to like a detective, and then we auditors imagine ourselves to be like Sherlock Holmes over here and, collecting audit evidence. So remember that the audit evidence then, evidence that helps the auditor evaluate management's financial statement assertions, consists of underlying accounting data and any additional information available to the auditor. So what type of audit evidence are we going to look at? Well, we are going to look at the accounting data, of course. That's going to be part of the evidence that we'll look into, but we might have other information that's going to be available to the auditor as well. That information could be generated from the client, or it could be originated or generated externally. We'll talk about how to gather the audit evidence and what the value or ranking of that evidence is. Just like if we were having a case and we're putting together a case where Sherlock Holmes, we're trying to figure out how valuable this evidence is. There's going to be a lot of information, of course, as there is all the time. There's going to be more information than we can deal with. What we need to do is take the relevant information, decide how relevant it is, so that we can then come up with some accurate measure or some kind of reasonable process to determine whether or not we have enough evidence to say that the assertions have been met or have not been met. As we start to rank then the value of our evidence and what type of evidence we want to spend our time pursuing and what type of evidence possibly is not worth our time pursuing, we will consider things such as, where did that evidence come from? Did that evidence come from internal to the company, or was that evidence provided by something external to the company? And we'll discuss more of those type of things related to the types of audit evidence in future presentations. Relevance, evidence related to a specific assertion being tested. This is something that seems very obvious, but many people get it wrong, or in other words, when we think about test questions, this is actually a fairly difficult type of test question, because oftentimes we think about different types of evidence. We as auditors say, hey, I know I have to do this. I have to do A, B, C, and D. I know I have to gather this evidence. That's what it says in the procedures. I'm looking at my check sheet. That's what I have to do. But if you were to ask them what exactly is the assertion, given all the assertions that we looked at in prior presentation, which exact assertion is it that you're testing for? Oftentimes, auditors are not as able to basically exactly say what the assertion is that they're testing for. And you need to know that in order to test it well, in order to really do the job up to par, up to what you want to be doing it towards. So when we think about relevance, then what we're thinking about evidence related to a specific assertion being tested. And the specific assertion then is not simply just that are the financial statements in accordance with generally accepted accounting principles. That's not a specific assertion. That's the general process you're trying to do overall. A specific assertion would be something like existence. I'm testing for existence. I'm testing for accuracy. I'm testing for whether this is being reported correctly, or something like that. That's going to be specific, not just, well, I'm just testing to see if this is in accordance with GAAP, with generally accepted accounting principles, which is a huge set of rules that you couldn't create one test for. You need to get into the specifics. And then reliability, evidence that can be relied on to signal the true state of a specific assertion that is tested. So again, some things are going to be more reliable than others. And one of the examples of reliability is, for example, did this information come from internal to the company or external to the company? So if we're testing something like cash, say, the classic example would be, well, if we want the financial statement, if we look at cash and we're trying to check it, we want a reconciliation possibly. And we might want, say, a bank statement. We want to confirm the balance from the bank. Now, they could give us a bank statement internally from the company, but that could have been altered. Not saying it would be, not trying to say that the company would alter a bank statement or anything like that, but it possibly could be. It would be more valuable evidence if we got the bank statement directly from the bank, which is one procedure we're often going to do when we test cash. We're going to go to the bank and say, hey, you tell us what independently, without talking to the company and what's on their financial statements, what the bank balance is at this given point in time. And that's going to be more valuable evidence. So when we think about the evidence, we're going to have to rank it just like Sherlock Holmes does, right? We're going to rank the evidence, or a detective does. And we want to see if it's going to be reliable evidence, how reliable is the evidence, and we have to determine what type of evidence we want to spend our time looking into. And we want to spend our time looking into the most reliable evidence that we can. We want to gather really the least amount of evidence that can then test our assertion. We don't want to spend more time that we don't have to be spending doing things that we don't need to be doing. We want to be efficient, and the way to be efficient is to basically value the evidence that we have. Sampling. Auditors examine a subset of the transaction based on previous audits and understanding of the company's internal controls or knowledge of the company's industry. So when we think about sampling, once again, note that when we consider the evidence, there's a lot of data, just like any kind of detective work. There's way too much data. We cannot take in all the data. We can't basically test all the data most of the time. Therefore, we're really reliant on sampling, especially if we're talking about large companies. The larger the company is, the more it's going to be impossible for us to test all the data. Not only that, but we can't do substantive testing. We're going to have to rely more on internal controls oftentimes. We're actually going to have to rely on the system, just like we do for the government. The checks and balances of the system, we as citizens are reliant on those checks and balances to stay in place and keep people in check. The same thing is basically true with the large companies as well. We need the internal controls. We need to test whether the internal controls aren't not only are put together, but have been put in place, are actually being used in a process, and test whether those internal controls are in place. And that's going to be part of basically our sampling process. To do that, we'll do some type of sampling. We're going to base that sampling based on our understanding of the company, possibly based on prior audits. That's going to have some impact on the sampling. We're going to have our sampling is going to be based on our knowledge of the company, and of course the industry. So different types of industries will dictate in terms of what type of things are going to be more important to some industries or the other. And the point of the sample is, of course, for us to make an accurate decision with less information. You can think of it as the same kind of process you might see in some type of polling situation where possibly you have some type of political poll and you want to say what people think about a certain person or what they're going to vote on or something like that. Of course, you're not going to call everybody in the country in order to do that. You have to do some type of sampling, and you could do statistical sampling to limit the amount of calls that you need to do and still get an accurate sample that hopefully will be representative of the entire population. Now, there's different ways that can happen, different sampling types of methods that can be used given the different objectives that are in place. So we'll talk about different sampling methods later as we get into the sampling process. So examining every transaction would not be cost effective. That's, of course, the bottom line. You just can't do it. All the evidence can't be done. We couldn't ask everybody in the country, who they're going to vote for. That would be ridiculous. But we can get some pretty accurate numbers using sampling. And if we use statistical sampling and we use different types of method that are going to be applicable towards the type of assertions that we're looking for, we can be much, much more efficient in terms of exactly what type of sampling we need, what type of testing we need to do in order to get to the level of assurance that we need to get to for our auditing process. In this presentation, we will take a look at the general format or general outline of an audit report. As we do so, remember that this is going to be the end process. So now we're imagining the end process, and as we go through future presentations, we'll be going through the audit process with the goal of ending, of course, with the end process of the audit report that is the document that's going to be issuing the opinion of the auditor. So in looking at the format of the audit report, we're visualizing where we're going, where are we going to end up at the end of the audit process. Now, the audit report is going to be fairly standardized because we have a specific goal in mind at the end of the audit process. That is, of course, to give our opinion on whether or not the financial statements are being presented in a fair way in accordance to whatever they are being prepared in accordance with, such as generally accepted accounting principles. Because the goal is going to be a specific goal, the format of the audit report will take a specific format as well. In other words, we have a pretty good idea of what we would like the audit report to look like at the end of the process. Now, you might be saying, how could we know what we would want it to look like when we're trying to issue an opinion and we don't know what our opinion is at the beginning? But of course, our opinion, what we're hoping for is to be able to say, hey, these audit reports are good. They have been presented in accordance with whatever they've been said they're going to be presented with regards to those assertions. That's what the specific goal is. That's what we're hoping will happen. And therefore, we have a pretty good idea of the format of the audit report at the end of the process. However, there are certain conditions which may restrict us from having that standard format to basically issue an opinion saying, hey, the financial statements are in accordance, and we're going to basically want to know exactly what those differences are so that we can then standardize what the financial statements or the audit report will look like if we have some problems, some areas where the financial statements do not line up exactly what we would hope to line up, where the audit doesn't go exactly as we would hope, where we can't issue exactly a clean type of presentation. So let's look at first what, of course, the normal format would be of the audit report, and then we'll take a look and think about some types of restrictions or deviations from that normal clean type of audit report that we would put together under normal or good conditions if everything runs smoothly through the audit process. Now, later on, we'll go through the audit report in more detail as we go through the steps of the audit, but we want to get a good idea of what the end point will be as we go through and start through the audit process. So audit report for a public company. So now we're thinking about publicly traded companies typically here. We're going to have a title line which includes independent registered public accounting firm. So we're going to be saying, hey, this is an independent registered publicly accounting firm. That hopefully will give some assurance to the reader of the audit report. Why? Because we're saying, hey, we're independent. We're not part of the company. Therefore, you can depend on what we're saying a little bit more, hopefully, than the company itself, because we're not invested in the company in the same way that, of course, management or an agent of the company would be. We'll discuss more about matters of independence later in future presentations. Also note that audit reports for non-publicly traded companies will most likely take a very similar type of format, but of course, the more stringent type of format, the longer type of format, is going to be those for the publicly traded companies. They're typically going to have more types of regulations. Therefore, that's the one we usually will consider, then possibly tone it back a bit or look at those types of situations or the wording, which may not be as necessary or restricted with regards to non-publicly traded types of companies. So the rules do differ slightly. Usually the rules are more stringent or more strict with regard to publicly traded companies, larger companies. Usually addressed to the stockholders and board of directors of the company. So note what's happening with the audit is we're going to have an audit. If it's a publicly traded audit, it's because it's required to have an audit in order to be publicly traded. Who's going to be hiring the auditor? The company. The company's hiring the auditor because they're the ones that are required to have an audit in order to be a publicly traded company. Therefore, the audit, who is the audit going to be given to? You're basically saying, hey, here's our opinion. That's what the audit is. That's what the audit report is, our opinion as the auditor. Who are we going to address this letter to, this opinion to? The stockholders and board of directors of the company. That's usually who we think is the most important for our audit report, right? The board of directors is going to be in charge, in essence, of regulating the actions of management of the company. The stockholders are the people that own the company and vote for then the board of directors. It's the board of directors then the people that hire management. So the audit then, judging the fairness of the financial statements, is in essence or in some degree some type of check or regulation on large companies that have this separation of duties or have a less direct management or type of agency issue between the owners, stockholders, and of course the management, who are a couple steps removed, the management being hired by the board of directors being voted on by the stockholders. So in essence, the audit can be thought of as something of a kind of a review of whether or not the information is being put together in accordance with what the job of management is to do, which is to put the financial statements together in accordance with the assertions of whatever regulations they're putting them together in accordance with, generally accepted accounting principles often being the case for for-profit types of organizations. Audit report sections include the opinion on the financial statements. So we're going to give the auditor's opinion on the financial statements, a paragraph with the auditor's opinion of internal controls if report on internal controls is included in a separate report. So as we go through the opinion, we're going to, of course, give our opinion on the financial statements. That's the end product. That's what the audit report is given to do. And then we will include the basis for the opinion, the critical audit matters, and then it's going to end with the signature of the CPA firm, the year the audit began serving as auditor, the year the auditor began serving as auditor, city and state where report is issued, and the date of the report. Now let's think about different types of opinions. Now, normally you would think that the audit report, what we're gearing towards, is to have an unqualified opinion. This is the highest level of opinion. It sounds funny because you have unqualified, sounds like a negation type of term. But what it means is, and it is a negation type of term, but it doesn't seem like the type of word that you would have for the best report that you can give. The one we're actually looking for is unqualified. And what we're saying here is that, look, the financial statements are good. The assertions are in compliance. They are in compliance with the assertions they say they're in compliance with. They put the financial statements in accordance with whatever format they said they were going to, such as generally accepted accounting principles. And we don't have any qualifications that we have found to that being the case within our audit. So it takes a little bit of time, at least it did for me, to look at something called unqualified as actually what we're expecting to happen. So we're hoping, if everything goes well, everybody really wants to issue an unqualified opinion at the end of the day. What we would like to happen is management wants to say, hey, I'd like to hire an auditor. I'd really like the auditor to say, hey, you did a great job. Everything looks good in accordance with the format that you were following in terms of generally accepted accounting principles, possibly. The auditor really wants to basically say, I've checked everything out, I've reviewed it as best I can, and I've gone through all the evidence, and all the evidence does show that you have indeed put the financial statements together in accordance with generally accepted accounting principles. I have no qualifications to that, and therefore I'm going to give an unqualified or clean audit report on it. That's what everybody wants to happen. That's what happens, hopefully, most of the time. I mean, if you have good clients that are putting this together, good companies, and the auditor will talk about, what type of clients auditors will work with and how to pick clients and that kind of thing later. But if you have a good set of clients that are putting together good financial statements and are, adhering to the regulations, then of course we would expect that most of our clients would have, and we would be issuing unqualified, best, clean type of audit reports. And if someone was to ask us why we gave the unqualified report, then we can provide the audit evidence in order to support our opinion about our good, clean clients that have been doing their job properly, representing the financial statements in accordance with whatever type of regulations they're saying they're representing their financial statements in. So that's what we would expect, unqualified. That's going to be the baseline report. That's what everybody's hoping to happen. Now, we might have qualifications though. However, what if there is an issue? What if there's a qualification? Well, there's going to be some kind of standards that we're going to have to say. So if and we'll go into this in a bit more detail, but if there's a problem, what we're saying here is it's not totally unqualified. We have a qualification here. So we might say, and that you can imagine this as saying, this looks good except for this qualification, right? Which is basically this blemish on it looks good kind of thing. And so we'll discuss that in a little bit more detail shortly. We could have an adverse opinion, which is basically, and that's not good. We would basically be saying no, and we'll talk a little bit more about that opinion as well. And we could have a disclaimer of opinion, which basically means we're not going to be able to issue an opinion on these financial statements. So let's take a look at that in a bit more depth. First, the unqualified opinion, which we talked about a bit already. The auditor's report audit opinion is the main product or output of the audit. So just remember, that's of course what we're trying to do. That's the product that we're giving, is the opinion on the report. That's what's lending to the trust of the third parties by a third party, opinion from us. And that's going to increase, hopefully, the confidence in the financial statements, and therefore better and more business transactions will take place because of it, because of the transparency, because of the communication in it, and people's better reliance on it. So the standard unqualified clean audit report is the most common type of report issued. And of course, that's the one we're looking for. We're hoping, that we can give a clean report. We want to say that we did everything well. Here's the clean report. Everything looks great, as we knew it would be, because we have good clients and everything's pushing forward as it will. Unqualified means that because the financial statements are free of material misstatements, so they don't have the material misstatements, and recall what material means, those that would change the opinion of a decision maker that is going to be a decision maker that is reasonable. So we have that term, reasonable decision maker. The auditor does not find it necessary to qualify his or her opinion. So we don't have a but in there, right? We don't have a this is the way it is, but except qualification about the fairness of the financial statements. So what if we do have a qualification? What if there's a problem? So we don't have the most standard, there's a qualification. So this is another type of audit report. We're going to have to qualify our opinion then. If an auditor's financial statements contain a misstatement that the auditor considers material and management refuses to correct the misstatement. So note there, we'll talk a little bit more about this later, but note how we have that we found a misstatement. And not only that we're going to say, hey, the financial statements are wrong. We found this misstatement. And management says, I'm not going to fix it for whatever reason. Maybe they have a good reason to do it or whatever, but they're not going to fix it. And that would mean, and it might be good. It might be a good reason. They might say, hey, that's going to misrepresent our financial statements. And we're going to say, but that's what generally accepted accounting principles says to do. It says you have to do this. And they might say, well, I'm not going to do it because I think it misrepresents my financial statements in this way, shape, or form. And we might go, well, we can't issue an opinion saying that the financial statements are correct in accordance with generally accepted accounting principle with this material misstatement on it. And therefore, if you don't fix it, then or change it, then we're going to have to put a qualification on the financial statement in some way. Or if the auditor is unable to obtain sufficient evidence regarding a specific account. So another situation might be, well, you're not giving me enough information to get at this number, this particular number. I can't get at it because you're not giving me the information to test it for what, and again, there might be valid reasons. It might be in another country. We might not have, the ability to do that. So for whatever reason, it might be a valid reason, but we can't do it. Can't test this thing, therefore we have a qualification. The auditor may qualify the report explaining that the financial statements are fairly stated except for misstatement identified by the auditor. So we're going to say, either there's a misstatement or there's something that we couldn't fully verify, and therefore, look, everything we tested is good, everything's good except this one particular point, qualification, I couldn't test it, or I don't believe it's in accordance with generally accepted accounting principles. And that's our qualification. Adverse. What about an adverse opinion? This isn't good. If the auditee's financial statements contain a misstatement that the auditor considers so material that it perversely affects the interpretation of the financial statements, the auditor will issue an adverse opinion indicating that the financial statements are not fairly stated and should not be relied upon. Now, if it comes to the point where we're going to say, hey, we're going to issue an adverse opinion, it's very rare that you would actually issue the adverse opinion, because probably what will happen before that point in time is you're going to start to indicate problems, and you're going to say, hey, look, you're not giving me this information. I can't find this. This looks wrong. This looks like it's not reported correctly, and you don't seem willing to change it or anything like that. And what probably will end up happening is, instead of we get to the adverse opinion, we might have a disclaimer, or the engagement may end at some point in time. In other words, if we're going through the engagement from the planning process all the way to the audit report, and things have not gone bad through that, going good through that process, the process might be terminated before the end of the time period, or we might be in a situation where we were unable to get the information we needed, and then issue a disclaimer of opinion. If not, then if we went all the way through and issued the opinion, and again, this is our report, this is the end product that we're trying to do here, the audit report, and they're looking for an unqualified opinion, we give an adverse opinion, people aren't going to be happy with this, but we have to follow the regulations on whatever the regulations are. So just note that adverse opinion, of course, is saying that there's going to be an auditor's financial statements contain a misstatement that the auditor considers so material that it perversely affects the interpretation of the financial statements. So we cannot give an opinion on it like we would like to do that would be unqualified or even qualified. We have to say adverse. And again, at that point in time, at some point, that might be just something that terminates the engagement, and we end up not issuing the report or disclaiming the report. Could happen before an adverse opinion or report is given, because obviously an adverse report would be of no use to a company, because they wouldn't be able to use it for, if they needed a bank loan or something like that. That's not what they're looking to get. So again, that would have to happen, but it's not what we would expect to be happening. And then there's a disclaimer. If a scope limitation is so large that it limits the ability of the auditor to make an opinion on the financial statements. And again, this might actually be more common, of course, because it could be the case that we just can't conduct the audit for either legitimate reasons or not. It might be that the client is not giving us the information for whatever reason. Scope limitation means that we just can't get to the information. We can't get enough information usually on something in order to basically get an opinion on it. So for example, they might have a part of their company in China or something like that, and regulations are such that we can't get to it. And if that part of the company is substantial enough, we're going to say we can't test it. We can't test that part of the company. And so we can't give an opinion on it. And so we could end up in the fact that, we have to disclaim it because we just don't have the ability to test on it. And then so we would issue the disclaimer. The auditor will issue a disclaimer of opinion indicating that it is not possible to express an opinion on the fairness of the financial statement. So we're just going to say, hey, there's a scope limitation. This is what we need to do in order to do the audit. We can't do it because we can't get the information, either because management or whatever won't provide it to us, or there are certain other limitations such as regulatory limitations on us. Maybe we're not big enough to be in all these different countries that are going to be necessary or to complete the audit, or we're being restricted by government regulation, say in other countries or other states or something like that. Therefore, we can't give an opinion because we couldn't gather the evidence in order to give one. In this presentation, we will take a look at the stages of an audit. We're going to take the full audit process. We're going to break that audit process down into stages, into chunks, and then as we consider and study the audit process, we will be studying them within these chunks. So we're just basically going to list out the chunks at this point, those stages at this point, and then as we move forward, we'll be concentrating in on specific stages. Now, as we do so, we do want to point out that many times when we consider the audit, we're thinking about the completed financial statements, and we're trying to think about whether they have been completed in accordance with a set of rules. So in essence, we're basically thinking about the end product, drilling down on it in some way to try to see if it's structurally sound or put together in accordance with some type of rules. If we were going to go about doing that, the first thing you'd probably do is say, hey, give me the financial statements. Let me look at them. I'm going to take a look at the balance sheet, and I'm just going to start it from top to bottom. Just give me that trial balance. I'm going to start it from top to bottom. Cash, is that accurate? Accounts receivable, is that accurate? And I'm going to then go through and think about tests for me to test cash, accounts receivable, accounts payable, property, plant, and equipment. I'm just going to go through the trial balance and start testing them. And so a lot of times we might be impatient to do that or think that that's going to be the first thing that's going to happen. However, that's not going to be the first. That's actually going to be happening down here, or at least that's when we go through the detail of something like that. That's going to be way down here. So we have all these activities happening before this process, before we get to the audit of business process and related accounts, before we basically say, hey, I'm just going to go through the balance sheet top to bottom, look at cash, look at accounts receivable, look at property, plant, and equipment, and so on and so forth. Now, that can be a little bit frustrating because, of course, when we think about the audit, that's one of the things we probably think about doing. And when we have a really small type of audit, if we're auditing like a small type of company, we may get to this process relatively quickly. But when we think about a larger type of company, remember, we can't rely just on the testing of certain accounts because there's too many transactions. We just can't do it. And therefore, when we plan the audit, we're often going to have to consider and plan more strategically. And that planning process will be strategically planning internal controls. So if you have a really small company that we're auditing, then in other words, you might get to the point where you could basically go through and do a lot more testing on just the substantive tests, as we'll go through and we'll consider when we go through the planning process. But just recall at this point in time, especially if you're talking about a large company, that actually just going straight to those accounts and trying to put together substantive tests related to them is not something that's going to happen until later on in the audit process. It's also actually one of the more kind of interesting components because when you're thinking about the financial accounting, that's usually what you're doing. If you're preparing for an audit process, then yeah, you're going to be preparing your internal controls and whatnot, but those are already in place by the time the audit usually is happening at that point. Well, you might actually be going through, and when we're thinking about how to apply our skills that we've learned related to audits, this is often some of the skills that we might think about. Well, how can we test for ourselves the imbalance? In other words, if I'm a small company or a large company and I put together the financial statements and now I have my financial statements, if I don't have an audit, how can I use my auditing skills to then give myself some assurance that these financial statements are indeed accurate, that these numbers represent what they should represent? Well, normally we would go through these type of activities that we will see in the auditing process. We're going to say, give me the balance sheet. I'm going to go from the balance sheet top to bottom and look at those accounts and look at the related type of income statement accounts as I look through those balance sheet accounts. That's usually what we would do. So when we get to this component, then it's going to be very useful for us, even if we're not in the audit process, even if we're GL accountants, we'll get to this component here. But note, larger companies, of course, are going to be dependent on internal controls. We as auditors are more dependent on internal controls. And therefore, in the audit planning process, we're going to spend a lot of time in the audit planning process and in the process of considering the internal controls because we have to rely on them with the larger companies before we can just go into the testing process. So the stages that will be involved, the client's acceptance or continuance. Two types of things could happen with a new client. Either we have a new client, completely new, where we're going to take the new client process and accept basically the engagement. This is usually, of course, done by the partner. So if you're talking about a large firm, the partners are often the ones that are going to be taking on basically the new process, the new type of engagement, setting up the terms with a new potential client, a new potential engagement. Or, of course, and actually possibly more common once we have an established type of relationship, is going to be the continuing clients that we have audited in the past, especially if you're talking about publicly traded clients. Those are going to be needed to be audited every year. So we possibly have a continuing type of process, and that's going to be a lot easier, of course, because we would think that the new audit for the following year, we want to make sure that everything is rolling forward and that we're taking into consideration any new information, of course. But you would think that we would already have some of the preliminary type of information down, and we would have the continuation process then. So those can be substantially different. Obviously, a new audit going to take in a lot more work. We'll talk about more of the details between those two than a continuing audit that we have done in the past, and therefore have some idea of what the needs are of the company. Then we have the preliminary engagement type activities. The preliminary engagement activities include the perform procedures regarding the continuance of the client relationship and specific audit engagement, determine compliance with independent and ethics requirements, establish an understanding of the terms of the audit engagement with the audit committee in accordance with auditing standards. Then we're going to have the planning of the audit. We're going to go through the audit planning process. The nature and extent of the planning activities that are necessary depend on the size and complexity of the company, the auditor's previous experience with the company, and the changes in circumstances that occur during the audit. The audit plan is going to be a very important process and often one that's overlooked when we start to think about the audit and how to put the audit together, because the plan is going to help us to be more efficient. We want to put the plan together so that we have a roadmap so that we can be as efficient as possible as we actually conduct the audit. So we're going to talk about the audit plan in some depth as we move forward. Then we want to consider and audit the internal controls. Once we have the plan, note we're going to audit the internal controls before we do what we wanted to do or we talked about in the first part of this presentation, which is to jump in and just look at those financial statements and start testing, doing substantive tests. So notice what we've done here. We've gone through the engagement. We set up an audit plan. Part of that audit plan is going to include us first looking at the internal controls. Now, the reason we're going to do that, of course, is because better internal controls, checks and balances, just like with the government. If you say, hey, the government has some system of checks and balances in place, that should make it less likely that there's going to be a type of problem that we're looking for, because those checks and balances are in place in order to regulate against those types of problems. Therefore, if the checks and balances are properly in place, then we should be able to do less substantive testing. So now that once we have the audit plan, we have to consider the internal controls, and basically the relationship that we will consider, and we'll discuss this more as we go, is that if they have a good system of internal controls and they are in compliance and actually implementing those internal controls, those are the two things we're typically looking for. Do you have a system of internal controls? Is it good? Does it work? Will it work if implemented? And then, of course, did you actually implement it? Once we've determined that, then we can consider what the audit tests that we will need. So then we go into the actual things that we would want to do from day one if we were just starting out in auditing. Give me that balance sheet and let me start testing top to bottom cash and whatnot. Now we can take a look at that balance sheet and look at it more objectively. We could say now we've tested internal controls with relation to cash. We've tested internal controls with relation to accounts receivable, property, plant, and equipment. Given those internal controls, we can now think about the types of transaction and number of transaction that we need within, say, sample sizes of transactions in order to get to the level of assurance necessary for an audit without basically overkill, without spending all of our time doing substantive testing here, hopefully spending our less time doing internal controls that will restrict or limit the amount of substantive testing that we'll do here. So that's why it's always going to be in this relationship. We got to do the internal control testing, then the substantive testing. Note, again, if you're a small company, if it's a small company and you don't have a lot of internal controls, I mean, if you're talking about a sole proprietor, you don't have many, because if it's just one or a couple people, they don't have any separation of duties. And we'll talk about more that relation of separation of duties and internal controls with regards to it. But it's something just to keep in mind, because as we look at an audit process for a large publicly traded company, we start to get in our mind that that's just the way things are again, and learn what the procedure is rather than the principle. Then when we look at these small companies, it's, auditors of large companies tend to say, well, that small company's doing it all wrong. They're just a mess. They're not having any internal controls. And that's just, obviously, if you think about it, that's because they're a small company. It's not wrong. It's just, they don't have the resources to be doing internal controls if you're a small company. If you're a very large company, as you grow, the internal controls then need to increase. So if you're auditing or doing some type of review or attestation agreement for a small company, you would expect the internal controls to be far less, because there's less controls needed. If you had too many controls in a small company, you would not survive in the industry because it would cost too much. The internal controls wouldn't be cost effective. So in that case, if you were to audit a small company and they weren't publicly traded for something like a bank loan or something like that, the bank needs an audit, you would expect to have fewer internal controls, do more substantive testing. You would expect to be doing something more like, give me your balance sheet and let me just test it from top to bottom, actually looking at more transactions within our sample size, basically, in that case. So there's always going to be that relationship between these two. Within a large company, our expectation, if it's publicly traded, is that they have a good set of internal controls, that they've implemented the set of controls. We expect the internal controls to be good. If they're not, we're in big trouble because we don't have enough time to test all the internal controls. So we're hoping that should be the case, where their internal controls need to be good in order for the audit to go well. Small company, we're actually expecting that the company is not going to have the best internal controls. They can't. They don't have the resources to do that. That's okay. We're just going to note that, and we're going to say, well, we're auditing a small company, one that doesn't have those internal controls, and therefore we're going to be reliant more on substantive type testing as opposed to internal controls. Then, of course, the next stage is to complete the audit. And once we do that, we'll evaluate results and issue the audit report. So once we have the evidence, we've gathered our evidence like our detective work, we've got it all put together, we're going to evaluate it, we're going to put it together, we're going to then put together the audit report. And of course, the expectation, the hope, is that the audit report is confirming that the assertions being made by management, the assertions that they have made the financial statements in accordance with whatever regulations they said they were doing it according to, typically generally accepted accounting principles for U.S. type companies, that the evidence does indeed confirm that assertions. And hopefully we can then issue a clean audit report saying that these financial statements are representing within a material, taken into degree, audit risk in accordance with the assertions that they said they were going to issue them with. Now, of course, it could quite be possible that we came up with evidence that says that that's not the case, or that we couldn't get enough evidence to support that decision, and therefore we can't give a clean decision on that. We'll talk about those situations, but obviously the hope is that we gathered evidence in order to prove the assertion being made by management correct, financial statements then being reported in accordance with whatever regulation that they said they were going to be reported with, and that would be the opinion that would be presented in the audit report. In this presentation, we will discuss types of audit, attest, and assurance services. When we consider these types of definitions, we are in essence thinking about what CPA firms do. What are the services that CPA firms provide? When we think about public accounting, what are the types of things that public accounting firms do? The first thing that comes to mind for most people are audits, or at least most accounting students. When you're thinking about accounting and you're ending up with an accounting degree, you're typically thinking, if you want to go into public accounting, that you're going to be dealing with audit. Or you might be considering dealing with tax. These are two types of things that many people, depending on where we are coming from, think about with regards to independent, say, CPA type firms, audit and tax. We want to have a fuller understanding of what a CPA firm, what a public accounting firm would provide, what those services would be, for a couple different reasons. One, we want to know what to expect if we were to work in public accounting, say, as opposed to a for-profit type of organization. Two, we want to know if we were going to do business with a public accounting firm, what types of services they may provide, so that we know how to look for the types of services needed within a public accounting firm. And three, as we think about audit engagements and attest type engagements, we need to know that there's going to be some conflict with regards to independence, which we'll talk about later. In other words, what type of services can we do and still remain somewhat independent and be able to do what many CPA firms see as the largest component? If they do full audits, then we want to say, okay, if we're doing audits, part of the components of being an auditor is to be independent, and we cannot be independent if we're too involved with, say, management type of activities or possibly in some other ways with the company that we are auditing, and therefore there could be conflict with the types of services we can provide as well. So we want to keep that in mind as we go through the different types of services as well. So what type of services does a typical CPA firm, public accounting firm provide? And what then later on we'll think more about what type of conflicts there could be with the potential services that would be provided. And as we do so, note that it makes perfect sense if we do audits for a certain type of company that we would know their accounting system quite well and may want to do other types of things to help them run their business more smoothly. But as we do so, we become more related. Our dependence or our independence from them gets diminished, which reduces the value of our audit opinion, because our audit opinion is supposed to be something that is independent. So as we go through these services, we want to keep that in mind. We'll talk more about independence in the future. Types of auditors include the external auditors, internal auditors, government auditors, and forensic auditors. We here will usually be considering the external auditors. When we're thinking about a CPA firm, we're typically thinking, or public accounting, of the external auditors. We're typically thinking about something that's not related to the company, and that's part of the benefit of who they are. They can give their opinion because they're not related to the company. You have an external auditor that comes in, they're paid, but they're not in any other way, or they're not in any significant other way related to the company. They have independence in that format. That's what we're going to be considering and focusing most of our time in on. Then we have internal auditors. Internal auditors are going to be within the organization. Now, they can do many of the same functions as an external auditor. They could perform the same type of procedures. And in some cases, the external auditor may depend on some of the work that is being done by the internal auditor. However, the internal auditor has a disadvantage in terms of the appearance, at least, if not in fact, of their opinion, because they're employed by the company. They're getting their paycheck from the company. So if I was a third party thinking about investing in, say, a company, I may not put as much value on the internal auditor, even though they may have done a great job, done the same type of work, because they're less independent. They have more dependence on the company. They're being paid. They're an employee of the company. So they're going to be an important tool, and they have their uses as well. However, they're going to be distinct from the external auditors in that these are people that are employed by the company, W-2 employees typically of the company. External auditors still being paid by the company, but they're an external firm and not being paid basically as an employee as an internal auditor. Both separate professions, or they're both similar type of professions. Both have their uses and their place, but they're distinct in that way as well. Then we have the government auditors. Now, when we think of government auditors, we're typically thinking about auditors that are auditing, in essence, the government. So the government may be then looking for someone to audit governmental entities. Now, if you're having the government audit governmental entities, it's quite possible that the governmental auditors may be, asking other governmental entities to audit, itself. So in some ways, then you might say that governmental audits are often internal in that way, because government employees are auditing other government employees possibly. But again, often a specialty type of field when we're talking about the governmental auditors. We here are going to be focusing most of our time on the external auditors. And then we have a forensic auditors, which have been growing, a field that's been growing in some ways, which is going to be more specific as well, focusing in on forensic areas. And of course, their focus is more on fraud or something like that. They're typically going to be employed to audit and look specifically for criminal type of activity oftentimes. Whereas when we're thinking about a normal type of audit process from the external audit, we're looking for any type of material misstatement, whether it be caused by fraud or some error or whatever reason it be caused. Our goal here on the external auditors typically is going to be looking for that material misstatement to give an opinion on the financial statement, as opposed to, in essence, looking specifically for matters and components of fraud or illegal type of activity. Types of services. So types of services typically include the audit services, attest services, assurance services, and non-audit services. So we talked a bit in depth in prior presentations on the difference between these items and the overlap between the audit services, the attest services, and then the assurance services. And then we might have, basically the non-audit type of services as well. These being, what the CPA firm will typically do. We'll go into a little bit more depth on some of these items here. Audit services can include different types of audits, right? We could be auditing different types of things. And again, our goal in an audit is typically going to be to give an opinion. We're basically giving our opinion on something. Why is that valuable? Why would someone pay for that? Because it's an external opinion that's going to make it easier typically for business transactions to happen. Like if I don't know somebody else, I don't know them, I want to basically have some assurance about whether I should do business with this other person. I want an independent third-party opinion, might make it more easy for business transactions to take place. And again, without any trust between individuals, firms, business associations, there is no business. Business stops. So that's going to be the major benefit that we have there. So we could have internal control audits, basically audits on the effectiveness of the internal controls. And you can think of internal controls as checks and balances, similar to what we have in a governmental unit. And we'll talk more about internal controls a lot in future presentations. Compliance audits. Are we in compliance with rules and regulations? So there might be certain standards, especially in certain industries, such as a homeowners association or something like that, could have specific kind of rules that need to be in compliance with regard to specific types of things and financial reporting related to it. Then we may be able to, audit in terms of a compliance audit. Operational audits, we might go through an audit of the operation, and usually that would be conducted to see if things are being used efficiently. Are the operations being done well? Are the tools and resources of the organization being used efficiently? And then we could have forensic audits. So this might be a type of audit, again, looking specifically usually for some type of illegal acts. We might be looking for employee fraud or something like that, specifically looking into some type of forensic type of activity, typically some legal type of activity, criminal type of activity, possibly with regard to the audit. We've taken a look at attest services in prior presentation. Let's take a look at some of the non-audit services. So these are going to be some of the non-audit services include tax preparation. And in this presentation, we will discuss different types of public accounting firms. Public accounting firms can range in size from a sole proprietor. We have the one CPA that's got the shingle on the wall, the plaque on the wall, and the trusty 10 key, to very large types of organizations. Organizations that have many different owners, could have thousands of different owners, which we would typically format in the form of partnerships and therefore call them partners, and thousands of staff. So we could have CPA firms with one individual that's at one set location, up to firms that are going to be located in offices around the world for one particular CPA firm, which has offices, of course, around the world. We might want to think about then the size of CPA firms in different types of tier levels. For example, we of course have the Big Four. These are going to be the largest CPA firms, and when we think about auditing publicly traded companies, if we have a publicly traded company, they will typically be audited by the Big Four. So in other words, the Big Four or the largest CPA firms have close to a monopoly on the largest types of companies that are required to have audits due to being publicly traded. So that's Deloitte, Ernst & Young, PricewaterhouseCoopers, KPMG. One of the reasons for this is that the Big Four firms are the ones that have the resources in order to audit the largest type of companies, because you'll note that, of course, the largest type of companies are going to have locations all around the world, and it's difficult enough for a CPA firm to handle a company that's going to have multiple different locations within, say, the U.S. If we're talking about types of locations all over the world, especially in more difficult places to have a firm, such as something like China, then it's more difficult for smaller firms to compete with the largest Big Four type firms with regards to the largest types of companies that are going to have locations all around the world. Also note, however, of course, that the fact that the largest four CPA firms having close to a monopoly on the largest types of companies can give some concern as well, because we would think that that's a lot of consolidation of power and control of the top companies being audited by a limited group or having a limited amount of options for the firms that are providing the audits for assurance related to them. Mid-tier, which is going to be substantially less in size than the big four, but still large firms, would be something like BDO or Grant Thornton, are going to be some concepts of the mid-tier firms. And note that mid-tier firms may be able to compete and pick up larger type of clients, as well as smaller tier firms could pick up larger types of clients as well by teaming up with different mid-tier or different CPA firms. So in other words, if we were a mid-tier firm and we had different locations around the world, but we didn't have a location in India per se, which might be a place where a company that we want to particularly or pick up an audit from has a location in, then we may partner up or try to see if we could partner up with another CPA firm that has a location there, and in so doing, gather the resources necessary to make some type of audit. But of course, to do that, we'd have to have some agreement across different CPA firms, which is a little bit more difficult. Whereas if we're talking about large firms, the big four firms having offices in more areas and can directly go to more locations, it's a little bit more streamlined and you would think more cost effective in that way as well. But just note, mid-tier firms can compete in that way, even if they're not as large and they don't have as many resources or locations, by basically grouping up. And then we have regional and local, which could be substantially smaller. So we might have different firms that just operation in a certain location, a certain region, a certain state, a certain location. In this presentation, we're going to take a look at a standard type of audit team. In other words, we're going to go through a standard type of audit team, look at what would be considered the different types of positions of the team, what are going to be the different duties of the people in those positions of the team. As we do so, recall that this is just the general type of team that we would put together for an audit, and it would vary in some degree or to some degree depending on the size of a CPA firm. Clearly, if we're a sole proprietor or a very small CPA firm, then we may have some variation or deviation from the types of team that we're going to put together. But this would be basically the standard type of team and the standard kind of terminology that you would expect in a CPA firm when discussing the types of the team and the types of duties that would be involved with those people within the team. Also note that these things could change a bit in terms of the size of engagements, how large are the audits we're talking about. Usually when we're considering audit in terms of audit as a whole, as we are here, we're usually thinking about publicly traded companies because we want to take the biggest type of audit engagement because it's going to be the most complex. And then if you're talking about smaller types of engagements, then of course it would have less detail. It's usually easier to then peel back the detail necessary for smaller engagement, but you always want to keep that in mind. Otherwise, you start to think that something is always complex. You may start to go into smaller engagements and overly complexicate things or think things that always should be having more complication than they need to have because everything that we have studied has been at the more complicated level. And note that most of the time, oftentimes when we're not auditing publicly traded companies, we may not have that level of complication. And even when we have the level of complication, we're usually working on specific things rather than working on the entire audit as a whole. And as we do so, we break those specific things down to specialization of duty and to more simplified tasks. So here's going to be the general overview of the audit team. So when we put together the audit, we're going to audit, say, a publicly traded type of company. Who's going to be involved? Well, we have the partner, we have the manager, we have the senior or in charge, and we have the staff and or associates. So we're going to go into now who will be involved in these things. So of course, this would be the top down of the audit. We have an audit engagement. We have the go-to kind of hierarchy of it. The person ultimately in charge is going to be the partner. And if you think about a type of organization that is a CPA firm, a public accounting firm, it's going to be organized in the format of partners. So the partners then are going to be the top tier. They're going to be like the management of an organization. So if you're comparing this to a publicly traded company, you're talking about the top management of the organization, like the CEO or something. If you're talking about a partnership, as is the structure for typical type of CPA firm, public accounting firm, then the partners are going to be the top level. They're going to be the people that are in charge. When you're considering audit, which is going to be the highest resource that a CPA firm typically does that generates most money from, The partners then are usually going to be the people that are ultimately going to be in charge. Now, that means that they're usually going to design the engagement, and they're going to be working with the client in order to set up the audit engagement, plan the audit. We'll discuss a little bit more about what the partner will be involved in, but just like a CEO, just like the top management, they're not typically involved when the grunt work, the day-to-day type grunt work. They're going to be involved more in the review work, and in the case of a partnership, of course, with setting up or picking up the clients. They want to work with the clients, discuss what the process will be like, pick up the engagements is going to often be a large part of what the partners do. And then they have the manager. Manager, of course, reports to the partnership. Under the managers, we have the senior in charge. And then under the seniors and the in charge, we're going to have the staff and the associates. So if you're thinking about the audit engagement, of course, then of course, most of the grunt work is going to be done by the staff and associates actually doing a lot of the counting and the 10 keying and all that kind of stuff. They're reviewed by the senior and the in charge. That reviewed by the manager, and finally signed off by the partner who was in charge of initially engaging the engagement with the client, with the company. So if we go into this in more detail, then top level partnership, basically kind of, again, equivalent to the manager, the top level, the top people in the CPA firm. What are they going to do? Agree on the scope and the service to be provided. So note, a lot of times the partnership is going to be working a lot with the client. They're guaranteeing the client, they're working with them and saying, hey, this is what we're going to do. This is what we're in charge of. This is what you're in charge of. This is how the agreement will go. So they're going to be dealing a lot with the clients, setting up the engagements and making sure that they have the communication with the clients with regards to the engagement. Oversee the planning process and that the audit is conducted in accordance with auditing standards. So the partner is often going to be involved in the planning process because they're the ones that are discussing, of course, and getting the engagement rolling. They then want to be involved in the planning process and then delegate that information to other people within the organization in a way that's going to be as most efficient as possible. They're looking at everything else, of course, as resources of theirs to help to make this audit go as smoothly as possible, be as efficient as possible, earn as most money as possible. Assemble an audit team appropriate to the task. So you can also think of a partnership as just that. If you think of a partnership, you can think of them almost at, a different type of owners. We have the partners here. They're going to then take the resources of the organization, including the staff, and delegate those staff to their engagements in order to basically complete the project. So they're going to try to find, assemble the team of staff. If you're talking about a large CPA firm, you got the partner, they're going to assemble the team of the staff involved in order to complete the audit process, which they will, regulate and be in charge of in terms of supervision. They're going to supervise and review the audit team and their working papers. So they will be ultimately in charge. The partner is going to be ultimately signing this. So although they're not going to be doing the grunt work, the day-to-day work, they do need to review it, of course, because they're the ones that are ultimately on the line in terms of signing off on it. They're going to sign the audit, concluding on adequacy of audit evidence. So they're going to look at the audit evidence. They're the ones that actually are going to, of course, sign off on the audit. Typically, the partners will, and therefore they got to make sure that the audit has been done in accordance with the rules and regulations of the audit, that enough evidence has been gathered in order to support whatever opinion is being given within it. Manager, now we had partner. Second, level here is the manager. We have the plan audit, including the team members' schedule. So you can think of them doing a little bit more of kind of the day-to-day. We've got the audit planning, the partnership. The partner was involved also with the planning and talking to the client, then delegating the more day-to-day type of planning to the manager. So the manager actually looking at the schedule, saying, hey, these are the team members. This is when you're here. This is when you're here. This is when we're going to go out to the engagement. This is when we're going to do this. And you're with me. You're with me. They're going to actually be delegating what's going to happen in terms of the actual procedures within the audit process. Oversee preparation and approval of the audit program. So they're going to be more in line with the designing and implementation of the groundwork, the on-the-ground audit program. Review the financial statement, working papers, and audit report. So they're going to be reviewing the financial statements and audit report. Oftentimes, of course, the partner expects the manager to have the audit report pretty much done, and then the partner's going to basically sign off on it and review it. And there might be, depending on the size of the CPA firm, the manager is often expected to basically have this thing tied down and then give it to the partner who should be able to review it and not have too many adjustments possibly. So it depends on the size of the firm, but they'll review the papers, make recommendations to partners, and oversee work of the senior staff. So they're going to oversee, of course, the work of the people below them, the senior staff, invoice and collect on payment for services. So notice they will be in charge here of invoicing for services. We are a CPA firm. We charge the client for the services. The service in this case, we're talking typically about audits. We want to make sure that we have the invoices out, collections on them, not only because we need the payment of it, but because it also can hinder our independence. If we have outstanding invoices or payments that have not been paid to us, then our independence is compromised to some degree as well. So we want to make sure that we're on top of that. Track and inform about auditing or accounting problems found. So we'll report any problems that we find to, of course, the partner above us. Then we have the senior in charge that's going to be under the managers now. So the managers, now we have the seniors in charge. Help develop the audit plan. So they're going to be involved in the planning process as well. And then we have the make the budgets. So they'll be putting the budgets together. Again, they're going to be more involved in like the grunt work now. We're getting closer to the ground level of putting the actual audit together. Delegate tasks to associates and direct the day-to-day procedures of the audit. So now they're not just scheduling, possibly when the audit's going to happen, but they're directing the day-to-day procedures. So we're saying, hey, this is, throughout the day, you need to do this, and the other thing to get past this. If we're going to a particular location, then we're going to go to that location as we're on site. Then we're going to be delegating who's going to be doing what in that particular location. So the in charge is going to be doing that day-to-day type of operations, managing the day-to-day type of activities. Review work of the associates, which are going to be under the senior level or in charge. Report to the manager, which is, of course, the direct above them, the senior in charge being the manager. Then we go to the staff and the associates. So this is going to be the lowest level. And of course, we would expect them to be doing most of kind of the grunt work, perform audit procedures they are assigned. So whatever audit procedure is determined that can be assigned to the staff or associate will be assigned there. And often that's going to be stuff like footing things, adding up columns. We're going to have to be counting things in terms of the staff and the associate. Might have to count the inventory, anything that we think can be assigned, of course, to the staff and associate. And notice that audit has a lot of check-in involved because we're going to be doing a lot of basically testing and then checking. And that means that we're going to have to do some checking in terms of many things that we expect to be a certain way, and we expect them to be that way. We just need to check them as the auditor. So oftentimes the staff and associate are the ones that are going to be involved with a lot of that checking, counting, footing, gathering data, pulling invoices, all this kind of stuff, and they'll be directed to do so by the senior in charge, directing, go pull this invoice, foot this thing, put together this type of worksheet, check these transactions, count that inventory. Those types of things can all be done by the staff. Make documentation of work completed. So of course, as they go through this stuff, they need to document it. They're going to be put the working papers together so that we can have some record of the procedures that have been done. And then we have to report any problems to the senior. If they encounter any problems, they report it to the person in charge of them, the senior. In this presentation, we will discuss government regulation, particularly pertaining to large publicly traded companies and accounting firms which audit them. The level of government regulation is really important because it's something that can change, and it can change dramatically based on certain events that happen within an economy. So note that there's got to be some balance between the amount of regulation we have and reducing the regulation, because as we know, government regulation is going to be increasing on the price and the cost. And the question is, as the price goes up for more regulation, are the benefits that we get from it worth the cost that we are paying? And oftentimes we don't think in that way when we think about government type of regulations. We know that audits in and of themselves is in a form of regulation because the government is saying publicly traded firms need to have an audit. The CPA firms themselves, the accounting firms that are auditing the publicly traded firms, are not necessarily part of government. They're private CPA firms. They are subject to regulations within their profession in being CPA firms, in being accounting firms, but the government regulations, of course, are requiring the publicly traded company to have an audit, and therefore they have that type of regulation. Also, of course, the CPA firms themselves are regulated in some format within the industry and possibly through government regulations as well. So what we need to do then is find the balance. What balance are we looking for with the amount of regulation that we have and the cost that we have for that regulation? Now, why would we want more regulation? Why do we have the audit in the first place, or why is the government involved in the audits? Well, what we're looking for in terms of the audit, as we've discussed in prior presentations, is that we want to increase the level of trust. Especially in the US, we have so much money that's actually coming in from other places that have a larger potential for growth because they're not as industrialized and therefore have a larger potential for growth, and they're a larger potential for return on investments. But people tend to come to the US, put their money into the US, not because of really the potential for growth or to get rich really quickly, but more because they do not have the same type of potential through lack of trust of losing the money that they invest in the corporate stocks that they put in within the U.S. And part of that is due to the transparency that has been built through regulation, through things like audits, so that when people put money into, say, the exchanges for a U.S. type publicly traded company, they have assurance. They feel some assurance. They feel trust that the money that they're putting in is being reflected by the financial statements that are being reported, and therefore they feel much more secure oftentimes investing in something like a publicly traded U.S. company, possibly, than other places in the world, even though, again, the potential return of other places that are not yet industrialized but that could be industrialized is much greater. We have a lot more potential for growth in something that is starting at a lower level than in something like a U.S. firm, which is already industrialized in some format. So then the question is, well, is there too much? Can we go too far? Obviously, at some point, if we increased regulations too high and we look for absolute assurance in some way, then it's going to be spending way too much money with regards to the cost of it. Because as we look at the cost of audits for publicly traded companies, they are very high, they are very expensive. And if we start to limit some other types of things that the CPA firm can do, that's going to take a toll on the economy. So the question is the added regulation we're putting in place going to pay for itself in terms of the added trust? What does trust do? It facilitates more transactions, which will stimulate the economy forward. So that's going to be the question. And notice we don't typically think of things that way. What happens is usually some kind of event happens, and we start to think that the pendulum swings all the way over, and we need to then put in more regulations or less regulations. And often it might be the case that we say we're going to reduce regulations, or we're not going to enforce regulations for a long period of time. Everything's going fine, possibly. Then some event happens which shakes people's trust, possibly. And then the pendulum swings all the way back over, and we don't really consider cost benefit. We just say, we have to make sure this never happens again, because this is the type of thing that happens with the government regulations. So you'll note over time, government regulations with regards to auditing, CPA firms, and other types of things will tend to swing. And as they swing, the swings aren't always the most modest type of swing. We don't typically often see the middle ground. We often see swings that are going to be a bit extreme, possibly. For example, there's a large amount of accounting scandals that happened in the 1990s and 2000, and those include things like Enron. Arthur Andersen was the CPA firm for Enron that you would think would have handled or caught some of those problems, but they were one of the large firms at the time and didn't, which was a problem. Tyco, WorldCom, Lehman Brothers. We won't go into the details of these scandals, but note that the number of these scandals and the size of these scandals were enough that people looking at it are saying, hey, I am losing trust, right? And we started to get concerned in terms of the trust of the type of publicly traded companies we have, because we know that in the U.S., the trust within the publicly traded companies that the financial statements are reported accurately, that when people invest in the financial statements, they're investing in something that is supported by the financial statements that are materially sound. That is something that draws in a lot of money, not only from U.S. people, but outside the U.S. It's worth a lot. So the fact that we had a lot of these different type of scandal situations and they weren't being caught or regulated within our current structure led us to say, hey, we need to do something. Now, I'm not saying that the pendulum swung too much. I don't want to get into a debate on whether or not it was an overreaction or not, but clearly there was a severe reaction related to this, and probably then some type of pullback after that point in time as well. So what was the reaction to this in the 1990s and 2000? Government regulations, including the Sarbanes-Oxley Public Company Accounting Reform and Investor Protection Act, often called Sarbanes-Oxley. So Sarbanes-Oxley Public Company Accounting Reform and Investment Protection Act. It was passed in 2002. Regulation of audit profession. So it actually regulated the audit profession as well, because you'll recall, in part, one of the things that happen if these are publicly traded companies, the CPA firms, the large CPA firms that have basically kind of a monopoly over the large companies. There's a very few amount of firms, an oligopoly, let's say, over the largest companies are being audited by a very small set of firms, and that became something of concern. So then the question is, well, we have to basically make sure that these large CPA firms aren't being compromised. They are not somehow colluding with in some way or working with these large companies to possibly deceive, given the fact that the dollar amounts are so large. So that would become more of a concern there, and created the Public Company Accounting Oversight Board. So this was a huge change. Now we have the Public Company Accounting Oversight Board, which was created by the regulation of Sarbanes-Oxley as a response to many of the large scandals from the large companies that you would think would have been caught or hoped to be caught within a standard required audit process. And then there's also Dodd-Frank Wall Street Reform and Consumer Protection Act. This one's a little bit more specific in scope to industries in many of its application. It passed in 2010. So let's take a look now at the auditor's responsibilities. Auditors' responsibilities provide reasonable assurance that the financial statements are materially free of misstatement, whether caused by error, fraud, or illegal acts. So notice that's what's supposed to happen here. We want reasonable assurance. Now, we're not saying that there's going to be complete assurance. There's going to be audit risk. It could quite be possible that there's going to be some material misstatement that is there. Well, not quite possible, but there's going to be some risk involved in it. Also note that the auditor is not looking necessarily for fraud. Most of the things that led to these added regulations are due to fraud. And it's our goal as auditors isn't necessarily, we're not saying, hey, we're going to catch all fraud, and we're not saying we're going to catch all mistakes or anything like that. We're saying we're looking for the material misstatements, whether caused by fraud or mistakes. So our goal is to look for those material misstatements. Now, of course, the frauds that we looked at, or the problems with these large scandals that led to the increase in regulation, are areas that looked material and therefore should have been something that you would think that the audit would pick up on. Reasonable assurance is not absolute assurance, however, that the material misstatements are detected. So we're never going to say absolute assurance. But again, if you look at the things that happened in terms of those large scandals during the time period of the 1990s and 2000, you would think that given the number of them and the size and scope of them, that they were, of course, things that we would expect to be caught. And that's, of course, what resulted in the increase in regulation. As we think of this increase in regulation, especially with regard to the CPA firms or the accounting firms that are doing the auditing, we do want to keep in mind the responsibilities involved, including who is responsible for the financial statements. Remember that the management is primarily responsible for maintaining effective internal control and for ensuring the fairness of the financial statements. So we always want to keep these two things involved in our head. We have the corporations, the large corporations that are controlled by the managers. They're run by the managers who are voted on by they're hired by the board of directors, who are voted on by the owners or the stockholders. And then we've got the CPA firms hired by the company, in essence, but supposedly independent, or should be independent in character through the separate regulations that they have, that are responsible for reviewing as to whether management has maintained the proper internal controls or give an opinion on the internal controls, as well as the fairness of the financial statement. So you have these two different sides that we have to always keep in mind with regards to the audit process and the regulation of it. Now, one of the primary concerns with these large scandals that happens is when management itself is no longer trustworthy. And this doesn't, you would think most of the time management is fairly trustworthy, because if you're talking about a large company, they have to be somewhat transparent within their operations, and they want to be possibly overly transparent oftentimes. But if you're in a situation where the top level management of a publicly traded company is seeking to be fraudulent, is seeking to deceive, in that case, it becomes a little bit more difficult in some cases, depending on the type of fraud, to detect, because the internal controls that are put in place, the checks and balances that are going to be put in place, don't typically apply or can be subverted or worked around with regards to the top level management. So the internal control, in other words, oftentimes separate the duties, who's in charge of what. But the person that's in charge of separating the duties is top level management. So if the fraud is happening at the top level management, as it did with some of these cases, then the internal controls themselves are a bit more problematic. They may not catch the problem. And that's, of course, one of the problems in place. And that's one of the things that are concerning, or one of the concerns currently being thought of with regards to these regulations, is what happens when the problem is within the top management. In this presentation, we will discuss corporate governance as it relates to audit and the audit committee. As we recall, thinking about the corporation and what the corporate structure is, we can consider the owners of the corporation being the stockholders. So we have the stockholders of the corporation being a step removed from the decision-making process. And you can compare this to something in a democratic government, say voters voting for representatives that then make the laws. Well, you have a separate kind of stage in the ownership of a corporation as well from the actual decision-making process on a day-to-day basis. And that, of course, means that with publicly traded companies, the owners are the stockholders. The stockholders then vote for the board of directors. The board of directors then is the one that's going to hire management. Management is the one that's going to be making the decision-making process. So you have this similar kind of setup where the owners are going to be a step removed from the decision-making process. The audit, then, we can think of one of the main users, or one of the main functions of the audit, is to build trust within the shareholders, or people that would be potential shareholders, purchasers, investors in the corporation. The board of directors is the body primarily responsible for management oversight of U.S. corporations. So note, of course, when we think about the corporation, management is there to act as agents of the owners of the corporations, the shareholders. So how do we know that the management is going to be acting as agents? What type of regulations do we have over management? What type of control do we have over management as basically the owners, as the shareholders? Well, we have the board of directors, who is voted on by the shareholders. The board of directors then responsible for the management hiring and the decision-making process of management, and evaluating that decision-making process. And part of that then, if we think about the audit, well, where's the audit going to fit into this process? Audit committee is a subset of independent board members that oversees the internal and external auditing work done for the organization. So we have a subset of the audit committee that's going to be dealing with the audit, because of course the audit is in some sense putting some type of judgment on the performance of management, because management is there in part to put together the financial information in accordance with the set of rules that they're required to follow. The audit then is judging whether or not that is indeed the case, and they will be reporting that to the people that are overseeing management, typically that being the board of directors, and more specifically in this case, the audit committee being, once again, a subset of independent board members that oversees the internal and external auditing work done for the organization. As we can consider this setup, note that we have the board of directors representing the shareholders, and we have the auditor who is basically making a judgment on the management to see if management is putting together the financial information in accordance with generally accepted accounting principles. So in a way, we have basically a check on management, a reporting from the audit from management to the board of directors. But also note that it's still the case that in essence, the independent auditor is being hired in some way by the company. And although we're reporting to basically the board of directors about, in essence, the performance of management, The auditors need to be considering themselves as independent, in essence, from the board of directors as well in order to render the best judgment that they make. In other words, it's possible that the would apply pressure as well to issue a clean audit report if the auditor feels, even though an auditor feels that there's some type of qualification that is involved in it as well. So although the audit then is going to be a judgment on management to see if the financial statements are put together in accordance with generally accepted accounting principles and they are reporting to the audit committee, and the audit committee is a subset of the board of directors that is responsible for the oversight of management, the auditor still has to be independent, of course, because the audit committee does still have incentive to want to have a clean audit report, avoid any problems with the audit report because they're invested in the company typically, and that investment in the company will be better served if we had a clean type of audit reports. We are back to this issue of independence, and we'll talk about this as we go through the auditing process. We want to make sure that the auditor is independent because the independence is what's going to lend trust not only to the current board members, the current shareholders, but to potential shareholders in the future, potential investors in the future. In this presentation, we will discuss organizations that impact auditing. We're going to start off with those organizations that impact auditing in the U.S., in the United States, including the SEC, the Securities and Exchange Commission, the AICPA, the American Institute of Certified Public Accountants, the PCAOB, or the Public Company Accounting Oversight Board, the FASB, the FASB, Financial Accounting Standards Board, and the ASB, Auditing Standards Board. This slide will give us more of a framework of these organizations. I won't go into it in detail because I know it is a little bit small to read, but this will be in the PDF files if you want to review it. Organizations that impact auditing internationally, so now we're talking about international as opposed to strictly the United States or the US, the ISAB, the International Accounting Standards Board, and the IAASB, the International Auditing and Assurance Standards Board, one more time, International Auditing and Assurance Standards Board. Auditing standards. Auditing standards help make financial statement audits that are conducted in a consistent and thorough manner. So you'll note, of course, that when we think about accounting in and of itself, we have to have the standards. That's what we've learned in financial accounting, that normal standard being generally accepted accounting principles in the U.S., the use of typically an accrual type basis. There are different types of standards we could use if we were to use, say, a cash basis or some other types of principles in order to put together the financial statements. It is possible to do that, but once we have a whole lot of different standards, it becomes a lot more difficult for us to be comparing from time period to time period, from company to company. Then, of course, when we think about the auditing standards that are going to be applied to the audit of financial statements, we want to have a similar process as well. We want to be able to say, hey, these financial statements are made in accordance with some type of standard. The more uniform that standard is, the easier it is for people, investors, banks, to evaluate those financial statements because they know they're on a particular standard, make comparisons of the same thing to the same thing. So the more standardization there is, the easier it is to be. And obviously, when we go through different countries with different standards in terms of how the financial statements will be put together and how the financial statements will then be audited, there can be a bit of difficulty in that. And that's going to be a constant kind of struggle. How much independence does a country want, such as the U.S., in terms of their regulations and how they're going to put the financial statements together, and how much conformity can we have in terms of regulations on a more global type of level. And if we go to a more global type of level, that conformity, who's in charge, of course, of the conformity as we move to different levels and different stages. So that's going to be obviously going to be a concern. Our goal for the financial accounting is to be standardized because we know that more standardization will be an improvement for decision makers that have to do less works because they can know one standard. But of course, there's difficulties in standardizing everything, especially on a global scale. They also serve as a criteria for evaluating the quality of the auditor's performance. Auditing Standard Setters. First, we have the ASB, the Auditing Standards Board. This is for non-public company audits. So if we're doing an audit for a non-public company, one that's not publicly traded, then we would be looking to the ASB, the Auditing Standards Board. And then you'll recall that we had the PCAOB that was set up as part of the Sarbanes-Oxley law, Public Company Accounting Oversight Board. That's for public company audits. So when we're considering publicly traded companies that we are then auditing, we need to be considering the PCAOB, Public Company Accounting Oversight Board. Then we have the IAASB, the International Auditing and Assurance Standards Board. It's used in international jurisdictions. So many different international jurisdictions use the IAASB. And again, as we go to international type of standards, the question is, how can we basically standardize things on an international basis? Who's in charge of standardizing things on an international basis? And if we were able to standardize things internationally, then of course that standardization hopefully would lead to more business, because it would lead to more ease of information transaction understanding. In this presentation, we will discuss the underlying principles of an audit, including the purpose and promise of an audit, responsibilities of the auditor, performance of the audit, and reporting. We're going to start off with the purpose and promise of an audit. The purpose of an audit is to provide financial statement users with an opinion by the auditor on whether the financial statements are presented fairly in all material respects in accordance with applicable financial reporting framework. So we'll recall it's in order to give our opinion on the fairness of the financial statements being reported in accordance with some certain type of framework. An auditor's opinion enhances the degree of confidence that intended users can place in the financial statements. And that, of course, means that if we are intending to invest in, say, a company, or do business with the company, give a loan to the company, we are more likely to do so if we have an independent auditor who has signed off and said, yes, these things that you're depending on, these financial statements, are indeed correct or materially correct according to the audit that we have provided, and therefore you can rely on them, and therefore will be more likely to have business transactions. An audit in accordance with generally accepted auditing standards is conducted on the promise that management and, where appropriate, those charged with governance have responsibility. So this is going to be the management responsibility for the preparation and fair presentation of the financial statements in accordance with the applicable financial reporting framework. So remember, it's management's responsibility to say, hey, I assert that this is indeed the case. It's the auditor's responsibility then to have an opinion as to whether that is true or not. This includes the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of financial statements that are free from material misstatement, whether due to fraud or error. So note that means that we have to have the internal control set up, because if we're talking about these large type of companies, the management is also in charge for setting up those internal controls, because without them, we would not be able to either audit or possibly even do or put together the financial statements in accordance with the appropriate framework that they need to be put together within. To provide the auditor with all information such as records, documentation, and other materials that are relevant to the preparation and fair presentation of the financial statements, any additional information that the auditor may request from management, and, where appropriate, those charged with governance, and unrestricted access to those within the entity from whom the auditor determines it's necessary to obtain audit evidence. So in essence, we're saying, hey, management responsible for allowing the resources to be accessed for the auditor in order to conduct the audit. If we go to the responsibility of the auditor, auditors are responsible for having appropriate competence and capabilities to perform the audit, complying with relevant ethical requirements, and maintaining professional skepticism and exercising professional judgment throughout the planning and performance of the audit. Then we have the performance of the audit. To express an opinion, the auditor operates reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. To obtain reasonable assurance, which is a high but not absolute level of assurance, the auditor, so note we have reasonable assurance, not absolute assurance. It's always going to be a test question that's going to come up anytime you see any absolutes in a test question. Probably not going to be a correct answer. Plans the work and properly supervises any assistance. determines and applies appropriate materiality levels or levels throughout the audit. We'll talk more about applying materiality type levels as we go through the process. Identifies and assesses risks of material misstatement, whether due to fraud or error, based on an understanding of the entity and its environment, including the entity's internal controls. Obtains sufficient appropriate audit evidence about whether material misstatements exist through designing and implementing appropriate responsibilities to the assessed risks. The auditor is unable to obtain absolute assurance that the financial statements are free from material misstatements because of inherent limitations which arise from the nature of financial reporting, the nature of audit procedures, and the need for the audit to be conducted within a reasonable period of time, and so as to achieve a balance between benefit and cost. And then we have reporting. Based on an evaluation of the audit evidence obtained, the auditor expresses in the form of a written report an opinion in accordance with the auditor's findings, or states that an opinion cannot be expressed. So that's going to be obviously the report. The report will be, in essence, issuing the opinion, whether that opinion be clean, whether it be a qualified type of opinion or other type of opinion. The opinion states whether the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework. That, of course, being our objective from the get-go, from the start. In this presentation, we will discuss Auditing Standards. We're first going to take a look at the ASB, the Auditing Standards Board. They issue the Statement on Auditing Standards, the SAS. So the ASB, Auditing Standards Boards, issues the Statements on Auditing Standards, or the SAS. Then we have the PCAOB, the Public Company Accounting Oversight Board. They issue Auditing Standards, or AS. Then we have the IAASB, the International Auditing and Assurance Standards Boards. They have the internal standards on auditing, the ISA. So in other words, we have the ASB, the Auditing Standards Boards, the PCAOB, the Public Company Accounting Oversight Boards, and the IAASB, the International Auditing and Assurance Standards Boards, as the standards setters. The ASB is going to be for, as we recall from prior presentations, non-publicly traded companies. The PCAOB set up with Sarbanes-Oxley for, that's going to be a law that set it up for publicly traded companies. And of course, the IAASB, International Auditing and Assurance Standards Boards. How do they then set the standards? Well, they issue these items. So the ASB has the Statement on Auditing Standards, the SAS. Therefore, that's what we actually look up when we want to consider what these standards are, the SAS. The PCAOB, the Public Company Accounting Oversight Board. If we're looking at the standards for publicly traded companies, then we look at what they produce, which is the Auditing Standards, which is the AS. And then if we're on international standards, the IAASB would be the regulatory entity, the International Auditing and Assurance Standards Board, setting the standards, those standards being what we'd actually look up, the International Standards on Auditing, or the ISA. So the ASB's SAS, they have two numbering categories. They have the AU numbering category for auditing standards, also organized by topic. So they're also going to be organized by topic. And then we have the SAS, chronological, according to when standard was issued. So these are if we have some kind of idea of when the standard was issued, or it can be useful or informative to look at the standards as they were issued. And that gives us some idea of what the thought process was, because we can see what is going on in a chronological type of order. If you go to this link, you can go to these standards and get to them on the website. Here's a look at the Statement on Auditing Standards, so you can take a look at the Statement of Auditing Standards here. Next, we have the PCAOB Auditing Standards, or AS. The PCAOB reorganize auditing standards into these categories. So you can take a look at these categories below, which they have been organized into. And here's the topical content. The information can be found at this link. Here's an example of the website. Here's the PCAOB, and you can scroll down and get the general auditing standards and go through them there. We then have the International Standards of Auditing, the ISA. and it has 36 individual standards covering the full range of auditing topics, but there's less structure to the organization than the other types of standards that we have taken a look at. You can find them at this URL. Here we are at that URL, and we are at the IAASB, and if we take a look at the standards, we could scroll through and get a feel for them as well. In this presentation, we will discuss audit planning stages. You'll recall that we broke out the audit into stages in prior presentations, those stages including client acceptance or continuance, preliminary engagement activities, plan the audit, consider and audit internal controls, audit business processes and related accounts, complete the audit, and then evaluate results and issue audit report. We here are going to be focusing in on these top 3 items. These top 3: client acceptance or continuance, preliminary engagement activities, and then of course the planning of the audit. This is all the stuff that oftentimes gets overlooked and which is very important. And this is the stuff that usually the top management team or the top components of the audit staff, including the partner and the senior auditors, are going to be involved in the planning process, because that's going to set the stage for what's going to be happening going through the audit going forward. So the planning is going to be very important, and then we're going to get into the actual process, of course, of conducting the audit after that planning stage takes place. What's going to happen within the planning stage? The accounting firm should determine the following items before accepting a new client. So first of all, we want to think about, should we accept a client as someone that we want to do business with? Because of course, we are reviewing the client, but we're hoping to issue a clean report. Everybody wants to issue a clean report. And in order to do that, we want to be engaging with clients that we expect to be good clients and that they have integrity and whatnot, so that we can issue a clean report. So it's very important for us to then be taking on clients and going through some type of process to vet them before we start the process of audit engagements, so that we save ourselves any kind of time of wasted time in the auditing process. Because if we go through an audit with a client that does not have integrity, and we put a lot of time into it, they're probably not going to be very happy at all to have a report at the end of the day that is not a clean report, or that if we decide that we have to remove ourselves from the audit, we can't complete it because of scope limitations or an adverse report. Of course, that's not going to be good for either party, and it's not going to basically continue on with the auditing process. So really important, and usually the people that are going to be involved here, of course, are the top level of the CPA firm, including the partner, in evaluating what type of clients they should be picking up. Do we have the ability to perform the engagement? So first of all, of course, we want to be able to think, do we have the ability to do the work? You might think, hey, we're a CPA firm. Of course we have the ability to do the work. But to consider this, we might have different types of industries and whatnot that this company is in. If we have never done, say, the construction industry or retail type of industry, and we don't know the details of it, those could be constraints. Now, that we could look into those constraints, get the research, then the question is, do we want to do the research in order to bring ourselves up to par in order to perform this engagement? There also could be limitations in terms of, what if they have locations outside of where we are at? We're a local firm. What if they have locations in states that we don't have any presence in? How can we get around those limitations? Can we get around those? We could work with other firms possibly to get around those types of limitations as well, but it's important for us to assess whether or not we have the ability, and that's going to be dependent from client to client. Are we and the company in compliance with relevant ethical requirements? So are we in compliance with any kind of ethical requirements that are going to be within the engagement process, including the standards for the engagement process, the normal business ethical standards, as well as standards with regards to us conducting the audit, including things like independence. And we'll talk more about what those are in future presentations. Does the client have sufficient integrity to do business with? And this is really important because, again, we don't want to be picking up clients that are going to be problem clients. We're not picking up clients in order to say, hey, we're going to audit anyone. We'll pick up any type of audit. And if the audit's good, we issue a good opinion. If the audit's bad, we issue a bad opinion. That's not really how it works. You would think kind of that would be how it works, because you think audits is a type of regulation. You would think that everybody should be audited and you should just basically issue whatever opinion is there. But note who is hiring the auditor again. The auditor is being hired by, in essence, the board of directors, in essence, the business. Everybody that is involved is expecting, hoping to have basically a clean opinion. The CPA firm has to not give a clean opinion if the evidence gives the fact that there is some kind of qualification or something like that. But they don't want to basically do that. We would like to say, hey, we're dealing with someone with integrity. They put the financial statements in accordance with the way they said they were. The assertions that they told us that they made the financial statements are indeed the way they made the financial statements in. And if clients don't have integrity, if a company doesn't have integrity, they're going to have problems getting a qualified or a CPA firm with a good reputation to audit their financial statements. And of course, that's going to be a problem for the company. So note that the job of the CPA firm isn't to pick up any client and basically, audit the client. And if it comes out, it is what it is. It comes out what it is, and we issue the report. If it's good, it's good. It's bad, it's bad. We want to be independent and issue the report. If it's good, it's good. It's bad, it's bad. However, we want to see as much as possible that if we see that there's going to be bad reports that need to be issued in the front side of things as we take on new clients, we don't go forward with the audit. It's not cost effective for ourselves or the client to do so. We say, hey, I don't think this is an audit we're going to move forward with. I'm not sure that the client has the integrity for us to want to pick up this engagement. It's simply not worth our time to go through the engagement with a high risk possibly of a not good result, and we don't want continuing engagements with clients that are going to be difficult for us to work with. So it's going to be very important. Again, that's going to be one of the principal jobs of obviously the partners to deal with the new clients and what type of clients they're going to be picking up. Do we have the ability to perform the engagement? So that could be including things like, do we have the technical skill and knowledge of industry and subject matter? So a lot of CPA firms will be focusing in on certain niches, especially if we're not in the largest CPA firms. Even large CPA firms are going to have different departments that focus in on different industry niches. Smaller CPA firms often find a niche. They do business by focusing in on a specific niche. And so if we then see clients or have an opportunity to take clients outside of that niche, then we want to say, hey, do I have the resources? Do I want to take on the resources? Get myself up to par to pick up whatever needs to be picked up in order to take on the engagement. Do we have employees with experience and relevant regulatory and reporting requirements? So note, different industries are going to have different types of requirements, and there's a lot of different types of audits we might be engaged in. We might be auditing, for example, for a specific type of reason. For example, we might be auditing on a state level for like an HOA, a homeowners association or something like that, in accordance with requirements for that state that's necessary to have for those specific requirements, which might need us then to know what those requirements are, which could differ than our other types of niches. So we need to know, do we have the people involved that know these regulations and what is needed within the audit? Do we have the necessary personnel with competence and abilities? Do we have the people we need to finish and conduct the audit in accordance with whatever special needs that audit is? Do we have or can we get specialists as needed? So we often might need specialists in different ways, because if we're going to do things, say, evaluate the value of certain type of assets, we might say have inventory that we don't know how to value, because obviously we're auditors, and if we're trying to say, is the inventory on the books at the correct value, we can go out and count the inventory as auditors. That's not hard. We could say there's that many units of inventory, but valuing the inventory, not very easy to value like clothing or something like that. If we're an auditor, it'd be different. So we might need specialists, and different types of areas are going to need specialists for certain types of reasons. Question is, do we have those specialists? Are we willing to find those specialists for as needed? Can we do the work on time? Obviously, again, there's going to be scope limitations with these things, and we want to make sure that when we take on the new engagement, what's going to be the time frame of it? And given all this type of information, can we do it within a reasonable time frame for both our purposes and the purposes of the client that we are doing business with? Are we and the company in compliance with relevant ethical requirements? Are we independent? That's going to be one of the key components. So when we think about ethical requirements, and we'll talk more about independence as we go, but one key thing is we want to be independent. And notice what we're doing here. We're giving our opinion on the financial statements in order for a third party, two business people, to do business and be able to rely and trust on each other. In order to do that, we need to be independent, and the best thing would be to be independent, not just in form and in substance. We want to basically say, hey, we did our job. It's not enough, in other words, for us to say, look, we did our job. We're a CPA firm. We did our job. I'm a CPA, and trust me, I'm independent, even though in appearance I may not be. So, for example, I might be on the board of directors. If I was a CPA on the board of directors of the company that we audited, it may well be that I was independent in my conduct, that I performed the audit in an independent fashion, and I didn't let that influence my opinion at all. But the appearance doesn't look independent, and of course the appearance matters when you're talking about a third party. If I'm going to some third party and I say, yeah, I audited the financial statements of this company, and by the way, I'm on the board of that company, and I'm an auditor, and I'm a substantial shareholder of it, I may have done a great job of the audit, but the other person is not going to help build their trust as much as if I can say, hey, I'm an independent auditor, and I'm not on the board. I don't own any stock in this company. I'm independent both in appearance and substance, and I'm also regulated by, the rules of being independent as a CPA firm. Then that's what's going to give more assurance. So when the problem with independence oftentimes for most people's mind is to say, hey, that doesn't bias my opinion. It doesn't bias my opinion that I know people in the company, or that I have siblings that work there or something like that. It doesn't bother that I still give an opinion that's valid because I'm a truthful person. But in appearance, it doesn't look good, and therefore that could still harm the quality of the opinion. And so then can we accept the client without violating any regulatory requirements or the code of professional conduct? So we want to be able to obviously accept the clients without violating any kind of code of conduct. Does the client have sufficient integrity to do business with? So some questions we might ask with regard to that. And again, any kind of client that doesn't have the sufficient integrity, we really would like to weed them out before any type of transaction, any type of engagement, because they will take a lot of time and waste a lot of time. We first need to determine and identify the reputation of the principal owners and top management. So what's going to be the reputation? Understand the nature of the client's operation and business practices. Determine the attitude towards internal controls and interpretation of accounting standards. And this is going to be a big one, because when we start to sit down and think about with the top management, what do you think about internal controls? What do you think about accounting standards? Do you have internal controls? How are they implemented? This is really important, especially with larger type of companies, because we're dependent on the internal controls as a major portion of our audit, as is the financial statement process typically of a well set up organization that's large is going to need good internal controls. And it's very possible for a good set of internal controls to have been set up yet not implemented. And you can kind of get a feel for that about what people think about internal controls. Is it necessary to have internal controls? How well are the internal controls made? What are the internal controls, and how well are they actually followed and established? And of course, setting the establishment of following internal controls is something that's going to be set by the top management. So you can kind of get a feel of what they think about those types of things when the discussion of top management happens to take on a new client. Determine if there are any indications of limitations on the scope of the work. In other words, when we start to think about and talk over what the engagement might look like, we want to think about what the scope limitations will be and get a feel for if there are any scope limitations involved. For example, if we start to say, hey, there's this one particular department that's over in China or something like over in some other area, we want to think about, well, how are we going to get access to that? Are there any problems with us getting access to that? If the client then says, you can't audit that particular department because they won't let us in, or for whatever reason, then we're going to have some scope limitations, and we want to consider those up front and get an idea of them as soon as possible. Determine if there are any indications of fraud or money laundering. Obviously, if we look into things and we start to get a feel for the idea that there might be some type of fraud, some type of illegal activity or money laundering, that would go towards the integrity of the client, and we probably wouldn't want to take on the engagement. The reasons for a company leaving the previous firm. Note, this is going to be a key question, and it seems like one of those questions that you would think is like, that's kind of a rude question, like, why did you leave the prior firm. But it's a standard question that we have to ask. It's basically standard type of practice. And of course, it makes sense to have this. If you're talking about a publicly traded company or any other type of company that needs an audit from a year-to-year point, and they're looking for a new CPA firm, it's natural for us in the CPA firm profession to then say, who was your prior, why are you leaving your prior CPA firm, and what are the conditions on which you left the prior CPA firm, and possibly even, can we contact the prior CPA firm just to see what the conditions are there. And again, that's going to be typical type of thing, because we want to know for our purposes and theirs, what was the problem with the engagement, so that we can both know what the engagement is if we want to take on the engagement, and so that we can do hopefully a better job possibly with whatever kind of limitations there were within the prior engagement. So hopefully, they left the prior firm, possibly they got too big and they grew and they left the prior firm because the prior firm is small, they don't have enough regional offices and whatnot, and that would be a fine thing. But it's going to be a common question for us to go to that prior firm and ask that, or to ask about the leaving of the prior firm and why you'd be looking for a new firm. If it's a new engagement and they didn't have an audit in the prior year, well, that would be self-explanatory. If they're a publicly traded company, then they would need to have an audit if they were publicly traded in prior years. If they're not publicly traded, maybe they need an audit now and they didn't need one last year, and that would be, of course, the reason they didn't have an auditor in the prior year. Continuing client retention. Periodically evaluate client retention. Now, if we're talking about a client that's continuing, then obviously we already know about the client. We don't have to do as much evaluation, but we do want to just keep in mind those key points that things could change, and things change gradually with clients. So it's easy for us to just, after time, things can deteriorate and we possibly don't know it, right? So we have to basically reevaluate, especially when key things type happen. So it's typical to evaluate near the close of the audit, or if there's some significant event that happened. If there's some type of event that happens, we may want to reassess and say, okay, let's reevaluate this client so that we make sure that we're up to date on our evaluation of our business dealings with the client. So if there's any arguments, for example, over fees, that could cause some tension with the client. It could be an indication of other things going on. So we want to basically reevaluate our situation with the client at that point. That means our fees on the audit. And conflicts over accounting and audit issues. If there's any conflicts, if we say, hey, there's an adjustment, this doesn't seem to line up to generally accepted accounting principles, and the client is saying, no, I don't believe that, or I'm not going to make that adjustment, or I believe you're right, that doesn't line up, but I still don't want to make the adjustment because of A, B, or C. Doesn't mean they're wrong necessarily, but it does mean that we want to basically reevaluate the situation at that point and make sure everything is running smoothly, and make sure that doesn't, or see if that's an indication of anything deeper. In this presentation, we will take a look at preliminary engagement activities. In a prior presentation, we took a look at the audit, breaking it out into stages. Those stages including the client acceptance and continuance, preliminary engagement activities, plan the audit, consider and audit internal control, audit business processes and related accounts, complete the audit, then evaluate results and issue the report. Now we are focusing in on the preliminary engagement activities. So note, we're still basically above the planning of the audit section before we get into the auditing of the internal controls, and finally to what most people would consider kind of diving into the actual activities, the audit business process and related accounts. Actually take and say, give me the accounts, let me go through and start auditing those activities. So the preliminary engagement activities: assess the compliance with independent and ethical requirements, determine audit engagement team requirements. So we're going to think, what are the team requirements that we are going to need for the engagement? Topics to discuss will include the engagement letter, whether we can use the work of the internal auditors. And note, if we're talking about a large type of engagement, especially for publicly traded companies, they probably have internal auditors. Those auditors that are going to be working for the company, they get a W-2 wages. Therefore, they don't have the same independence, which is part of the need for us as the external auditor to be auditing. However, they're going to be doing many of the same type of procedures. Therefore, our question then is, well, can we use their working papers? Or in other words, to what extent can we use the working papers or the work that is being done by the internal auditors in order to collaborate our evidence as the external auditor and possibly lower the amount of work we need to do? if we're looking at smaller type of companies, we may not have any internal auditors. Obviously, at some level, you have to get above some threshold level before hiring an internal auditor is going to be appropriate. But publicly traded companies will typically have them. And again, our question is, can we use the work that they do? The role of the audit committee. So we're going to discuss the role of the audit committee as we go through, of course, the auditing process. And you'll recall that the audit committee is going to be a subset of the board of directors. The board of directors is going to be voted on by the stockholders, the owners of the company. They are in charge of hiring management. So they're the people that basically we will be talking to much of the time when we're considering the audit process, setting up the audit process, reporting the audit process, and when we issue the audit report. Engagement letter documents the terms of the engagement, including. So now we're talking about the engagement letter. You'll obviously, whenever we have a new engagement, we want to give the engagement letter. And I would recommend this with just about any type of engagement. Of course, we would want it with an audit because it's a pretty formal type of process, but you want it with basically anything you're doing. If you're doing bookkeeping or something like that, you probably want the engagement letter. Taxes engagement letter. A few different reasons, because you want to list out exactly what you're doing and what the responsibility of the client is. If you don't have the terms set up very well, then it's very possible for the two people involved or the entities involved to not have an understanding of what's going on or what's being expected. It's also possible for kind of work creep, we could call it, to happen as well. In other words, it's possible for the client to slowly basically ask for more types of services and us to be providing them without basically reassessing what the engagement is, what the actual terms are, possibly not, billing for them in the proper way that we should be doing. Within an audit, of course, it's very important for us to determine upfront, this is what we are doing, this is what you are doing. It could be very confusing for smaller type of companies that may not have as much experience with the audit to have that separation of what's going on here. What's the purpose of an audit? Especially for a small company, maybe they need an audit for a loan or something like that. They might have the impression that the CPA firm is there to basically put together, do more work to help put together the financial statements or something like that, as opposed to reviewing the financial statements that are put together by management being responsible for the assertions. Publicly traded companies, obviously, that should be pretty well known because the audit process is a required process. So engagement letter then. We want to list out the objectives. We want to know what the management's responsibilities are, and we want to know what the auditor's responsibilities are. So we want to make any limitation of the engagements. We want to list out any kind of limitations of the engagement. Engagement letter may also include, so these are basically the minimum. This is the minimum of what we would have in the engagement letter. We could include, in addition to the minimum, plans for use of specialists or internal auditors. So if there's a specific plan for the use of the internal auditor information, or if we need some type of specialist, say to review the value of certain assets or something like that, we may list that in terms of the engagement as well, so that is clear. Limitation of liability of the auditor or client. So we may put kind of like, this is kind of like a disclaimer in there, the limitation of the liability of the auditor or the client. Any additional services agreed to be provided. So if we have anything above and beyond the audit, we want to list out, hey, this is the audit, this is another engagement we might have. Now, note, you may want to have this outside of the engagement letter. In other words, if you're going to do the audit and then you're also going to do tax work or something like that, it might be best to say, hey, here's the audit engagement letter, here's the tax engagement letter. You might want to, in other words, have two engagement letters for separate engagements so that you don't start blending these things together in the mind of the client and or yourselves in the CPA firm. Now we'll take a look at a little bit more detail related to the audit committee. Requirement of audit committee members of publicly held companies according to Section 301 of Sarbanes-Oxley Act includes member of the board of directors and independent, directly responsible for overseeing work of any registered public accounting firm employed by the company, must pre-approve all audit and non-audit services provided by its auditors, must establish procedures to follow for complaints, and must have authority to engage independent counsel. In this presentation, we will discuss the planning stage of the audit. In prior presentations, we broke down the audit process into a series of stages, those stages including client acceptance and continuance, preliminary engagement activities, plan the audit, Consider and audit internal controls, audit business processes and related accounts, complete the audit and then evaluate results and issue the audit report. Here we, of course, are on planning of the audit. We'll start off with audit strategy. The overall audit strategy will help the auditor to determine what resources are needed to complete the engagement. As we think of each audit, remember that each audit is going to be substantially different. So we want to know what the audit strategy will be. We want to make sure within the planning phase we do a good job, because that's going to set the groundwork to make sure that the resources that we need are there and that we apply them efficiently and go through the process of the audit as quickly and efficiently as possible. Audit plan. An audit plan is then developed in more detail than the strategy. So first, of course, we're going to think of the overarching strategy. You could think of us trying to put this framework together. First, we're thinking about the overarching strategy. Then we're starting to frame this thing. We're actually putting together the plan being more concrete, the plan being closer to a blueprint that we can then follow in a step-by-step mapped out type process, as opposed to the strategy not quite at the blueprint type level, not quite listing out exactly what's going to be happening, however, getting to that point. So the audit plan is then developed in more detail than the strategy, should plan how to conduct the engagement in an effective and efficient manner. And of course, that's always going to be what we want to do in the planning phase. We want to set it up in such a way that we have the steps followed out. We know what to expect. We believe we know what to expect, and we're going to set up a strategy to go through those, noting any types of areas that are going to be more time consuming than others, making sure that we have them aligned in such a way that we can complete them as efficiently as possible, possibly putting together different types of tests that can test different things at the same time, and lining up more time frame that will be needed for those areas that we know will be more difficult and more time consuming. The planning steps include assess the business risk. So we're going to say, what is the business risk? Establish materiality levels. We'll discuss more about what the establishment of materiality levels are. But note, we're always going to have to be thinking that we're not going to have the 100% assurance. There's always going to be some risk. There's going to be some risk, and therefore we need to calculate what the materiality risk would be, which is a little strange because we're actually calculating what would be acceptable amount of degree of risk or amount of error in terms of materiality in order to plan the audit. So we'll discuss a little bit more of how to do that. Consider the need for specialists. Do we need specialists? Of course, we are the auditors. We're specialized in accounting. There's going to be specialists possibly that will be needed in terms of database specialists. How do they put things together? How are they formatting things from an IT perspective? Possibly specialists in order to value different types of assets, such as real estate, such as different types of inventory or something like that. We need to make sure that we have those specialists that will be needed for those particular areas. Identify any related parties. So are there related parties to this entity? We know that if there are related parties, then they have transactions between the related parties. We can't rely on the market forces to be guiding what we expect from those transactions, and therefore we need to know who the related parties are, what type of transactions you have with them, and then how you're recording those transactions. Are they recorded in accordance with generally accepted accounting principles as they apply to related parties? Evaluate additional value-added services, and document overall audit strategy, audit plan, and prepare audit program. So once we have all this, of course, then we're going to put together and document the strategy we're putting together, the plan we're putting together. We want to do that for a couple different reasons. One, we want to make sure the plan is put together so that we can then follow it. We can delegate out to the rest of the people that will be involved in the audit what that plan will be and then execute. And then, of course, we also want to know this because it's part of the documentation for the audit. If we were to have some review of the audit or to look at our process that we have done, either ourselves or by some review body, we want to be able to show, hey, this is our strategy, this is our plan, here's the documentation for it, and here's us moving forward with it. Assess business risk. To understand the entity and its environment. So we want to assess the business risk, and we want to understand the entity and the environment. Now, as we get into risk, note what we're doing. We're looking at the planning process here. We're trying to set up the audit. We're trying to say, and ultimately say, what types of testing do we need? How much testing do we need? And in order to do that, we have to think about these ideas of risk. So we're going to say, what are the risk factors? And the risk factors will help us determine how to set up the audit, how much time it will take to do the audit, and how much work or what types of work or what types of work we're going to have to put together for it. We would like to do this in like as scientific a method as possible and tell us, well, this is the level of risk. we have here, and that's going to determine how much testing we have to do on A, B, C, or D. And we're going to try to do it as numerically as possible. But of course, assessing risk in something like the business risk in a business environment, understanding the entity and the environment, is somewhat of an art form as well as a science. So note that we're going to have to get a feel for the understanding of the entity and the environment. Our goal then is to assess the business risk within that entity, within that environment, and that'll help us better understand and set up how much testing is going to be necessary as we go through the audit process. To identify business risks that could result in material misstatement. This is our objective as we consider the business risks. We're saying what type of environment are they in, what type of entity are we dealing with, and then for our purposes, we're saying could these type of entities and the environment they're in lead to a higher risk of material misstatement in the financial statements. And obviously some industries are more highly complicated, some industries are more risky just in general, some are risky in terms of being a going concern type of risk, and some are just risky or complicated in terms of how they have to put together their business model, and those things can increase the likelihood of mistakes and problems happening, which would lead to misstatements. Those are the types of things we want to assess. Understand how the entity responds to the business risk and ensure response has been done. So the business then should understand their entity, of course, their environment, what type of environment they're in, what type of business they're in. If they're in a type of business that has a complex type of business structure in order to generate the revenue in some way, then of course they know that, and they should have a system set up, a system of controls set up in order to deal with whatever risk is involved for that particular industry. We want to understand the risk. We want to ask the business, how do you deal with this risk, and see if they are implementing whatever controls and whatever functions they have in place to deal with that particular risk for that particular type of business entity. Using this information, the auditor assesses the level of risk of material misstatement in the financial statement accounts. So we're going to use this information, of course, to assess the level of risk in the financial statements of material misstatement, because, of course, that's our goal when we make the audit, is to see whether or not, or give an opinion if there's material misstatement. That's what we're going to be gathering evidence for, as detectives would. And part of that evidence gathering process in the front side of things is to assess the business risk and put that in as part of our plan. Establish overall materiality. So we're getting back to this idea of materiality. Now note, again, in the planning process, we got to think of materiality, because that means that the type of decision that could lead people that are reading or looking at the financial statements to affect their decision. So a problem with the financial statement that could be large enough that a reasonable person may have their opinion affected if there's an error related to it of that size, or something is, say, omitted of that size. We need to know this in the planning stage and actually work it into our planning process, because when we think about things of risk, how much testing we're going to have to do, we have to think about, well, what is an acceptable amount of overall materiality misstatement, in essence, which seems, again, a little bit counterproductive. You would think that we would try to be eliminating all problems, and that's going to be our ultimate goal. You might think that we're going to try to shoot for eliminating all misstatements, and then whatever we don't get is fine. But that's not the way we have to do it. If we're trying to do this efficiently, we have to say, okay, what's going to be the material misstatement that would be basically acceptable, that would be under the threshold, and then start to plan our process from there. So to do that, then we have to establish things like the overall materiality. So we have to establish tolerable misstatement of accounts and establish tolerable misstatement of disclosures. So when we break this down, then when we think about, okay, what would be a reasonable material misstatement that would be tolerable, acceptable, something that if the financial statements were misstated up to this degree, then they would not be materially misstated. As we consider that, we could think of the misstatements per account. So we're going to establish tolerable misstatements for accounts. Then as we start to audit those accounts, we will have a tolerable misstatement that we can work with as we go into those accounts. Same thing is true for establishing tolerable misstatements for the disclosures to the financial statement. Related parties. identification of, accounting for, and disclosure of transactions with related parties. Note that an entity is related to a reporting entity if, among other circumstances, it is a parent, subsidiary, fellow subsidiary, associate, or joint venture. So we're talking about related type of parties in these transactions. And just like if we're talking about individuals and we were related parties to, say, siblings or something like that, or family members, then we know that transactions between those related parties are going to be a mess. They're not going to follow normal, what we would expect market type of behavior. And therefore, we need to know who the related parties are and how are they going to be recording information to the related parties. So we're thinking about those entities that are related to them. And we know that like family relationships with business transactions are going to be funny. And so once we know that who the related parties are, we want to know what the transactions are with them and how those transactions are taking place. So we're going to inquire about names of the related parties, nature of the relationship, the types of transactions with those related parties, reasons for entering into the transactions with the related parties. And again, if we look into these things, obviously the reasons for transactions with related parties could differ substantially than what we would expect for the reasons of transactions for parties that were not related. In other words, if you have a business transaction with a party that's not related to the company, then of course it's probably due to the fact that the company needs revenue generation being the objective in some way, shape, or form. We paid for something in order to have revenue generation in some way, shape, or form to help us with that process. Related party transactions, it could be a little bit more convoluted as to what was the nature or reason of a particular type of business transaction. And of course, we will document the audit strategy, audit plan, and prepare audit reports. Document about audit tests. We want the nature, the timing, and the extent. So when we have this documentation, we want to be documenting nature, timing, extent. Document how the entity is managing risk and the effects of the risk on controls on the planned audit process. Audit supervision, engagement partner, and other supervisory members. Tell the engagement team members their responsibilities, of course. Instruct engagement team members to identify and communicate audit issues and review the work of engagement team members. In this presentation, we will discuss types of audit tests, keeping the overall audit objective in mind. The overall audit objective to give an opinion on the financial statements to see whether or not those financial statements are free of material misstatement. As we go through the types of audit tests, we're going to break down that process to specific things that we are testing. We may be testing internal controls. We may be testing other types of assertions. And we want to make sure that as we think about these tests, we are thinking about what is the thing that we are testing. Are we testing the internal controls? Are we testing specific assertions? Are we testing specific assertions related to specific type of accounts? We'll get into this in more detail as we start to go through each component of the audit, but we want at this point to get an overview of the types of tests within the audit. So types of audit tests, we have risk assessment procedures used to attain an understanding of the entity and its environment, including an understanding of internal controls. So when we're testing for risk assessment procedures, we're trying to get an understanding of the entity. We're trying to get an understanding of the internal controls. The test of controls, then, is going to evaluate the effectiveness of the design of the operation of internal controls. Really big process when we talk about large type of companies. The internal controls, something that we have to rely on, and therefore we will be testing the controls directly. One reason we do so is because testing the controls allows us to rely on the controls if the controls are strong, and that allows us to do less substantive testing, which should save us time. If we had to do substantive testing, testing the actual accounts, then and have a high level of testing there, it would take a lot more time than us to be able to determine that the level of controls are high enough that we can do less substantive testing. So that's going to be one of the goals that we have. Then the substantive procedures will be detect material misstatement in transaction class, account balance, and disclosure component of the financial statements. And this, again, is usually what most people think of. If you were to think of an audit and you were just going to jump in and say, let's audit this thing, let's take a look and make sure these financial statements are materially correct, you'd probably say, give me those financial statements and let's just start going right through the accounts, cash, accounts receivable, whatnot. Well, that's basically the substantive type procedures. You may do that in a small type of audit, and that might be somewhat of an effective way to go. But the larger the audit gets, the more we have to depend on the internal controls, because taking that approach would involve of just going straight to the substantive testing the actual account balances, is going to take too much time. So just note that there's always going to be that emphasis, especially here as we're emphasizing the audit of the larger type of businesses, publicly traded companies. And then once you peel that back down to smaller types of companies, you would expect the internal controls to be weaker, and the substantive tests then to be something that you possibly have to do more of. Test of controls include inquiry. So that's going to be the appropriate management, supervisor, and staff personnel who we're obviously going to be asking questions about. That's going to be one of the types of tests of control. As we think of the tests of control, you might want to think about, well, how reliable are these types of things, and start to think, as we think of our detective type work, how high on the list of evidence are these types of things that we're looking at. Obviously, inquiry is something that we have to do because that's going to give us an understanding. But who are we inquiring on? The management, the supervisor, and the staff. And of course, that's also the people that we are judging in some way or giving some type of opinion on as to whether the financial statements are put together well. So note that we have to depend on these things because we have to get an idea of the internal controls. But in the list of evidence, the inquiry as compared to like third-party type of information, something outside the company not prepared by management, would be higher on the scale. So just note that we need to have inquiry, but of course we can't have inquiry in and of itself as usually the only type of evidence for many types of things, especially for the complete audit process. Then we have inspection of documentation, reports, and electronic files, so we can actually go in and inspect. We have observation of the application of specific controls. So when we think about controls, of course, we can inspect the documentation to see if those controls are being done. We can go in and observe. And note, controls are going to be kind of like a bureaucracy. They're going to be a system of things that have to be done, usually things that people might complain about, right? They're going to have more types of tests, more types of separation of duty, more type of documentation that has to be stamped as it goes through, and approval processes happening. We can actually go through the process and see whether or not, and observe whether or not these things are happening. Because note that controls are things that you could eliminate a lot of times in a particular type of transaction, and it may actually speed up the transaction. Not having a separation of duties, in other words, could make it faster to complete the process. However, the risk would be higher that there's going to be some type of fraud or some type of problem, potential problem could happen there. Therefore, we have the internal controls as the businesses get larger. So it's quite possible that the controls are set in place. Good controls are set in place, so they're all mapped out. You have a good plan of controls, but they're not implemented. They've gotten weak. People are not going to the controls because they're shortcutting the controls because they don't see the purpose of the controls. And we would catch that. We could see that if we go through the observation, and that we could clearly happen. We could basically say, hey, these are the controls. You're supposed to have this checked off by this person. There's supposed to be some supervisory check, and you're not doing that. Why? And the explanation could be, well, because that takes more time. But we have to do it because it's going to lower the risk of problems happening. So we can go through and observe that. And we can have reperformance, which is the application of the control by the auditor. So we can actually reperform some of the controls and see if they are indeed done in accordance with our reperformance. Just to double check, take a sample and reperform and double check. A walkthrough is where we're actually going to be tracing a transaction from its orientation to its inclusion in the financial statements through a combination of audit procedures like inquiry, observation, and inspection. So then we're usually going through a few different processes, following something through a few different processes, and using whatever we need to use in order to follow that process from the orientation to where it falls or where it finally ends up on in the financial statements. So here's just some examples of tests of controls examples. This is the internal control. This is the test of controls. So remember, internal controls are things like the company has some kind of bureaucracy, some kind of process that they're having in order to safeguard against problems. Things like fraud, things like theft of the employee, things like misrepresentation or misreporting. of types of things. So they set up these internal controls. We want to know what those internal controls are, so we're going to ask about them. And then they're going to tell us about them, and they're going to try to tell us that they have good, strong internal controls, because that's what we want to hear as the auditor, of course. Then we're going to go in and we're going to test the internal controls to see if not only they know what good, strong internal controls are, that they've mapped out the good, strong internal controls, but that they're actually implementing the good, strong internal controls. So we're going to have to test the internal controls, not the account balances now. We're testing whether or not they're going through the processes, the controls, the checks and balances in their system, which we believe will heighten the ability for them to have financial statements that are not materially misstated. So we have the separation of duties between the shipping function and the order entry and billing. This is a common type of internal control, separation of duties. Well, how can we check to see if there's a separation of duties between the shipping function and the order entry? Well, we could observe and evaluate whether the shipping personnel has access to the order entry and billing. So notice the shipping person shouldn't have access to the order entry and the billing. That's the separation of the two. Now, if they do, it would be easier because the shipping person could do the two jobs at the same time possibly and possibly save time. But the point is that you want two different people to be involved in those different things, so that if they wanted to have theft or some type of problem happen, they would have to collude. And therefore, that's how we can test basically whether or not that separation is taking place. And it's quite possible, again, that it doesn't take place and the control isn't followed. It could happen. And not even that there's a fraud happening or that there's theft happening. They might just say, hey, this control was taking too much time and we took it out. And then of course we're gonna say, well, the internal control needs to be in place so that we reduce the likelihood of fraud. And that's going to go towards whether or not the management is actually enforcing the internal controls that are in place, that they have set up in order to do these things. So credit department personnel, initial sales order indicating credit approval. So are they initialing to indicate that there is credit approval? So we can inspect the sales orders for presence of initials of credit department personnel. So obviously there's going to be an approval process. They're going to stamp it off with the initials of some kind saying that there was a credit approval. We can go through the sample of the sales order and see if the initials are indeed there. So again, we looked at the internal control process. They say that they checked this to see that they had a process for the approval check. And we go through and test the documentation to see not only that they're documenting that as an internal control, but they're actually at least stamping off some of these documentations, giving an indication that they're following through with that internal control. Billing department personnel account for the numerical sequence of the sales invoices. So the sales invoices in a numerical sequence, we can inquire of the billing personnel about missing sales invoice numbers. And so if we inquire the billing department and they say, I don't know, what do you mean about invoice numbers at all, or then that would be an indication that they're not really checking for the missing sales invoice numbers. So they should have an idea of what type of invoice numbers have been misstated and maybe have a list of them possibly. Tell us about the missing sales numbers. Agree sales invoice to shipping document and customer order for product types, price, and quantity. So this is a common type of process and control we're going to have. We're going to agree the sales invoice. So we have the sales invoice to the shipping document. That's when the shipping actually goes out, and the customer order. So we have three documents that should be basically tied together, and we're going to basically want to agree those three documents. How can we check that? We can recompute, in this case, the information on a sample of sales invoices. So these are just some tests that we can take a look at. We'll take a look at more types of tests in the future. These are tests, remember, of the internal controls, an example of them. And then we have the substantive procedures. Now, the substantive procedures are typically what are going to happen later on in the audit, because, of course, that happens after we test the controls. And we'll go through this in the planning process when we discuss this more, but we're going to test the controls to see if they're high or low. Then we're going to determine how many substantive tests we need and go through the substantive tests in as efficient a way as possible. These are usually the longer tests, but also the ones that are most familiar, the ones that we would kind of think about. Again, if you were just going to jump into the audit, you'd probably be starting to think about substantive type testing if you were going to try to test the accounts of the financial statements. So tests of details. tests of errors or fraud in individual transactions, account balances, and disclosures. So we're just going to go right in there. We're going to give me those account balances, give me those disclosures, give me that general ledger, and we're going to go in and start trying to, test these transactions. Again, publicly traded company, a lot of transactions, a lot of things to test. We would like to limit the amount of testing as much as possible. How do we do that? We hopefully can increase, the controls are high and therefore less substantive testing. Analytical procedures, also substantive testing, evaluate financial information through analysis of plausible relationships among financial and non-financial data. Now, the analytical procedures, I would often think of the analytical procedures as the things that you can kind of do more in the office, right? You can basically compare the financial statements last year to this year. You can see if they went up. You can compare it to different type of industries. You can see if there's substantial changes in those type of numbers. So a lot of times when you think of analytical procedures, you're thinking these are the auditors in their own office with the financial statement, basically comparing the numbers, looking for changes in the ratios and whatnot. So as a shortcut, I would kind of think of analytical procedures as the things that the auditor could do in basically their own office, as opposed to other types of tests where they would have to go out to the customers or to the client and actually start digging up invoices and whatnot and looking at physical documentation, possibly start counting things and counting inventory and that type of stuff. So analytical procedures, evaluation of financial statements, information through analysis of plausible relationship among financial and non-financial data. Then we have dual purpose tests. It often makes sense to design audit procedures to conduct both a test of controls and substantive tests of transactions simultaneously on the same document. And whenever we can do this, we're obviously very excited. This is a very exciting thing. If we can have a dual purpose test, in other words, if we could test the controls and do the substantive tests with the same procedure, we're going to try to design the audit to do that as much as possible because that will save us time. You'll recall that we're going to test the controls typically first, test whether the controls are high or low, and then design and think about how many substantive tests we need to do. Those tests usually taking more time, and therefore we want to reduce how many of them there are. So as we think of the tests of controls, however, good planners, as we are of the audits, we're always going to be thinking forward and say, hey, as we're doing these tests of controls, can we also document and do some of the substantive tests at the same time, considering we're digging into these particular areas of work as we think about the tests of control? Anytime we can do that, we do that, because that, of course, will save time. Once we complete the tests of controls, go to the substantive tests. As we go to the substantive tests, we're going to say, hey, we've already tested some of these a little bit because we did that during the test of controls and we documented that out. That's going to save us some time, save us some money, and make us happy. In this presentation, we will discuss materiality determination, or in other words, how to determine materiality. As we go through this, note that we're still really in the planning of the audit stage. And when we break out the audit, we broke out the audit into stages. We're thinking about this in the stages. We had the client acceptance or continuance. We had the preliminary engagement activities. We got the planning of the audit. Then we consider and audit internal controls. Then we go through those audit business process and related accounts, those substantive tests. Then we complete the audit and finally evaluate results and issue the audit report. Important to keep that in mind. We're focusing here mainly when we're thinking about the evaluation of materiality at the beginning of the audit. So as we go through the audit, we have an idea of what those materiality levels will be, allowing us to better plan the audit and then execute that plan through the audit process. So then first, what is materiality? Once again, this is going to be materiality as defined by the United States Supreme Court interpretation. A fact is material if there is a substantial likelihood that the fact would have been viewed by a reasonable investor as having significantly altered the total mix of information made available. So let's go through that a little bit again. We're going to go through this again. We got a fact is material if there is a substantial likelihood. So again, that word substantial likelihood is going to be a key term because it adds some ambiguity. What does that exactly mean? We don't know exactly, but we can get some kind of idea with that wording, that the fact would have been viewed by a reasonable investor. So similar to that term we always hear in the law, reasonable person, reasonable investor, common sense type information is kind of what we would think our mind goes towards with that. But again, some ambiguity in terms of what exactly materiality means in terms of a quantifiable number as having significantly altered the total mix of information. And I would interpret that to mean that this misstatement that we're looking at, this misstatement that we're thinking about, would tell us or have us alter the total mix. In other words, in our case, usually the total financial statements or our opinion of those total financial statements due to the problem that is there, typically a problem being an error or something that is omitted. So how do we apply then materiality to an audit? First of all, we're going to determine the overall materiality. And this is typically going to happen within the planning stage, the overall type of materiality. So we want to think about materiality as a whole, as a total on the total financial statements. Then we're going to think about determine the tolerable misstatement. As we think about tolerable misstatement, note what we're doing here. We're saying this is the materiality level. When we consider the materiality level, we are thinking about then conversely, the level of misstatement then that would be tolerable. We're actually thinking about how much misstatement would be okay or under the threshold of a material misstatement, which would not be okay. So once we have the materiality level, we can determine tolerable misstatements. As we do so, we're looking at the allocation of materiality at individual account and class transaction levels. So now we're thinking about materiality not at the overall level, not at the financial statements as a whole, but at the individual accounts and the transaction levels. That's going to give us a more defined kind of system that we can apply to actual audit processes, because when we audit the financial statements, we will be breaking that into the individual account and transaction level. Then we can evaluate the auditing findings, and that happens near the end of the audit process. So we're going to say, hey, what's the overall materiality level? Then we're going to determine the tolerable misstatements, and we're going to do that on the individual account type levels. We're going to go through the audit. Then we're going to evaluate. We're going to take these tolerable misstatement levels and take the results of our audit, evaluate the audit findings. That's going to happen towards the end of the audit, where we're going to take what we found within the audit, compare it to what the determined overall materiality level is. Let's think about that in a bit more detail. Overall materiality determination. Quantitative benchmark used to establish overall materiality includes. So this is the overall level. This is what happens at the beginning. We're kind of thinking of the full financial statements as a whole. So we need benchmarks to do this. So when you're thinking about what would be a materiality level that we can think for the financial statements as a whole, we're thinking about those large benchmark numbers. And you could just imagine, well, how would I go about this? How would I go about thinking about what's a material misstatement on the full financial statement level? Well, the big numbers you'd be considering then is income before taxes. So we might think about income before taxes or net income before taxes. We might think about the total assets. So when we're talking about tolerable misstatement or types of misstatement, we're thinking about misstatements that might be material on the entire financial statement. We might be using total assets then as some type of format to calculate what might be material and what might be not material. Notes receivable, we might be using net assets, or we might be using total equity, and obviously total equity assets minus the liability giving the total equity. So these are the type of big type numbers that we would think of as we would be considering whether or not something would be a material misstatement or not. Now, once we have the quantitative amounts that we're going to be used to determine the overall materiality, they may be lowered by qualitative factors. There might be qualitative factors, in other words, quantitative, qualitative. Quantitative, those numerical factors, the ones we really want, because they're going to be a lot easier for us to work with for numerical factors, and qualitative factors that we can't put a number value to as easily, but which we might take into consideration. So the qualitative factors may include material misstatements in the prior year. If there were material misstatements in the prior year, that may affect our materiality, our overall materiality determination in the current year. High risk of fraud. If there's a high risk of fraud for whatever reason, possibly they're in a typical type of industry or something like that that has a high risk of fraud, then that could affect our materiality threshold as well. Potential loan covenant violations. So if there's any loan covenant violations, that could be a problem. Small amounts that could cause the entity to miss forecasted revenues or earnings, or affect the trend in earnings. So anything that's good, if there's a small amount, that could be a higher risk, and therefore materiality would be affected. The entity is in a volatile business environment, has complex operations, or operates in a highly regulated industry. These are also areas where, once again, we may say, hey, we're going to adjust the materiality level because of those risk factors. Tolerable misstatement. So now we're moving to tolerable misstatement from overall materiality. Tolerable misstatement, the amount of planning materiality allocated to an account or class of transactions. So now we're talking about not the entity as a whole, but we're talking about the account and class. We're getting down to the more granular type level here. Combining tolerable misstatement is usually greater than planned material for the following reasons. So at the end of the audit process, we're going to look at the tolerable misstatement, and we're going to think about the tolerable misstatements and compare them to the total misstatement for the total financial statement. So in other words, you might think that if we had the tolerable misstatements and we were to add up all the tolerable misstatements per account, it should equal the total misstatement. But that's not typically the case. Typically, the tolerable misstatements, as we allocate them to the accounts and classes, if we were to add them all up, would still be less than the total misstatement that we would be looking into for the full financial statement for the full audit for the following reasons. Not all accounts will be misstated by their full tolerable misstatement. So we're going to set a tolerable misstatement for each account, and our hope, of course, is that as we audit these accounts, that they're not going to be at the full tolerable misstatement, and therefore when we add up the tolerable misstatements, they'll be less than the overall misstatement for the full financial statements. The audits of individual accounts are conducted simultaneously. Materiality is often small fraction of the account being audited, and planning procedures will be enough to identify significant misstatements. So materiality is often a small fraction of the account, and we're expecting that our planning procedures will be enough to identify the significant misstatements, of course. When errors are found, we usually have additional testing to that particular account, which should reduce the amount as well. So typically at the end of the audit process, when we think about adding up the tolerable misstatements, they should be less than the overall materiality level. Misstatement and audit findings. As audit evidence is gathered, the auditor aggregates misstatements from each account or class of transactions. So we're going to take these misstatements, we're going to aggregate them together as we go through the process. So we're imagining in the timeline, we had the overall misstatement, or we had the materiality for the audit as a whole, the financial statements as a whole. Then we thought about each individual account as we go through each individual account and thinking and comparing to the tolerable misstatement. We will aggregate the misstatements from each account and class as we go through the auditing process. We're going to consider the effect of misstatements not adjusted in the prior year. So we're going to look at the prior year, look at the misstatements from the prior year. We're going to compare the aggregate misstatement to the overall materiality. Then we're going to look at the aggregate, meaning combining together all the misstatements, comparing that to the overall materiality level we determined at the beginning of the process. If the aggregate misstatement is less than overall materiality, the auditor can conclude that the financial statements are fairly presented. So then we're going to add up the misstatements, and we're going to basically say, is this less than the materiality level? If it is, then we can say that the financial statements are presented free of material misstatement, obviously including some component of audit risk. And so that's going to be our process. So note, again, the goal here as we put this together is not to say we're going to eliminate all risk, all problems, all errors or problems, whether it be due error or fraud. Our goal isn't to do that. It's to set a reasonable level, and then we're actually going to work, of course, that reasonable level into the audit process. We're going to plan for what that level of materiality will be at the beginning. We're going to then break that out by class, and then we're going to add that up and check it out and compare it to what the overall level was at the end of the audit process. In this presentation, we will discuss audit risk model. We're going to start off with what audit risk is. So what is audit risk? Risk that the auditor expresses an incorrect audit opinion when the financial statements are materially misstated. So for example, if we were to give the most common type of opinion for the audit, a clean opinion, an unqualified opinion in essence expressing that the financial statements, in our opinion, are put together in accordance with whatever standard they said they were going to be put together with, for example, generally accepted accounting principles. If that was the case and there was a material misstatement from that standard, from generally accepted accounting principles, then we would have a material misstatement that would be against our opinion of it, and our opinion would therefore be wrong. There's always a risk for that to be the case, even if we were diligent, and that's what we're going to put into our system. We're always going to be saying, hey, there is a risk that we could do our due diligence as a competent auditor, go through the audit, and still there be a material misstatement in the financial statement that we did not detect, even though we issued a clean opinion for it. What we're going to do is never say that that's going to be eliminated. That risk is never eliminated, but we're going to try to make it as low as possible. So we want to consider the audit risk, the risk that we have, say, a clean opinion or something like that, and there was a material misstatement that was not detected. We want to discuss what that is, and of course set that risk level to a low and acceptably low level. So we can think of that on the assertion level in terms of the financial statement level, at the financial statements as a whole, as well as the individual account balance or disclosure level, when we're actually breaking that down into a more granular level of the actual accounts and the disclosures for them. The audit risk model then is going to include some key definitions. Those definitions being inherent risk, which we're going to represent with IR, control risk with CR, and detection with DR. We're going to put this information into more of a formula type format. Note as we do so, we start to think that this is a very defined type thing. We see a formula, we're saying this is an exact process, so that's what goes into many people's minds when we see a formula. The number is what it is. Every auditor would come up with that exact same number and the exact same formula if they follow the same procedures. Not necessarily the case here. We're going to take this. This is more of an art and science as opposed to just a science. We're going to take this information and we're going to put them into a formulaic format. That's going to help us to conceptualize the interplay between these concepts, inherent risk, control risk, detection risk, so that we can think about the audit risk overall as well. Let's now consider these individually, starting off with inherent risk. Inherent risk, possibility of an assertion in an account or disclosure to be misstated due to error or fraud that could be material before consideration of any related controls. We're thinking about an assertion in an account or disclosure, so we're considering actual accounts. We're on that granular level, and then we're considering the removal of controls. So we're going to say, what if there are no controls here? We're going to take out the controls because, of course, the controls within the organization are designed in order to detect types of risks. So we're going to say, what if we didn't have any controls, and this particular assertion about a particular account, what level of inherent risk is there? And I would think of this as a risk that just basically is in part, or it's part of the actual thing. It's inherent to it. It's already embedded within it. So for example, if we're thinking about something like cash, and if we took out the controls over cash, then cash is going to be more inherently risky. Why? Because it's very liquid. Cash is liquid, therefore it's going to be higher probability that there will be fraud or something like that, because it's more susceptible to something like fraud. If we took that same type of thing, we took out the controls and we considered like a building, the office building, well, there's less inherent risk with relation to the office building because it's less liquid. It's less likely that someone's going to take that office building, put it into their back truck, and run off with it. That's not typically going to happen. So there's less inherent risk when we think of, say, an assertion with regards to whether or not the office building is going to be stolen, as opposed to whether we think about cash because of the liquidity of it. So that's what we're going to be thinking about, the kind of concept that we would think about with inherent risk. We're going to say, hey, if we remove the controls, we consider the specific assertion with regards to this particular account and disclosure, what would be the risk related to it? And you can see that there would be drastic differences with different types of things. If we have different types of company with different types of inventory, people that sell things like diamonds that are highly valuable and liquid, possibly, or easy to steal, would be more risky, more inherently risky than someone that sells something of a low value, like lawn fertilizer or something like that. It would be a lower value type of item that could still be theft. It's still worth something, but it might be less inherently risky when you consider the inherent risk between the two of them. What about control risk? That's going to be the possibility that a material misstatement that could occur in an assertion about an account or disclosure will not be prevented or detected and corrected on the timely basis by the organization's internal controls. So control risk, now we're going to be putting the controls back in place. So when we consider the control risk, the possibility that there is a material misstatement that could occur in an assertion about, once again, the account or disclosure level. So now we're at the account or disclosure level. We put the controls back in place, and we're trying to think, okay, now that the controls are in place, what's the probability or the risk that the controls aren't sufficient enough in order to basically catch any kind of misstatement that could be put in place? So inherent risk, no controls. Then we put the controls in place. So if we're thinking about something like cash, what are those controls? What are the risks that the controls related to cash are in place? Now, obviously, if you think of something like cash, you would think the inherent risk is very high. The company then would have some system of controls, of course, to be put in place in order to account for the fact that the inherent risk is high. And the question then is, are the controls enough to detect the risk? Or what's the likelihood that the controls would not catch a risk? And we would think about the controls again on an account level as we go through the accounts inventory, cash, different types of accounts with relation to the controls. Then we have the detection risk. That's going to be the risk that the material misstatement will not be detected by the procedures performed by the auditor to reduce audit risk to an acceptable level. This could result from inappropriate audit procedures, misinterpretation of audit evidence, or failure to recognize a misstatement. So then detection risk is our risk. It's on our level. Now we're at the audit. So note that the control risk or the inherent risk aren't really our responsibility. It's not our, whatever industry they're in might be more risky than another industry. That's inherent to whatever industry and the accounts related to it. The control risk are their controls. They've implemented them. The company has, management has. That's their responsibility. Detection risk, of course, is our responsibility because that's going to be the risk that the material misstatement will not be detected by the procedures performed by the auditor to reduce the audit risk to an acceptable level. So now we're thinking about, what type of procedures are we putting into place in order to basically detect any kind of problems, because our job, of course, is to issue an opinion on the financial statements. So we're going to try to consider what the detection risk for us would be that there's some type of misstatement that our audit processes do not detect. Now, the interesting thing here is that we are going to vary our detection risk based on, in essence, the formula. So our detection risk could be a result of these items: inappropriate audit procedures. So if we set up our audit inappropriately, of course, misinterpreting audit evidence. So maybe we have the evidence, but we misinterpreted it, and that resulted in us not detecting a material misstatement. Failure to recognize a misstatement. So maybe there was one there and we just missed it. We've just failed to recognize it. It's possible. So the audit risk model then is going to be in this kind of formulaic type of equation. We've got the inherent risk and control risk is going to be equal to the risk of material misstatement. So when we consider the inherent risk and the control risk, that's going to be equal to the risk of the material misstatement. And if you think about that, again, these are the things that are basically involved by the company, right? The company has control over, one, the inherent risk, the business that they are in, the environment they decided to take on. It's inherently risky, or whatever the inherent risk level is. And then the control risk are the controls that the company put in place in order to mitigate whatever risk model that they have taken on within their business model. That, of course, is going to equal the risk of the material misstatement in the financial statement. Notice detection risk isn't in this process because that's the risk of us detecting outside our audit process, detecting the material misstatement. This is basically the risk that a material misstatement is there. Then we're going to put in the audit risk. The audit risk is going to be equal to the inherent risk, the IR, the control risk, the CR, and the detection risk. So this is basically going to be our formula to determine, in essence, or think about what total audit risk is. Or we can consider it in this format. Audit risk is going to be the risk of material misstatement, because, of course, the risk of material misstatement includes both inherent risk, control risk, the two things that are going to be the factor of, in essence, the company on the company side, and then the amount that's on our side, the detection risk, our audit. Did our audit test it? So this is basically the responsibility of the company being in whatever industry they are in, inherent risk and the control risk. And then this is on our side, the actual audit process to detect. The auditor also needs to consider engagement risk as they consider engaging with different clients and taking on different types of engagement, different types of auditors. The auditor's exposure to financial loss and damage to professional reputation, that's going to be the engagement risk. So engagement risk, auditor's exposure to financial loss and damage to professional reputation. This could be a result of, say, litigation, other events arising that are connected with the financial statements. So if we audit the financial statements, we have an opinion of the financial statements, then we're done with that particular engagement. But of course, those financial statements are going to be used within some kind of business process. That's why we did the audit. If it's a publicly traded company, then investors are going to be investing in those financial statements. It could be an audit for some other reason for non-publicly traded companies, such as to get a bank loan or something like that. So if there are other events arising that are connected with the audited financial statements, the financial statements being used for some kind of business process, then that could be a problem for us, or that could cause potential problems or be some source of a liability in the future, engagement risk. And then we have any adverse publicity. So if there's some kind of adverse publicity, say we're auditing a company that maybe we have a clean opinion of the audit, but publicly they're not popular for whatever reason, that could cause the auditing firm problems as well. So if we're talking about publicly traded companies, they could have a high degree of presence in the public. And again, even if their financial statements are clean, the public impression, of course, will rub off as well on possibly the auditors that are working with, that are doing business with that entity. Now we'll take a look at the steps in the audit risk models. The audit risk model typically will include, we're going to set a planned level of audit risk. So when we think about audit risk, we're actually going to set the audit risk. So typically we're going to say, hey, this is the audit risk that we are going to set, and then we're going to assess the risk of material misstatement. So the risk of material misstatement from the company side of things is what they're in control of. That's the inherent risk and the control risk. And what I mean in control of, inherently, things are inherently risky. No one's in control of that, but they chose to be in that industry, and therefore they are basically responsible for taking on that business control, inherent risk, and the control risk, their internal controls. Then we're going to determine the appropriate level of detection risk, which is our responsibility now. So here's the formula for audit risk. Note that we're going to set the audit risk, however, we know, and then we're going to determine inherent risk and control risk. And then we're going to be looking for, with our formula, with our analysis, with our thought process, our equation, the detection risk. That's the risk that of our audit detecting a material misstatement. So detection risk then is going to equal the AR, which is going to be the audit risk, which we're going to set. We're going to know that. Well, then we've got the IR, which is the inherent risk, and the CR, the control risk. These are going to be the known items so that we can set the DR, the detection risk. Now, the thing that's kind of funny about this, of course, is the thing that's a little bit unusual when you start to think about this model and questions about this model. It's easy to get confused about what the detection risk should be. Should it be high or should it be low? And how should we set the detection risk with regards to this model? In other words, if we think about the detection risk, you're thinking about the risk that we're going to perform the audit, and the audit is not going to detect a material misstatement. We want that risk to be low. We want to have a low detection risk. Now, you would think that we would want the low detection risk all the time. We would always want to have a low detection risk, you would think. However, note we want to have an interplay between the detection risk and the other factors. The goal of this detection risk is to help us to put together the audit procedure in such a way that it's most efficient. And if we can rely on the internal controls, and if we're in a less inherently risky situation, then you would think that we can do less of the procedures, and that would mean that the detection risk would actually go up, but we would still be okay given the fact that we're in a less risky environment and we have internal controls that are sound. So if we think this out kind of numerically or from more of a mathematical type of standpoint, we've got the audit risk. This is going to be the overall audit risk. Then we have the inherent risk and the control risk. So the internal control. So remember, the internal control risk represents the fact that do we have sound internal controls, and the risk that the internal controls would not be catching a material misstatement. So if we had good internal controls, the company had good internal controls, then you would think that the control risk would be low. We'd have a low risk that there would be an error that the internal controls wouldn't catch. Inherent risk, if we're in a less risky environment, you would think that we would then have less risk, that there would be just inherent risks due to the nature of the type of business that we have. So if these two risks are low, then this equation, the numerator is going to be lower. It's going to result in a higher number that we would calculate then for the detection risk, which would make sense because, of course, if we had sound internal controls and we're in a less risky environment, then we can do less testing in our audit and still be okay. So we actually, in terms of the audit procedures, we actually kind of want this to be high. Why would we want this to be high? Because if this is high, we're doing less work. If this is high, we're depending more on the fact that we're in a good environment or not a really risky type of environment, and we are saying that the controls are sound. The business we're working with has sound controls that are more likely to catch any kind of problems, and therefore we can set our detection risk higher, do less work, and still be okay within the audit process. And we're hoping for that to basically be the case, because again, these large publicly traded companies, we have to depend to some degree on the internal controls. With smaller companies, we would expect the internal controls to be less effective, and therefore this risk to be higher. And if this risk is higher, then we're going to have to set our detection risk lower, which means we would do more substantive testing. So you can kind of think through this equation. What if the inherent risk was high? What if the control risk was high? What if it was low? What would happen then to the detection risk? Just remember that when you're thinking about the detection risk, you're thinking that if it's high, it's almost a good thing, because that means we're doing less work and depending more on the controls and just the environment. If it's low, that means we're depending less on the controls, and we're probably then going to have to do more of the substantive testing. So now there are some limitations to the audit risk model. So these are the audit risk model limitations. Model is based on judgments and assessments. Therefore, judgments and assessments must be good for the model to be good. So notice this isn't an exact science. Once again, we have judgments and assessments involved to help give us a mental image on how we can compare these concepts. And of course, that means that the outcome, what we get from this model, is only as good as the judgments and assessments that we make as we put the model together. In this presentation, we will discuss understanding the entity and environment. When we want to get an understanding of the industry and environment, we are considering factors that include nature of the entity, industry regulatory and external factors, internal control, objectives, strategies, and business risks, and entity performance measures. Auditor will obtain information to understand the nature of the entity. So what type of information are we going to get? We're going to gather this information to understand the nature of the entity. We want to gather information related to business operations, ownership and governance structures, investments and investment activities, financing and financing activities, and financial reporting. So we're going to gather information related to these areas. We're going to go into a few of these areas in more detail, starting with the business operations. Business operations, the type of things that we're going to gather in order to understand the entity, includes revenue sources, products, and services. So what obviously do they do for revenue sources? What products and services do they have? That's going to be a primary important type of activity when we're trying to understand the nature of the business. Conduct and operations. We want to know who their alliances are. Joint ventures, if they have any joint ventures. Outsourcing of activities. Do they outsource some of their activities? Are they key activities? Are they very important? How dependent are they to people like joint ventures, alliances, and other people involved? Because that'll assess some of our risk factors with regards to them. Then we have the product facility locations. Obviously, where are they located? How many facilities do they have? Where do you produce these products? Where are they located at? Warehouse and offices locations. So we also want to understand where the offices are, where the inventory is stored, where the office locations are at, where's the admin done, business done. Are there any key customers? Who are your key customers? If they're in a type of industry where we have some very large customers, we want to make sure that we understand that, because larger customers or consolidation of larger customers could be a concern, because then we want to make sure that they're solid, because if they're not, that could be a problem. Key suppliers is the same thing. Do we have large suppliers? I mean, it's a lot of the stuff that we sell coming from a particular supplier. If so, the company is obviously very dependent on that supplier, and that's going to be a significant factor to consider when considering the environment and risk related to it. Investment and investment activities. So we're going to understand the entity with regards to investment and investment activities, asking questions or looking into factors including recent or planned acquisitions or divestitures. So what type of investments or divestitures might be planned or made? Of course, we're looking for usually substantial material type of items. Investments and dispositions of securities and loans, capital investment activities, as well as investments in partnership and joint ventures. Again, of course, we're typically looking for the larger scale type of items here when we're considering the business as a whole, considering material type of factors. Financing and financing activities. So we're trying to understand this business. What kind of financing do they have in order to help them generate or push forward with their operations? What kind of financing activities do they do? So we want to know if there's any subsidiaries and associated entities. So do they have any associated type of entities related to them that could be involved in their financing structure? Debt structure. So what kind of debt structure do they have? And we're going to want to know the leasing arrangements, if any. Related parties. Again, related parties can be a significant factor with regard to financing and financing activities. Use of derivative financial instruments. Are they using derivative financial instruments? Because, of course, that can add to some complexity with that type of instrumentation that we may need, actually some specialization in order to fully understand that type. The auditor must identify and understand the entity's objectives, strategies, and use to achieve those objectives, and business risk associated with those objectives and strategies. So you'll note as we get this understanding of the business, as we go through these factors and understand them better, this is the overarching objective we're looking into. What is the entity's objective? Obviously, revenue generation, we would suppose, would be part of the objective. But what's their strategy for this objective? Strategies used to achieve the objective. What are they putting in place in order to get to that particular goal? We need to have an understanding of that so we know the nature of the business and therefore can better audit it. And then we want to know the business risk associated with those objectives and strategies. So what are the risks of the objectives in and of themselves, the industry, where they're at, and the risks of the strategies that they are implementing? Are they implementing strategies that are more or less risky as they try to achieve certain types of objectives? All these can be factors for helping us to assess what type of testing we need to do within the audit engagement. In this presentation, we will discuss an auditor's assessment of internal controls. As we do this, recall that the internal controls are something that we're typically going to be looking at, we're going to be assessing before we jump into the substantive type test, before we start taking a look and say, just give me the trial balance, let me start testing each type of account, let me go straight through the balance sheet accounts, the income statement accounts. We want to first test and assess internal controls to help us decide and hopefully limit the types of substantive testing that we will then do. So that's kind of where we are in the audit. We have planning, and then we have the assessment of the internal controls, typically that then being done before the substantive testing. Auditors should understand and assess effectiveness of internal controls in order to identify types of potential misstatements and factors that affect the risk of material misstatement. So as we look through the internal controls, we're going to identify those areas where the internal controls are weak, or possibly where there's some type of combination between an inherently risky thing as well as possibly weak internal controls. That's then where we're going to spend more of our time as we process through the audit, doing more substantive type of testing. An understanding of the effectiveness of internal controls helps the auditor to in designing appropriate audit procedures. And that, of course, is the goal. Note that this is basically, we're in planning, then testing the internal controls. And then once we test the internal controls, that will help us, in essence, to plan, in essence, for the actual substantive testing that we will do at that point in time or after that point in time. Risk of material misstatement. That, of course, is what we're looking for within the audit. We want to give an opinion that the financial statements are reported in accordance with whatever standard they're given to be reported in, possibly generally accepted accounting standards. We're looking for those material types of misstatements, which can take two forms. One, errors. Two, frauds. So when we think about the auditing process, remember, we're looking for the material misstatement. And we're not looking specifically necessarily as a whole or in general what the source is or what type of error it is. Now, we'll get into some specifics, but in general, the goal of the audit is to see that the financial statements are in accordance with whatever standard and free of any material misstatement, whether they are a result of errors or fraud. In other words, our goal isn't just to look for fraud or criminal type of activity, it's to give an opinion on the financial statements. That said, however, we want to consider the two types of things that could lead to a misstatement and consider what factors are involved within them. And if there's going to be a larger risk for something such as fraud as opposed to errors, or errors as opposed to fraud, then of course we want to take that into consideration as we design our tests. So errors are going to be unintentional misstatements of amounts or disclosures in the financial statements. And this is quite possible, obviously, when we put together a large process of the financial statements in accordance with some system, generally accepted accounting principles, using accrual standards, revenue recognition, and expense recognition, or the matching principle. It's quite possible that we have some issues, some problems, some errors that could be material, and we want to basically have our audit process set up so that we can detect those errors and make adjustments for them. Fraud is the intentional act by one or more among management, those charges with the governance, employees, or third parties involving the use of deception that results in the misstatement in the financial statements. So fraud is going to be intentional, errors unintentional. Obviously, the fraud is more concerning to us because it's going to be an intentional error. Notice that we are less concerned with fraud. We're going to catch the fraud, but we're less concerned with it when it's a lower level of fraud. So if it's a lower level of employees that are stealing from the company and we find that within our audit, one, it's very likely that that won't be as material or material to the financial statements because although it's theft, although it's fraud, it's lower on the scale, and therefore it may not be something that a third-party person who's depending on the financial statement would alter their decision or not. And if we were to take action on that scale, we could then go to the upper level of management, discuss that with them. They can basically fire the employees involved and everything is okay. We're more concerned, of course, with the upper level type of fraud, and that happens on the upper levels. Upper level management is committing fraud, especially fraud intentionally trying to deceive on the financial statements. That's going to be more of a concern, a problem, because they can go around certain types of internal controls, and that could also be more difficult to detect within the audit, which again is one of the main reasons when we go through the assessment process to pick up the clients, we want to make sure that we're picking up clients that have integrity, and therefore we can rely on, hopefully, and trust the internal controls and the management's implementation of them in good faith to some degree, of course. Examples of misstatements: inaccuracy in gathering or processing data to prepare financial statements. So we had a problem with the gathering of the data. Omission of amount or disclosure. So it might just omit something altogether. And when we think about these types of things, remember, your skepticism is on the company trying to look better as opposed to worse typically. So when we think about omission, we're thinking, well, maybe they omitted something like liabilities on the financial statements, didn't report something like liabilities somehow, or expenses possibly, as opposed to omitting a large asset that they could have put on the books or something like that. Disclosure that is not presented in accordance with generally accepted accounting principles. So it's quite possible that there's some type of disclosure that wasn't on the books in accordance with the standard that we're measuring these towards, oftentimes being generally accepted accounting principles. Incorrect accounting estimate caused by overlooking or misinterpreting the facts. So we know that we have accounting estimates within accrual accounting. If there was an inaccurate type of estimate, then because facts being overlooked or misinterpretation, that's another cause. Fraud includes intentional misstatements. Now, the fraud components or areas of fraud, the two areas of fraud would be fraudulent financial reporting and misappropriation of assets. Now, the misappropriation of assets, if we're talking about something such as theft, misappropriating assets, oftentimes that you're talking about someone that's going to be lower on the chain in the organization. And again, that seems really, it is bad, it's theft, and so, but it's going to be easier for us to fix once found. Once we see the theft, if it's going to be someone lower on the chain, then possibly, again, it's probably not something that's large enough that may not even be material to the financial statements. We can report it to the upper level of management. They can fire that individual or look into it. They can reassess the internal controls, whatever needs to be done, and everything pushes forward as we would expect. If the fraud is in the financial reporting, that means there could be an intentional deceit in the financial reporting, possibly trying to deceit in terms of the audit as well, because obviously if they're reporting the financial statements, saying that they're reporting them in accordance with some standards such as generally accepted accounting principles, are intentionally not reporting them in accordance with that standard and trying to go through the audit with us as the auditing firm, representing that they are, when we're specifically giving an opinion that whether or not they are or not in accordance with this standard. That's of course more concerning to us because it's on the upper levels of management, and that type of fraudulent misstatement of the financial statements could be significant to the financial statements. And the reason that's such a big deal for publicly traded companies is because other people are dependent on those financial statements. So although theft seems kind of worse in if someone was actually stealing money or inventory or something like that, it's usually at a much smaller scale than a fraudulent misrepresentation of the financial statements happening at the upper level management, distorting the financial statement, resulting in facts that could result in people investing in types of companies in such a way that they would not otherwise do so. So again, the upper level management, usually that's the type of fraud that we're most concerned with, of course, with the auditors. Misappropriation of assets involves the theft of an entity's assets to the extent that the financial statements are misstated. So if we have misappropriation of assets, note in the audit, any type of misappropriation of assets, if we see theft or something like that, we can pursue that and inform the proper people within management about it. But of course, our goal within the audit is to look for those types of things that are going to have a material impact on the financial statements. That's the goal of the audit. So our audit isn't generally to find possibly theft of the employees if it's for the opinion on the financial statements as a whole. The theft of the employees isn't our main goal. But of course, if the theft gets to the point that it's going to be causing a misappropriation or misrepresentation in the financial statements, then it falls within the scope of our financial statement, and our financial statement testing hopefully will be enough to pick that up. So this could involve the theft of assets, so actually stealing assets of the company in some degree. And again, if you're stealing something like staples or something like that, if the audit was to pick that up, could report that, but it's probably not large enough that it would actually have an impact on the reporting of the financial statements, considering materiality levels. Now, if there was large-scale theft of assets of some kind, then of course, at that level, we should be having our designing of the audit to basically pick that up. Paying for goods or services not actually received by the company. This is a common type of theft where basically there's payments that look legitimate, but they're paying for goods and services that aren't really there. And part of this would be something that might be able to be catched by a higher degree of internal controls. Not the proper verification within the internal controls could result in a type of theft where you would have people paying for services that aren't actually there. Embezzling cash received. So that would be another form of theft, of course, embezzling the cash received. Fraudulent financial reporting includes falsification, manipulation, or alteration of accounting records or supporting documents used to prepare financial statements. So we're actually taking the documents and we're falsifying the documents. Possibly someone or within the management is falsifying the documents, manipulating the documents in some way, altering the documents. Notice that this type of manipulation would have to be very conscious if we're actually if the company is creating a falsification or a manipulation or actually taking documents and altering them. That is a very deliberate act basically to deceive. And usually it's to deceive on basically the higher level, because it would take the higher level of management to really go through normally and manipulate the documents in that kind of format. Intentional omission from or misappropriation in the financial statement of events, transaction, significant information. So if they were to actually say that they're going to omit activities that are happening, possibly say a loan or something like that or happen, or some type of liability on the books or something like that. Again, something that you would typically see in the upper level of management, because the types of things that would be omitted that would have a significant impact on the financial statements are those that aren't typically the day-to-day type of transactions, but the larger type of transactions, those that would have more direct control by the upper management. And also, of course, the upper management can then intervene as well within the internal controls to do something such as these types of activities. Intentional misapplication of accounting principles relating to amount, classification, manner of presentation, or disclosure. So they could basically alter what the generally accepted accounting principles are, some types of misappropriations that have happened in the past. For example, estimates. Anytime when there's an estimate, they can alter, think about altering the estimate to be to manipulate the data. For example, they could take the assets of the company and not depreciate them according to what would be appropriate depreciation, and therefore result in assets that are overstated and possibly the expenses that are understated. Similar process could be done with allowance for doubtful accounts or something like that, understating the allowance for doubtful accounts, overstating then the net accounts receivable. These are types of things that could be done within the manipulation of the accounting using estimates. So anytime you see some type of estimate, estimated value of the assets, estimated value of liabilities, estimated depreciation, estimated allowance for doubtful accounts, those are areas where it's possible that management could try to manipulate the data in such a way that it's significant, that it would have an impact on decision makers of the financial statements. In this presentation, we will take a look at a general type of response strategy when responding to the risk of material misstatement. Remember, our goal here as the auditor is to take a look at those financial statements, give an opinion on the financial statement to see whether they are in accordance with some type of standard, typically being generally accepted accounting standards. Therefore, we are looking for those items that are going to be material misstatements, material deviations from generally accepted accounting standards, and we want to think about the thought process of responding to the risk of those material misstatements. Here's a flow chart that we'll go through that we can actually visualize basically the thought process as we think through a material misstatement. So we're going to assess the risk of material misstatement at the financial statement and assertion level. So we have a risk of a material misstatement. We're going to check them that at the financial statement level as well as the assertion level. We're going to start with the financial statement level because if there's risk, if we look at this risk and if we say that this is something that can have an effect on the financial statements as a whole, our end goal, if we're saying that there's going to be a material misstatement or there's a substantial risk of material misstatement at the financial statement level, then we could take a look at it at that level because that is our objective to give it an opinion on whether or not the financial statements are free of material misstatements. So do these risks relate perversely to the financial statements? If yes, we're going to develop an overall response at the financial statement level. Now, if the answer is no, then we want to consider this at the assertion risk level. And you can think of this at the more granular level. So we could say, well, if it's not at the financial statement level, that this risk we think that's going to have a material impact on the financial statement level, we still want to consider whether it has an impact on the assertion level. The assertions, individual assertions by management. Recall that we went through basically the types of assertions that management has. We want to test those specific assertions. And even though some type of misstatement may not be something that we're going to say, hey, this has a material impact directly on the financial statement level, we still want to consider whether it has an impact on the assertion level, because we're going to set a misstatement threshold or tolerable misstatement threshold per assertion. And so we still want to consider basically any kind of risk or material risk at that assertion level as well. Determine what might go wrong at the assertion level, and then design audit procedures for the assertion level of risk at that point. Auditor's response to the risk assessment. Auditor may do the following to respond to financial statement level risk. So the financial statement level risks, this could be the response of the auditor. Assign personnel with more experience or specialized knowledge. So if we see a risk, financial statement level risk, what can we do about it? Part of the plan we might want to put in place as we go through the auditing process is to say, hey, we're going to put more experienced personnel or more specialized personnel. We're going to put people that have more experience in the auditing process in general, or possibly people that have more experience with a particular set of problems in a particular type of audit we're doing, possibly problems related to a specific industry or problems related to a specific type of activity that is within that particular audit. Review selection and application of accounting policies to identify bias that may create a material misstatement, and add elements of unpredictability in the selection of audit procedures. In this presentation, we will discuss the evaluation of audit test results. At the completion of the audit, the auditor should evaluate whether total misstatements cause the financial statements to be materially misstated. So we can imagine our auditing process here. We're starting off, we're planning the audit. As we plan the audit, we consider what misstatement would be. What would be a material misstatement? Our goal here is to give an opinion. Hopefully that opinion is that the financial statements are free of material misstatements. Therefore, we need to know what is or what would constitute a material misstatement. As we think about what would constitute a material misstatement, we're actually also considering what is a tolerable level of misstatement. What level of misstatement then would be tolerable at the financial statement level? Then as we go through the audit, we're breaking the audit down into individual, basically accounts, assertions, transactions. We're considering at the assertion level what would be tolerable misstatements at the assertion levels as we go through that testing. At the end of the audit process, then we're imagining now ourselves at the end, we're going to evaluate whether the total misstatements, so we're considering the potential misstatements as we go through the auditing process, whether they cause the financial statements to be materially misstated. So then we're considering back at the complete financial statement level, taking the financial statements as a whole. If we add together the total misstatements that we're basically looking through as we go through the audit on the assertion level, would they add up to be materially misstatement at the financial statement level as a whole? If financial statements are materially misstated, what if that is the case? What if the financial statements, what if we look at it and we say the financial statements are materially misstated? Is there anything we can do at that point? Because of course we don't really want to issue anything other than basically a clean opinion, an unqualified opinion, if we can avoid it. That's basically the objective. We want to be able to say, hey, we've got good clients, we've got honest clients. The clients have said they put their information together in accordance with generally accepted accounting principles. We tested the assertions, and they did indeed do as they said and put the financial statements together in accordance with generally accepted accounting principles. If that's not the case, then we're going to request management to eliminate the material misstatement. So if we see a material misstatement, it's quite possible we could say, hey, and it could be something that's not fraud or anything, of course. It could be something that's an error, some type of material misstatement. We can say, hey, we would like you to, correct this, eliminate the material misstatement, make the adjustment that needs to happen, and to be in accordance with generally accepted accounting principles so that we can give an opinion that the financial statements are represented in accordance with generally accepted accounting principles. If management does not make needed adjustments, the auditor will issue a qualified or adverse opinion. And this could happen if management says, I'm not going to do that. It might be the case, again, it might not be the case where there's basically fraud happening here. The management might have a reason and say, hey, I think that it should be represented in this way for one reason or another. And we're going to say, well, look, we have generally accepted accounting principles, and generally accepted accounting principles say that you have to put it in this format. And we're giving an opinion as to whether the financial statements are in accordance with generally accepted accounting principles. Your idea of, I want to report it this way because it makes sense, but it's not generally accepted accounting principles, possibly, right? So we could have that kind of issue on a one basically issue. And if that's the case and we can't resolve it, then of course we have to report it on our audit opinion. So if it's just one type of thing that's the case in, then we're going to say, hey, that they're basically on generally accepted accounting principles except this one item, which is deviating from generally accepted accounting principles, and possibly explain why management thinks it's important to represent that and take that deviation, resulting in a qualified opinion as opposed to an unqualified opinion. If it's more pervasive than that, or if there's a lot of things going on, then we have to give an adverse opinion. And obviously an adverse opinion on the financial statements is pretty much useless to the company. So at that point in time, if there's no agreement on the financials, on the action that the management should do in order to put the financial statements, we might have to also just disengage from the engagement at that point in time. And if we don't disengage, if it comes down to giving an adverse opinion or disengaging, oftentimes it ends up in a disengagement at that point in time. So if auditor decides that the misstatement is or may be the result of fraud and that the effect may be material, the auditor should then obtain audit evidence to determine whether material fraud has occurred and the effect. So we're going to dig down into the fraud to see if it has a material effect. And notice our focus here is really on the financial statements. It's not necessarily on the fraud in and of itself. It's on what is the fraud, the nature of the fraud that we want to dive into is what's going to be the effect on the financial statements, because of course our goal here is to make an opinion on the financial statements and the reporting of it, not necessarily as it would be in, say, a criminal type case, or if we're auditing from a forensic type of situation to look for a criminal type of fraud type of activity. We will pursue that, but notice where our aim is. Our goal is at trying to see what the financial statements, and if the financial statements are presented fairly. That's our primary purpose. That's what we are engaged to do. Think about implication to other areas of the audit. So if there's a fraud here, does this have implications elsewhere? And one way we might do that, if it's lower management, if it's lower employees that committed the fraud or something, even if it's substantial, then the question is, well, what other types of areas do they have influence over? Possibly not many, because of internal controls, because of separation of duties. If the fraud, on the other hand, is in upper levels of management, again, that then gives us pause. We're saying, well, now it's possible if there's fraud at that level of misrepresentation or misstatement, then it could be more pervasive because they have more influence, whereas lower level people have restrictions due to separation of duties. So we want to think about what does this fraud have a result on other areas of the financial statement and the credibility of the audit evidence that we have in the financial statements as a whole. Discuss the issue and plan to approach it further with the appropriate level of management, at least one level above those involved in committing the fraud, and with senior management. So if we detect fraud, then of course we're going to discuss it with someone. Most of the time, the fraud is employees, and oftentimes some type of beneficial to the employees, some type of theft or something like that. And if that's the case, then of course we talk to the proper level of management, possibly one step removed, not the level right above, but the one above that, and then upper management. And again, that hopefully is something that can then be detected at that level and taken care of within the organization, and not give us questions about the integrity of the upper level management, hopefully, which would be more problematic. Suggest the management consult with legal counsel. So we're always going to basically say, hey, our objective here is to see that the financial statements are reported and free of material misstatement. You have, if you have some type of fraud or illegal activity happening here, fraud being an illegal activity, you should consult with legal counsel and pursue it further in that direction. Our responsibility, of course, is towards the financial statements and the reporting of them. Think about withdrawing from the engagement. Now, if the fraud happened at a lower level, again, it's something that an employee committed fraud, theft, even if it's substantial. We go to the upper level and we can say, hey, the upper level management didn't have well-designed internal controls or whatnot. This fraud took place. It shouldn't have taken place. But it's not the fact that the upper level of management were somehow involved or somehow manipulating or deceiving. If, again, however, that the fraud is in the upper level of management, if we perceive that we're getting documentation that was altered in some way, or there's some type of fraud involved in the representation of the financial statements, what we're engaged to give an opinion on, then we might say, hey, that we're gonna remove ourselves from the engagement. And again, that's not something we want to do, because we waste a lot of time to do that. So we want to be able to determine this at the front end. What type of clients do we want to pick up? Do we want to pick up clients? We want to pick up good clients with integrity, so we don't run into this problem. But if we go halfway through the audit and we say, I don't have any faith in the integrity of management at this point in time, then and then at some point we'd have to consider just withdrawing from the engagement as well. In this presentation, we will discuss documentation of risk assessment. So recalling our goal as we go through the audit, we're giving an opinion as to whether the financial statements are in accordance or prepared in accordance with some set of standards, typically being generally accepted accounting principles. As we do so, we will gather evidence, that evidence being formatted in the form of documentation. So the documentation is going to be our evidence that the financial statements are free of material misstatement, or will be evidence of the opinion that we give on the financial statement, the most common being that the financial statements are free of material misstatements and unqualified opinion. Now, that documentation is, of course, for us, so we can look back at it if there's any kind of situation or any kind of problem and recall what happens. We also want to format that documentation in such a way that someone who is an experienced auditor, someone who has experience in these types of situations or in this type of documentation, can look at it, can review it, can determine what types of assertions we are looking to assert on, or gather evidence about and determine what our conclusions will be. So considering the documentation, as we go through the documentation, note that 1, we want the documentation to give us evidence in a similar way that we would have for a case so that we can back up or support our opinion with it. We then, 2, want to format our documentation in such a way that an experienced third-party individual can come in and look at it and say, okay, I see what you're doing. I see what the assertion is that you're driving at with this particular form of documentation. I see the work that is done, and I see how you came to the conclusion that you came to. So documentation of audit risk assessment. Auditors should document discussion with engagement personnel. So when we have the discussions with engagement personnel, when we have our inquiries, we're going to document, of course, the inquiries that we have. We're going to have specific type of questions. Those questions geared towards specific types of assertions, and we will document the responses that we get to them and put them in our working papers as our piece or a part of our audit evidence. Procedures done to identify and assess the risk of material misstatement due to error and fraud. So obviously, as we go through, we're going to set up the procedures. We're going to document those procedures that were done as we go. We're going to do the procedures, and we're not just going to basically say, oh, the procedure went well. We're going to move forward and then issue an opinion. We want to be able to 5 years later go back and say what were the exact procedures that were done and what was the result of those procedures and be able to look back through it. The way to do that, of course, is with documentation. Fraud risk or other conditions that result in additional audit procedures. As we go through, if we look at the types of results that we're getting from our testing and we determine, hey, there could be more risk of something such as fraud, then a typical next step will be to add more procedures that will be in alignment with that type of risk. So we'll put more procedures in place, and as we do so, of course, we want to document that type of information as well. The nature, timing, and extent of procedures performed in response to fraud risks identified and the result of the work. So the nature, timing, and extent, we're going to put that within the documentation. We'll take a look at this documentation in more depth as we go towards specific types of things that we will be testing assertions on, especially when we go through the substantive type testing, actually looking at the accounts and testing each of these accounts in accordance with those assertions related to them. Nature of the communications about errors or frauds made to management, the audit committee, and others. Now, fraud communication. This is always a big question because the question always comes up like, what if fraud is found? What's our responsibility? Because, of course, our responsibility overall, what we've been engaged to do, is to give an opinion on the financial statements. Remember, that's always our main goal, to see whether or not the financial statements are materially misstated or not. Our goal isn't to detect fraud necessarily, except to the extent that it's going to be misstating materially the financial statements. However, when we do detect fraud, we're saying, hey, this is an illegal thing happening here. What's our responsibility for the detection of fraud, and how do we go about that? Because obviously it's a touchy type of situation. So what do we have to do exactly if fraud is detected? What's going to be the steps that we need to take within that situation while still keeping our eye towards the goal, towards the process of what we're engaged to do, give an opinion on the financial statements as a whole. So fraud communications. If evidence that fraud may exist is found, the issue should be brought to the attention of the appropriate level of management. So remember, most of the time, the fraud is committed by some lower level type of employee, the lower level type of employee trying to benefit in some way, possibly through some format of theft. And so if that's the case, then we can report the fraud to the appropriate level of management, and the management then, and we could advise the management to take corrective action, possibly take the legal counsel as we have discussed in prior presentations, and then we can possibly go back forward to what our focus is on, and that's going to be the reporting of the financial statements. Fraud involving senior management, however, and fraud that causes material misstatement of the financial statements should be reported directly to the audit committee. So note, if we're concerned about the senior management, the risk of senior management committing fraud or not being able to rely on senior management, then we're going to go directly to the top level that we can go to within our audit commitment. That's going to be to the audit committee. Now, you might be thinking, well, wouldn't the audit committee then possibly be involved in the fraud as well? Or can we trust basically the audit committee? Note that the incentives between the audit committee and the senior staff aren't always lined up. It is possible that the audit committee could be involved or in some way or have some understanding of fraud, but it's not necessarily the case. So if we just explore that for a little bit here, note that the structure of the corporation is that first we have the owners of the corporations, the shareholders. The shareholders vote for the board of directors. The board of directors then is what is created, or the audit committee is created from the board of directors. The board of directors and the audit committee, with regards to the audit specifically, then the board of directors hires management, and therefore they're going to give some oversight on management. So if you look at the incentives of management and the incentives of the board of directors are pretty lined up to incentivize generally the owners because they're the ones that vote for the board of directors. Management is supposed to be acting as an agent of the owners and being oversought by the board of directors, but management can have different type of agency problems as well. For example, if we're talking about a type of organization that has large bonus incentive plans, so if management reaches, or if the company does well and reaches a certain incentive level in terms of revenue generation, then possibly they get a large bonus. Well, in that case, obviously the owners of the company, the stockholders, might agree with that type of incentive plan because they want to incentivize growth. But the management could have an incentive then to inflate the numbers in order to achieve the bonus. So you can see that in that case, it could be possible that management would have an incentive to do something deceptive in order to achieve a bonus, whereas the incentives of the committee members, the board of directors, the owners, wouldn't have that same type of incentive, and therefore it's quite possible that we could report and go to the board of directors, and they would take action in that situation, given the fact that the management might be deceiving them in that case as well. But it's also possible that the board of directors is looking for inflated numbers, possibly because they think that the value of the stock would go up for it, and maybe they were aware of management doing things that are possibly distorting the financial statement representation. So just note that as we do this, we go to the highest level. When it's management, we go to the highest level. We go to the board of directors, and we go to the audit committee, which is basically a subset of the board of directors. And again, you might think, well, what's that going to do? Because they're the ones that hired management. And again, consider that the incentives aren't the same. It's possible that management could be doing stuff because of an agency problem that would benefit them and be deceptive to the board of directors, or possible not. But that's the highest level that, of course, we go to, because that's what the engagement is with us. That's who engaged us in order to work on the project. So an understanding should be reached with the audit committee regarding the expected nature and extent of the communications about misappropriations perpetrated by lower level employees. It's important to note that disclosure of fraud to parties other than the client's senior management and audit committee is usually not part of the auditor's responsibility. So in other words, if we were to detect fraud, you're saying, okay, this is a criminal type of thing happening here. What's our responsibility for it? Do we have to report it to the public? Do we have to report it to the police? What's going to be basically our responsibility for it? Now, note once again that if the fraud is going to be on a lower level type of fraud, if it's by an employee, then typically our responsibility is to report it to upper management and possibly the audit committee if it's something that's going to have a material effect on the financial statements. We typically don't need to go further from there. The action then should be taken at that point. We advise that the management and the company take legal action at that point as well, and then they can take it from there and pursue whatever path needs to be pursued, given the fact that, of course, the fraud or the illegal act was done and they were the people that were harmed by it. So we can inform, we can advise, and that's typically where we go from that point. Now, if it's at an upper level than that, note that our engagement, the engagement that we have at the upper level, is in order to give an opinion on the financial statement. So if we see that the fraud is causing a material misstatement and we continue with the engagement and there's no adjustment or correction of the errors involved, we'd have to give it an adverse opinion. So we would give an adverse opinion, and of course, no one would be happy with an adverse opinion. The other thing we might do is simply disengage from the engagement. Again, if we don't feel like there's integrity within the upper management, and we don't feel that we can give an opinion on the financial statements, then typically we can disengage from the engagement at that point. So the following are going to be exceptions. So when there's going to be exceptions to the rule, that we would basically go outside of the audit committee and possibly have to discuss any kind of illegal type of acts or fraudulent type acts outside of the audit committee and with the entity that we are engaged in. So in compliance with legal and regulatory requirements, so if there's some type of legal or regulatory requirement that warrants us to basically discuss, then we would go outside the normal pattern. When a successor auditor makes inquiries of the predecessor auditor about the client. So within the audit profession, note the audit profession is going to want to communicate with and amongst ourselves, because that's going to be part of the professionalism of the audit process. Part of that is that if you're going to pick up a new client, you typically call the prior auditor and ask them, how did the engagement go? What's going on with this client? Are they, is this a client that you recommend, or was there any issues or problems that happened or arose from this client? Did you have any disagreements over auditing standards that the client had a problem with, and this and that? That's a typical type of call that we're going to have within the profession of audit and in the CPA. And therefore, within that professional setting, from one auditor to the next, typically thinking about whether we want to engage with the client, that would be another area where you could discuss these type of items as well. When a subpoena is received, so if there's a subpoena, then that's a requirement by the court that we'd have. So it's possible that we'd have to discuss the information if subpoenaed, and a funding agency or other specialized agency in accordance with requirements for the audit of entities that receive government financial assistance. So in special type of situations where they're receiving government financial assistance as well. In this presentation, we will discuss audit evidence, types of audit evidence, and management assertions. As we go through the audit, we'll recall that the objective is to give an opinion on the financial statements and whether or not they are in compliance with some set of standards, such as generally accepted accounting principles. To do that, we're going to pick up audit evidence and we're going to document that audit evidence. It will become more clear what types of audit evidence will be applicable to a specific type of assertion when we start to consider specific assertions, specific account types. For example, when we start to think about cash and we think about the types of tests and audit evidence and assertions related to it, that becomes more concrete and easy to think about. We'll do that in the future. However, at this point in time, we want to get a broader concept of what type of audit evidence we're looking for. This is going to be very important in the planning stage, and it helps us to go all the way through as we start to audit, think about different types of accounts that we will be auditing in the future. So once we go through the actual auditing and testing of these items, you may want to then take a step back to something like this and get a more general view of it once again. So we'll go through this general view, audit evidence, then we'll go through the actual audits and we'll be applying different types of procedures, gathering different types of audit evidence related to specific accounts, specific assertions. At that point, you want to take a step back again, because your goal is to have a broader idea of why we're doing that, so that you can really put together an audit plan rather than just go through some specific type of procedures in accordance with a checklist. So here's the audit evidence and audit report. We're looking first at the relationship between the financial statements and the audit report. So you'll recall that the financial statements are what we are going to be issuing, of course, our opinion on the fairness of them. Management assertions about components of the financial statements are one way that we're going to break down those financial statements. We're going to say how we're going to put together our report. We're going to say these reports are in conformity with some type of process, such as generally accepted accounting principles, according to management. Management then is asserting that that is indeed the case. We will list out and break out what those assertions are. Then we're going to basically test those assertions. We're going to go through audit procedures in order to do that testing of those assertions. We'll provide evidence on the fairness of the financial statements. We're going to document the evidence that we have found on the fairness of the financial statements. Then the auditor is going to reach a conclusion based on the evidence. We're going to take the evidence that we put together of the fairness of the financial statements. Hopefully, the hope is that the financial statements are reported fairly in accordance with the standards, such as generally accepted accounting principles. Then we issue the audit report. The audit report, again, issuing an opinion on whether or not the financial statements have been reported fairly in accordance with generally accepted accounting standards or generally accepted accounting principles, if that's the standard on which we are auditing. So to do this, we're going to take the financial statements and we're going to break them down into management types of assertions. And there's going to be two categories of management assertions. We've taken a look at these in the past. I'm not going to go through them in a lot of detail. You can look at a prior presentation, but just note that we're going to break these down into the assertion levels to help us to come up with different types of audit procedures. So management assertions about classes of transactions and events and related disclosures. They include occurrence, things actually occurred, completeness, do we have everything involved in this process? And again, you're imagining the audit procedures we might put together in order to test for these things. Did something actually happen? In other words, is something on the financial statements, how could we test for something on the financial statements that might not be there, right? A completeness, how can we test for something that should be on the financial statements but is not? We have authorization, so is there proper authorization? Accuracy of the financial statements, the cutoffs, and that has to do with the year end and the beginning, so timing differences. And you can think there we're typically on an accrual basis, accrual as opposed to a cash basis or some other timing difference. So those cutoff dates, the end of the year, the beginning of the year, important. Classification and presentation. Then we have assertions, and another group of assertions, management assertions about account balances and related disclosures at period end. So now we're looking at the account balances and the related disclosures. We have the existence, we have the rights and obligations. So do they exist? And you can apply this, the easiest thing to apply this to would be some type of asset, such as property, plant, and equipment. Does it exist? Right? You could think, is what's on the books actually there? Do you have rights and obligations to it? Is that actually your stuff? Or is it basically on consignment or some other stuff? If it's the inventory that's on the books actually owned by the company, or is it owned by somebody else? And so we want to know who has the rights and obligation. Completeness, is everything complete? Is everything there? Accuracy, valuation and allocation, classification, and presentation. So these are going to be the different type of assumptions we're going to test, of course, for these different types of assumptions. Audit evidence, information used by auditor in arriving at conclusions on which the audit opinion is based. So if an auditor gives an opinion and we were to ask the auditor, why did you give that opinion? Then of course they should be able to provide evidence for the opinion that they have been given. If they don't have the proper evidence, then they didn't do their due diligence in doing the audit and putting the audit together. So we want to make sure that we have the evidence. Related concepts to audit evidence, nature of the audit evidence, sufficiency and appropriateness of audit evidence, as well as evaluation of audit evidence. We'll go through these in a bit more detail, one at a time. Nature of audit evidence, form or type of information. So when we're considering what is the nature of the audit evidence, we're thinking about the form or type of information. We have accounting records, and then we have other types of information. The accounting records include things such as records of initial entries and support, general ledger, subsidiary ledgers, journal entries and adjustments to financial statements, worksheets and spreadsheets supporting allocations of costs, calculations, reconciliations, and disclosures, and any kind of contracts. These are the things that we would consider in basically the accounting records. What about the other information? Other type of information might include things like minutes, meetings, the meetings of the minutes of the board of directors, for example. Those things aren't necessarily in the financial statement, but we often review something like the minutes because they can give us an idea of the mindset of the people involved, the decision makers, and they could give us an idea of some transactions, some large transactions typically, that might be financial in nature. So minutes are some other information. Third-party confirmations. So we might talk to third parties. Again, we're not talking about actual accounting records or the accounting records per se here, but we might be discussing third-party type of information to confirm certain things normally related to the financial statement. Analysis reports from an industry. So we might look at the industry and be comparing the books or comparing something from the company we are auditing to industry standards. Data about competitors to use as comparison. So we might be picking, instead of the industry as a whole, a particular competitor that would be a good comparison to use. Control manuals, information gotten by auditor from inquiry, observation, and inspection, other types of information that's outside just standard accounting record type of information. Sufficiency and appropriateness of audit evidence, we here focusing in on sufficiency. Sufficiency is going to be the measure of the quantity of audit evidence. So when we think about is the audit evidence sufficient, we're typically thinking about the quantity of the audit evidence, and we're gathering evidence in order to prove our opinion or support our opinion. The greater the risk of misstatement, the higher the quantity of audit evidence needed. So if we look at the risk, if we're auditing something that has a higher degree of risk, one of the ways that we will mitigate that and issue our opinion is to have a greater amount of, obviously, quantity of evidence to support our opinion. The higher the quality of the audit evidence, the lower the quantity of audit evidence needed. The other way we're going to support our opinion is try to think about what type of audit evidence is going to be highest in terms of the most valuable type of audit evidence, the most convincing type of audit evidence, and if we can get more convincing, higher value type of audit evidence, then we don't need as much of it in order to support our opinion. Sufficiency and appropriateness, now focusing in on appropriateness. Appropriateness is a measure of the quality of the audit evidence. So sufficiency, how much. Appropriateness, now we're focusing in on the type of audit evidence, the quality of it. So relevance and reliability are the key factors when we're thinking about the quality of audit evidence. Reliability factors include independent source outside the entity. And we'll discuss more of these as we go through the auditing process, but just note that when we're considering the evidence that we're picking up, we want to consider how valuable that evidence is, how convincing is that evidence. So if we're talking about an independent source outside the entity, that's going to be more valuable evidence because it's going to be corroborated by someone outside the entity and therefore not having an internal, basically, influence as being part of the company. So we typically give that a higher value, just as a detective would giving a third-party opinion about somebody or some event or something a higher value possibly than someone being accused of something or something like that. So we want that third-party opinion would be higher value. Effectiveness of internal controls. So better internal controls would obviously be better evidence. Auditor's direct personal knowledge. So if we're talking about something that's part of the auditor's knowledge, then that's going to be something that could be pretty good evidence because, again, the auditor is an independent auditor. So if it's part of the auditor's knowledge and not something that's completely dependent on from, say, management, then it would be more reliable or more convincing, typically, it not being, relied completely on someone internal to the company, which is the entity being audited. Documentary evidence. So this is going to be evidence that's actually written down that have documentation for, so we can actually think of different types of documents, bills, invoices, and whatnot, bank statements. And then if we have the documents that are original documents, those are typically of a higher value. So if we're talking about not a recreated document, not a copied document, but the original document, that'll typically have higher value because it's thought that that's going to be less likely that it will be tampered with or altered if it is the original document as opposed to some type of copy. If we get that original document as a form of confirmation directly from the third-party source, an independent third-party source giving us, say, the bank statement as opposed to the original bank statement being given to us by the company, that would be a more reliable source as well because it's going to be the original documentation, but it's from the source or third party as opposed to the company as well. In this presentation, we will discuss audit procedures. We're keeping in mind our objective. Our objective is to audit the financial statements. As we audit the financial statements, our objective is to give an opinion on the fairness of those financial statements in relation to a set of standards, typically being generally accepted accounting standards. To do that, we're going to go through audit procedures. And as we go through the audit procedures, we're going to document that evidence in order to support our opinion. As we go through each of the audit components, when we start to test specific accounts, for example, it will be more clear as we think about specific accounts what type of audit procedures would make sense, what type of assertions would make sense with regards to those specific accounts. However, we want to take a step back because we want to think about the audit process as a whole as we plan for the different types of audit procedures. Going through the audit process, that's going to give us a better understanding of the process as a whole. It will also help us to plan more efficient audit procedures as we move forward with them. So we're going to be discussing here audit procedures from a step back, a general perspective that we would then apply to specific accounts and assertions, as we will do in future presentations. Audit procedures: acts performed by the auditor to gather evidence about whether specific assertions are met. So you'll recall that we're going to take the full audit, our goal to see if the financial statements are reported fairly, breaking that up to specific assertions, typically assertions related to specific transactions, disclosures, and or accounts. Then we're going to apply our audit procedures to those specific assertions. The grouping of the audit procedures will include risk assessment procedures, test of controls, and substantive procedures. So we're going to have the risk assessment, then we're going to go through the test of controls. You'll recall we're going to test the controls, which is kind of like the bureaucracy, the process, the checks and balances that are in place. Then we move to the substantive tests. The substantive tests are the ones that would come to most people's mind if we were going to just start to test things. We would go through and say, hey, let's take a look at these accounts. Let's go through substantive tests related to those accounts. But before we do that, within the planning stage, we have audit procedures related to the risk assessment, then the test of controls, which we must rely on to some degree, especially for large publicly traded companies, then put together the substantive test, which of course we can limit, hopefully, due to the fact that we're going to fill up some of the bucket of evidence, which we'll talk about this kind of bucket analogy of filling up the bucket to get enough evidence in future or a future part of this presentation. Audit program: set of audit procedures prepared to test assertions for a component of the financial statements. So we're going to put together then an audit program within the planning stage. And the audit program, once again, a set of audit procedures prepared to test assertions, the assertions by management, for a component of the financial statement. So we break the financial statements down into components in order to assess certain assertions with tests. We're going to come up with those tests and put them together in the format of an audit program. Audit program for accounts receivable, for example. So now this is going to be a specific example. We're going to say we're looking at the account of accounts receivable. How can we put together an audit program which will consist of tests of assertions? So what are the assertions? What tests can we put together to test them for that specific account of accounts receivable? So the management assertions with regards to accounts receivable are existence. Are the accounts receivable actually there? Rights and obligations. Do we own the accounts receivable, or possibly they sold the accounts receivable and are being collected in some other capacity? Completeness: are the accounts receivable recorded complete? And valuation or allocation. So if we go through the audit procedures, then existence: do they exist? We want to confirm accounts receivable do exist. And we might do that by basically actually contacting people listed in the accounts receivable, possible customers, and say, do you indeed owe the company money, or had you at this point in time some type of confirmation process? Rights and obligation: inquire of management whether receivables have been sold. So if we have accounts receivable on the books, our question is, did you sell that to basically a collection agency or something like that, or are they yours basically to collect? It's possible to sell, in essence, the accounts receivable. Completeness: agree total accounts receivable subsidiary ledger to accounts receivable control account or general ledger. So typically the accounts receivable will have a subsidiary ledger. That subsidiary ledger is going to be broken out by typically customer. We want to make sure that the subsidiary ledgers are going to agree to the control or the major account, the accounts receivable account. Valuation or allocation: we're going to test adequacy of the allowance for doubtful accounts. So in other words, accounts receivable under the accrual method, generally accepted accounting principles, needs to be set up under the allowance method. Typically, if it's going to be material in terms of the accounts receivable that would not be collectible, we're then going to have to test and possibly recalculate the calculation for the allowance for doubtful accounts, which would be that contra asset account, and lower the value of the net accounts receivable. Another audit procedure would include the inspection of records and documents. Inspection of records and documents: evidence from external documents is more reliable than that obtained from internal documents. So when we're going through those documentation as a part of our evidence, if we get that documentation from external sources, that's going to be more value than from internal sources. Why? Just like it would from a detective. If we're looking at the information and we're auditing the company, the fairness of the financial statements, the assertions being made by the management, then a third party, someone not related to the company, is going to be more valuable. The documentation from them more valuable than that that was created internally, because if the internal documentation, if management did want to deceive us, it would be more easy for them to do that with internal documentation. So we always have to maintain this level of skepticism as the auditor. Now, there's a few different ways that we can inspect the documentation. If we think about the documentation in terms of source documents and then the journal or the ledger, or in essence the books, we can consider the source document as the driving documentation that leads towards the transaction that will be on the books. If you think about accounting software, then these are going to be the source documents, are usually the documents that actually drive the recording of the transaction within accounting software. So for example, if you work with some accounting software, let's just say QuickBooks, and you were to put in the source documents, a check or an invoice or a bill, these are the things that actually would generate the actual journal entry, the thing that would basically trigger the journal entry. Those are going to be the source documents. So we can trace then the source documents, the things that in essence trigger the transactions within the system. They trigger the transactions because, of course, they're related to the proper point in time, or the attempt or the thought is that they are related. In other words, revenues recognized in accordance with the revenue recognition principle, and then expenses with accordance with the matching principle or expense recognition. When inspecting documents and records, we often take what we consider to be source documents and we will compare them to the journal or ledger, the related journal or ledger. So the source document is going to be that driving type of documentation, the documentation that's going to be driving, in essence, the journal entry. Why? Because the documentation is going to be that which is going to be as close to the revenue recognition principle or the matching principle with regards to when we recognize revenue or when we recognize expenses. When you look at accounting software, let's take, for example, just QuickBooks, that's going to be the documentation that will actually drive the transaction typically. So when we enter something like a bill, source document. When we enter something like a check, source document. When we enter something like a invoice, that's going to be a source document. The software will actually record the debits and credits, of course, at the point in time that we enter that information into the accounting software. So what we want to do then is say, take a look at that source document and compare it to the books that are being created for it. A couple different ways we can do that. One is we could say, let's take the source document and compare it and track it to what we call it tracing to the actual general ledger. So to do this, we might say something, go out to the client and say, give us these invoices. We've randomly picked these invoices. We'd like you to give us those invoices. We're going to take those invoices and then we're going to trace them to what we would think the related journal entry would be on the books. So we start with the source documents. We trace them to what we would see on the books. Now to do that, and if it was an invoice, we would expect to see revenue on the books and possibly accounts receivable on the books. So we're going to trace them over and see if that is indeed the case. When we do that, we're thinking about completeness, because what we're doing is we're starting with the source document, which you would think if we had the source document, it should be in the books. So we want to be able to find it in the books. If we don't find it in the books, but we had the source document, we're pretty sure that it should have happened, should have been recorded, but wasn't. And that means that we don't think the books are complete or something's wrong in that case. Now, notice when we're thinking about completeness, oftentimes we might test revenue and whatnot, but we might be thinking more about those types of things that would make the company look bad, because our skepticism is always on the company possibly trying to look better than they are. So we might be doing this more in terms of the tracing for something like a bill. We might be saying, give us all these bills. Those would make you look bad, and then trace them over, or like a loan or something like that, and see if they're actually being recorded on the financial statements as they should. Now we can also go the other way. We can go from the journal, the actual books, and we can vouch that back to the source document. So we're going to say now it's on the books, and we're going to vouch it back. So if we took something like sales, the sales would be generated by what we would think would be invoices. We can start with the books then, pick out those sales items, and then say, I would like to vouch these back to the actual source document, which in that case would be invoices. And we would do this, you would think, with something like invoices, revenue, because again, if they're trying to look good, what might a company do to try to look good? Increase revenue. How would they increase revenue? Possibly have something on the books in terms of a revenue, and then when you take it back to the source document, there's no related invoice for it or something like that. So in this case, we'd be testing for occurrence And oftentimes when you test for occurrence, you're looking at things like assets and revenue because it's more likely that the company would try to overstate those types of things, assets and revenues. Now we'll take a look at audit procedures with regard to the inspection of tangible assets. So when we think about tangible assets, we're typically thinking about those larger types of tangible assets like property, plant, and equipment. And those are types of things that we can physically examine, of course. So if we have on the books, if we look on the books and they say that we have this many pieces of equipment, this many forklifts, this building, this piece of equipment, well, one thing we can do is actually go out there and physically examine whether or not that piece of equipment physically exists. So we may not be able to value it as easily as an auditor or anything like that, but we can at least go out there, we can look at it, and we can say, yep, there's a building, and we can inspect the tangible assets, usually the larger property, plant, and equipment type assets. We can also have inspection of the tangible assets, watching a process or procedure be performed by others with relation to it. Now we're going to take a look at inquiry as a type of audit evidence. When considering inquiry, it is just what it would sound like. It's us asking questions, and typically who are we going to be asking questions to? Usually it's going to be some form of management. We're usually talking about upper management, and then we're going to be talking about who's going to be in charge of a particular type of system, and or if we're testing a particular type of process, we may perform inquiry to whoever's in charge of performing whatever type of process we are looking into. So inquiry: evaluate the knowledge, objectivity, experience, responsibilities, and qualifications of individual that is questioned. So as we think about inquiry, we have to think about who it is that we are inquiring. What's going to be the item that we are testing here? Why are we inquiring this person? And is this person qualified to answer the inquiries? Now, when you think about inquiry, you're going to possibly think in your mind, if you're thinking about a detective, you're saying, hey, we're trying to review the management and try to see that this company is performing or putting together the financial statements in accordance with some set of standards as they said they are. Therefore, is inquiry reliable? And of course, as we'll see, we'll look at a hierarchy of the type of evidence. Inquiry isn't the most reliable type of evidence, but just like a detective would, we have to go in and of course, inquire, document the inquiry, and then treat it as we would any other type of piece of evidence, even though it may not be the most high valued evidence as would evidence that would be from, say, a third party that's not related to the types of assertions that we're trying to test for. So inquiry is a really important thing to keep in mind. Format questions to be clear, concise, and relevant. When we ask the questions, we want to say what's the actual assertion that we are looking for. We want to format the questions that are going to be very clear with regards to the specific assertion that we are inquiring about, so that we can document the answers and have our audit evidence that we need to complete the audit. Understand and use both open and closed format questions. So we want to be pretty good at being able to ask questions when we think about these different types of inquiry formats. So when we're trying to get broad knowledge about, say, the environment or the culture of the organization, we might be asking more open questions. You know, what does management think about internal controls? What do they think about, the auditing process? What do they think about financial statements and the accuracy of financial statements? These are all open-ended questions that someone could just, go on a story about. And then if we're asking a specific type of question, then we might have basically a yes or no type of question, a yes or no type answer of a question. Is this part of your procedures? Do you do this as part of your procedures? Do you sign off? Do you have to talk to someone else in order to get approval for this process or that process? Answers yes or no. Who is it that you go to for approval in order to approve some component? So there's no ambiguity in the answer to that. It's pretty much straightforward, one word, few word type of answer. So that can actually have a big effect on how well our inquiry process goes, is to be able to use those things well. Understand and apply active listening. So active listening often involves, there's different definitions of active listening, but one definition or one way to apply it would be to actually repeat back what the individual is saying. So if you're asking a question about, who do you have to go to in order to get approval, or what is the approval process, and say they go through a list of basically approval processes, then as we document this information down, we're going to repeat it back and say, this is my interpretation of what you just said right here. You're going to do A, B, C, and D. This is the process. Is that correct? And then in that format, we could basically hopefully build rapport at the same time as making sure that we're fully understanding, so that we can document what type of inquiry we're going through. Ask appropriate follow-up questions based on responses. So as we get better at the audit process, when we think about these types of items, we're gonna, as we go through the questioning, we may have other questions that would be relevant during that time period. Really good if we have a good interviewer that can basically go forward and ask those follow-up questions at the point in time that we have the interview, as opposed to going back, getting some supervision, and then asking new questions where we got to schedule multiple different engagements. So what we'd like to do is be able to say, ask the questions, any more questions that come up during that time period that we didn't initially have written down, we'll go ahead and ask those at that point in time as well. Next audit procedure is confirmation. Third-party direct written response to the auditor is what the confirmation is going to be. Notice what we have here, a third party, that's going to be someone outside of the organization, and it's a direct written response. A direct written response meaning it's not going to the company, it's going to the auditor. And the classic example of this that you're going to do almost all the time, even no matter what the assessment of the risk is with cash typically. So when we have cash, we'll typically look for confirmations from the bank to verify, considering the fact that cash is a very liquid type of asset and therefore something worth, a confirmation process typically. And what we'll do is we'll basically go to the bank and say we would like a direct confirmation, not basically, we're not going to give it on the letterhead of the company and let the company receive it and then give it to us. No, we want it directly from us. We're going to say, hey, we're the auditor of the company. We're performing an audit in accordance with the company's consent, and this is our agreement. We would like to get a confirmation of, say, the bank balance at this point in time, and have that mailed directly to us, right? And that's going to be the process that we'll typically do. And by doing that, it doesn't go into the hands of the company who potentially could alter it. Now, hopefully, we're working with a company that won't alter it. We're not, but the point is that the evidence is higher valued on our system, and what we're trying to do is gather the evidence of high value. And so if we get it from the third party, it's higher value in our evidence, and so that's what we will typically try to do. Now, as we go through specific confirmations, we'll talk about different types of confirmations. There's a whole lot of different ways we can word the confirmation. We can, for example, with regards to cash, we can word the confirmation of, the client says that this is the amount of cash balance as of this stated date. Is that what your records show as well? And they would just have to say yes or no, or we can ask them for the bank balance and not give them the number, which is a bit higher amount of confirmation, but also note that the people that we're confirming with don't have to respond to us. So the bank probably will, but if we're talking to other people, like people that owe them money for accounts receivable, they're more likely to respond to us if we just ask them if a more direct question as opposed to a more open question. They may not mail the confirmation back. So we'll get into more of those types of things when we actually have confirmations related to specific assertions. But the reliability varies depending on these kind of factors: the form of the confirmation, in part the type of wording we have in the confirmation, the prior experience with the entity, that's going to be a factor as well, and the nature of the information being confirmed. What type of thing is it that we are confirming? Is it cash? Is it accounts receivable? Is it a loan or something that's on the books? So here's going to be a confirmation process. This is going to be types of confirmations or things that we typically would consider a confirmation as an audit procedure to gather some audit evidence. So cash, again, almost always will you do cash. Doesn't really matter what the risk factors you say. Cash is inherently risky. Therefore, we almost always confirm to the bank. We send a letter to the bank, not on the company letterhead, but on our letterhead. We are the auditor. We're auditing this company. We would like to confirm, any liabilities as well as cash, typically with the bank. And then accounts receivable. So we might have confirmations to customers, and you can see this will be a little bit more difficult. We're not going to send out a confirmation to all the customers, but we're going to say if we could send out a sample of confirmations, we can give an idea that these accounts receivables are real, and therefore be good with them. But note that the accounts receivable, the customers, aren't as likely to give back the confirmations to us. So we have the bank. If the bank doesn't mail us back the confirmation, we have a problem. If the customers may not mail back the confirmation, and we're going to have to think about what type of confirmation or how many would be acceptable to get back from customers. So inventory on consignment. So what if they have inventory on consignment that's somewhere else? Then we might have a confirmation for the consignee. The accounts payable, we might have actually send things out to the individual vendors, confirmations, not things, to the individual vendors. And we'll probably do this more for the receivables because we're more skeptical of the receivables being real. Accounts payable, it's less likely that they're going to overstate accounts payable. So the confirmation to confirm that the accounts receivable that they're reporting on the books is actually there, less likely, but could be something worth doing. Bonds payable, the bondholder. Insurance coverage, we might contact the insurance company. So audit procedures, we have the recalculation. We can go through recalculation as an audit procedure. We'll go through the mathematical accuracy. So we'll actually go through whatever, if it was like depreciation and we wanted to recalculate it to see if their math was accurate. Any type of estimate, we can do that with. Allowance for doubtful accounts, we can recalculate it. If it's something a little bit more complicated than the recalculation, we could reperform it where the auditor executes procedures or controls. So that might include something that's a little bit more complex of a procedure than just the recalculation, but we'll go through those procedures and see if we come out to the same or similar number, something that's in the ballpark, hopefully, to the number that's being used, to see if the process that they're putting in place for the calculations and the procedures are in alignment with generally accepted accounting principles. Then we have analytical procedures as a form of audit procedure. Examination of financial information made by a study of plausible relationships in both financial and non-financial data, as well as scanning, which can be defined as reviewing account data to identify significant or unusual items to test. I would consider the analytical procedures as something usually that you would do in the office. So if we're in the auditing office, basically the analytical procedures, we can usually get the data, we get the financial statements, we can run ratio analysis, we can say compare this year to last year, look at the dollar differences, look at the percentage differences year over year, comparing relationship ratio analysis within the current year, and we can look for different types of relationships or unusual items within those relationships or changes that we may want to further dig into as part of the audit evidence, and just consider within, you could think of it kind of a scanning process to consider whether the relationship of the numbers look reasonable, or if there's items within the relationship of numbers that look unreasonable or worth us looking into further due to changes year over year or to industry standards or something else of that nature. Now that we've looked at some of this data, the different type of evidence, we want to consider the hierarchy of evidence. When we put together these procedures, we're going to be thinking about how are we going to put together these procedures, and we want to do so in the most efficient way. So we have the lower procedures that are going to be less evidence. So we were to think about a court case type of scenario. This evidence is good. It fills up the bucket of evidence, but it's not as good of evidence as the higher evidence that we would like over here. So if we only had one piece of evidence, we want the higher evidence rather than the lower evidence. The lower evidence is going to be the observation and the inquiry. So obviously, if we're just going to ask them something and they're the person that we are judging as to whether, you know, they're putting the financial statements in accordance with a set standards such as generally accepted accounting principles, they're just saying so is worth something, right? It's worth something, but it's not the highest degree of evidence because they're the people that we're looking into in terms of testing on the procedures. So we want inquiry, we want observation, but those aren't going to be the highest forms of evidence that we can have. We want them, we're going to have them, we're going to fill the bucket with them, but there's not going to be anything in the bucket. That's not going to be the only thing in the bucket, and we'll get to the bucket analogy shortly here. And then we have inspection of records and documents, so to inspect the records and documents, the confirmation, the analytical procedures, and the scanning. These are all in the mid-level. And then the high level is going to be the inspection of tangible assets, so the reperformance and the recalculation. So in essence, if you think about the high level, that's of course going to be the stuff that we do as the auditor. We're going to we've recalculated, we've redone it here, we've reperformed, recalculated, we went and inspected it, and so we can rely on ourselves as basically the auditors, the people that are in charge of reviewing. At the mid-level, notice we have the inspection of the records, we have confirmations of going to be the third party, which is better than the internal confirmation, analytical procedures, comparing to see if there's going to be differences or changes from year over year, other type of analytical and scanning, and then of course the stuff that's going to be more dependent on the people that we are kind of judging in terms of whether or not they put the financial statements together fairly is going to be the lowest portion of evidence. yet still applicable. So if we consider this process in kind of a flowchart type format, we could start off with, after assessing potential effectiveness of internal controls, will test of controls be conducted? So if we're trying to think about a certain assertion or a certain account, this is the process that we can think about going through. We have, after assessing potential effectiveness of internal controls, so we discuss whether the controls are effective or not. Then the question is, should we have further testing on the controls? If we're talking about a publicly traded company, we almost always test the controls. If the controls were not effective, we have a big problem. And you couldn't complete the audit because we wouldn't be able to do it within the time frame. We have to test the controls and rely on the controls to some degree. If you have a small company, it may not be that case if it's a non-publicly traded company. So then we're going to do the test of controls. We're going to apply our tests of the controls, the bureaucracy, and then we can then we ask the question, can effective and efficient substantive analytical procedures be done? So in the case of this question 1, anytime we have a red box, by the way, that means that we have a question of a yes or no. We have a yes or no answer. If the question up here was no, then we'd go straight down to this question, can effective and efficient substantive and analytical procedures be done? The only time that this would be no to this question up top would typically be for a non-publicly traded company, which may not have effective internal controls because they're small. Publicly traded companies must have internal controls. If the answer is no, then we probably can't complete the audit within the time period that would be needed. Then if we're going to start from here now, and we're going to go forward, we're going to say, perform substantive analytical procedures. So if they can be done, then we will do them. Is additional substantive evidence needed? So then we ask the question, do we need more evidence at that point in time? If the answer is yes, then we're going to perform substantive tests of details on transactions and or balances, and then we're going to have the documentation. Going back up to this red box, if the answer was no, then we're going to have, are there any performed substantive tests of details on transactions, and then do the documentation. If here the answer is no, do we need any additional tests? And the answer is no, then we go to the documentation. So bottom line, typical type of transaction. After assessing the internal controls, we then typically test the internal controls. And then once we test the internal controls, we're going to, can effective and efficient substantive analytical procedures be done? Usually the answer is yes. And so we're going to say yes, perform substantive analytical procedures. Once that's done, we ask the question, given that evidence, do we need more substantive procedures? If the answer is yes, we do more. If the answer is no, then we go, okay, we're good. The bucket is full. We have the evidence necessary in the bucket for that, and therefore we document the results. Now let's take a look at this bucket analogy that we've been talking about here. Note that what we're doing is trying to get some evidence, and you can imagine the evidence we're gathering as, so we have to fill up basically a bucket, and once we get the bucket up to a certain level, we could say that we have enough evidence for a particular type of assertion. So we might think that we have the risk assessment procedures as part of our process of filling up the bucket of evidence. Then we have the test of controls, because the controls are going to be something that we're going to need to depend on. Then we're going to have the substantive analytical procedures. And note, if the test of controls are strong, we can have less substantive analytical procedures and still fill up this bucket. And then we have remaining assurance needed from test of details. So we have risk assessment procedures, and so we assess the level of risk. Then we do the test of controls, and that's going to give us some evidence, but probably not enough. Then we do the substantive tests in order to fill the bucket. We do as many as we think we need to, given the risk and the test of controls. And then we assess whether or not any more testing is done, and we do remaining assurance needed from the test of details. Another useful way to imagine this is to consider, as we go through the auditing process, when we think about starting off the audit, we often think that we're just going to go through the balance sheet account and test each line item. And we can kind of think of it that way, but we want to plan the audit so that we're filling up the buckets as we go. So if this was one particular assertion or one particular account that we're trying to find assertions related to, assertions of completeness, accuracy, cutoff, presentation, disclosure, existence or occurrence, valuation, rights and obligations, as we go through planning the audit, we have the test of controls, substantive tests, tests of details, And these things will actually fill up the bucket for multiple different accounts, possibly, or multiple different assertions as we go. And as we do that, we want to basically note which buckets are being filled up so that we can limit the amount of work that we're going to do. So, for example, when we go through the controls testing and risk assessments, we might start to fill up some of these buckets related to this assertion: completeness, accuracy, cutoff, existence, and whatnot. And then when we go to the substantive testing, then we can say, well, this is going to start to fill up these buckets here, and we can start to consider which buckets need to be more filled up at this point in time. It's not a straightforward process like we work on one bucket at a time. We're trying to plan the audit process so that we do the least work as possible. If we can do one procedure that fills up multiple buckets or something like that, then we're going to try to do that. Then we have the test of details, which once again could fill up these buckets, and you have that overlap. And our goal, of course, is to get enough evidence to fill each assertion's bucket to say that we have enough evidence for that assertion to make a conclusion on that particular assertion. In this presentation, we will take a look at audit documentation. Keeping in mind our objective within the audit to give an opinion on the financial statements to be in accordance with whatever standard they are said to be in accordance with, such as generally accepted accounting principles. In order to do that, we will have audit procedures, and of course, we will need to document those audit procedures in order to support our decision. Now we're going to be talking more about that documentation, the audit documentation. Audit documentation is auditors' records of the audit procedures performed, relevant evidence obtained, and conclusions reached. So let's read that one more time. The audit documentation, auditors' records of audit procedures performed. So that's going to tell us what did we actually do within the audit in order to get evidence for the assertions being made or for the opinion that we give on the financial statements. And then we have the relevant evidence obtained, about the evidence that is obtained. So we want to document the evidence that is obtained, and the conclusion that we reach. Of course, our conclusion will be based on the evidence. We're going to go where the evidence leads in terms of the conclusion. Audit documentation or working papers functions. These are the functions of the audit documentation. We often call them the working papers. Working papers being something that we put together on the audit side of things. We're going to include the working papers as part of our audit documentation, part of our evidence, part of our support to our opinion. So they provide support for the audit report. So when we create the audit report, which provides our audit opinion, the documentation will, of course, support that opinion. Aid in the planning, performance, and supervision of the audit. So as we go through the documentation or as we go through the audit, we want to document as we go, and the way we document as we go will be in such a fashion that it's going to help us to move forward with the planning, performance, and supervision of the actual audit process. Provide a focal point for reviewing work of subordinates. Helps to provide a basis for quality reviews. So the documentation is going to be something that we're going to be using in order to review as well. The more standardized the procedures that we perform and the more standardized the documentation of those procedures that we have, the easier it is for us to delegate those procedures to others and then review the work that is being done by them. Audit documentation should show how the audit complied with auditing and related practice standards, show evidence for the auditor's conclusion about each material financial statement assertion, show that the underlying accounting records agree or reconcile to the financial statements, and contain a written audit program explaining auditing procedures necessary to accomplish audit objectives, as well as be constructed in such a way to enable an experienced reviewer to, so we're talking about another reviewer. If we're taking a look at this documentation, it's supporting our opinion. What if someone else was to look at that documentation and see whether it does indeed support our opinion? It has to be constructed in such a way that an experienced reviewer of that documentation could understand the nature, timing, extent, and results of audit procedures, evidence obtained, and conclusions reached, and determine who performed and reviewed the work, show the dates of the work and the reviews of it. So the documentation, of course, should give the evidence, and a third party who is experienced with documentation related to audits should be able to understand the nature, timing, extent, and results And the working paper should also indicate who did the procedures and who's in charge as well. So we'll often have initials or some type of initial or signature process saying, hey, this is the person that did the procedure. Here's the person that reviewed the procedure. Types of audit documentation files. Now, when we store our audit documentation, we're typically going to have a client file, and oftentimes it'll be grouped in two types of client files. We'll have a client file for the permanent files, and then we'll have a client file for the current files. So this current files is going to be the current information that we're working on, the current audit, the current year that we're going to be working on. The permanent file, we're going to have that type of information that's going to be there for long periods of time. So when you think about these two types of files, if you're setting up your auditing system, you're setting up your system for clients in general, if you're public accounting, oftentimes you want to think what types of files are going to be there that aren't going to change, that I want to have in a permanent file. They're going to be there for a long period of time. What type of files do I want to put in the current file? These are files that possibly, if I do a yearly audit, are going to change each year. These are the things that are going to change each year. And so that's a typical type of grouping. Permanent file type of activities, the corporate charter, obviously that's not going to be something that's going to change all the time. We put that in the permanent file. Significant contracts, so if they're going to be long-term contracts for a long period of time, we want to have that in the permanent file. Possibly the chart of accounts. The internal controls is something that could be set up and established for a long period of time. Organizational charts are going to be something that typically have a longer period of time, because when we're considering the organizational charts, we're typically thinking of the upper management of the organization, term of stock, and bonds issued. When we think about the current file, we're thinking about those types of things that are going to happen in the current time period. So the current audit information that we're doing often happening on a yearly basis. So these are things that we might group basically on a yearly basis in terms of the current file that we are working with. So we have the adjusting entries, we've got the audit plan and programs for that current audit of the current year, working trial balance for the current audit current year. We have the current financial statements and auditors reports for the current year, the minutes for the current time period, and the working papers. So as we go through the audit, then most of what we'll do is we'll take the current year from the last year. We'll look at how everything was going to be formatted. We'll start with the current year for this year, and anytime we need to dip into those type of items that are going to be long-term type of contracts or something like that, then we'll jump over to the permanent file where those things will be housed. Audit documentation format will typically include something like, and different type of firms may have different formats of their working papers. Also note that working papers don't need to be the most formal type of working paper in order to be something that will be useful within audit evidence. But what we do want in the working papers, and the more standardized the working papers are some of this type of necessary information that will be included in this format. But as we go through this format, don't get the impression that every type of working paper is going to be exactly the same or have it the exact same type of format. We want to have this key information on it, and this is a good format to have the audit documentation and working papers in. So we often have the heading, which would include the entity name, the title of the working paper, which of course will give us an idea of what this working paper is trying to do or what evidence it's providing for us, the entity's year end. So we want to know what year end this working paper is applied to. Then we have indexing and cross-referencing. These are going to be indications that provide a trail from financial statement to audit documentation. So we're going to use some type of indexing or references within our working paper, providing that trail from the financial statements to the audit documentation. This will become more apparent when we go through some examples of the audit process of specific type of accounts. You can imagine basically us taking a trial balance, labeling that trial balance, and tick marking off in such a way that we can indicate which working paper is going to be tied to which type of line item on the trial balance or the chart of accounts which we are auditing. We want to basically be able to tie those things out, indexing and cross-referencing to do that. Then we have tick marks, indications next to work paper items showing auditor actions and reviewer actions. So we're going to have then tick marks which are going to show the auditor action and reviewer action. Again, this will become more apparent when we actually put together working papers for particular assertions and account balances. And just note that different types of organizations may use different types of methods for their tick marks and for their indexing and cross-referencing, but we need to have some indication of the indexing and cross-referencing. We need to know this information. We need to know who's the entity. We would like the title. We want the entity's year end. We want to know what the account is that we're working on, and who it is that's going to be putting together this information, who it is that is going to be reviewing this information. And typically, CPA firms will have a systematic set of formats in order to do their indexing, cross-referencing, and tick marks. Documentation retentions. Documentation should be organized in such a way that evidence supporting financial statements amounts can be easily found. So note, as we store this documentation, we want to think about down the line this supporting evidence. Obviously, as we complete the audit, as we do the work, it's fresh in our mind and we can explain it to anybody if they were to ask about it. But as time passes, of course, some of the people that worked on the audit may not even be in the same organization, in the same firm anymore. We want to make sure that we have the documentation in such a format that it does provide the necessary evidence to support the opinion that is given. And of course, part of that is going to be the way that we organize. Part of that's going to be the way we cross-reference and we use tick marks within the documentation. Audit documentation is property of the auditor. This includes documentation prepared by the entity at the auditor's request. And this is going to be an important distinction when we think about the working papers. Although the working papers, the documentation we put together is about the company that we are auditing, the working papers themselves are part of our audit. So any working papers we put together as evidence is going to be part of the audit, not something that's going to be the property of the company. That includes working papers that we put together within the auditing process. It also includes any kind of calculations that we ask from the company to put together as part or in conjunction with the audit process. Documentation should be retained for a number of years from the completion date of the engagement per the Sarbanes-Oxley Act. In this presentation, we will discuss the topic of develop audit expectations. When using analytical procedures, auditors need to have expectations to use as a type of benchmark. So it's going to be similar to a scientific type of method. We're going to say these are the expectations, this is what we expect to have. Then we're going to run the tests and see if they are close to what the expectations were. Now then the question would be, well, how do we come up with these expectations? The sources of the expectations could come from the financial data, from budgets, from things like industry standards. We might take the industry standard as benchmarks. Competitor information might help us to serve as a benchmark and expectations. And management's analysis is what the types of things we may use for the benchmarks, so that then we can run those analytical procedures, those kind of ratio type procedures, those types of things I would consider often done. We can imagine them being done within the audit office. We're going to run these types of analytical procedures to see if they make sense in accordance with our expectations set in accordance with some type of benchmark. Next, we want to discuss the concept of precision with relation to the quality of an expectation. So precision relates to the potential effectiveness of an analytical procedure, degree of reliance that can be put on the procedure, and how closely does the expectation approximate the correct but not known amount. Amount of desired precision can differ with these factors, including the purpose of the analytical procedure. Why are we putting the analytical procedure together? Function of materiality and required detection risk. So when we think about the detection risk, we're thinking about what the level of detection risk is. If the assertion being tested requires a low level of detection risk, the expectation needs to be very precise. In other words, when we consider our audit formula to consider what the detection risk is for this particular procedure, then if we're setting the detection risk to be low, that means that we want a low level of risk that we won't be detecting the problem, and therefore we need more precision so that we would be more likely to catch the problem. So note, it can be a little confusing when we think about these risk factors such as detection risk. If we're saying that we want a low detection risk, that means that we want a very precise type of test to make the detection risk, the risk that we don't detect something, low. Factors affecting the precision of analytical procedures. 1, desegregation, which is going to be one of the major types of internal controls. If we have proper desegregation between duties, we're more likely to have better controls and therefore more reliable data. Plausibility and predictability of the relationship being studied. So when we think about the relationship, we're thinking about ratio analysis oftentimes, or comparing numbers when we're thinking about analytical procedures, those things we can kind of do in the office, in the auditing office, as we compare the numbers out. And therefore, when we're comparing relationships of numbers, there could be different degrees of what the plausible relationship will be. So we have to know, we have to have an understanding as we go through these types of comparisons, what is the plausibility and predictability of the relationship that is being studied with the analytical procedures. The reliability of the data. So the data that we are using, of course, when we do analytical procedures in the office, it's only as good as the data that we are getting. So is the data that we have reliable, or how reliable is it? And then we can go from there with our analytical procedures with what we have. Types of analytical procedures used to make the expectation. So what type of analytical procedures are we using in order to get to that expectation? These are things that are going to affect factors affecting the precision of analytical procedures. Tolerable difference size depends on. So what's going to be the tolerable difference? You can see this procedure kind of like a scientific type method. We have what would be similar to our hypothesis. This is going to be basically our benchmark, our expectation. And then we're going to perform the procedures and see how close they are to the expectation. Then, of course, the question is, well, what's going to be the tolerable amount of difference? There's going to be a difference because it's just an estimate, which we are now reperforming. What then would be a tolerable difference size? And that will depend on the significance of the account. So what type of account are we looking at? If it's a very important account, then possibly we're going to be more precise. If it's cash and cash is very important, then we probably want a low difference when we do these type of analysis. So that's one of the main things that's going to be effective. Degree, and also, of course, always we're relating to materiality. What's going to be a material type of account, one that might affect decision makers as well. Degree of reliance that we'll put on substantive analytical procedures. So when we think about the audit as a whole, recall that analytical procedures is going to be one of the things that we do. The question is, how reliant are we on the analytical procedures? If there's going to be other procedures that are going to basically cover this information, then possibly we don't need, the difference could be larger in this analytical procedure and we can move on and basically do more testing other places. However, if we're relying more heavily on the analytical procedure itself, then we're going to want to have a closer, obviously, or a lower level of tolerable difference to be more reliant on that information. Precision of the expectation. So obviously some expectations we might have are going to be more precise than others. So some expectations we can be pretty precise in terms of what we think the results should be. Others, we're going to have a wider range of expectations. So that would vary depending on what type of thing we're looking at. We're going to have an idea of what type of variance could be there. If we're comparing to industry standards, then the average might be on the industry standard, but there could be a fairly wide range of difference if we're comparing to something like an industry standard as the benchmark. The next thing we'll do, of course, is investigate the differences greater than the tolerable difference. So we're doing the analytical procedures, we're setting the tolerable difference, and the most kind of basic type of analytical procedures you could think of with this would be to compare 1 year to the prior year and see what the dollar difference would be, as well as the percentage change differences, and possibly take those and set some type of benchmark amount, and then think about those types of changes that are going to be over and above the tolerable differences that would be set. Again, there's a whole lot of different types of analytical procedures we can do, but that would basically be the procedure we're having, right? We're going to say this is the expectations. Everything should be within this range, we would think. Anything that's going to be outside of this range within our analytical procedure, we will then dig into, do further testings on. So then differences identified by substantive analytical procedures indicate an increased likelihood of misstatement. So obviously if we're outside the range, we're outside the norm. That doesn't mean that there's a misstatement for sure. It just means that there's something that's unusual. It's not like the norm if we're comparing to industry standards, or if we're comparing to last year, it's different than industry standards, or it's different, or it's a significant increase or decrease as compared to the last year. And therefore, that could be an indication that there's an error, or we can simply look into it and find exactly what that difference is due to. It might not be an error, but we might want to look into it and just basically see what it is. So we go in through the quantification, the follow-up with quantification, collaboration, and evaluation. Now we'll take a look at these individually. So we have the quantification. That's going to be our follow-up type of procedure. Determine whether the explanation or error can explain the observed difference. So obviously, once we have a difference outside the norm, we're going to see if we can explain it, if we can quantify what that difference would be due to some circumstance or error. Corroboration: obtain sufficient audit evidence that links the explanation to the difference and substantiate that the explanation is reliable. So once we've basically said, hey, this is going to be the difference, we believe what this difference is, then we want to go in and actually test that. We want to corroborate that information. So we're going to obtain sufficient audit evidence that links the explanation, what we believe the difference is due to the difference. So then we're going to basically corroborate. And then we have evaluation. Evaluate results of substantive analytical procedures to decide whether the desired level of assurance has been achieved. So once we've gone through this process, we're going to say, okay, how does it look now? Have we achieved the desired level of assurance at this point in time? In this presentation, we will take a look at and discuss internal controls. Internal controls. Management is responsible to implement and maintain controls that provide reasonable assurance that adequate controls exist over the entity's assets and reporting. The internal control system should ensure assets and records are safeguarded and produce reliable information for decision makers. So a couple key points when we think about the internal controls. We are the auditor. We're positioning ourselves, thinking of ourselves as the auditor. Note that the internal controls are something that is done by management. So like the financial statements, when we audit the financial statements, those being prepared by management, the internal control system also something designed and implemented by management. And so the internal control system is implemented in order to provide reasonable assurance that adequate controls exist over the entity's assets and reporting. So the internal controls, you can think of it kind of as a bureaucratic type of system. They're going to put in more bureaucratic systems. We think of it as an entity growing in size. They're going to need more of these kind of bureaucratic types of systems, more checks and balances, more internal controls in order to assure more reliability over the assets that the company possesses, as well as the reporting that will be a result as well. And then us as the auditor will take a look at those internal controls, test those internal controls, and see whether or not we can rely on those internal controls as part of our auditing, and thereby test controls rather than test as much of the substantive testing that we would have to do if we had little to no internal controls. Risk assessment procedures are used by management to obtain an understanding of the entity's internal controls, identify the most important controls, recognize potential for misstatement given the controls, and design test controls and substantive procedures. Note that we as the auditor are going to have a good idea of what good internal controls should be, or we need to have a good idea of what good internal controls should be as we review the internal controls of the company. And you might then ask, well, why wouldn't the auditor then help to implement internal controls? And that's a natural type of thing to happen within an audit engagement, to say, hey, the management might say, hey, well, the auditor should help us basically to implement proper internal controls. Just note that you need to be careful, and we'll talk more about this with the separation of duties, but we want to mention it here that the auditor needs to be careful in terms of what types of internal controls or what type of advice are being given with regards to internal controls, because that's going to be starting to give more advice in as if you're basically part of the management of the organization. In other words, it could harm the separation of duties, and it would also result in the fact of the audit basically testing the internal controls which the auditor themselves had either designed and or implemented. And if that was the case, if the auditor designed and helped to implement the internal controls, then you have a clear kind of separation or a clear kind of problem in terms of the independence, you would think, right? So that's going to be one of the issues that you'll see often come up with these types of relationships between the public accounting firm doing auditing, needing to be independent, and then also as you're learning, as you're knowing this business, you're getting a better idea of this business than anybody else would, and therefore it's natural for the business to want more information, such as information that would be more on a management type of level, and the auditing firm needs to also maintain separation. So that's one of the kind of problems that go into place as we go forward and think about things like independence. We'll discuss more of those in a future presentation. This is COSO's Internal Control Integrated Framework. So here's our objectives. We typically are going to break these out to three types of objectives: reliability of financial reporting, effectiveness and efficiency of operations, and compliance with laws and regulations. As we consider these objectives, note when you consider internal controls in other words, you may hear internal controls and think of it in different types of frameworks. We are thinking about it in terms of financial statement auditors. We're auditors, and therefore we're thinking about internal controls mainly related to the reliability of the financial statements. But when you hear internal controls in a general kind of framework, it may be the controls over the reliability of financial framework, or they might be internal controls over the effectiveness and efficiencies of operations. Notice those aren't the same thing. They may be related, they may have overlap, but they're not going to be basically the same thing. The controls over the efficiency of the operations are designed to make us more and more efficient. The controls over the reliability of the financial statements are designed in order to make sure that the financial statements are capturing what is happening and being reported in accordance with some set of standards, possibly something like generally accepted accounting principles. Note that the controls over the reliability of financial reporting may coincide with the controls over the effectiveness and efficiency of operations. However, they may not in some cases. The fact that we need to put some controls in to make sure that the reliability of the financial statements is there may cost us in terms of effectiveness and efficiency. So they may not always be going the same way. We might have to put controls in that would reduce effectiveness and efficiency in some way in order to make sure that the financial statements are reported well. And then we have compliance with laws and regulations. And this might be seen very clearly for many people in laws and regulations related to something like safety. We might have laws and regulations like OSHA type of laws and regulations that would be required to maintain, to make sure that we're in accordance with safety regulations. That can also be designed or formed on the level or called, of course, internal controls. Now, when we're thinking about internal controls, we're not usually thinking about the safety internal controls because we're not auditing that. That's not what we're there to audit typically if we're auditing the financial statements. So although those are internal controls, they're probably not where we're really focused on, because our job is to give an opinion on the financial statements. So we're focused mainly over here on the internal controls that are related to the reliability of financial reporting. So internal controls related to the preparation of financial statements for external purposes are the internal controls related to an audit. That's what we're really looking for. However, internal controls related to operations and compliance objectives can be relevant when they relate to data auditor uses to apply auditing procedures. So there might be cases where the items will be relevant too, and we can take a look at the internal controls for them as well. But again, our focus, of course, is here with regards to our internal control. Be aware that when you hear internal control just generally outside of the realm of basically a public accounting firm, they may well be referring to something that's not what we're going to be focusing in on. They may be referring to the effectiveness and efficiency of operations or compliance with laws and regulations as opposed to reliability of financial reporting. In this presentation, we will discuss the effect of information technology on internal controls. This is, of course, a big area and a growing area with regards to businesses' internal controls and auditing, and it's an area where auditors often have to find help, often need specialists. In other words, the auditor is going to be able to know or want to know what type of audit procedures, what type of internal controls are necessary. For example, a good separation of duties. Work with the IT professional in order to see whether or not that separation of duties has been implemented into the database system, often with some kind of separation or restriction to the type of information that can be accessed through a database program. So obviously with larger and larger companies, there's going to be larger and larger IT requirements, larger restrictions of data, and so certain people are going to have access to certain types of things. And that's going to be one of the huge benefits that you can have. You can have a database program that allows different people to have this different access. One of the benefits that you have. So I notice when we think about information technology to businesses, a lot of times I get one of two reactions. One is a lot of excitement for the separation of duties that can be taking place and an increase in internal controls and a higher level of safety to some degree. And another with a lot of skepticism in terms of if we don't understand the system that's put together and possibly risk to something like hackers or something to get information that wasn't intended for them to have, or possibly internal controls that aren't well designed and the separation duty not being well designed for some reason, and therefore having some exposure to information that could be going to the wrong place is one of the major defaults or one of the major problems with technology. So let's go through some of the benefits, pros, and cons of technology here with regards to the internal controls. Benefits include consistent application of predefined business rules and performance of complex calculations in processing large volumes of transactions or data. So in other words, when we're thinking, of course, of large volumes of transactions or data, if we could set up a system that they're all going to be the same, in other words, if they follow the same set of rules, a database program can apply those very efficiently over a long period of time, much more efficiently, of course, than an individual can. So any kind of repetitive work that can be put together with a system of rules is something that's great, because the time will be better, and of course the consistency will be better as well. Facilitation of data analytics for enhanced internal decision making. So it could provide better analytical procedures, again, saving a lot of time with regards to the processing of the analytical procedure, the information. Now, I can't make the decision, of course, but just putting the information together, put it in those well-defined, once again, types of calculations that it can just take the information from and then generate that information for us in such a way that we can then decide on it is great. Greater timeliness, availability, and accuracy of information. So the information is usually going to be able to be put together more quickly with a database type program, more available because we have a lot more ability to get to the database program, especially now, considering it might be over the web or something like that, different access type of area for it. And accuracy is actually should increase if we use the system well. A system doesn't mean that it's going to be accurate for sure, because we could still find ways to have problems. But if we design the system well and we know what the system does well, calculations, then it's going to be accurate with regards to those calculations, as long as we put the input in there correctly. A greater ability to monitor the entity's activities, policies, and procedures on a timely basis. So once we have stuff into the system, we can do a lot of monitoring systems a lot more easily. And that's one great thing about these database systems, that we can have that separation of duties. We can have certain people be able to monitor what other people are doing while still restricting whether or not they can change that information that the other person does. And that allows for great separation of duty and great ability for supervision techniques to basically happen over that database type of system. Enhanced segregation of duties through security controls, applications, databases, and operating systems. So segregation of duties, that's one of the major internal controls that we're going to have. That's one of our checks and balances. The system will allow us to do that. So we'll be able to say, you only have control over this part, you only have control over that part, and therefore we'll be able to separate duties. So notice that as a company grows and gets larger, we typically have more internal controls, more separation of duties. And it can be, when you look at it from the worker's standpoint, and all you can see on your end is like, I only have limited access to this database program and I can't see what everything else is going on. It can be restrictive at the same time. Notice that too much separation of duties, too much restriction to people in terms of how much access they have to a certain database limits some things as well, because it is basically red tape. But you need to find that balance, and it's a great way. The database program is a great tool to be able to find balance in that. You can limit certain areas for certain people in terms of what they can access in the database program. Greater ability to prevent or detect circumvention of controls. So we can also have better supervision type of duties oftentimes to be able to track what's happening. We can actually see, who was in the database program, who's doing what within the database program. Risks, then, these are like basically the downside. Unauthorized access to data that may result in destruction of data or improper changes to the data. So it's quite possible when you have the database program, even if you put the right restrictions in, that people can get access to it, because of course, especially if something's on some type of online database program, nothing is completely secure, of course, and it's quite possible that you can have problems. If you don't have a well-designed database program, then it's quite possible that people are going to get the access to the data, or improper people are going to get access to the data, possibly do something such as an error, delete the data, or have some kind of changes or do something improper to the data. Reliance on systems or programs that, unknown to management, incorrectly process incorrect data, or both. If we have very complex database systems, this is happening more and more, because what happens is management no longer having to do the calculation, but just depending on the number that has been gotten from the calculation, no longer understands the complex calculation itself. So the data input, therefore, that you're going to put into the system in order to generate these types of calculation could be off, because a lot of times we don't know as much in terms of what needs to be input properly in order for the computer to do a complex calculation to get the right result. And once the result has come out, we may not be able to interpret it quite as well, because we're not understanding the process. We're not going through the calculations of it. So although the computer can do complex calculations, the ability for us to interpret them and also put in the data necessary to do them properly can actually deteriorate as we become more dependent on the computer to do the calculation. Unauthorized changes to system or programs. So there could be obviously unauthorized changes. We got to be able to make sure that we have controls over who is operating the system. Problem with that, one is that obviously the person that's designing the internal control system that has an idea of what the separation of duties should be is separate from the IT department that knows how to actually implement the segregation of duties in the IT process. And there has to be really good communication between those individuals to put into a separation of duties that works. Unauthorized changes to data, a similar kind of problem. Inappropriate manual intervention. So we could have manual interventions within the system that are not properly put in place again. And this all comes down to how well the database program is going to be set up. Potential loss of data. It's possible that we could lose the data. We always have to be thinking about how are we going to conserve the data, because if we're in a system where we're not basically saving everything off the system and basically putting it into a file somewhere like it used to be, where we have hard copies and whatnot, then all of our data is on a server somewhere. And the question is, of course, that server can be deleted. Can we lose the server information if there was a problem? How do we support this information? How can we possibly back up this information? That all becomes an issue as we get more information on a database system as opposed to a more of a traditional system. In this presentation, we will discuss internal control components. We're going to first go through it and we're going to list out the internal control components, and then we'll go into more detail on each of them. The first component, we have the control environment. We have the entity's risk assessment process, control component number 2, control component number 3, control activities, number 4, information and communication, number 5, monitoring activities. So these are the 5 internal control components. Let's now go into them in more depth, starting with the control environment. Number 1, set of standards, processes, and structures that provides the foundation for carrying out internal control processes throughout the business. The board of directors and senior management establishes the tone at the top of the business regarding the importance of the internal controls. When we consider the control environment, we are looking at that overall type of foundation, and an important piece is the tone at the top of the foundation of internal controls. We can think of this as internal controls having 2 separate components as we consider them. One is the design of the internal controls. How well are they designed? Do they do what they should do in terms of a good design? The second is going to be in terms of what's the implementation of the internal controls, which often comes down to the tone at the top of management. Does management think it's important to have these internal controls? Sometimes those controls actually making it more difficult to go through some of the processes that need to be done, but which are important in order to safeguard whatever type of assertion that control is being set up for. We as auditors are good at designing or thinking about what an internal control system should look like, but the implementation of the system is equally as important. We can have a well-designed system and have it not be implemented. And again, if the management at the top doesn't enforce the internal controls, these added steps often that have to be done in order to go through a process, in order to complete some type of assertion related to that internal control, then the controls will become more lax and will be less applied. So we want to be able to assess the overall environment and the attitude at the top of the internal controls, which will then flow through to the rest of the organization. Entity's risk assessment process, a dynamic process for identifying and analyzing risks to achieving the objectives of the business. Risk assessment helps the business determine how risks should be managed. thought is given to possible changes in the external environment and within the business model that could harm its ability to achieve its objectives. So obviously, when we're considering the internal controls, implementing the internal controls, we have to have an idea of the risks of the organizations, the risks of the business. Each organization risk is going to be slightly different depending on what type of industry they are in, how large the organization is. So we need to get an idea of what the risks are in order to basically set up and implement and decide whether or not the implementation of the internal controls are sufficient to mitigate the specific risks related to a specific organization. Next, we have control activities. Actions established by policies and procedures that help management directives to be carried out. Management directives to mitigate risks to the achievement of objectives. Control activities are done at every level of the organization and at various stages in the business process. So the control activities are the actual activities we have put in place these controls, or the actual actions established by policies and procedures to help management directives to be carried out. So this is actually what you can think of as basically kind of like the red tape that's going to be put in place. These are the actual checks and balances. The checks and balances, the policies and procedures that can actually make it a little bit longer to go through certain types of process due to things such as separation of duties for a process having limitation to what people can see in a database program as part of that separation of duty, possibly making the process longer, but helping to safeguard or implement some type of controls that will be related to some type of assertion that will be necessary. So we have to weigh the pros and cons every time we implement a new type of internal control activities. Information and communication. Information is necessary for the business to carry out internal controls responsibilities in achieving objectives. Communication includes both internal and external communication. It provides the business with information needed to carry out day-to-day internal control activities. Communication enables employees to understand internal control responsibilities and their importance to the achievement of objectives. It also allows for upward flow of operating information to management. So obviously, once we set up the control procedures, we need to be able to have good information, good communication. You can imagine this as setting up, we could say, okay, what are going to be the risks of the organization? How are we going to set up the internal controls? What are going to be basically the separation of duties? What are going to be the processes that need to be put in place to control activities? Then how can we implement that information? One, we want to have the thing to be set up well. We want to know exactly what the internal controls are as thoroughly as possible so that we can explain it as easily as possible. Then we need to communicate that in some way. So obviously, once we have the controls, some of them being items that might not be completely intuitive when we're trying to achieve simple business type objectives, because they may have goals other than what we would think of as the business objectives. And therefore, we have to basically communicate that information. We want to be able to communicate both the actual internal control, the procedures that need to happen, so that the employees understand the internal control's responsibilities and their importance to achievement. But they also need to understand the why. They need to understand the importance of it as well. If you can be able to implement the importance, that goes back to the environment in some way. And notice there's, of course, some overlap between these types of items. If the employees know both what the controls are, that they are important at the top, that the people at the top think it's important that we implement the internal controls, and they actually have an idea of why it is important, then of course they're going to be much more likely to implement those internal controls, even if it causes them a bit more problem within their day-to-day lives to achieve their other type of business goals that they're typically looking to achieve in a day-to-day process. Next, we have the monitoring of activities. Evaluations are used to ascertain whether each of the 5 components are present and functioning. Findings from evaluations are evaluated and differences are communicated, with serious matters reported to the senior management and to the board. So we can imagine this process. We assess the risk, we set up the internal controls, we implement the control activities, we communicate the control activities, and then of course we have to monitor the control activities. So if we find deviations within the monitoring activities, we're going to report them to the proper level of management and possibly to the board of directors, depending on the severity of the deviations. In this presentation, we will take a look at principles of internal control components. We're going to list out our 5 components of the internal controls, and then we'll list out principles related to them, those 5 components being the control environment, risk assessment, control activities, information and communication, and monitoring activities. We're going to start off with the control environment, listing the principles related to control environment. First principle, business shows a commitment to integrity and ethical values. So we're looking at this in terms of the controls of the organization, in terms of the organization as a whole, that the business shows a commitment to integrity and ethical values. Note, these things aren't always the easiest things for us to write down and communicate, but you can think about how can we get a feel for that. We're going to be, of course, talking to people, inquiring about it, and writing down our impressions of the control environment in terms of business shows commitment to integrity and ethical value. Principle number 2, board of directors shows independence from management and exercises oversight of the development and performance of internal control. You'll recall that the board of directors are represented and voted on by the owners, the shareholders. So therefore, they should be able to provide some oversight over management, which in essence are the people that they hire in order to act as agents of the shareholders. So the board of directors should show independence from management. The more independence from management, then, the more you would think the board of directors would have good oversight over management. Whereas if there's less independence from management, it would be a more difficult situation. You would think the oversight wouldn't be as good over the performance of the management. Third principle, management sets up with board oversight, structures, reporting lines, and authorities and responsibilities in the pursuit of objectives. So we have the setup and the board of directors being involved in this with the structure, the reporting lines. We have the business hierarchy, the reporting lines within it, and authorities and responsibilities in the pursuit of the objectives. What are the authorities and responsibilities? This is going to be really important because, of course, people need to understand their specific roles and responsibilities. It seems like a basic thing, but oftentimes people don't have a good idea of what their responsibilities are. Things fall down, in the middle between the responsibilities of 2 individuals possibly, and we don't know exactly who to hold accountable because it was never well defined in the first place. Principle 4, business shows a commitment to attract, develop, and retain competent employees in alignment with objectives. So we're looking at the types of employees that are being brought into the organization, and we might also consider the overturn of employees. Are they bringing up the employees that seem to be performing well, the best top performance of the organization? Are they basically retaining employees that are well-performing employees? Is there a high turnover of employees, and what's going to be basically the feeling of employees, which can be indicated in whether there's a high turnover or not, or whether they're basically able to develop employees within the organization. Number 5, business holds individuals accountable for their internal control responsibilities in the pursuit of objectives. This, of course, lines out with first determining what the responsibilities are for different individuals, and then determining whether or not the individuals have followed through with their responsibilities. And the people that aren't following through, we know who to hold accountable, and we want to be able to see that the people responsible for certain conditions or for certain objectives are the ones being held accountable if those objectives are not met. Next, we'll take a look at risk assessment principles, or principles related to risk assessment. Principle number 1, business specifies objectives with enough clarity to enable the identification and assessment of risks related to objectives. So when we're thinking about the risks, we need to know exactly what the objectives are, so that's going to help us to identify what the risks are. We need to be clear about that, and the more clear we are about that, the more clearly we can basically assess what those risks are and take action with regards to them. Principle number 2, business identifies risks to the achievement of its objectives across the entity and analyzes risks as a basis for determining how the risks are to be managed. Once we understand what the risks are, we want to see them across the organization, and then we can come up with a plan, of course, to see how we want to deal with those risks. How can we mitigate those risks? Principle 3, business considers the potential for fraud in assessing risks to the achievement of objectives. So we want to consider fraud, and we'll talk a little bit more about the fraud factors that can be put together, or what's going to increase the likelihood of fraud. We want to basically set up an environment within the organization to lessen the likelihood of fraud as part of the components of our internal control. So first we have to say, what are the risks of fraud. Some of those risks are going to be things that we can apply to any type of organization. Some might be specific to the type of organization that we are in. We want to see where the fraud risks are highest and put in policies and principles in order to mitigate them. Principle number 4, business entities and assesses changes that could significantly impact the system of internal controls. So we're going to identify and assess any changes. Anytime we have a significant change, we should have in our mind what is the internal control, what are going to be the risks related to any significant changes, and we should basically map out what are going to be the risks related to the significant change, make adjustments as necessary based on those changes and those adjusted risks. Next, we'll take a look at the principles related to control activities. Principle number 1. Principal selects and develops control activities that contribute to the mitigation of risks to achievement of objectives to acceptable levels. So now we're on basically the ground floor. We're talking about the control activities, the actual implementation and development and implementation of those control activities that are going to be put in place in order to contribute to the mitigation, the lessening of the risks to the achievement of objectives to acceptable levels. We're going to be thinking about things then including performance reviews as our control activities, physical controls as our control activities, the segregation of duties. This probably being the one that you want to think about first. When you think about internal controls in general, one of the first thing that probably comes into mind should be the segregation of duties. You probably think of things like performance review, or people, when they first think about internal controls, are probably thinking about some type of performance reviews. When considering audit and setting up the audit procedures and someone asks you about internal controls, the first thing that should come to your mind is really the separation of duties as one of the major functions and factions or areas of internal controls. Then we have the information processing controls. Principle number 2, business selects and develops general control activities over technology to support the achievement of objectives. So once we have these set up, once we have the control activities, we will set them up, and we're probably going to need technology in order to do this. We're going to have some type of database program as part of our internal controls. Oftentimes, that's going to allow us to do things like the separation of duties, like having the performance reviews through the interaction and the setting up of that database. And of course, we need IT professionals to help us with that part of it. So we set up the internal controls, work with IT then to help us to implement those by restricting or manipulating the database to give certain restrictions and assignments to different individuals. Principle number 3, business sets up control activities through policies that establish what is expected and procedures that put policies into play. So obviously, once we implement this information, we're going to actually put into play the policies and the procedures as we set this thing up. So we're imagining, of course, we set up the controls. Now we're going to in the part of the control system where we have to actually implement and put those controls into place, which involves us setting up the policies and procedures and implementing those policies and procedures. Next, we have information and communication principle. Principle number 1, business obtains, makes, and uses relevant quality information to support the functioning of internal controls. This could include identify and record valid transactions, classify transactions correctly, measure the value of transactions correctly, record transactions in the correct period, correctly present transaction and disclosures. Principle number 2, business communicates information internally. Communication includes objectives and responsibilities for internal controls needed to support the functioning of the internal controls. Obviously, when we set up the internal controls, we then need to have the good communication in order for people to understand those internal controls in terms of what is expected of them, as well as what the reason is to some degree, because that'll give them some incentive to follow through and make sure that they are implementing the internal controls, and possibly the feeling of well-being and self-worth as they go through the internal controls. Some processes which can seem like they're going to be something that's not contributing to the performance, but actually is when you think about it out on the bigger picture level. So principle number 3, business communications with external parties regarding issues affecting the functioning of internal controls. Next, we're going to take a look at monitoring activities, principles related to it. Principle number 1, business selects, develops, and performs ongoing and or separate evaluations to determine whether the components of internal controls are installed and functioning. So of course, we're thinking about the internal controls here in terms of what are the risks. We come up with a plan for internal controls. We then implement that plan with the control activities. We communicate that information, and then of course we monitor that information to see if the internal control processes are set up well, if they're implemented well, if they're doing what we would expect them to do. Principle number 2, business evaluates and communicates internal control problems in a timely manner to parties responsible for taking corrective action. If there's problems in the internal controls in terms of either the way the internal control is set up, not well designed, or in the way it's being implemented, not being implemented or followed through with, then we go to the appropriate level of management and discuss the implementation and or design at that point. Parties include senior management and the board of directors as appropriate. Obviously, if it's to the point where we can discuss this with senior management and take care of it, then that would be it. If it's something that's going to be a serious flaw in the internal controls and have substantial risk, then of course we would want to include the board of directors as well. Audit risk model. You'll recall that the audit risk model represents in a formula type format audit risk equals the inherent risk within, basically inherent in the organization or the type of business that we're in line with, the control risk, what we are talking about now, and then we have the detection risk. This is the auditors, basically whether the audit will pick up any problems within the auditing process. These two, recall, are kind of on the business side of things. What industry they're in, what's inherently risky about the business ventures that they are in, that's their decision to be in that business and take on those inherent risks. The control risk is what they are designing in their bureaucratic system as they set up their business model. That, of course, is the component that we're focusing on here when we consider the overall audit risk model. In this presentation, we will take a look at an internal control flowchart mapping out the processes and procedures related to internal controls. Starting off with the develop and understanding of internal controls by evaluating the design of controls, determining if the controls have been implemented. So that's the first thing we're going to do. We're going to say, hey, what are the internal controls? Could you give us the design of the internal controls? And then we want to determine whether or not the internal controls have been implemented. Next, we're going to document the understanding of the internal controls. So once we have that understanding, we, of course, as auditors gathering evidence, will then document that understanding. And then we come to the question point. That's what this red box then means. So we have a question, a yes or no type of question. Does the auditor intend to rely on the controls? So at this point, we have to say, do we rely on the controls or not? Now, if we're thinking about a publicly traded company, we will probably be saying, yes, we're going to rely on the internal controls. If we cannot rely on the controls, we're in big trouble because we typically can't do enough substantive testing in the time frame given to really support the full audit of a publicly traded company. However, if we have something less than a publicly traded company, it may well be the case that we don't intend to fully trust or rely on the internal controls, and therefore we're going to do more substantive testing. So remember, at this point, publicly traded company, are we gonna rely on the internal controls? We hope we can at this point, or else we're gonna have to take into consideration what we're gonna do going forward, whether or not we can basically finish the audit within the scope of it. If we're talking about a smaller company, we may say no, and in that case, we're gonna do more substantive testing. So you can imagine if we have a smaller company, we're gonna say, okay, this internal controls aren't something that we can completely rely on. What are we going to do then? We're going to do a substantive strategy, meaning we're going to set control risk at the max. We're going to say control risk is high, meaning there's a high risk that the internal controls set up by the organization, by the business, will not detect a material misstatement. And therefore, we need to do more testing on the substantive testing side. So what are we going to do? We're going to increase the amount of the substantive testing instead of wasting our time or going further thinking about testing the internal controls, which we've determined not to be sufficient and therefore not something that we rely on within our audit process. Therefore, instead of testing internal controls, we're going to go straight to what we would think of as the more kind of substantive test, the test of going right to the accounts in essence, and start to test assertions related to account balances and transactions. If we can rely on the controls, which again we will have to, hopefully to some degree for large organizations, publicly traded companies, then we're going to look at a reliance strategy. and we're going to plan and perform tests of controls. So if we're going to rely on the internal controls, what we're going to do then is then do further planning and testing related to the internal controls, because it should be easier to test the controls, the checks and balances in the system, as opposed to just trying to check the end result, all the transactions that are resulting from the checks and balances. So we're going to go in and basically check the checks and balances of the system, depend on it hopefully, and therefore, or be able to depend on it hopefully if we trust them, and then we can do less of the actual substantive testing. Set control risk based on the test of controls. So once we test the controls, then we'll set the control risk at that point in time. Then we're going to ask ourselves another question at that point in time. Does the achieved level of control risk support the planned level of control risk? So have whatever control risk we then set after looking at it, does that meet what we've decided on in terms of our planned control risk? And then if the answer is no, then we're going to revise the planned level of substantive testing. So in other words, if we have a Reliance strategy, we're going to set the level of basically the control risk, and then we're going to do the testing, and if we have to make an adjustment, then we make an adjustment and we adjust then and revise the level of substantive procedures. So in other words, if we cannot, if the control risk is different than what we assess the control risk to be in the planning stage, we're going to account for that by revising the level of substantive testing on the account level and the assertion level, the transaction level, as opposed to on the checks and balances or internal control level. We'll document the level of control risk that we have determined to be, and then we'll perform the substantive procedures based on the level of assessed control risk. So obviously, once we set the control risk, then we can move on to the next stage and say, okay, now we can determine how much substantive testing we need to meet our objectives, go down to the ground floor, the actual kind of thing that most people probably think of within audit, is and actually dig into those accounts on the substantive level, going through accounts and transactions related to them. If, on the other hand, going back up to this red item, we asked this question, does the achieved level of control risk support the planned level of control risk? If the answer is yes, it does, then we're going to rely on those controls, and we'll go forward and go straight down to the performed substantive procedures based on level of assessed control risk that we have determined. In this presentation, we will discuss a substantive and reliance strategy. In other words, we will be comparing and contrasting a substantive strategy and a reliance strategy. So once we have an understanding of the internal controls, the auditor can then decide on following a substantive strategy or a reliance strategy. So we have an understanding of internal controls, then our question is, what type of strategy are we going to follow? If we're going to follow a substantive strategy, that means that the strategy sets control risks high for some or all assertions because of one or all of the following factors. When thinking about substantive strategies, it's easy to kind of get the concept down sometimes, but still mix up which way things are going. And when we think about test questions, when we think about something like control risk being high or control risk being low, what's that mean for substantive strategies? It's easy to get kind of turned around on that. So when we think about a substantive strategy, you're thinking about basically the inline type of strategies, meaning we're going to be relying on kind of the ground level work, the kind of more of the grunt work, where we're typically going to be needing a lot more of it. The substantive tests, you can think about the types of tests being out there. We're going to be out there at the business, where the auditors were out there at the business. We're asking them to pull files, give me some invoices, give me some bills. We're going to be testing this, tracing this, tracking this information. A lot of work on the substantive testing. So if we have a substantive strategy, we're relying basically on the more work strategy, us actually going out there and doing more digging into the operations of the organization. So the reason we would have a substantive strategy is because we're not reliant on internal controls. For some reason, we've decided that the internal controls are something that we couldn't rely on. And so if we can't rely on the internal controls, we're going to be doing more substantive, more actual work type testing. Now, once you have that down, you need to basically understand that that means that control risk has been set high. So we actually set the control risk high. What does that mean? So you recall that the control risk is going to be one of our risk factors. If we say the control risk is high, then that means that there's a high risk that the internal controls that were set up by management will not catch a material misstatement. So that means, so the control risks being high, in other words, means that we think that the internal controls are weak for whatever reason, and therefore we can't rely on the internal controls. And so we're going to skip more testing of the internal controls and go straight to the more difficult or longer testing of the substantive type testing, actually going out to the client, picking up those files, give me some bills, give me some invoices, let me trace these and test these and track these back. So that's going to be the information. So a substantive strategy sets control risk high for some or all assertions because of one or all of the following factors, which could include controls do not pertain to an assertion. So the control setup might not be something that's tied out to that specific assertion that we are testing for. Controls are assessed as ineffective. So they might have internal controls that are put in place, but if they're not effective and or they're not effective for the particular assertion that we're trying to test for, then that's going to be a problem with the internal controls. Testing the effectiveness of controls would not be efficient. So it's possible that the internal controls are in place, but we just can't test. Testing the effectiveness of the internal controls maybe would be more difficult, take more time than the substantive testing in some particular cases, in which case, why would we do the more work? We're doing less work. We're trying to do less work. That's the point of us relying on internal controls in the first place. If it takes us more work to do the internal controls or test the internal controls than do the substantive testing, then we'll do the substantive testing. Our reliance strategy, the one that we hope to be using and almost have to be using for publicly traded companies, but may not be using for smaller than publicly traded companies due to the fact that we need to rely on internal controls for publicly traded companies in order to have the scope of the audit fit into the time frame that usually will be necessary for them, whereas smaller companies don't usually have the ability to implement the same internal controls. Therefore, we're going to rely on the internal controls. So under our reliance strategy, the auditor plans to rely on internal controls and assesses control risk at a lower level. So now we're going to say, at this time, we're going to say we've looked at internal controls, we have an understanding of internal controls, and therefore we're going to rely on the internal controls. We think they're good, and therefore we can rely on internal controls and do less of the actual substantive testing, the more groundwork type of testing. So in terms of lower or higher, what that means is the controls assess the control risk at a lower level. So we're going to assess the control risk low. What does that mean? It means that the risk of the controls not detecting material misstatement is low, which means the controls are strong. So if the controls are strong, the control risk is low. The risk that the controls that are being set up, the separation of duties, doesn't catch the error is low. So we're going to set the control risk low, and therefore we can depend more on it and do less of the substantive type testing, given the fact that we are depending on the controls, and therefore set the detection risk higher. And the detection risk being that our substantive test, our audit process, won't catch a material misstatement. We can actually make that higher because we're relying on the controls. So we can have a higher detection risk, lower on the control risk, and still be within the range that we have planned for in our audit strategy. In this presentation, we will discuss assertions about classes of transactions and related control procedures. In this presentation, we will take a look at assertions about classes of transactions and related control procedures. So we're going to think about the assertions related to implementing the internal controls. So we're thinking about management putting together their internal controls. They're basically sets of checks and balances. We're going to consider the assertions for which they would want to put controls in place for, and then the type of control activities, the actual putting in place of those controls that would relate to those assertions. Now, this is going to be important for us to know because it's often something that people get confused on, both in a testing situation and in practice, because we often start to just basically memorize different types of controls. And we say, well, you just have to put this control in place, and that's just it. That's just the way it is, because that's where I was last time. I learned a system of controls. These are the controls. You need to put those into place. And when we're testing, we often do the same thing. When we're actually testing these assertions and the different sets of controls from the audit perspective, we do a similar process. We need to test this particular test. But from a test standpoint, as well as the implementation, we need to know the whole process to really do it well, because each business is different to some degree. So we need to first think about what the assertions are, and then think about the types of controls that would be put in place in order to achieve those objectives. Now, some of them will be universal. Obviously, everybody has a bank account. everybody should be reconciling their bank account and doing certain things over cash. And you could basically say, hey, those controls are universal, but you should still basically know the assertions related to it because we want to know the whys. And that'll help us really to customize the internal controls, which is what we want to do. We want to basically say, hey, what are the risks for this particular organization? And then put in a set of controls related to those. And one way to think about that is the assertions. Also, test questions will break out in this format in two, which students have a lot of trouble to pick up, meaning we'll think about the types of control activities, but possibly have difficulty tying those control activities out to the proper assertion. So you want to be able to pick that up. So first we have the assertion of occurrence. So what type of control activities would be related to the assertion of occurrence? We have things like the segregation of duties. And remember, occurrence basically means you're kind of thinking about the completed work, the financial statements, the GL, with the books being put together. And then you're trying to say, is the stuff that they put on the books, did it actually occur? The testing that actually occurred. Or from the management standpoint, we have this stuff in the end product. On the financial statements, we want to see if that actually happened in terms of occurrence. So did it actually happen? So we're going from the end result backwards typically. So we could have segregation of duties. It's going to help with the assertion of occurrence. Segregation of duties, one of the major type of internal controls that we will have, because it'll mean that we typically have two people involved in most systems, and therefore it's less likely for an occurrence problem to be due to error or due to something like fraud due to the segregation of duties. So segregation of duties, if we don't know an answer to a test question, probably a decent guess to go for the separation of duties, the segregation of duties. Pre-numbered documents that are accounted for. So if we have the pre-numbered documentation, that can help us with the occurrence. Daily or monthly reconciliation of subsidiary records with independent review. So we want to think about the subsidiary records, things like the accounts receivable subsidiary ledger, breaking out by customer, tying that out to something like the general ledger account with a independent review. Completeness. Now we're thinking about completeness. Now we're kind of thinking about the other side of things. Occurrence, we're going from the end result back. Completeness, we're thinking about are there transactions that happened that should have been recorded financial transactions but weren't? They didn't make it to the GL. They didn't make it to the financial statements. How can we set up internal controls to reduce that, to be able to say that the assertion of completeness has been met and have controls to be somewhat confident of that? We could have pre-numbered documents that are accounted for, so that pre-numbered documentation is going to give us a check. We could have the segregation of duties. Once again, segregation of duties, making it less likely that an error happens, that we didn't record a transaction if there's more than one person involved in the recording of that transaction process. It also makes it less likely that there's something like collusion or some, it would take collusion, two people getting together to commit some type of fraud intentionally, not making the financial statements complete for some reason. Daily or monthly reconciliation of subsidiary records with independent review. So we're going to do that same process of looking at those subsidiary ledgers and reviewing them to make sure that they tie out to what is on the actual financial statements. Things like the accounts receivable subsidiary ledger by customer, accounts payable by vendor. Then we have authorization. Do we have the proper authorizations within our control system? We have general and specific authorization and transactions at important control points. We want to make sure that we have those authorizations in place in those specific control points, and that we're basically able to show that those actions are taking place, that the authorization is happening. Accuracy, internal verification of amounts and calculations, monthly reconciliation of subsidiary records by independent persons. So obviously accuracy, we want to see if things being reported are accurate. So we have internal verification of amounts and calculations. We want to verify different types of calculations, especially calculations possibly that might be a little bit more unusual, things like calculating the allowance for doubtful accounts or depreciation. And then monthly reconciliation of subsidiary records by an independent person, once again, will help us with that accuracy, because things like the subsidiary ledgers for the accounts receivable and accounts payable, making sure that those are lining up and tying out to the ledgers, as well as something like inventory and things like that will be tying out to the primary account. And then we have the cutoffs, which have to do with the end of the period and the beginning of the period, the proper timing of the information. Is it reported in the proper time period? You're thinking of things like adjusting entries with financial statements. Those are the timing type of entries to make sure that we have properly aligned with the typically accrual principles of revenue recognition and matching or expense recognition. Those are procedures for prompt recording of transactions and internal review verification. So the prompt recording of transactions is going to help us to not have that problem of, say, recording an invoice that the work was done before the time period ended, but we didn't invoice till after the time periods ended, and therefore we recorded the revenue afterwards. The closer we're able to record transactions to the date that the transaction happened, the more likely we're going to not have like cutoff issues where we have these timing problems. And then we want internal reviews and verifications. Next assertion, classification and presentation. Internal review and verification as part of the control activities and the chart of accounts. In this presentation, we will discuss the process of an auditor obtaining an understanding of internal controls. So we've discussed what internal controls are. We've discussed the fact that the internal controls are the responsibility of management. We've discussed the factors for management to set up a good system of internal controls. Now, of course, we'll be thinking about those internal controls from the audit side of things. So we, on the audit side of things, need to have an understanding of what good internal controls are, and therefore be able to audit think about whether or not the company we are working with have implemented the internal controls well. Therefore, as we consider the auditor's objectives on the internal controls, or us reviewing the internal controls from the auditor's perspective, we're going to go through some of the similar points that we've seen in the past as we thought of what good internal controls are, but now, of course, from the perspective of us auditing and thinking about whether or not we as auditors can rely on the internal control system set up by management. Auditor will obtain an understanding of each of the 5 components of internal control to plan the audit. So we had the 5 components of the good internal control, including the control environment, the entity's risk assessment process, control activities, information and communication, and monitoring. We, as the auditor now, going to go look into those 5 components and get an understanding of each. Our objective is to identify types of potential misstatements, identify the factors that affect the risk of material misstatement, and design test of controls and substantive procedures. So, of course, our goal is to get an understanding of the internal controls in order to identify types of potential misstatements to see because our objective as the auditor is to determine whether or not the financial statements are put together in accordance with a set of standards such as generally accepted accounting principles, identify those factors that affect the risk of material misstatement. Once we have an understanding of that, we can design tests of controls, whether or not we want to further test the controls to see if we want to rely on them, and or the substantive test, the actual groundwork testing, the main, larger portion of the testing we would need to do within our audit process. Understanding internal controls includes an understanding of the control environment, the entity's risk assessment process, the information system and communications, control activities, the monitoring of controls, those 5 components. Documenting the understanding of internal controls. Our documentation of the internal controls will take various forms, including procedures manuals and organizational charts. We'll include things like flowcharts. We'll have internal control questionnaires. So when we have the questionnaires for internal controls, and the narrative description, we'll have a narrative description of the internal control. So as we think through and process through the internal controls, you can imagine us looking at these types of objectives and trying to document the evidence. And remember, we're trying to get an idea of the internal controls. We want to gather evidence related to the internal controls depending on that internal controls for the opinion that we will give. Therefore, we're going to imagine filling our buckets up of the evidence that we need to gather in order to issue a good opinion. And these are going to be types of things that we can put together in order to fill that bucket up, in order to provide us with evidence with relation to the internal controls. You can imagine the internal controls aren't always the easiest thing for us to test. So they're going to have some subjective nature. So part of our analysis of the internal control are going to be things like interviews, and therefore we want to know what the organizational charts will be. We can have flowcharts within the process. What are going to be the internal control process? And we're going to have things like questionnaires and possibly a narrative type of format. in terms of what our results were when we went through things such as inquiry. Now, note that the entity size and the internal control, as we've mentioned a few times in the past, will be a factor. If we have an entity that's going to be small in nature, we would expect the internal controls to be small and therefore not be able to rely on them. If we have a larger entity, publicly traded company, for example, we would expect the controls to be strong, effective internal controls. So just remember, if you're auditing someone that's going to be smaller, if you're working for a smaller firm that audits, say, a particular niche or something like that, as opposed to a larger firm that's auditing publicly traded companies, then you may well be in a situation where you cannot rely on the internal controls totally. They should still have some internal controls, but you probably won't be able to rely on internal controls in the same fashion because they just don't have what would be necessary to implement strong internal controls. They don't need them. I mean, they can't do them and be cost effective at that level. And as a company gets larger, they really need to do them in order to safeguard against large risks that could result if they had not implemented sufficient internal controls, and therefore we as the auditor can depend on them more likely in the large organizations. Limitations on internal control. Now, once we set up the internal control, we need to have an inherent idea of the inherent limitations within internal controls. Although we will rely on internal controls, we can't rely totally on them. We can't rely totally on things like checks and balances because there's still problems. One main problem is collusion. You'll note that collusion, is kind of like a bad word for communicating together because what it means is the separation of duties usually means that we're trying to separate duties so that it would take multiple people to commit a fraud. So if someone committed fraud or even an error, it would take multiple people to commit a fraud. Now, if people wanted to intentionally commit a fraud and they went around the separation of duties by colluding, by talking to each other and then planning to basically commit a fraud that could be committed if only one person was in charge for two types of system items, including, say, recording and possession of something like assets. If one person was in charge of that, they can basically have a higher likelihood of committing fraud and not having a problem or not being caught. If we have a separation of duties, there's less likely they'll be caught. But if they collude together, plan together, and then commit fraud together, that's going to be something that internal controls cannot typically eliminate entirely, that kind of problem. Then we have human errors. Obviously, there's always a problem of human error, even within a good internal control system. Now, a good internal control system will limit the human error because that's going to be one of our objectives. So a good system will be able to catch more human error. That's going to be one of the things we do, but human error is always going to be a problem within a good internal control system still. And then the management override of internal controls. To an auditor, this is the most concerning for us. And that's why we're really concerned with, on the front end, whether we're dealing with management, and when we consider the control environment, we're trying to see if management, if people at the top have integrity, and if they basically are going to be implementing the internal controls well throughout the organization, if they feel that a strong internal control system is good. Why? Because if management wants to circumvent internal controls at the top level, they can basically do so because they're the ones they don't have you can't really have separation of duties from top management. They're the ones that are in essence enforcing, so they can go around that separation of duties. So this is going to be from a high problem in terms of the financial statements being materially misstated. This would be the one that would be kind of most concerning from an audit perspective. Hopefully, we're again dealing with clients that have good board of directors, good oversight, and management with integrity. Those are the type of clients we're trying to pick up. But that's going to be the one of these factors that could result in the largest misstatement would typically be this one here. Assessing control risk. So when we as auditors go through the assessment of control risk, remember we're going to set control risk high or low, and that's going to help us to determine how much substantive testing we want to do. So we're going to identify specific controls relied on. What are the controls that are being relied on? Then we're going to perform tests on controls on them. So we'll actually test those controls. We're going to be doing testing of the internal controls as opposed to substantive testing of accounts and assertions related to transactions, testing the controls, and then we're going to conclude on the achieved level of control risk. Then we're going to make a conclusion. We're going to say what we think, how strong or weak we think the controls are, whether or not we can depend on them. That being our assessment on the control risk. That'll help us to determine the amount of substantive testing we will need. In this presentation, we will discuss performing and documenting tests of controls, starting off with the performing of tests of controls. Recalling what tests of controls are, they're going to be the responsibility of management. Management setting up the tests of controls, the control system, often including some format of checks and balances, some separation of duties. We can imagine then, how could we as the auditor go in and test the internal controls? Well, a large part of it is going to be us going in and having inquiry, asking questions about the internal controls. Now, we already have an idea of the general set of internal controls, obviously. We as an auditor, we're going to say, hey, there's some set of internal controls that I have an idea of, some that would apply to basically any type of industry, some that might be specific to this particular type of industry. We want to then go in with our understanding of what we would think of as controls, make inquiries about what controls are in place. Obviously, many of those inquiries will be talking to top management, as well as the people that are involved in basically regulating the internal controls. So we'll get an idea of the internal controls. Now, you might be thinking, how is that a test on the internal controls? Well, of course, first thing we need to do, it's not the most reliable test to actually just get a map of the internal controls that should be in place by management, who is the people that basically we are, in essence, reviewing. However, if we get an independent idea of what the internal controls are from management, we can compare and contrast it to see whether or not it lines up to basically our idea of internal controls, or our idea of what assertions they should be basically putting controls in place for. And so we're going to get their idea of what the internal control is, and we're going to basically be able to map that out to what we have. Now, of course, that doesn't test whether or not the internal controls are being put in place correctly or not. It just gives us an idea of what they're telling us the internal controls should be in a narration type form typically. Inspection of documents showing the performance of the control procedures. Now remember, whenever we think about controls, we think about two sides of it. One, do you have internal controls? Do you have a good system of internal controls? Is it mapped out? Does it go along with the assertions that we would expect to be in place given your industry? And two, are they actually being implemented? So this would be more on the implementation side. Now we're going to say, okay, this is what we believe the internal controls are, considering our inquiry. We know what the internal control system should look like. Now we're going to see, are they actually happening? Are they being put in place? We could do that with inspection of the documents, showing the performance of the control procedures. We're digging into the documentation, not doing substantive testing now, testing the controls, testing the procedures, testing the checks and balances. Observe the application of the control procedures. So we can go in and actually do observations to see if the control procedures, the checks and balances, the oversights are happening, the separation of duties are happening. So we're doing audit work that we would typically think of, you might think of on more substantive testing, where we actually go out and do some observation here. But here, no, we're not doing testing of the account balances. We're doing testing of the controls, because if we can ascertain that the controls are in place, are strong, then we can do less of the substantive testing there. So we're still at the facility, at the client's place, instead of as the homey office over at our auditor's office, but we expect to be able to spend less time over at the client's place over here by testing the controls, as opposed to us doing a lot more testing over at the client's place, having them pulling invoices and doing other substantive type testing on the substantive level. And then we have the reperformance of the application of the control procedure by the auditor. So of course, if we want to test the controls, whether they're done well, we could reperform the control in certain circumstances and see if we come out to the same result. Next, we're going to document the level of control risk achieved. Documentation may include working papers. So of course, we're going to put together our working papers as we do our testing as documentation. We're thinking about that documentation that we're going to be piling up the evidence. The controls are going to be a part of our evidence, not just the substantive testing. The controls are part of our evidence to verify and back up, support our opinion. Internal control questionnaires. So we're going to have internal control questionnaires supporting our opinions, and memorandum type of formats. We're going to have memo type of formats, a more narrative type of format that will be supporting our documentation as well. In this presentation, we will discuss substantive procedures. The substantive procedures are going to be those main things that come to most people's minds if you're thinking about an audit of financial statements, because these are the types of things where we would actually go into those accounts, dig into those accounts, go to the client's office and start digging through invoices or asking for invoices and bills and things of that nature. It's also the largest bulk of testing, where we would spend the most amount of time. It's the most time-consuming amount of testing. Note that we will first consider the internal controls in order to then decide how much substantive testing is needed. As we think about the substantive testing and the types of substantive testings, we need to think about our detection risk strategies. Now, we've looked at this to some degree with the control sides of things, because remember that if we can rely on controls, then we're going to rely on controls and do less substantive testing. So we often call that a either low detection risk strategy or a high detection risk strategy. So what does that mean? If we're going to say that something has a low detection risk strategy with regards to the substantive test, we're basically talking about substantive testing in that case. That means we've set detection risk to be low, and that means we need to do more substantive testing, meaning detection risk is the risk that our audit does not catch a material misstatement. If we're going to set that risk to be low, then we have to do more testing so that we are more likely to be able to catch a material misstatement in the financial statements. And that means if the detection risk is set low, that means we're doing more substantive testing, which likely means that we didn't rely completely on the controls. In other words, we decided that the control risk or the controls weren't as strong as they could be. Therefore, we set the control risk to be high, meaning there's a fairly high risk that the internal controls will not detect a material misstatement, and therefore we had to set the detection risk low, resulting in us doing more substantive testing. So it makes sense when you think about the relationship between the controls and the testing, but when you start thinking about the detection risk and it going up and down, you got to keep straight what it means for detection risk to be low and detection risk to be high. So given this, we're going to say the nature then, audit test for every significant audit assertion using these kinds of audit tests. So what we're going to do basically, if we have a low detection risk, we have to do a lot of testing. So we're going to do audit tests for every significant audit assertion because we need to be more thorough with it. So we'll have physical examination, review of internal documents, we'll have confirmations and reperformance, the extent, testing of significant accounts and transactions. And recall that this is going to be, of course, more extensive given the fact that we set a low detection risk. If we have a high detection risk, that of course means that we are relying on the internal controls, meaning we said the internal controls are strong, therefore the control risk is low, the risk that the internal controls will not catch a material misstatement is low, therefore we can rely on them and do less substantive testing and therefore set the detection risk high, meaning we're basically saying we're doing an audit with less substantive testing. It's more likely that our audit might not detect a material misstatement, but we're okay with that given the fact that we believe the internal controls are strong. So we're going to set the detection risk high, meaning we're doing less substantive testing, and it's more likely then, if we do less substantive testing, that our substantive tests will not be able to catch a material misstatement, but our overall audit average for the audit risk will be okay given the fact that the internal controls are being relied on. So with a high detection risk strategy, the nature, corroborative audit tests using these types of tests, we're going to have still physical examination, analytical procedures, substantive tests of transactions and balances. And then the extent is going to be limited testing of accounts or transactions. So of course, we're going to limit the number or the amount of testing of the transactions to a lower level than if we had a low detection risk. Now, consider the timing of the audit at this time. When we consider when are we going to do these types of procedures, you might start to think, hey, most of the companies we work with will have a December 31st year end, and that means we're going to be really busy at the end of the year, because you would think then that we'd have to wait till the end of the year, of course, then we'd have to get the information, then we'd have to start to prepare and test the financial statements. In other words, if we're trying to test for the accuracy of the financial statements, it would make sense that the financial statements would have to be created, which means the period would have to have been ended. Then they would have to put together the financial statements and give them to us. where we can then take that data and review that information at that time, sometime after the year end. So given that that's typically the way we would think about things, which means the year-end process is very busy. Of course, it is very busy in a CPA or a public accounting firm. However, there are types of things we might be able to be doing in the interim. And that's what we want to think about all the time when we do the audit. We want to see how can we plan this thing to be as efficient as possible. And to be as efficient as possible, we would like to see what types of things we can do in the interim and what types of things we have to do at the year end, so that we can basically utilize the entire year as well as possible and save that valuable time, which is going to be at the year end as much as possible. Now, note as we do this, of course, if we're talking about important stuff or we're talking about things that are going to be more risky, then we have to wait till the year end because we want to test the entire year. But if we're thinking about different types of things like how the system works or the internal controls and how the internal controls are set up, we might be able to test some of those things in the interim, because that's going on the types of things that are going to be format or structure based and or things that possibly were okay last year, or we'll take a look at some other reasons why we might be able to go in the interim before the year end and do some testing and hopefully save some times within our audit process. So if we consider basically a timeline, we have the start of the year, we're going to have the end of the year. So the start of the year here, we might have then some interim test of controls, say in July. Now, if we could test the controls, we can go in there and do some tests of controls in the middle of the year. And it could be the case, well, then we tested them in July and then the company just totally threw away all their controls right after we tested them for the rest of the year. Possible, not likely, because the tests of controls are something that's going to be a systematic process. And we do want to test that during the year, because once the year is ended, if we were to go in and test the controls and do things like observation, we're really testing the controls that are being applied in the following year. So test of controls is actually something that we would like to go in and see what those controls basically look like periodically through the year. And that'll also save us time at the year end when we do the audit. Now we're going to have the year end process here. The substantive testing then, the year end, we're going to say here's basically December. Most of our substantive testing, we might be able to, do some at the last month of the year, basically. And then, of course, at the year end, and then sometime in January is when we're actually going to have the full GL that's going to be set up, because the company's going to say, yeah, the year's over, but I haven't finalized all the books yet. I'm not ready to have everything finalized for the audit at that point. So we can do some testing closer to the year end, and the testing that we do closer to the year end, we're usually more comfortable with because we have more information, more of the year to test. But then, of course, once we get that financial information, which will probably be after year end, once the company says, "Hey, I've finalized this. I've closed out the year. Basically, here's the financial statements." That's really when we go and we can do the bulk of the substantive testing, and we might do that all the way up to March, or however much time it takes for us to take that information and then complete the audit. So just note, as you do the audit, we're really going to be conscious of this timeline, of course, and most of that valuable information is going to be after the year end when we can apply most of the tests. However, we want to pull as many tests into the interim as possible to make it easier to save that valuable time at the year end. So how might we do that? Well, the interim test of controls could think, so if we're doing test of controls within the year then, as opposed to at the end of the year, the interim test of controls, assertion being tested is less significant. So if we have an assertion that we don't think is the highest significant assertion, we might do it in the interim because we still want to test it, but it's not the most important thing. And if it is, then we would want to do it at the year end because we want to basically test the entire year on the really important things. Control has been effective in the prior years. So if we've audited before and we've said, hey, this control is pretty effective, we don't see any change in this control, and so therefore we see fairly consistent control here, let's go in and test it in the middle of the year, and that might be an efficient way to go. Efficient use of staff time, so it could, and we always are looking at the efficient use of our staff time. Interim substantive procedures, so these are the substantive procedures, which you might think is a little bit more difficult oftentimes to do the interim testing of the substantive procedures, to go actually in there and test accounts. But we can do that to some degree, of course. It's just that we might have to go in and do the testing at the middle of the year because we only tested half the year, and we'll have to go back in and probably do more testing at year end at that time too. So we can test things in terms of substantive testing, which is basically the groundwork or the bulk of the testing after we think about the internal controls. How much substantive testing will we need? By testing the control environment, we can the reason for substantive procedures. We can consider what type of reasoning there is for substantive procedures and think about those types of aspects with relation to substantive testing. Assess of material misstatement, nature of transactions or balances, and relevant assertions. What's the nature of the transaction and assertions? Ability of auditor to perform appropriate procedures for the remaining period. In this presentation, we will discuss internal control matters and the communication of them. Internal control matters including control deficiencies, significant deficiencies, and material weakness. So we're going to go through the definition of what a control deficiency is, what a significant deficiency is, and what a material weakness is. Starting with the control deficiency. A control deficiency is when the design or operation of a control does not allow management or employees in the standard course of performing their assigned function to prevent or detect and fix misstatements on a timely basis. So let's go through that again. So the control deficiency, obviously we're having a problem with the internal controls here. So this is going to be, and we're going to report it as a control deficiency. It's when the design or operation, so the design or the operation of the control that's been put in place, does not allow management or the employees, so the employees that are involved in this process, in the standard course of performing their assigned functions. So we can't sit there and say, well, they could have done it if they did these other things that are outside of what they're assigned to do. No, the control means that it's in their assigned function to prevent or detect and fix misstatement on a timely basis. So it's not allowing them to prevent or detect and fix on a timely basis the misstatement. That's going to be a deficiency in the control, of course, leading to a higher risk that the misstatements are going to be misstated in some way. Then we have a significant deficiency. We're stepping it up a level to significant deficiency. One deficiency or a combination of various deficiencies with internal controls that is less severe than a material weakness, but is significant enough to merit attention by those in charge of governance. So let's read that one more time. Significant deficiency, one deficiency or a combination, so we might be talking about a single deficiency or a combination of them, with internal controls. So obviously we're talking about the internal controls, the procedures to safeguard over things like the financial statements being represented in accordance with a set of standards like generally accepted accounting principles, that is less severe than a material weakness, which is going to be the next thing we'll look at. A material weakness, this is less severe than a material weakness, but is significant enough to merit attention by those in charge of governance. So it's something that we would want to bring to the attention to those in charge of governance. Then we're going to go to the material weakness, again, stepping it up a notch. Material weakness, a deficiency or a combination of deficiencies in internal controls resulting in a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected and fixed on a timely basis. So this is going to be pretty bad here. We're going to say now we're on the level of the material weakness. That's one of our key terms, material weakness. A deficiency or combination of deficiencies in internal controls. So we're considering, once again, the internal controls, those procedures, those safeguards, that red tape, in essence, that's put in place, checks and balances, resulting in a reasonable possibility. So we have our term reasonable possibility for a reasonable person to think that a material misstatement, so now we have a misstatement that is material in nature, which are the ones that we as auditors are, of course, most concerned of the entity's financial statements, which of course is what we are auditing, what we're concerned of here, the financial statements, will not be prevented or detected and fixed, which means there might be a material misstatement that the control will not be picking up on a timely basis. So that's the material weakness. In this presentation, we will review internal control deficiencies and then discuss the communication process for those internal control deficiencies. So first we'll go through the definitions. We've seen this in prior presentations, so I'll go through this a little bit more quickly Control deficiencies are when the design of operation of controls does not allow management or employees to prevent or detect misstatements on a timely basis in the normal course of performing their functions. Then we have the significant deficiencies, a step up. Significant deficiencies is one control deficiency or a combination of control deficiencies in internal control over financial reporting that is less severe than a material weakness, but important enough to merit attention by those responsible for oversight of the company's financial reporting. Internal control deficiencies. Control deficiencies can be serious enough to be more than a significant deficiency, also being considered a material weakness. So the next step up is a material weakness in the system of the internal controls. So if we have a material weakness, that of course is a more severe problem. A material weakness are a deficiency or a combination of deficiencies in ICFR, resulting in a reasonable possibility that a material misstatement of the annual or interim financial statements will not be prevented or detected on a timely basis. Auditors must consider two dimensions of the control deficiency. So the two dimensions we're going to consider then are likelihood, is it reasonably possible, and magnitude, the material significant or insignificant. So when we consider these types of deficiencies, we're trying to measure these deficiencies. We're trying to say, is it likely? How likely is this to happen? And then we need to think about the magnitude if something were to happen, to consider the risk, and that is in the consideration of materiality, significant or insignificant. So here's going to be our table to kind of think about what the action should be, what type of communication, what should we do with regards to the deficiencies. So if it's going to be material, but it's remote likelihood of anything happening, or if anything is remote, we're not going to have any action taken. If it's remotely likely, not likely to happen, we're not going to have any action taken. If it's reasonably possible or probable, and it's going to be material, then we have a material weakness. And a material weakness, that's going to be severe because it's reasonably possible or probable, and it's material. We're going to report it externally to audit committee and to management. So we're going to talk to both management and the audit committee in that case. If it's not material but significant, so it's not material but significant, and it's remote, nothing. If it's reasonably possible or probable, significant deficiency. That's what we're going to define as then, significant deficiency in our table. What do we do about it? Report to the audit committee and to management. If it's not material or significant, not material or significant, keyword or, as opposed to one or the other, then we're going to say that we have the control deficiency. It's going to be a control deficiency, and we could simply report that then to management. That's the least severe case, control deficiency, which we can report to management. In this presentation, we will discuss audit sampling as it relates to internal controls. Anytime we think of sampling, what we want to think of is that we have a population of information. We're trying to determine something or test something about that population. We want to test not the entire population, but some sample, some subset of the population in hopes that we get information that is representative of the entire population. And we can compare this oftentimes to things like polls. If they're opinion polls, people take opinion polls, and you often read about opinion polls. The opinion polls is going to be the opinion of some subset of a group that has been asked particular questions or characteristics in some format, and the hope is that that poll is going to be representatory of the entire population. We are, in essence, doing the same things within an audit, but within an audit, we need to determine what the population it is that we're trying to sample, what the specific characteristic is that we are sampling, and we will apply sampling to the controls oftentimes when we're testing the controls, and then we might apply sampling to certain types of tests with regards to substantive tests. So here, we're thinking about audit sampling, we're thinking about the tests of controls. Both statistical and non-statistical method of audit sampling are permitted by auditing standards. We will talk more about what these two items are, but just note that the statistical method is going to be a more precise type of method than a non-statistical method. However, it's going to be more costly in order to apply a statistical method. So we'll get into more depth in the future on that. Note that, in other words, we would typically think that the statistical method would be the better method most of the times because it's more precise. However, non-statistical methods are still acceptable and may be appropriate given the circumstances. The number of times an auditor needs to apply sampling techniques to gather audit evidence has gone down because of two developments: well-controlled automated accounting systems and powerful audit software to download and examine entire populations of data. In other words, if we're testing types of items that are going to be very repetitive in nature, if we have a well-designed computer system, then the computer system will be able to calculate that information with a high degree of accuracy. Whereas in the past, if it was done by hand, then we would have to go through and do more testing because it would be more likely that there would be more errors. So the automation of things that are going to be systemized or standardized means that we can usually rely on the system and check to make sure that the inputs are correct. And if they are, and it's a very standardized or set process of calculations, then the computer can be fairly relied on in terms of the control, and less testing or less sampling then would be necessary. We also have powerful software that can be used on the audit side, which can download entire sets of information. So in that case, if we just basically were able to input entire sets of information as opposed to us manually going through that information and then set in the computer system that we are looking for certain criteria which are fixed, then the computer, if we have those criteria that are very fixed and they're able for the computer to go through, the computer can go through large amounts of data and look for standard sets of items that would be standardized for a computer to do. If that's the type of testing that would be needed, we can basically test the entire population given the fact that we have the computer power and we can basically give the inputs which are all standardized for the computer to do that type of information. Sampling is still necessary to some extent for the reasons below. So we're not going to be able to eliminate all the sampling. For example, control processes often require human involvement. So anytime you have human involvement, if it's not just an automated type of system, then there's going to be room for error, and that means that we're going to have to go through the samples in order to do the testing in that circumstance. Testing procedures often require the auditor to physically inspect an asset. So if the auditor has to physically inspect something, then of course that's going to be something that has to be done by the auditor, not automated. In some cases, auditors are required to obtain and evaluate evidence from third parties, so third parties outside of the organization. Audit data analytics are only as good as the quality of the underlying data, the data that goes into that system. Often the completeness, accuracy, and validity of the underlying data needs to be tested, and sampling can be effective and efficient technique. In other words, once the data is in the system, if it's going to be set to a set standard of control so the system can then process it from that point, then the system is likely to take that data and do what is necessary in a systematic way. But the input that's going to be going into the system then is where we would want to check, because that's where the errors could happen, because obviously the calculations that the computer will be going through will be only as good as the inputs that are put into that computer. Audit data analytics often identify a large number of potential exceptions that the auditor can test using sampling as well. Key concepts that will be included as we think about sampling will be the audit sample, the sampling risk, the confidence level, and the tolerable and expected error. We're looking at these terms in more detail, starting with audit sampling. Audit sampling: selection and evaluation of less than 100% of items in a population of audit, selected in such a way that the auditor expects the sample to be representative of the population and therefore likely to provide a reasonable basis for conclusion about the population in total. So again, audit sampling, selection and evaluation of less than 100% of items within a population. So we have a population which of course represents 100%. We want to take something other than 100% of it because we don't want to test the entire population. Selected in such a way that the auditor expects the sample to be representative of the population. So how do we do that? The traditional way is to have a random kind of sample selection. However, we might use other types of methods depending what we are testing on. But the key point here is it needs to be representative and therefore likely to provide a reasonable basis for conclusion about the population as a total. So then we're going to test that subset, and we're hoping that we can then apply that subset testing to the population in total. Then we have sampling risk. possibility that the sample drawn is not representative of the population. So that's going to be one of the risks we have. So if we have an entire population, we pull a sample from it. Our hope is that that sample is representative, just a smaller kind of representation of the entire population, so that we can draw conclusions on the smaller sample, taking less time, that we can then apply to the entire population. But if that sample is not representative of the entire population, then we're gonna come to a problem. We're gonna come up to the wrong conclusion, possibly. So sampling risk has two types. The first type of the sampling risk is, in a test of internal controls, it is a risk that the sample supports a conclusion that the control is not operating effectively, when the reality is that it is operating effectively. It is also called the risk of under-reliance. So let's go through that again. In the test of internal controls, it is a risk that the sample supports, so the sample that we're testing supports a conclusion that the control is not operating effectively. So we're going to say the control is not effective considering the sample, when in reality it is operating effectively because it's not representative of the entire population as a whole. So that's going to be our problem. In substantive testing, it is the risk that the sample indicates that the recorded balance is materially misstated, when the reality is it is not. So in substantive testing, then, it is the risk that the sample indicates that the recorded balance is materially misstated, materially misstated, when the reality is that it is not. Now, the other side of it, the other type would be of the sampling risk is, in a test of internal controls, it is the risk that the sample supports a conclusion that the control is operating effectively, that it is operating effectively, when the reality is that it is not operating effectively. So in that case, we'd say the sample was wrong. We tested it because of it wasn't representative of the entire population. We gave it a clean go here on the control when it was not good. This is also called the risk of over-reliance. In substantive testing, it is the risk that the sample supports a recorded balance, supports the recorded balance, so basically says that it's not materially misstated, when it is really materially misstated. Sampling risk. Factors in determining the sample size. So these are going to be factors to determine the sample size. If we're thinking about, okay, now we want to pick some size that's going to be smaller than the population so that we can test it, the question is, well, how big of a population do we need, or how big of a sample size do we need in order to be representative of the entire population? So we have some components of that, including confidence level, tolerable error, and expected error. The confidence level represents the desired level of assurance in the results. So in other words, what's the desired level of assurance that we need? The tolerable error is the acceptable defect rate. So that's going to be the acceptable rate of defect. We'll get into a little more detail on these definitions shortly. And the expected error is the historical defect rate. Now we'll take a look at some of these in more detail, starting with the confidence level. So the confidence level complement of the sample risk. For example, the auditor might set the sample risk for a particular sampling application at 6%. So if we set the sample risk at 6%, that means that the confidence level would be 94%, 100% minus the 6%. Tolerable and expected error. So the sample size is determined largely by how much the tolerable error, so the amount of tolerable error is greater than the expected error, so tolerable error over the expected error or greater than the expected error once the desired confidence level is established. Precision at the planning stage of the audit sampling, that's the difference between the expected and tolerable deviation rates, and the allowance for sampling risk, that's going to be the term auditing standards use to refer to precision. So in other words, again, we're defining basically, in essence, precision at the planning stage of the audit sampling. That is the difference between the expected and tolerable deviation rates. The allowance for sampling risk, that's the term that auditing standards use to refer to precision. In this presentation, we will discuss audit evidence and audit sampling, and discuss when sampling might be used, when it may not be used, and provide some examples. First, we'll take a look at some situations where audit sampling is often used. In other words, sampling will typically be used in these circumstances, and then we'll take a look at circumstances where audit sampling is not often used. So when would we use sampling methods. Typically, we're going to use some type of sampling if we have inspection of tangible assets. If we're going to go out and inspect the tangible assets, then we're not going to inspect all of them. We're going to have to do some type of sampling method. So we're going to take some sampling method, decide which of those tangible assets we need to go inspect, and then we'll go inspect those particular tangible assets and get an idea of whatever type of assertion we're looking for with regards, such as existence of those types of assets, and then be able to apply them to the population as a whole. Inspection of records or documents. And obviously, this is going to be one of the main items that we're going to use sampling for. If we want to inspect some type of document, such as invoices or bills, we are clearly not going to be doing that for all of the invoices or bills. We're going to have to use some type of sampling method in order to determine which items we want to sample, pull those items, which of course the client loves when we go and tell them we want these basic shipping documents, we want these invoices and these particular bills, and then inspect some type of sample in those circumstances. Reperformance. If we're going to reperform something as the auditor, we're going to go through the calculation again for some type of item that is necessary to see a calculation, to see if the calculations are done properly. We're not going to do that for every type of transaction that requires that type of calculation. We will pick some sample of them, reperform the calculation, see if they're done correctly, and hopefully be able to apply that to the population as a whole. Recalculation is going to be similar. If we're going to recalculate something or reperform something, we're going to do that for some type of sample of the population. And then a confirmation. So confirmations are typically going to be done with some sample. We typically think of confirmation with things like accounts receivable, possibly accounts payable. If we want to go through it and test the accounts receivable, we may confirm that with particular customers. We probably aren't going to confirm all of the customers to see if money was owed or try to send out a confirmation for all of them. What we will do is pick some type of sample, make determinations from that. Audit sampling is not often used for these type of items, including analytical procedures. Those are the things that we can think of basically in the office. So if we're thinking about we're in the office, we're doing analytical procedures, we're comparing last year to this year, we're seeing the dollar changes, we're seeing the percentage type changes, we're comparing to industry standards, we're doing ratio analysis, that type of things. We don't typically do a sampling method. We're basically comparing numbers and we're doing the analytical type of procedure. So we're not usually picking just some type of sample to test. We're basically testing the relation of the numbers on the financials and related documentation. Scanning, similar type of process. So we don't typically have the sample method for scanning. Inquiry, if we're going to do an inquiry process and have questions about some type of assertion, then of course we're not going to basically randomly sample who we're going to inquire about it. We're going to determine what it is we want to know, who's the best person to talk to, and then we're going to inquire that particular person. Observation, we may not do as much in terms of observation as well for a sample. We might go out and observe what is happening at that point in time. So let's take a look at a process, for example, the inspection of tangible assets. So if we're going to go out and we're going to inspect tangible assets, tangible meaning they're physical, you can touch them, then and we're going to go out and test them, possibly testing at least for existence. Are they actually there? They're on the financial statements. We found them. Are they actually out there? So we could think about us, getting a list of these tangible assets that represent numbers on the financial statement, and then randomly choosing in some way, picking some sample of them that we get to go out there and then physically look at to make sure that they actually are there. So auditors typically participate in the business's year-end inventory count. So obviously this is one of the physical assets we want to look at if they have inventory. Is inventory. Typically, companies will count the inventory at the end of the year. We're going to want to be present at the end of the year, and we want to be there for that physical count. When there are a large number of items in inventory, the auditor will select a sample to physically inspect and count. So we're going to go out there. We can imagine us basically randomly picking in some sample fashion the types of inventory we want to go out and count. Then we go out there and count it. And it can be kind of funny. A lot of auditors have different experiences with going out and counting the inventories. For example, I've gone out and counted inventory and basically, had the people pull out boxes of inventory that they just counted. It has the number of inventory on the side, and I have to tell them to open it up and recount the inventory as the person that just counted it's looking at me going, I just counted that. The number's right on the side. And we've also had things where, if you're telling them that you need this specific item of inventory and you go to a warehouse of it, it may be the inventory box way in the back shelf, of course, that you randomly selected as the type of inventory that you want to inspect. So they got to, pull out the forklift and get to that box in the back, in the back of the inventory area. But we need to randomly basically count these to verify the count that is being given to us in our reports. And then if we test the sample on that, then we have inspected it and we can have more assurance that the total, hopefully the whole population, is correct. Inspection of records or documents. Certain controls may require the matching of documents. The procedure can take place many times a day. The auditor can gather evidence on the effectiveness of the control by testing a sample of the documentation packages. So we could pick up the packages, we could see whether or not those relationships exist. Therefore, we could say, hey, we need a sample of these basic packages given the information. And then so that would mean that the auditor or the company would have to pull the sampled items that we have requested given our data, and then we would go through those packages and see if the relationships do indeed exist within them. Reperformance. Publicly traded entities must document and test controls over important assertions for significant accounts to comply with PCAOB. The auditor may reperform a sample of the tests performed by the entity. In other words, the auditor will look at the control procedures that are in place and basically reperform or go through basically those control procedures that are listed. Confirmation. Rather than confirm all customer accounts' receivable balances, the auditor can select a sample of customers. So a confirmation basically would mean that something like accounts receivable, if we have the receivable on the books, that's how much money is owed to the organization from customers. We take a look at the subledger by customer, breaking out by customer who is owing money at the point in time of the financial statements. Then we want to confirm that. We're not going to confirm all customers, but we're going to send out some confirmations. So we're going to send out those confirmations to the actual customers possibly and see whether or not they agree with the fact that they owe the company money. And we could format those confirmations in different formats. We'll discuss that later. But the point is that we're not going to send a confirmation typically to all receivables. We're going to pick a sample of them and then confirm some sample in that format that hopefully will be representative of the entire accounts receivable so that we can then say that the accounts receivable does look like it's fairly stated. Now we're going to talk about testing items with a particular characteristic. We can have a few different scenarios. One, we can have a few large items that we're testing. When an account or class of transactions is made up of a few large items, the auditor can examine all the items in the account or class of transactions. So if we only have a few things and they're large, for example, if we have property, plant, and equipment, and we only have a few large purchases of equipment, then we can go through and we could say we don't need to take a sample of those. Of course, there's not many of those large purchases that are going on. We're going to go through and take a look at all of them in that. And then we could have a circumstance where there's a small number of large items. In other words, we might have more kind of transactions that are going on, but we have a few of those transactions that are going to be very big in relation to the total. Well, clearly, if that's the case, we may not want to do just a random sample. We're not going to say, hey, you have all these items and there's these three huge items, however, out of the population of 500 items that make up the bulk of the total amount in this account. Well, we're probably going to look at those larger items. We're not just going to randomly sample at that point. We're going to take a look at those items that are making up the bulk of the balance. So when a small number of large transactions make up a relatively large percent of an account or class of transactions, auditors will typically test all the transactions greater than a particular dollar amount. So we're going to say, hey, there's a lot of transactions here, but we can see that they're not evenly distributed. Some of these transactions are very large as compared to the other types of transactions within it. For example, we might be looking at payroll or something like that, and we might notice that there's some very highly paid individuals that make up the bulk of the payroll. Well, we might go through there and say, we're going to test within the payroll, we're going to test everything that's going to be over a certain dollar amount in some case and test that amount. The same could be with property, plant, and equipment. We might have some smaller purchases of property, plant, and equipment, and then some very large purchases that make up the bulk of the property, plant, and equipment. and we might have some type of dollar limitation in those items as well. Testing one or just a few items. Automated information systems will process transactions consistently unless the system or program are changed. The auditor can test the general controls over the system and any program changes while testing only a few transactions processed by the IT system. So in other words, if we're thinking about an IT type system, notice that the IT system will process transactions routinely and correctly, given the fact that the way the computers will process the transaction if the inputs are input correctly. Given that, what's our job as the auditor? The auditor can test the general controls over the system. So we're going to test the controls of the system in general, because if the system is processing well, then the numbers should be good, given the fact that the computer will accurately, give the number given the proper inputs. And then we're going to look at any program changes. So what we want to think about is when does the change happens. That's the point in time that we want to test what those changes are, while testing only a few transactions. So we can do that, of course, by testing much fewer transactions, given the fact that we're accounting for the computer's ability to record transactions accurately, looking at those points where the changes would happen within the way the computer will calculate. In this presentation, we will discuss types of audit sampling. Auditing standards recognize and permit both statistical and non-statistical methods of audit sampling. So what are statistical and non-statistical methods of audit sampling? We'll start off with the statistical method, use of the laws of probabilities to compute sample size and evaluate results. The auditor uses the most efficient sample size and quantifies sampling risk. So when we think about statistical sampling as opposed to non-statistical sampling, we're thinking about a more formal type of sample selection, and the more formal sample selection using statistics, using statistical mathematical analysis, can give us a more formal approach and give us more exact types of calculations than a non-statistical method. Non-statistical sampling, auditor does not use statistical techniques to determine sample size, select the sample items, or measure sampling risk. And of the two, you might be saying, well, why would we do one or the other? In other words, why wouldn't we use statistical sampling when it seems to be the more accurate way to go? Of course, part of that is going to be cost effectiveness and complexity with statistical sampling. The advantages of statistical sampling are it can design an efficient sample. So we can design an efficient sample, and therefore, when we think about the sample size, what we want to do is to create a population as small as possible that we can do the least work as we need. In other words, if you were thinking about polling people to get their opinion or the population's opinion on something, you would like to poll as few people as possible in order to get an accurate opinion. And that's what statistical sampling is better at doing. It's better at giving us a very efficient sample size. Whereas if we were just to basically not use statistical sampling, we would have to select a sample size that seems reasonable without being as efficient, and therefore probably be overestimating the sample size, probably leaning towards that side of things, and therefore possibly doing more testing as a result of not being as accurate on the sample. Can measure the sufficiency of evidence obtained. Once we have the evidence, we don't have to just say, hey, look, the evidence says this. We can have more accurate type of statistical measures as to how accurate the sample can be using statistical measures, as opposed to saying, well, this is just what our sample says with regards to this assertion, and we're just going to apply it out. We can give more specific types of calculations. Can quantify sampling risk. So we can actually quantify the sampling risk instead of us doing as we would do with non-statistical, which would basically say we're going to set the risk at these levels and then basically do our sample and see if that's going to correlate. In this case, we can actually quantify, put a number to the sampling risk. Disadvantage of statistical sampling. So you might say, well, why wouldn't we do the statistical sampling then? Well, cost more to train auditors in the techniques. Statistics isn't the most easy thing to do, obviously. And there's a lot of, just like when you think about statistics being applied to different types of samples and polling and all the kind of things the problems that can be in statistical sampling, we got to be aware of those types of things as well when we apply statistical sampling to whatever type of sample we are testing for. Costs more to design and conduct sampling application. So obviously to design a statistical sample, we're going to have a more formal study. We're going to be more exact and precise there's got to be a cost-benefit analysis anytime we have something such as that. There's a lack of consistent application across audit teams, so different audit teams could have different applications rather than us having just basically a set of general rules. If we have non-statistical sampling, we might just basically have a set of rules which would actually be possibly more formalized across different teams. To statistical sampling techniques, we have attribute sampling, we have monetary unit sampling, we have classical variables sampling. Now we'll go into these in more depth, starting with the attribute sampling. So attribute sampling used to estimate the proportion of a population that possesses a specified characteristic. Test of controls are the most common use of attribute sampling. So we're going to often use it to test the controls. And remember, the two things we're going to be testing oftentimes with sample sizes, test of controls, and substantive type testing. Examples: the business's controls require that all checks have 2 independent signatures. So that's going to be one of the controls that we have. The auditors can plan a test of that control using the attribute sampling. So attribute sampling then can be applied to see whether that control is indeed in place. Then we have monetary sampling, another type of statistical sampling. Unit sampling uses attribute sampling theory to estimate the dollar amount of misstatement for a class of transactions or an account balance. So now we're going to use similar theory looking for the dollar amount, however, often used over the classical variable sampling because it has a number of advantages over the classical variable sampling. And then we'll take a look at the classical variable sampling. Auditors sometimes use classical variables sampling to estimate the dollar value of a class of transactions or account balance. It is more often used to determine whether an account is materially misstated. In this presentation, we will take a look at attribute sampling applied to test of controls. When conducting a statistical sample for a test of controls, auditing standards require the auditor to properly plan, perform, and evaluate sampling application and to adequately document each phase of the sampling application. Those phases including the planning, the performance, evaluation, and document. We're going to go through each of these phases, of course, starting with the first one, that being the planning phase. Within planning, we will set test objectives. Objective of attribute sampling when used for tests of controls is to evaluate operating effectiveness of the internal controls. We will define the population's characteristics, those including define the sampling population, define the sampling unit, define the control deviation conditions. Discuss these items in more depth shortly. Next, we will set the sample size using desired confidence level or risk of incorrect acceptance, tolerable deviation rate, expected population deviation rate. Again, we will go into these items in more depth shortly. Now we're going to go into the definitions up here in the define the population characteristics, starting with they defined the sampling population. So what does it mean to define the sampling population? That's going to be all or a subset of the items that constitute the class of transactions make up the sampling population. So the sampling population is the entire population. So for example, if we wanted to test something, say we're testing an internal control related to the purchasing process, some type of verification within the purchasing process. We have the purchasing documentation going through. We want to check that there's some type of verification in accordance with the set of controls, which may be indicated, say, by initials related to that documentation. So the population size then would be all of the documents that would be involved in this purchasing documents that should have this indication on it that they have been properly verified in accordance with the internal control. That's going to be the entire the full population or the sampling population. Define the sampling unit. The sampling unit then is each sampling unit makes up one item in the population. So in this case, it would be one of the purchase order documents that we're looking for that would have this indication that it does have the verification on it. This sampling unit will be defined in relation to the control being tested. So that's going to be our unit that we're going to be testing. We're going to be testing these units, and then we're going to be testing to see if they apply or are in compliance with what we are looking for. In this case, we're going to say some type of initial that would indicate the verification. Define the control deviation condition. A deviation is a difference from the adequate performance of the internal control. So if we were to, for example, look at this document, be expecting some initial that would indicate the verification, and we don't find that, then that would be the deviation. We'd have to say, okay, there's going to be an item that we have found that's a deviation. Doesn't mean that the whole population is now wrong, because we might expect, depending on the type of controls, that we will have some deviation, but we're testing the amount of deviation within that basic sample size that we're then going to apply to the entire population. Then if we go to the set the sample size using desired confidence level or risk of incorrect acceptance. So we're thinking about the setting of the sample size, looking specifically at the desired confidence level or risk of incorrect acceptance. Confidence level is the desired level of assurance that sample results will support the conclusion that the control is functioning effectively. Usually, when the auditor has decided to rely on controls, the confidence level is set at 90% or 95%. So notice we're getting very specific in our testing here using statistical sampling, actually using the units of 90 to 95%. This means the auditor is willing to accept a 10% or 5% risk of accepting control as effective when it is not. So that means that within our statistical sampling, we're recognizing that we're at a 90 to 95% statistical sampling, which means we're willing to accept that the sample is incorrect or the results from it are incorrect at 5% or 10% in this example. Tolerable deviation rate. The maximum deviation rate from a prescribed control that the auditor is willing to accept while still considering the control effective. For example, if a control is highly important, the tolerable deviation may be set to 5%, but if it's only moderately important, we may set it to 10%. So once again, tolerable deviation, what is going to be tolerable within the deviation? The maximum deviation rate. So the deviation rate now, that's going to be the maximum deviation rate from a prescribed control that the auditor is willing to accept while still considering the control effective. So we're going to say we accept these deviations, and we're still going to basically come to the conclusion that the control is effective. Expected population deviation. This is the expected population deviation rate, is the rate the auditor expects actually exists in the population. The larger the expected population deviation, so the deviation, the basically deviation from what we were testing, the larger the sample size must be. So if we're considering that if we look at it, we consider that there's going to be a larger deviation, then we would want to increase the sample size because there's going to be more risk, not considering any other factors. Attribute sampling population size. Although it would seem so, population size is not an important factor in determining sample size for attributes sampling. So let's read that again, because this is a bit counterintuitive if we're not a statistician here. The population size is not an important factor in determining the sample size. And if you're not a statistician, you would probably think that it would be. You'd probably say, well, how do we know what the sample size would be? Well, wouldn't we first need to know how large the population is? In other words, if you're talking about basically trying to poll the entire country and determine what their opinion is about a certain who they're going to vote for or something like that, you would think that you'd have a bigger poll just based on how big the country is. In essence, the population size being the thing that's going to determine what your sample size would be. You'd need a bigger sample, you would think, in order to represent a larger population. But that's not the case generally when you're talking about large number type of items. Now, if you're talking about small populations, that may well be the case. The population size has little or no effect on sample size except when the population is relatively small, say less than 1,000. So if you're talking about you want to basically take a sample of something that's less than 1,000 and think about how big the sample size should be, well, then you might adjust it based on how big the sample, the population is. If it's something under 1,000, you might adjust then your sample to coincide with a population that was 500, 600, up to 1,000. But if you're talking about large populations, then that no longer is necessarily the case. We do have these relationships below, so we're going to have these relationship factors in this table. Expected population deviation rate. So if we want the expected population deviation rate to go lower, now this is the expected population deviation rate, then the effect on the sample size would be to decrease. So if we want the expected population deviation rate to increase, then we're going to increase the sample size. So these are the factors we're taking into consideration. And then we have the tolerable deviation rate. the tolerable deviation rate, if we want it to go lower, we're actually going to increase the sample size. If we want the tolerable deviation rate to go higher, we're going to decrease the sample size. So in other words, the tolerable deviation rate has that inverse relationship. And then we have the desired confidence level, and that's going to be the straight relationship again. If the desired confidence level, we want it to go lower, then the effect on the sample size is to decrease. The desired confidence level, if we want it to go higher, the effect on the sample size is to increase. And then again, the population size, decrease size only when the population is small, say less than something like 1,000. In this presentation, we will take a look at attribute sampling applied to test of controls, focusing in on performance. You'll recall that when conducting a standard sample for test of controls, auditing standards require the auditor to properly plan, perform, and evaluate the sampling application and to adequately document each phase of the sampling application. Those phases including plan, perform, evaluate, document. We took a look at the plan last time. We're taking a look at perform this time. So the planning is now done. We're going to get down to the actual work, the actual doing, the actual performing. So perform. Select the sample items. So we're going to go through select the sample items using either the random number selection or a systematic selection. We'll talk more about these shortly. Perform the auditing procedures. And these are going to be some terms that we will use as we consider those auditing procedures with relation to the selected sample items. These include unused or inapplicable documents, voided documents, inability to examine a sample item, stopping the test before completion. So if we apply our example to this, then we're going to say that our example, we're looking at some type of verification in the controls of the purchasing. We want to see if there's a verification. We're going to take this purchasing document. We're going to check it to see if it has some initials on it which would indicate that it went through the verification process. So if we were then to think about selecting the sample items, we're either going to use a random number selection or a systematic selection in order to take the entire population, which is going to be these basic purchase documents, and then take some portion of them so that we can check or verify them. We're going to be, in essence, checking or verify a very simple check to see if it has the initials on it that we would expect that would indicate that the internal control that we're checking for has indeed taken place. We will be keeping in mind these factors as we go through that process, and we'll discuss them in more depth shortly. So now we're thinking about the select sample items. We can use either the random number selection or the systematic selection. We'll start with the random number selection. This would be the most common type of selection. If we have a sample or a population, how can we choose which ones we're going to test? Well, we can do some type of random testing. And we're going to have every item in the population has the same probability of being selected as every other item in the population. So that doesn't just mean that we take all the items and kind of randomly ourselves look into it, because if we just try to pick something randomly, we don't usually have a random selection. Although that might be a method that someone could use, but it wouldn't be completely random. We'd have to use some kind of random number generator type of selection, and that would make it so that every item in the population has the same probability of selection as every other item. So that's going to be our classical type of method when we think about any kind of statistical sampling. First thing that should come to mind is the default random kind of selection. But that's not the only method we could use. We could have a systematic selection. That's where the auditor determines the sampling interval by dividing the population by the sample size. The starting number is randomly selected in the first interval. Then numbers are selected in a consistent interval. So we might then basically pick the first interval and then select a random interval of numbers. Basically, you can imagine we have a list of numbers and we basically start at some point and then we randomly select, or not randomly, we have a consistent interval of when the next number will be as we go through that set of numbers. And in that way, there's some pros and cons to this you can consider. The random sample is completely random, which has some pros and cons that there's no bias in the random sample in terms of which ones were picked. However, you might get unusual groupings because random samples might just randomly group a lot of stuff in one area as opposed to another. And so the timing of when these things happen might not be as consistent. Whereas if you want something to be timed throughout the year consistently, then you might try to take some type of systematic selection where you know it's going to be somewhat random and that the intervals will be taken throughout the system, but you'll have some more uniformity in that you'll have items that will be there probably throughout the entire year, given the format that you have selected within. Now we're going to take a look at the performance and auditing procedures and consider some of these terms. So we're going to perform the auditing procedure. In our case, we're going to be checking that these documents have the verification that we're considering in the internal control. Unused or unapplicable documents. So what if we have, in other words, in our random sample, because we randomly chose these things, we select some document that is either unused or it's not applicable. We look at it and then we say this is just a blank item, it's not used, it's not applicable for whatever reason. Well, what do we do then? The auditor should replace them with a new sample item unless they are found to be unusual in some way. So in other words, if we took something that's unused and we say, well, this obviously it isn't some, there's nothing wrong with it per se, it just happens to be something that's going to be an unused number. What should we do with it? Should we count it in our sample? No, we're just going to basically remove it and we're going to replace it with another one unless there's some problem with it, in which case it might be that that is a deviation from the control. So in our case, if we found just a blank purchase order that has nothing on it, well, it wouldn't have a signature that would have verification for it because it's blank, and therefore it's not really applicable. So we would probably want to replace it and put another one in there. However, if we came to the conclusion that there should be something there to it because the invoice numbers or the purchasing order numbers should be in alignment, then we could consider it possibly a deviation in that case. Now we'll consider within the performance and auditing procedures inability to examine a sample item. So what if we go through our process, we're looking for the purchasing document in our case, and we have an inability to get it. We can't get it for whatever reason, we can't find it. Well, if we can't find it, if we can't get it, and we should be able to get it and find it, the sample item is a deviation for purposes of evaluating the sample results typically. In other words, if we're checking to see if the initial is on it, to see if the control is there, if we go in and we can't find the document that we're looking for that should have the initial on it, well then we're going to consider that a deviation. Next, we'll consider stopping the test before completion. So is there some case that we might be able to stop the test before completion? Why? Could save some time if we're able to do that. If a large number of deviations are detected early in the test of controls, auditors should consider stopping the test as soon as it is shown that the results of the test will not support the planned assessed level of control risk. So if we go through this and we say we're going to check that our initials are on there, and check for this control to be in compliance with the system of controls, and we just check a few of them, the first few that we check, we have a high rate of non-initials on there, and therefore we have a high rate of items that are deviations. As soon as we hit the point where we say, hey, we have enough deviations at this point in time that we're not going to meet the standard that we were looking for, we could stop right there. We don't need to test more of the population to determine that we're not going to meet the point that we're trying to meet at. So there could be a point then that we could save some time and say, hey, we found the number of deviations that has already surpassed those that we were considering acceptable, and therefore we're going to stop in that case. Is not there a control deviation? In this presentation, we will take a look at attribute sampling applied to test of controls, focusing in on performance. You'll recall that when conducting a standard sample for test of controls, auditing standards require the auditor to properly plan, perform, and evaluate the sampling application and to adequately document each phase of the sampling application. Those phases including plan, perform, evaluate, document. We took a look at the plan last time. We're taking a look at perform this time. So the planning is now done. We're going to get down to the actual work, the actual doing, the actual performing. So perform, select the sample items. So we're going to go through select the sample items using either the random number selection or a systematic selection. We'll talk more about these shortly. Perform the auditing procedures. And these are going to be some terms that we will use as we consider those auditing procedures with relation to the selected sample items. These include unused or inapplicable documents, voided documents, inability to examine a sample item, stopping the test before completion. So if we apply our example to this, then we're going to say that our example, we're looking at some type of verification in the controls of the purchasing. We want to see if there's a verification. We're going to take this purchasing document. We're going to check it to see if it has some initials on it which would indicate that it went through the verification process. So if we were then to think about the selecting the sample items, we're either going to use a random number selection or a systematic selection in order to take the entire population, which is going to be these basic purchase documents, and then take some portion of them so that we can check or verify them. We're going to be, in essence, checking or verify a very simple check to see if it has the initials on it that we would expect that would indicate that the internal control that we're checking for has indeed taken place. We will be keeping in mind these factors as we go through that process, and we'll discuss them in more depth shortly. So now we're thinking about the select sample items. We can use either the random number selection or the systematic selection. We'll start with the random number selection. This would be the most common type of selection. If we have a sample or a population, how can we choose which ones we're going to test? Well, we can do some type of random testing. And we're going to have every item in the population has the same probability of being selected as every other item in the population. So that doesn't just mean that we take all the items and kind of randomly ourselves look into it, because if we just try to pick something randomly, we don't usually have a random selection. Although that might be a method that someone could use, but it wouldn't be completely random. We'd have to use some kind of random number generator type of selection, and that would make it so that every item in the population has the same probability of selection as every other item. So that's going to be our classical type of method when we think about any kind of statistical sampling. First thing that should come to mind is the default random kind of selection. But that's not the only method we could use. We could have a systematic selection. That's where the auditor determines the sampling interval by dividing the population by the sample size. The starting number is randomly selected in the first interval, then numbers are selected in a consistent interval. So we might then basically pick the first interval and then select a random interval of numbers. Basically, you can imagine we have a list of numbers and we basically start at some point and then we randomly select, or not randomly, we have a consistent interval of when the next number will be as we go through that set of numbers. And in that way, there's some pros and cons to this you can consider. The random sample is completely random, which has some pros and cons that there's no bias in the random sample in terms of which ones were picked. However, you might get unusual groupings because random samples might just randomly group a lot of stuff in one area as opposed to another. And so the timing of when these things happen might not be as consistent. Whereas if you want something to be timed throughout the year consistently, then you might try to take some type of systematic selection where you know it's going to be somewhat random and that the intervals will be taken throughout the system, but you'll have some more uniformity in that you'll have items that will be there probably throughout the entire year, given the format that you have selected within. Now we're going to take a look at the performance and auditing procedures and consider some of these terms. So we're going to perform the auditing procedure. In our case, we're going to be checking that these documents have the verification that we're considering in the internal control. Unused or unapplicable documents. So what if we have, in other words, in our random sample, because we randomly chose these things, we select some document that is either unused or it's not applicable. We look at it and then we say this is just a blank item, it's not used, it's not applicable for whatever reason. Well, what do we do then? The auditor should replace them with a new sample item unless they are found to be unusual in some way. So in other words, if we took something that's unused and we say, well, this obviously it isn't some, there's nothing wrong with it per se, it just happens to be something that's going to be an unused number. What should we do with it? Should we count it in our sample? No, we're just going to basically remove it and we're going to replace it with another one unless there's some problem with it, in which case it might be that is a deviation from the control. So in our case, if we found just a blank purchase order that has nothing on it, well, it wouldn't have a signature that would have verification for it because it's blank, and therefore it's not really applicable. So we would probably want to replace it and put another one in there. However, if we came to the conclusion that there should be something there to it because the invoice numbers or the purchasing order numbers should be in alignment, then we could consider it possibly a deviation in that case. Now we'll consider within the performance and auditing procedures inability to examine a sample item. So what if we go through our process, we're looking for the purchasing document in our case, and we have an inability to get it. We can't get it for whatever reason. We can't find it. Well, if we can't find it, if we can't get it, and we should be able to get it and find it, the sample item is a deviation for purposes of evaluating the sample results typically. In other words, if we're checking to see if the initial is on it, to see if the control is there, If we go in and we can't find the document that we're looking for that should have the initial on it, well, then we're going to consider that a deviation. Next, we'll consider stopping the test before completion. So is there some case that we might be able to stop the test before completion? Why? Could save some time if we're able to do that. If a large number of deviations are detected early in the test of controls, auditors should consider stopping the test as soon as it is shown that the results of the test will not support the planned assessed level of control risk. So if we go through this and we say we're going to check that our initials are on there, and check for this control to be in compliance with the system of controls, and we just check a few of them, the first few that we check, we have a high rate of non-initials on there, and therefore we have a high rate of items that are deviations. As soon as we hit the point where we say, hey, we have enough deviations at this point in time that this we're not going to meet the standard that we were looking for, we could stop right there. We don't need to test more of the population to determine that we're not going to meet the point that we're trying to meet at. So there could be a point then that we could save some time and say, hey, we found the number of deviations that has already surpassed those that we were considering acceptable, and therefore we're going to stop in that case. Is not there a control deviation? In this presentation, we will take a look at non-statistical sampling for tests of controls, recalling that in prior presentations we noted we can use statistical or non-statistical sampling methods, and then we went through some of the methods for statistical sampling, a more formalized method that will be using statistics for the testing of controls. Non-statistical sampling, not using some of those statistical methods, having pros and cons, however, including possibly being able to go through some set formats as opposed to the mathematical statistical samples for each item, which could be a little bit easier to do. Some of the cons might be that we end up with basically larger sample sizes, possibly, given these conventions might be erring on the larger size of things. So we could end up doing more testing, but spending less time on some of the rigors of the statistics for the statistical sampling. So here, non-statistical sampling. Decide on the sample size. That's the first thing we're going to do. Decide the sample size when we're applying the non-statistical sampling. Same kind of theory we have here. We've got a sample. Our example is that we have some purchase documents. We're trying to see if they are in compliance with the control of, saying, a verification process, which we're going to see if there's initials on the documentation that would relate to that particular control. So if that is then the case, we're going to decide what's going to be the sample size. The entire population would be all of those purchasing documents. We want to then decide what will the sample size be, how many of them do we need to test. Auditing firm may have a non-statistical sampling policy giving general guidelines as to the sample size. So we might have this in basically a checklist or some kind of non-statistical policy that we might have that could actually be easier for us to use. So that, for example, if control reliance is low, the firm may choose 15. That might be basically the policy. If moderate, the sample size might be 25, and if high, the sample size might be 50. So we might have basically a set of rules that we're going to basically have and apply to consider what the full sample size would be. We might just basically have a grid that would show us sample size, the total population, and then give us basically the sample size that we would take from that in our non-statistical type of sampling method. A benefit of this kind of non-statistical sampling is that it promotes consistency in sampling applications. So this actually has a benefit in that although it's not statistical, we're not doing a statistical calculation and being as precise in terms of the statistical calculation, it will be more consistent in that we're just basically going to take this conventional rule, look at the chart, and basically apply the sample sizes in accordance with the set of rules that have been set up. Sample items selection. So now that we're thinking about, now that we have the sample size, how do we select those items? In our case, the purchasing documents. How do we go in and pick which ones we're going to be using within our testing? Non-statistical sampling allows the use of random or systematic selection. So we can apply, again, the thing that we would most think about, the random basically selection. However, it also permits the use of other methods such as haphazard sampling. When haphazard sampling selection is used, sampling units are selected without any bias, in other words, without a special reason for including or omitting items from the sample. Upper deviation rate calculation. With a non-statistical sample, the auditor can calculate the sample deviation rate. However, they cannot mathematically quantify the upper deviation rate computed and sampling risk associated with the tests. In this presentation, we will take a look at substantive tests of details of account balances. Statistical concepts discussed regarding sampling for internal controls also apply here. In other words, in prior presentations, we've taken a look at statistical sampling methods with regards to testing of controls. And now we're considering the substantive testing. So remember, we're going to be testing the controls. Those are going to be the checks and balances, or we can think of them as checks and balances. Then we're going to hopefully be able to do less substantive testing. However, some of the procedures that we use in order to test the controls, including sampling type of methods, are often used within the substantive testing. So now we're thinking about the substantive testing. This is the bulk of the testing we typically think of within the audit. You could think of substantive testing more as that type of testing where we're actually digging down into, give me that balance sheet. Let's go straight through the trial balance, cash, accounts receivable, property, plant, and equipment. Start digging into those items, testing those actual transactions related to them. This is where the bulk of the work typically will be. Important determination of sample size. We want the desired confidence level. So what's the confidence level that we want to have? We need the tolerable misstatement. So how much misstatement then is tolerable? Remember that we are looking for the material misstatements. And therefore, in order to attest, we need to then think about what a tolerable misstatement would be, what type of misstatement would be tolerable, and then we want the estimated misstatement. What do we think the estimated misstatement will be? Population can play a larger role in some of the sampling techniques used for substantive testing. So we noted last time that, especially when we're considering statistical sampling, the population size might not be as effective or in terms of how large we're going to have our sample size. Here, we're going to say the population can play a larger role in some of the sampling techniques used for the substantive testings as opposed to the testing of control. Misstatements discovered in the audit sample must be projected to the population. So obviously, if we find a misstatement within the sample, we then project that to the population. And there must be an allowance for sampling risk. This is going to be our example then. Information about inventory account balances. We have our information about the inventory. Book value of inventory account balance. So we have a book value of inventory at the $3,000,000 to $300,000. Book value of items selected. Then within our selection, the book value is $110,000. And then when we go through our process, the audit value of items selected comes out to be $106,700. The difference between those two giving us the total amount of overstatement observed in the audit sample is 3,300. So the ratio of misstatement in the sample then is 3%, because we're going to take that 3,300 and divide it by the book value of the items. So that's going to be the 110,000. So again, total population, the 3,300,000, the book value of the sample, the items we have, 110. Given our testing, we have a value of 106,700. The difference between the book value of the sample and our 106,700 is 3,300. Then we're going to compare that 3,300 deviation or difference to the book value of the sample, not the total population. That gives us a 3%. That's the ratio of misstatement in the sample. If we apply the ratio to the entire population, then we get a best estimate of misstatement in inventory of 99,000. So now we're going to take, of course, that 3% misstatement, apply it out to the entire population, the 3,300,000 at 3%. That gives us a misstatement that we would project at the 99,000 on the dollar amount. The result of the audit test depends on the tolerable misstatement associated with the inventory account. So if the tolerable misstatement is 50,000, we cannot conclude that the account is fairly stated because our best estimate of the projected misstatement is greater than the tolerable misstatement. So if we said the tolerable misstatement in our example, back up to our example, is 50,000, and we projected here based on this information 99, then we're in trouble here because we have 99 versus the tolerable only being the 50. If the tolerable misstatement is 50,000, we cannot decide that the account is fairly stated because our best estimate of the projected misstatement is larger than the tolerable misstatement. In this presentation, we will discuss monetary unit sampling, or MUS. Monetary unit sampling uses attribute sampling theory to express a monetary conclusion instead of a rate of occurrence. Let's read that one more time. Monetary unit sampling uses the attribute sampling theory. So we're going to be using those attribute sampling theories, but now we're going to express monetary conclusions, basically dollar amount in conclusions, instead of a rate of occurrence type of conclusion. And when we consider this, obviously we would think about what types of tests we would want this type of conclusion, a monetary conclusion, as opposed to a rate of occurrence, as we'll discuss shortly. Monetary unit sampling is often used by auditors to test accounts like accounts receivable, loans receivable, investment securities, and inventory. These accounts, you can think of accounts that we might want to have then. Why would we use the MUS, the monetary unit sampling? Because we want to have a conclusion that will have that monetary dollar amount type of conclusion. Monetary unit sampling. Attribute sampling theory is used to estimate the percentage of monetary units in a population that might be misstated. So we're going to use that attribution sampling theory to estimate the percentage of monetary units. The percentage of monetary units, so that's where the monetary is coming into play, the dollar amount in a population that might be misstated. Then it multiplies this percent by an estimate of how much the dollars are misstated. Now we're going to talk about some of the advantages of monetary unit sampling, MUS. When the auditor expects a minimal misstatement, MUS usually results in a smaller sample size than classical variable sampling. So when we are considering the advantages, we are comparing and contrasting to another method that can be used, classical variable sampling, as a compare and contrast. The MUS will result in a smaller sample size, that being a benefit because it results in less testing for us. So if we can get results that we need with a smaller sample, that's typically what we want to do. When monetary unit sampling is applied using the probability proportional to size procedure, it automatically results in a stratified sample. So we already have that within the process. Does not require the user to make assumptions about the distribution of misstatements. So we're eliminating an assumption, which is nice as well, because anytime we have the assumptions, there's room for errors to be made. Monetary unit sampling disadvantages. Disadvantages include the selection of zero or negative balances also often requires special design considerations. So given the way we're setting this up in terms of the monetary unit type calculations, in essence, a zero or negative balance can throw things off. And so that therefore can mess things up. The selection of a zero or negative balance then often requires some kind of special consideration. When more than a small amount of misstatements are detected, the sample calculations may overstate the allowance for sampling risk. So one more time, when more than a small amount of misstatements are detected, so we have over a small amount of misstatements, the sample calculations can overstate the allowance for sampling risk. In this presentation, we will discuss the monetary unit sampling, or MUS, process, the steps that we will go through to apply the monetary unit sampling. We're going to have the planning part, we're going to have the performance, and the evaluation. This is where we're going to break the steps up into these chunks, into these categories: the planning, performance, and evaluation. The planning is going to have two components to it because we're going to have a long description of what is in the planning. So there's the planning part one. Decide on test objectives. And as we go through these, we will first review them and then we'll go through them in some more detail shortly. Define the population characteristics. Population characteristics including define the population, define the sampling unit, define a misstatement. Then still in the planning area, decide on the sample size using, so we're going to decide on the sample size and use these to do so, desired confidence level or risk of incorrect acceptance, tolerable misstatement, expected population misstatement, and population size. Once we have the planning set up, we'll go into the actual performance. We'll actually be doing the process here now that the plan is set up. We're going to select the sample items. So we're going to select the items that will be sampled. Then we'll perform the auditing procedures on them. We're going to perform, say, the tests or the auditing procedures to the sample. Then we're going to have the evaluation once we have performed the monetary unit sampling, which will be calculate the projected misstatement and the upper limit on misstatement, and then we're going to come to that final conclusion. So we're going to go through some of these steps now in more detail. So now we're going to keep in the planning phase. we're considering the decide on test objectives. So we're in the planning, decide on test objectives starting off in the process. Sampling can be used for substantive testing too. Remember that we're in the substantive testing as opposed to the testing of controls to test reasonableness of assertions about a financial statement amount. So we're often considering the amount, like accuracy or existence of an amount typically. Now, this is the most common use of the sampling for substantive testing. However, we can also develop an estimate of an amount as well using this method. Define the population characteristics. So within defining the characteristics, we need to define the population. So recall that the population is the monetary value of an account balance. So typically we're considering the population size oftentimes when we're thinking about sampling size. When we're thinking about sampling size for dollar amounts, now we're saying the population is the monetary value of an account balance. So if we're thinking about accounts receivable, the population size basically is the monetary balance, the amount of the accounts receivable on the balance sheet. For example, obviously the accounts we're thinking of are accounts receivable and inventory. So if we think about something like inventory, we can say, hey, they have units as well that we can test to see if the units are there, but we are considering here the monetary value, the amount on the balance sheet in a monetary terms. Then we have define the sampling unit. An individual dollar represents the sampling unit. So the sampling unit will be dollars. Define a misstatement. Difference between the monetary amounts in the business records and the amounts supported by the audit evidence. So we're going to go through the test, we're going to get the audit evidence, we're going to come up with an amount, we're going to compare that to the amount reported on the business records. Then we have the decide on the sample size we have the desired confidence level or risk of incorrect acceptance, the tolerable misstatement, the expected population misstatement, and the population size. Now, we've seen this factor table in prior presentations when we applied statistical sampling to tests of control. We have the similar table with the relationships of these items. In other words, the factors, the change in the factor, and the effect on the sample size. The difference in this table is going to be the item in red. Note down here that we are considering the sample size as a relation to the population. So population size does have more of an effect on the sample, what's going to happen with the sample, as opposed to the control testing. So keep that in mind. The rest are going to be the same here. We have the expected population deviation rate, change in the factor. If we lower it, the effect on the sample size is a decrease. If we increase it, we have an increase. So that's going to be like this. The same type of thing is happening. The lower the decrease, increase. Then we have the tolerable deviation rate. This is inverse relationship. If the change in the factor is lower, we have an effect on the sample size increase. If it's higher, effect on the sample size decrease. And then the desired confidence level, it's going to be the same. It's going to have the same relation: lower, decrease, higher, increase. And then the population, if we want the change in the factor goes lower, then again we have the same. It would be decrease. Higher would be an increase. Next, we're going to go to the performance. We have the select sample items and perform the auditing procedures. We're concentrating here on the select sample items. The auditor will select a sample by using a systematic selection approach called probability proportional to size selection. So we're going to use probability proportional to size selection. The sampling interval is determined by dividing the book value of the population by the sample size. So we'll take the book value, what's on the books of the population, divided by the sample size. Each individual dollar in the population has an equal chance of being selected, and the items or logical units larger than the interval will always be selected. So the units larger than a specific interval. After we have the selected sample items, we will of course perform the auditing procedures. Auditor does the planned auditing procedures on the logical units containing the selected dollar sampling units. Next, we have the evaluation. So once we've gone through the performance, we have the evaluation. Calculate the projected misstatement and the upper limit on misstatement. The misstatements detected in the sample need to be projected to the population. So we're going to project what happened in the sample, of course, to the population in total. Then we're going to come to conclusion. So we're going to make a conclusion based on this process. Often the decision is whether the balance is materially misstated or not. So remember, we're typically considering something like the balance in accounts receivable or the balance in something like inventory on a dollar basis. And the question is it materially misstated or not? So that's going to be, in essence, typically our conclusion that we're getting to. Tolerable misstatement is compared to the upper misstatement limit. So we're going to say, what's the tolerable misstatement? What's the upper misstatement limit? If the upper misstatement limit is less than or equal to the tolerable misstatement, we decide that the balance is not materially misstated. And that's, of course, the conclusion we're hoping for. However, what if we have a case where that's not the case and we say that it is materially misstated given our sample? In a situation where the misstatement limit is greater than the tolerable misstatement limit, the auditor will conclude that the balance is materially misstated. That's a problem. It's materially misstated. What do we do from that point forward? Well, we can increase the sample size. In doing that, we would basically be thinking, well, maybe it's not materially misstated. Maybe our sample is misrepresenting. Possibly we can increase the sample size and do more testing and see if indeed it is materially misstated or if there's something wrong given the sample population that we have. We can perform other substantive procedures. We might say, okay, let's do other types of procedures to test whether or not this balance is correct or not correct, or how incorrect or what we believe the balance should be. So we might do other procedures, request the entity adjust the balance. If we come to the conclusion that the balance is misstated, and we've tried to test things, we've said, okay, we've looked and we said it was misstated. The sampling said it was misstated. We increased the sample to double check it. We've done other types of substantive testing, and we still come to the conclusion that there's some type of misstatement. We're going to request then that the entity make an adjustment to the balance so that the balance will be properly stated, so that we can report that the balance is properly restated on the financial statement in the opinion of the audit report. However, if management refuses to adjust the balance, the auditor will consider issuing a qualified or adverse opinion. So it's possible we say, hey, look, our audit says that your inventory and or your accounts receivable are overstated, and we believe that's the case. We think that this adjustment needs to be put in place. It's possible that the management then says, well, I don't believe that, or I'm not going to do that for whatever reason. If that's the case, then we would have to issue possibly a qualified opinion, basically saying, well, the financial statements look correct except for this one deviation, or an adverse opinion if it was severe enough for us to think that the financial statements were not materially stated correctly, then an adverse opinion. And if that were the case, if we were going to give a qualified or definitely an adverse opinion, and the client wasn't making the adjustment that we think is clearly needs to be made, it might be the case that we'd have to stop the engagement at that point as well. In this presentation, we will take a look at non-statistical sampling for tests of account balances. Note that we took a look at non-statistical sampling in a prior presentation with relation to tests of controls. Here, we're applying non-statistical sampling for account balances. So you will see some similarities within the application of the non-statistical sampling. Sampling unit for non-statistical sampling is generally a customer account, an individual transaction, or a line item on a transaction. The following items must be considered when we're thinking about non-statistical sampling. Identify individually significant items. So we're going to consider those items that are individually significant. We'll talk more about that shortly. Determining the sample size, selecting sample items, and calculating the sample results. We'll at some of these items in more detail now, starting with identifying individually significant items. Items to be tested individually are items that may have a potential misstatement that individually exceeds the tolerable misstatement. So let's read that one more time. Items to be tested individually are items that may have the potential misstatements that individually, in and of themselves, in other words, exceeds the tolerable misstatement. So if we look through the data and we have these types of areas that the misstatement themselves for that individual item could exceed the tolerable misstatement, we want to pick those items out. These items will be tested 100% because the auditor is not willing to accept any sampling risk with regards to these items given their nature. As significant items. Determining the sample size and selecting the sample. So how do we determine what the sample size is? This is going to be our formula. Sample size will be equal to the sampling population in the book value. So the book value population Then we have the tolerable minus the expected misstatement. So tolerable misstatement minus the expected misstatement will be divided into the sampling population book value, or sampling population book value divided by tolerable misstatement minus expected misstatement times a confidence factor. Now, this confidence factor might be given in basically our audit papers. We might have some standardized kind of factors that we would use, something like a table such as this, where the assessed risk of the material misstatement is here, and then the desired level of confidence is going to be here. So if we have a high assessed risk of material misstatement and a high desired level of confidence, then we're going to have a higher number that we're going to be used as the confidence factor, in this case 2.9. If we have a high assessed risk of material misstatement and a moderate desired level of confidence, then we'll have a lower factor, high assessed risk of material misstatement, and a low desired confidence. Then we have a lower factor. If we have a moderate, and then of course, and a high desired level of risk, we're at this number. If we have moderate and then a desired, we're at this number, and so on and so forth. And you can see what the desired or what the effect would be in the formula given those numbers here in the confidence factor section of the formula. Calculate the sample results. Ratio projection method. So we're going to have two methods that we could use to calculate the sample results. This will be the ratio projection method. Apply the misstatement ratio to in the sample to the population. So we're going to get the misstatement ratio in the sample, apply it to the population. It would look something like this. Assume the auditor finds $1,000 misstatement in a sample of 10,000. So we have a $1,000 misstatements in the sample of 10,000. The misstatement ratio then is 1,000 over 10,000, or 10%. Now, if we apply that to the population, we could say, well, what if the population totals 300,000? The projected misstatement would then be 30,000, because we're going to take that 300,000 times the 10% and get the 30,000. So that's the ratio projection method. Not the only method, though, because we could use the difference projection method. Projects the average misstatement of each item in the sample to all items in the population. For example, assume the misstatement in a sample is 100 items that total $400. So 100 items which total $400 is the misstatement, for an average misstatement of $4. So we're going to have the $4, which is the 400 divided by 100, and the population contains 15,000 items. The projected misstatement would then be 60,000, or the $4 times the 15,000 items. So that's going to be the difference projection method. In this presentation, we will take a look at classical variable sampling. Within classical variable sampling, normal distribution theory is used to evaluate the characteristics of a population based on sample data. Auditors generally use classical variable sampling to estimate the size of misstatements. So we're going to estimate the size of a misstatement typically with the use of classical variable sampling, or when classical variable sampling is applied, it's typically used to estimate the size of misstatement. Sampling distributions are formed by plotting the projected misstatements yielded by an infinite number of audit samples of the same size taken from the same underlying population. So this is going to be our standard distribution type curve that we would expect to see. If we have a larger population, the curve will typically tend to a shape more like this. If we have a small sample, then we'll typically have a curve that will look similar to this. Obviously, the larger sample giving us more precise data around the mean, which would be right here. A sampling distribution permits us to estimate the probability of observing a single sample result. The sample mean is the best estimate of the population mean. So here's the population mean, and then we could use basically statistical theory. A sampling distribution permits us to estimate the probability, so we can estimate the probability using our standard deviation methods of observing any single sample result. So we can consider what the single sample result would be, or what's the probability of a sample result to occur. Now we're going to take a look at advantages of the use of classical variable sampling. We're going to be comparing and contrasting as we consider the advantages. You're thinking of comparing it to the monetary unit sampling. So this method will result in a smaller sample size than monetary unit sampling when the auditor expects a relatively large number of differences between book and audited value. So remember, our goal, typically, we would like to have a smaller sample size because that means less work for us, less actual testing for us. So this method will result in a smaller sample size. So hopefully we get good results with a smaller sample size than MUS, monetary unit sampling, when the auditor expects a relatively large number of differences between book and audited values. The techniques will work well for both overstatements and understatements as opposed to monetary unit sampling, and the selection of zero balances generally does not require special sample design considerations. And again, that was one of the problems with the monetary unit sampling, not a problem here with the zero balances. Classical variable sampling disadvantages. Some of the problems with classical variable sampling: when little or no misstatement is expected, it does not work well. So if we're going to have little to no misstatement, this design isn't going to be working well for us. To determine sample size, the auditor must estimate the standard deviation of the audit differences. So we have to include then an estimate. And anytime we include an estimate, we increase the complication or the likelihood of some type of problem as a result from it. If few misstatements are detected in the sample data, so we have few misstatements, the estimated variance used for the evaluation can underestimate the true variance. So once again, we have these few misstatements, and it causes a problem. The projection resulting of the misstatements and the related confidence limits are not likely to be reliable under those conditions. Sampling unit. The sampling unit may be a customer account, an individual transaction, or a line item. For example, when auditing accounts receivable, the auditor may define the sample unit to be the customer's account balance or an individual sale invoice included in the account balance. The sample size determination. Here's the formula for the sample size, noting that CC is the confidence coefficient. SD is going to be the estimated standard deviation. We're going to take the population times the CC, confidence coefficient, times the SD, estimated standard deviation, divided by the tolerable misstatement minus the estimated misstatement to the power of 2. In this presentation, we will discuss auditing revenue. We're going to be discussing the revenue cycle and the approach of auditing the revenue cycle. First thing we want to consider is the revenue recognition principle, because obviously when we audit the revenue, the timing is going to be one of the major principles that we need to consider with the auditing of revenue. We therefore have to understand the accrual principle as it relates to revenue. That's the revenue recognition principle. Now, this is going to be a fairly detailed revenue recognition principle because we want to see this step by step as we can apply it to the approach for auditing revenue. So revenue recognition principle, just in general terms, we might just say that we're going to recognize revenue when it has been earned, but we want, as opposed to when cash is received. That's probably what most people would say as a revenue recognition principle. But we want to be very specific in this, and we want to be able to apply this to different types of businesses as well, because we may have some businesses that sell goods, inventory. We may have other businesses that have services. So revenue recognition principle: revenue can be defined as inflows or other increases of assets of an entity. So we're going to say there's some kind of inflow. Does it have to be cash? Did we define cash here? No, because another inflow, it could be accounts receivable, for example, going up as we make a sale on account of the entity, or settlement of liabilities. This is often something that is overlooked. It's quite possible that we make a sale, and instead of receiving something, instead of getting some type of asset, accounts receivable or cash, we have something that is a liability that's relieved in some case, reducing a liability. Now, that's not normal process that happens. Usually accounts receivable goes up or cash goes up, but it's quite possible that we could have a liability go down, and that would still be revenue. It should be in the definition of an entity from providing goods, so goods or inventory, providing services, so we're having services which would be non-inventory related for a service type company, or from activities that make up the entity's major operations. So when we are considering revenue, we're typically considering those major operations. So, for example, if we're in the business of selling some type of inventory and we actually happen to sell some stocks and bonds, some of our investments, we're not a financial company, but we sold stocks and bonds, or we earned interest on stocks and the bonds and we had capital gains of some kind, or interest income or dividend income, this would be another type of income, but it's not going to be our principal revenue recognition in the operations of the business. So let's go through this one more time. Revenue can be defined as inflows or other increases in assets of an entity or settlement of liabilities of an entity from providing goods, providing services, or from activities that make up the entity's major operations. So what are we going to do in the auditing of the revenue approach? Within the auditing process, we're going to have to understand the business. What is it that they do in order to generate revenue? We're going to identify the contract with the customers. So what's going to be the contract that is involved with the customer with regard to revenue recognition? What kind of contract is it? Is it goods or services that are being given? Is it goods that are being given or services that are being given, or some combination of the two? Identify the performance obligations in the contract. So what is the performance that has to be done? We need to know that because that's a major component to the revenue recognition principle, because that's typically the point in time when the revenue should actually be recognized within the agreement. Determine the transaction price. So what's going to be the transaction price for the contract that's being involved for the major operation of the business. Allocate the transaction price to the performance obligations in the contract. So we're going to allocate that out, and then recognize revenue when the entity satisfies performance obligation, which of course is in alignment with our revenue recognition principle. Revenue recognition fraud risks. So as we go through this, we want to be considering the fraud risks. One type of fraud risk is side agreements. Side agreements are arrangements that are used to alter the terms and conditions of recorded sales. So we're going to be altering the terms, and that's typically not a good thing to do because it could be deceptive. That's where the fraud comes into place. So one more time, arrangements that are used to alter the terms and conditions of recorded sales in order to entice customers to accept delivery of goods and services. Then we have channel stuffing, which is a marketing practice that suppliers sometimes use to increase sales by incentivizing distributors to buy substantially more inventory than they can promptly sell. And of course, we can imagine this happening at the end of the year. If you could imagine a manager at the end of the year saying, I need to increase sales to this level because I want to get my bonus and I have to get over this level before the end of the year. The cutoff is at 12/31. How can sales be increased? Well, maybe we can somehow incentivize our distributors to purchase more before the end of the year in some way. And they're going to purchase more than they otherwise would, thereby increasing the sales before the cutoff. Now, in the long term, of course, it's not going to be a good thing because the increase in the sales and the cutoff would be just a timing difference. So that would indicate that you would think that sales would decrease after the year end. It kind of distorts basically the numbers, and it could actually decrease the amount that is going to be sold, because you might have to have some type of incentivification in order to incentivize someone to have the higher purchases, maybe by discounting, and or hurt the relationship with the distributors in that way by kind of changing the normal terms. Related party transactions. Transactions that are not considered at arm's length. So, for example, if a company had something like a subsidiary and there was some type of related party transactions, the subsidiary being in some way owned or related to the parent company, you can imagine sales types transactions that would happen to the related party. That could be another way that a manager or a company might try to manipulate or increase their sales by basically making sales to a related party at terms that aren't arm's lengths, meaning they're not like normal market sales because they're at related party level. And then we have bill and hold sales. Sales where the customer agrees to purchase the goods, but the seller retains physical possession until the customer requests shipment. So this is another thing that you can kind of imagine happening at the end of the year. You can say, oh, well, what if there's going to be some type of sale that's going to be agreed upon, but the company is holding on to the inventory. They don't actually distribute the inventory until after year end. So you can imagine the cutoff date, sale happens, but the company is holding on to the inventory, not shipping it till after the cutoff date, well, typically, the sales should be recognized when the service is done, when the work is done, when that relates to inventory, goods. That's usually at the point in time that they have been shipped or at the point they have been arrived, whether it be FOB shipping or FOB destination. So you can imagine this type of situation. Invoice goes out, accounts receivable goes up, sales goes up. They say, well, they have purchase that has happened, but the inventory hasn't been shipped yet. And therefore, it's just basically on the books as a sale at that point, even though the transaction hasn't taken place. Revenue recognition process. So what's going to be the cycle for revenue recognition if we're selling goods? So if we sell inventory, we're going to have purchases. We're going to purchase the inventory that we're then going to mark up and sell. Then we're going to have the inventory. We're going to be tracking the inventory. And then, of course, we'll have cash sales. So this is the case if we sell it for cash. We would have purchases. You can imagine then us holding onto the inventory and then putting it possibly into a store, at which point we make sales for cash at the store point, and that would be our cycle. What if we had sales that were going to be made on account? We may have then purchases. We're then going to have the inventory that we're going to track. Then we're going to have credit sales. So now we have a sale. We can imagine basically a credit sale, accounts receivable sale. We didn't get cash at the point in time of the sale. We expect to get cash sometime in the future. And then, of course, that's going to be recording the accounts receivable now being involved. Now that we have this accrual process, accounts receivable, and then we're going to have the cash collection on the accounts receivable. So most of the time when we think about basically sales on account, this is the cycle. This is the more complex cycle we would have. If we make sales for cash, we would have a more simplified cycle looking like this. Type of transactions related to the revenue process. What kind of transactions are we going to be looking at? We're going to have the sales of goods or rendering of services for cash or credit. So obviously we're going to have the sales that will be taking place. These are going to be the transactions that we'll be testing. So when we consider revenue, we will be testing these transactions. Our focus is on revenue, but notice this full transaction that will be happening, sales of goods or rendering of services, which will include revenue, possibly cash, and we'll talk about the accounts involved shortly. Receipt of cash from customers in payment for goods or services. We also want to test the receipt of cash from customers for the goods and services. And then we're going to have the return of goods by customers for credit or cash. So this is the other thing that could happen. The customer could come back and return the transaction. So these are the transactions we're concerned with regard to revenue recognition. What are going to be the accounts then that we will be considering with regard to revenue recognition, the revenue process? Now, our main account is of course revenue. But as we test revenue, we're going to also be testing some of these other type of items to some degree or another, given the fact that we have to as we test revenue. Note that that could be a good thing, because as we go through this testing process, as we go through these accounts, we will be testing other types of accounts as we go, which means we can possibly do less testing once we get to those basically accounts and those transactions, because we would have already touched on them to some degree as we've been considering the revenue process. So then these are going to be the financial statement accounts that will be affected. As we consider revenue, then we're also going to be considering these type of accounts because they're involved in the transactions. The sales transaction will involve accounts receivable if we make sales on accounts. Therefore, to some degree, as we test the revenue process, we will be testing accounts receivable. We'll have sales or revenue because obviously revenue will be involved in the sales transactions. Allowance for uncollectible accounts. This is going to be something that will be involved with accounts receivable as we consider the value of accounts receivable. The allowance for doubtful accounts will be part of that net value. And then the bad debt expense representing those receivables that are not going to be collected. That's important with regards to the revenue process because really those bad debt expenses are sales that didn't really happen. It's really kind of a negative sale that happened when someone says they're not going to pay us. Then the sale never really happened, and we have a bad debt expense is really kind of a negative sale in that sense. So it's related to the sales transactions. Cash receipts transactions related to this revenue process. We're going to be dealing with cash, either with the cash sales or with the receipt from sales on account paying off the accounts receivable. So as we test then the sales, we'll also be testing cash. So we'll do some testing of cash. Of course, in that process, we will be concentrated on cash in and of itself as we test cash at some point. We're testing the bank reconciliations and whatnot. But as we test revenue, we also look at cash to some degree, at least on the deposit side of things. And then we have the receivables, accounts receivables transaction, because it will be going down as we collect cash on account. And then we'll have cash discounts as well that we'll have to consider with regards to cash transactions. Then we have sales returns and allowance transactions. So sales return and allowance. And this is going to include the sales returns and the sales allowances. We want to consider these at the same point in time as we consider the revenue process, because although these are broken out as separate type of accounts and they act kind of like expenses, they're really contra sales accounts. What that means, if someone came back and said, hey, I'm giving the inventory back now, well, the sale never really happened then. It's basically a reversal. So we don't usually decrease the sales account recall. What we do instead is we make these other accounts which are kind of like contra sales accounts. They're going to be They're going to be debit balance accounts that are basically revenue accounts that are debit balance contra revenue accounts. And that's going to be the sales returns and allowances. And then, of course, the accounts receivable also involved with the sales returns. In this presentation, we will discuss types of documents and records that will be used within the auditing of revenue process. So we're thinking about the auditing of revenue, the types of documents and records that will be involved. We're going to be listing out the types of documents and records, which can seem like a boring process, but it's a very important process for a couple different reasons. One, these are the actual documents that we're going to go through. We're going to have to ask the client for. So we're going to have to go to the client. We're going to have to dig through these types of items when considering the auditing of revenue. We need to know what they are. We need to go and get them. The second thing that's really important here is because many people that go through the accounting process learn the debits and credits much better or more detailed than they learn the related documentations to it. And therefore, they don't, oftentimes when we go through the accounting process and we learn accounting, we may actually have the financial transactions in terms of debits and credits down a lot more than the documentation that is related to it. Auditing is a great practice that gets us in tune with what are the documentations related to the financial transactions that are involved. We need that, of course, for the auditing process, but we also need it if we're just doing business or we're working on the GL side of things or just working with accounting software, because all these things are going to basically use this type of documentation in order to trigger the financial transaction, the debit and credits that we have learned. So we have to understand the documentation so that we can understand how to apply the debits and credits into an accounting system, into the accounting software. And that's something that many students pick up in the auditing type of process. So type of documents and records. We've got the credit approval form. Credit approval form for credit sales. So if we have a credit sale, obviously a sale on credit, we haven't gotten cash up front, the entity must have a formal process to determine if the customers are credit worthy. This is obviously oftentimes going to be some type of thing that we want to check into. Depending on the type of industry we are in, the sales process that they might have a high degree of basically non-payment in it. And if there's a credit approval process, we want to make sure that the credit approval process is in place so that there's more likelihood than, of course, if you have the credit approval, that the payment will be received when you make sales on account. Customer sales order shows the details of the type and quantity of products or services ordered by the customer. So that's going to be the customer sales order. Again, shows the details of the type and quantity of products or services ordered by the customer. Then we have the open order report. This is going to be important for the auditor. A report for all customer orders where processing has not been completed. So if we have some kind of system where there's going to be items where the processing has not yet been done, we need to know what the open order report is, because if the work has not yet been done, typically we shouldn't be recording the revenue until the point in time that the work has been done. So we need to know what the system is, when the revenue is going to be recognized, when the work is done, so that we can test that system. We have the shipping document. Typically serves as a bill of lading. It has information on the type of product shipped, the quantity shipped, and other relevant information. So we want to basically be able to check those shipping documents, because the shipping documents, if we're talking about goods that are being shipped out, are often the point that we are going to recognize basically the revenue. In other words, the revenue for goods that are being sold typically happens when the goods are delivered in some format. The goods are delivered. How do we test when the goods are delivered? Well, if the goods are shipped from a warehouse or something like that, we would need to be able to look at the shipping document, and that's going to be one way that we know the quantity of goods as well as when the shipping actually took place, and therefore be able to tie that out and consider when revenue was recognized. Then we have the sales invoice used to bill the customer. Contains information on the type of product or service, the quantity, the price, and the terms of the trade. So obviously the sales invoice is our invoice. So we usually call it an invoice from our side. To the customer, it's going to be the bill, right? We're sending out the invoice to the customer. They are receiving the bill. Therefore, this is going to be usually the point in time with a lot of accounting software might trigger a sales process recording revenue at the point in time the invoice happens. But note that really if they're shipping goods, the revenue should be recorded at the point in time that the shipment happens or when some type of delivery happens, whether it be FOB shipping or FOB destination. So we're going to have to be looking at the relationship between these types of items and when the system, the accounting software, is recording the revenue with relation to them and see if there's any kind of timing difference issues that we need to consider. Then we have the sales journal. After a sales invoice has been issued, the sales need to be recorded in the accounting records. The sales journal is used to record information about the sales transactions. So the sales journal will be a specialized journal that's just going to show basically the sales type of reports. This might be a report that we'll have to print out. If we're using accounting software, we might have to ask for basically a sales journal, a sales report. The names can differ. Note that when we go to different types of industry, different types of companies, they may have different names. The accounting software may generate reports in different types of formats. So we need to understand, what the general name is of the report and what it is that we're looking for on it, so that when we get the report, we can recognize that we have indeed gotten the information that we need, even if it's not by the same name. Then we have the customer statement, mailed to the customers, has details of all sales, cash receipts, and credit memorandum transactions. Accounts receivable subsidiary ledger. This is obviously going to be really important when we consider the sales process and consider the auditing of accounts receivable itself. Has an account and detail of transactions for each customer. So the subsidiary ledger, remember, when we think about accounts receivable, of course, we've got accounts receivable representing what is owed to the company by customers. We then break that out by not just the GL by date, as all accounts are broken out on the general ledger by date, but also by subsidiary ledger, the subsidiary ledger breaking it out by customer. So now we have the same detail broken out by customer. That's going to be important, of course, for accounts receivable. Accounts receivable aging report summarizes all customer balances in accounts receivable subsidiary ledger. Each account is classified as either current or placed into one of several past due categories. So this is a similar type of process. On the balance sheet, we got accounts receivable. That represents what is owed to the company by customers. Then we're going to break that out by customer, subsidiary ledger, but also an aging report, subsidiary ledger type report, which will break out who owes us the money, but also break it out by how old that money is or how past due it is. Is it current? Is it 30 days past due? Is it 90 days past due? That'll help us to value the accounts receivable and see if the collections are actually happening in a timely manner with regard to the sales on account. Remittance advice. Part of the customer's bill that is returned with the payment. So when we think about the remittance, when you receive a bill, like a utility bill in the mail or something like that, that little slip that you're supposed to fill out the amount and then send it back, that's going to be important within the internal controls process, because when that goes back to the system, that remittance, you can have a check in the envelope, you can have the remittance that will then come back, and those two things will typically be recorded and go to different departments and be recorded as a form of check and balance. So when we're testing the internal controls, that's going to be an important document. Cash receipts journal, used to record the cash receipt of the entity. So we'll have the cash receipts journal. Again, within accounting software, it might be that we're going to be asking for some type of report with relation to the cash receipts journal, which may not be named exactly the cash receipts journal, but obviously we're looking for a report that has cash receipts on it. credit memorandum used to record the return of goods by customers. So this is going to be important for the recording of revenue as well, because the credit memorandum, which is usually something that many times within even the accounting process, if you ask the bookkeeper or the people in the accounting department what's the journal entry behind a credit memorandum, they don't really know, right? It's obviously because it's backwards. It reverses the sales. So we have to understand that the credit memorandum is typically going to be the reversal. There's going to be some type of return. And therefore, it's the easiest way to think about it, the transaction related to it, is going to think about the sales transaction that will typically be reversed, and then make any kind of adjustments such as sales. Instead of sales, you've got the sales returns and allowances. So anyways, the credit memorandum form can be a little bit confusing to analyze when you have those returns, because most of the times when we think about accounting, we think about the sales process, and the return is a little bit backwards in our mind. So credit memorandum, we have the write-off authorization. Authorizes the write-off of an uncollected accounts receivable. Final approval is often done by the treasurer. In this presentation, we will take a look at the major functions, the major parts, the major components of the revenue process. The revenue process will generally start with the order entry. The order entry is the acceptance of the customer orders for goods and services into the system. Then we're going to have some type of credit authorization if we're in a system where we have sales on account and we're applying the credit authorization, which is an approval of customers' orders for credit worthiness. So we're going to say, is this customer credit worthy? Then we have the shipping of goods that have been authorized. So once the goods have been authorized, we'll have the shipping process. Again, this considering that we're selling goods. We're selling goods that we are then going to be shipping. We are shipping the goods out that have been ordered and where the customers have had credit worthiness for them. Then we have the billing process, issuance of sales invoice to customers for goods shipped or services provided, processing of billing adjustments for allowance, discounts, and returns. So that's going to be the billing process. And then, of course, we have the cash receipts. Once we have sent the bill out, we expect to receive cash. We could consider this and think about this as cash being then received in the mail that has been billed for previously. Processing of cash receipts from the customer will then happen. And then we're going to have the accounts receivable, recording of all sales invoices, collections, and credit memorandum in the individual customer accounts. We need to be tracking the customer accounts within, of course, the accounts receivable and related subsidiary ledgers. And then we have to be considering the general ledger, the GL type accounts, which is the accumulation, classification, summarization of revenues, collections, and receivables in the financial statement accounts. So let's go over this in a bit more detail. So we have the order entry. That's going to be the first process in the revenue process, is the entry of sales order into the system. So obviously we're going to have the sales order into the system. That's typically the first thing that we would think about with regards to the revenue process. That's going to then have the credit authorization. Credit authorization will determine that the customer is able to pay for the goods or services purchased. Failure to authorize credit can lead to extensive bad debt for the entity. So if there is no credit authorization, then of course that may be the case that depending on the industry, the bad debt would be increasing, meaning we would have a higher likelihood that there's not going to be payments of the credit. So we as the auditor want to determine if there are going to be if there are a lot of sales, first of all, that are on account, meaning we didn't get cash at the point of sale, and if it's going to be a type of industry that's going to have a high degree of possible non-payments on account, a high degree of bad debt, and what level of credit worthiness, what's in the system in terms of the internal control for checking credit is in place. And then are they actually applying the policy of a credit check and testing that internal control? Shipping. Goods should not be shipped and services should not be provided without proper authorization. The main control is payment or proper credit authorization for shipping. And then, of course, the billing process helps ensure that all goods shipped and all services rendered are billed to the customer. Then we have the cash receipts. All cash collected must be identified and deposited at the bank. So when we have the cash receipts, one of the things that we'll be considering when we go through this process in more detail is, of course, that we got the cash receipts and they should be depositing those into the bank, hopefully very regularly, like daily, into the bank. Accounts receivable, all billings, adjustments, and cash collections must be properly recorded in the customer's accounts receivable records. We want to make sure that the accounts receivable is tracking by customer so that we can determine how much is owed to the organization by customer. Then we have, of course, the general ledger. Helps ensure that all revenues, collections, and receivables are properly recorded and classified. In this presentation, we will discuss the segregation or separation of duties related to the revenue recognition process. So we've discussed the components of the revenue recognition process. Now we're going to talk about one of the major types of controls with relation to it. And this is one of the major types of internal controls with relation to any type of process that we are going to set up. We as the auditor want to consider the system, the separation of duties that will be involved in it to understand the control system. If we were to be implementing some type of system, some type of accounting system, we would also want to be considering the separation of duties as we do so. Also note that as we think about separation of duties, there is kind of a best practices for separation of duties, but also as we have larger organizations, then of course we'll have an increase in the separation of duties. So again, if you're thinking about a large publicly traded company, you're going to have a lot more separation involved as you would with a small type of organization. When we are considering the implementation or testing of internal controls, we have to consider the size of the organization to determine what the appropriate number of internal controls will be. Also note that as an organization grows, you're going to need more people involved, and those people might not be as tightly knit, and therefore you might need more kind of separation of duties involved within it as well. The goal of the separation of duties is going to have those key points within the process that we're talking about, revenue recognition here, where there could be errors or there could be fraud to take place. That's where we want the separation or segregation of duties so that we have at least two people involved in those processes, and therefore they're less likely to make an error that wouldn't be catched by those two people. And if fraud was wanting to be committed, it would take two people to collude, to work together in order to consciously commit the fraud. So the fact that there would be two people involved makes it less likely for it to take place. So here's going to be our table. We've got the revenue and accounts receivable function here. So that's going to be on the left column. And then we're going to have the entities or the parts of the organization that will be involved in it, including the order entry, credit, shipping, accounts receivable, cash receipts, IT, and the treasurer. So these are the people or organizations or places within the organization that will be involved in the processing of these functions, and we're going to see the separation as we go. So we have the receiving and preparing of customers' orders. That's going to be in order entry. Then the approving credit done separately within credit. And then we have the shipping goods to customers and completing shipping documents. That's going to be separate again, shipping department. Then we have the preparing of the customer invoice. The preparing of the customer invoice, again, separate. We have the accounts receivable, which may be aided by the IT department, depending on how the IT system is set up. Then we have the updating of accounts receivable records for sales. The updating, again, accounts receivable, assisted by IT as necessary. Then we have the receiving the customer remittance. So that's going to be that little remittance form that's going to be coming back along with the check, hopefully, that we would receive in the mail. That's received separately by the cash receipts. So now we have a separate person involved of the receipt of the remittance. And then the updating of the accounts receivable records is going to be separately done by, once again, accounts receivable. So you can see the handling here of the remittance separate from the updating of the records. And then we have and that's of course going to help with any kind of problems that hopefully with regards to misappropriation or errors or some type of fraud with regards to the receipt. And then we've got the preparing accounts receivable age trial balance. Once again, the accounts receivable aging trial balance, the kind of the subsidiary type of ledger by an aging report done by the accounts receivable and assisted by IT if necessary, as necessary. Authorized accounts receivable write-off. So what about the write-off process of accounts receivable? Meaning when we determine that accounts receivable is going to be bad debt, we're going to write it off to bad debt. Again, that's another area that we want to be concerned about. Make sure that we have a separation of duty in, because we can imagine a situation where that could be a problem or a place where fraud could take place. and that's going to be done separately by authorization by the treasurer. So you can see our process here. Now notice there's a lot of people involved here. This would be a fairly extensive type of organization within the accounts receivable process to have this many components involved. In a smaller type of organization, we may have less controls, and we want to basically be able to consider what types of controls are going to be necessary. All companies should have some degree of control. Even if we only have a couple employees, we want to have some degree of control. The question is, what's the appropriate level of controls with regard to the size and format and industry of the industry? In this presentation, we will take a look at inherent risk assessment as it relates to the revenue process. So when we consider inherent risk, you'll recall that inherent risk is going to be one of those risk factors we need to consider with regards to internal control and the assessment of how much substantive testing we will need to do for a particular process. This process, of course, being the revenue recognition process. I typically think of the inherent risk as the risk that nobody really has any direct control over. It's just inherently risk, the inherent risk of the type of thing that we are looking at. It's just in the type of thing we're looking at. So in other words, if you were to remove the internal controls, the inherent risk is just the inherent risk of that type of thing, which is going to be the reason that we put the internal controls in place and will help us to guide what type of internal controls would be in place. Now, of course, the inherent risk then is something that the auditor doesn't have direct control over. It's something that the business has some control over, kind of monitoring by putting in types of internal controls and by choosing what type of business they are in. So in other words, of course, different types of industries will have different types of inherent risk. So the business has chosen the inherent risk to some degree by choosing the type of business, the type of industry that they are involved in. Then they can mitigate that inherent risk through things like internal controls. So when we consider the inherent risk, then we want to think about what is the inherent risk process here, so we can think about the effectiveness of the internal controls with relation to mitigating that inherent risk, and as a factor to consider how much testing we need to do in terms of substantive testing. So with regards to the revenue recognition process, we have factors related to the industry. So what type of industry are they in? Some industries are just more inherently risky with the revenue recognition process, and there could be different components within that risk, such as, we might be in a type of industry that has a high degree of non-payment of the receivables. That just might be the type of industry they are in. They might have a high degree of sales and a high degree of bad debt or something like that. We want to know what the inherent risks are related to the factors of the industry that they are in. Complexity of revenue recognition issues. So how complex is the revenue recognition process that we are taking into consideration? It's a pretty straightforward type of revenue recognition. If we're in a store and we give the goods and they pay us cash at the same point in time, that's a pretty straightforward type of process, not too complex. If we have accounts receivable involved, a bit more complex. If we have shipping now involved, a bit more complex. If we have things like cash discounts involved, that's going to be a bit more complex. If we have a lot of returns and allowances types of things, again, things are starting to get a bit more complex within the revenue recognition process. The difficulty in auditing transactions and account balances. So how hard is it for us as an auditor to be going through and auditing the actual transactions and the account balances and the misstatements detected in the prior audits. So we're going to take a look at the prior audits. We're going to look at the number of misstatements that were detected within them. And that will give us an indication that if there's a lot of misstatements last year, then we're probably going to say that there's a higher inherent risk involved at this time. In this presentation, we will take a look at the assessment of control risk related to revenue process. We've discussed the components of the revenue process. We discussed the consideration of the inherent risk. And remember, the inherent risks are those types of risk factors within the revenue process that if we did not have any controls, the inherent riskiness of the revenue process. Now we are considering the control risks, which are those controls that we would put in place after typically considering what the inherent risks are. The control risks then mitigating to some degree some of the inherent risks within the revenue process, depending on the type of organization or industry we are in. As the auditor, of course, we want to consider what the control risks are related to the revenue process, so that we can have an understanding of those controls, assess them as high or low, and have an understanding of how much substantive testing we need to do then with relation to the revenue recognition process. So control risk assessment revenue, we want to understand the revenue process based on a reliance strategy and document it. So we're going to test the internal controls with relation to the revenue process. Then, of course, document that. That's going to be part of our audit evidence. Plan and perform tests of controls on revenue transactions. So we're going to have to testing of controls on the revenue transactions and set the control risk for the revenue process and document it. So then we're going to basically say after the test of controls with relation to the revenue process, we want to set what the control risk will be. And remember, the control risk relates to the ability for the controls to detect a material misstatement. So we want to be able to set the control risk, consider the inherent risk, and then think about how much substantive testing that we will need to do. So we'll need to get an understanding of the control environment. The control environment, an understanding of the control environment is usually done on an overall entity basis. In other words, we're kind of considering within the control environment the overall attitude towards internal controls within the entity. That's usually done from a top-down perspective. What's the attitude at the top with relation to the control environment that usually flows down or flows through the entire organizations. Entities' risk assessment process. Understand how management thinks about risks that are relevant to the revenue process. Auditors should estimate the significance of the risk and assess the likelihood of its occurrence. Then we consider the control activities. These are the actual activities that are going to be set in place within the control system related to revenue. It's the auditor identifies the controls to ensure the insurance for transactions and events are being met. Documentation of the auditor's understanding of the revenue process may be accomplished by using. So we're going to document this information with possibly procedural manuals. What are going to be the procedures within this process of the revenue recognition? And remember, the control activities are the actual controls that are going to be in place. So now we're thinking about how can we document our understanding of the actual controls that are in place. We could use procedures manuals to get an idea of what the controls are in place and document those controls. A narrative description of what the controls are. We might put it in a narrative form. We might have a flowchart that will give us the major components within a flowchart type format of the system as it goes through the revenue recognition process. And we might have an internal control questionnaire that could be set up as part of our documentation with relation to the control activities as well. In this presentation, we will take a look at the testing of controls related to revenue transactions. Now, we're going to go through a table first. We're going to go through this fairly quickly, basically reading through this item, which I know is going to be a little bit tedious to do, but this is probably something that you're going to want to go back to and look at a few more times because these are the actual procedures. This is everything laid out, and then we'll go into some more detail about some of the key components within here. So we have the assertions. These are things like the occurrence and completeness. We have the possible misstatement. This is the misstatement, the concern of management, the weakness, the problem that the control would be trying to set up. And then we have the example of the control activity. This is the control activity set up by management, good internal controls, which are designed to solve this possible problem, this possible weakness within the revenue recognition process. Then what are we going to do? How are we going to test then the controls that have been set up? So we have the assertion. These are things like occurrence and completeness. We have the possible misstatement, the problem that could be happen with relation to this particular assertion. We have management's attempt to solve the problem with internal controls, and then our attempt to test those internal controls to see if they are indeed in place and solving the problem here. So let's go through this. We'll read through this fairly quickly, and again, we'll go through some of the key components later. This will be a little bit tedious to do, but you might want to take a table like this, spend some time with it, because this is basically going to be a layout of the internal controls themselves and relating them to the assertion, which is a point where many people have problems with. In other words, in the actual audit, many beginning auditors are pretty good at basically just knowing what the tests are or following through the checklist. If you were to ask someone to tie those out to the actual assertion, which is often done on test questions, then may have a problem with that. But within designing the audit or understanding the audit and reviewing the audit, we really need to have this understanding not just of the procedures, but how the procedures are put together and what assertion they relate to. So if we have occurrence, The possible misstatement related to occurrence is fictitious revenue. So we may have fictitious revenue that wasn't there with relation to revenue recognition. How do we control against this? The internal control set up by management, separation or segregation of duties. That's often going to be one of our main internal controls. Test of controls. What do we do as the auditor? Observation and evaluation of good segregation of duties. We'll observe it, we'll evaluate it. And then we have the other possible misstatement, revenue recorded, inventory not shipped, or services not done. The control related to it that's supposed to stop this or prevent it or detect it. Sales recorded only when there is an approved customer order and shipping document. What are we going to do in order to test that control? Testing of a sample of sales invoices for the inclusion of authorized customer order and shipping document. If there's an IT application involved in this, examination of the application control as well. We'll also take a look at numerical sequences of the sales invoices, or this is another internal control, numerical sequence of the sales invoices. That's going to be a check. What are we going to do to test it? Review the testing of client accounting procedures for numerical sequences of the sales invoices. And then if there's an IT component, we'll take a look at that. Monthly customer statement and complaints handled independently. This is going to be a piece of the control. How do we test that control? Review and testing of client procedures for mailing, handling complaints. Then we have the next assertion, this assertion being completeness. So now we're on the completeness assertion. What's the possible problem with relation to completion? Inventory shipped or services done while revenue is not recorded. So, and this would be one that we're possibly not as concerned with, because this would mean that they're under-reporting revenue, and we're probably leaning towards the side that they might over-report revenue and try to look better rather than worse. But we're going to test for completeness here, which is the inventory shipped or services done. We did the work while revenue is not recorded. And obviously on the company side, this would be a concern on the company side, because if something was done and the revenue wasn't recorded, then obviously that could be a problem. So we're going to say then the controls that are set up to prevent this: numerical sequences of shipping documents and sales invoices. So we should have the numerical sequences as a form of check. How can we check this as the auditor, whether this control is in place? Review and testing of clients' procedures for accounting for numerical sequences of shipping documents and sales invoices. And then if there's an IT component, checking that. We will also, another internal control set up by the company, shipping documents are matched to sales invoices. So we're going to match the shipping document to the sales invoice. How do we check that as the auditor? Tracing a sample of shipping documents to their sales invoice and to the sales journal. Another internal control related to this completeness assertion: sales invoice reconciled to daily sales report. How do we test that as the auditor? Testing of a sample of daily reconciliations. Another internal control related to completeness: open order file that is maintained currently and reviewed periodically. So an open order file. How do we test that for as an auditor? That control is indeed in place. Examination of the open order file for unfilled orders. And then the next problem that we can have related to completeness is relevant and required disclosure is omitted by management. So what if there's a disclosure that is omitted? So we're going to have the internal control of a disclosure checklist that is going through, and then we can review that control by review the financial statement disclosure checklist by the auditor. Next assertion is going to be authorization. So authorization, possible problem with relation to this assertion: inventory shipped or services performed for a customer who is not a good credit risk. So there's a good credit risk, not a good credit risk, and we ship how can we guard against that with an internal control that was set up by the company? The internal control set up good procedure for authorizing credit and shipment of goods. How can we test that internal control as the auditor? Review of clients' procedures for granting credit. And then we're going to have an examination of sales orders for evidence of good credit approval. If there's an IT component, we'll check that as well. The next possible problem with relation to authorization: shipments made or services performed at prices not authorized or on terms not authorized. What's the internal control related to it? Authorized price list and specified terms of trade. So we have an authorized price list, specified terms of trade. How can we test that as the auditor? Testing the control. Comparison of prices and terms on sales invoices to authorized price list and terms of trade. And if there's an IT component, we'll take a look at that. Next assertion is accuracy. What's the problem related to accuracy? We're going to set up internal controls to help to reduce revenue transaction recorded at a dollar amount that is not correct. What's the internal control we're going to set up in order to reduce that problem? Authorized price list and specified terms of trade. We also have the control of each sales invoice agreed to the shipping document and customer order for product type and quantity. Verified mathematical accuracy of the sales invoice. And then how are we going to test for these items as the auditor? Examination of the sales invoice for evidence that client's personnel properly verified mathematical accuracy. So we should see some kind of indication that there's a verification process. Recomputation of the information on a sample sales invoice. We'll recalculate it. If there's an IT component, we'll take a look at that. Then we're going to have the next problem that could happen with relation to accuracy. Revenue transaction that is not posted correctly to the sales journal, customers' accounts in accounts receivable subsidiary ledger or general journal. What's going to be the internal control related to it? Sales invoices is reconciled to daily sales report. Daily posting to sales journal is reconciled with posting to subsidiary ledger. How can we test that internal control is in place as the auditor? Examination of reconciliation of sales invoice to daily sales report. Examination of reconciliation of entries to sales journal with entries to subsidiary ledger. The next item, the next internal control that we can set up with relation to the assertion of accuracy is the subsidiary ledger is reconciled to the general ledger control account. How can we test for that as the auditor? Review of reconciliation of subsidiary ledger to the general control account. Next assertion, these are the last three here. It's going to be the cutoff, the assertion of the cutoff. So at the end of the year or the beginning of the year, the cutoff periods. Possible misstatement with relation to the cutoffs is revenue transactions recorded in the wrong period. That's the problem. How do we solve that as the company that puts in the internal control? All shipping documents forwarded to the billing function daily. So we're going to have the daily process so that it's going to be recorded, same day. And then how are we going to test for that as the auditor, that the control is in place? Comparison of the dates on sales invoices with the dates of the relevant shipping documents. And then the next internal control, daily billing of goods shipped. So we want to be billing daily. We don't want the lag time happening here. And the examination of that internal control as the auditor, comparison of the dates on the sales invoices with the dates they were recorded in the sales journal. Then we have the next assertion of classification. Classification, possible problem related to it. Revenue transactions that are not properly classified. Revenue transactions not properly classified, that's the problem. What's the internal control we can put in place? We want to have a chart of accounts. How can we test that chart of accounts as the auditor? Review of sales journal and general ledger for proper classification. The next internal control we could have related to classification. Proper codes for different types of products and services. What's the procedure we can do related to that control? Examination of sales invoices for proper classification. If there's an IT component, we'll take a look at that. Finally, last assertion, we have presentation. Presentation, what's the possible misstatement with relation to that assertion? Revenue transactions that are not properly presented and disclosed. What's the internal control to guard against that? A chart of accounts. How can we test that as an auditor? Review sales journal and general ledger for proper aggregation and disaggregation of revenue transactions. Determine if disclosure is needed. Examination of sales invoices for proper aggregation and disaggregation. Check if there's an IT component to it. Test that. Review disclosure checklist and related disclosures for relevance and completeness. So again, we went through this pretty quickly, but these are probably a table you want to spend some time with. If you can understand this table, you get a good idea of the assertions, the problems related to it, the control that would be put in place by the company, and then our testing of that control. Because remember, what we want to do as the auditor is be able to rely on the controls to be able to handle some of these assertions and therefore be able to do less substantive testing. Now we're going to take a look at a few more components in a bit more detail. The auditors need to be occupied by two types of material misstatements related to the occurrence of revenue transactions. Now remember, as auditors, we're often skeptical that the financial statements are going to be somehow overstated most of the time. So we're usually more concerned, leaning towards the concern of some type of overstatement happening. The largest type of misstatements that could happen would be due to something like fraud or something like that. And in that case, you normally would think that there would be some attempt to overstate. In the case of revenue, that would mean that you would try to make more revenue, make the revenue higher than it might otherwise be or it should be. And therefore, if we're considering the occurrence of revenue, that's what we're considering. We're considering, hey, is there something on the revenue? If we go from the revenue back, if we go from the income statement account of revenue back to the actual transaction to see if it should be there, should it actually have occurred? Did the transaction actually happen to create that revenue? That's one of the things that we're most concerned with regards to revenue. And so what our concern then is going to be with a sale to fictitious customers. And you can imagine a company saying, hey, how can we increase revenue? Or it could be an error as well. But if you're thinking about fraud, you could say the company, and this, when as an auditor, of course, we're always considering what could happen and then thinking about how could we test for it, what kind of control should be in place. Well, it's possible that a sale is put in place that's fictitious. A sale to a fictitious customer would be the easiest way to look good, right? You would say, oh, here's a sale to a customer. We're going to record an increase to the sales revenue, and we're going to record an increase to, say, accounts receivable. We don't need to have any actual thing happen. Cash didn't take place or anything like that. That would be a fictitious sales that would increase the revenue. That's a concern for us as the auditor, of course. Recording revenue when inventory has not been shipped or services has not been done. Now, this is a similar type of thing, but it may not be basically the same thing. So obviously, if we're talking about a fictitious sale, it's probably the case that you have some type of fraud, a sale that didn't actually happen, a sale that was recorded. If we're recording revenue when inventory has not been shipped, it may well be a legitimate type of sale that happened, but the inventory has not yet gone out. And again, this could have a fraud component or it could have an error type of component to it. So for example, you can imagine a company trying to say, well, I want to increase the sales in this certain time period. I'm going to sell to this individual over here, but I want to basically push these sales into this time period, this year, making a timing issue, try to put it before the December year end by basically recording the sale or making the sale transaction before the time period. And even though the goods are not shipped, and the transaction therefore not completed until after the time period. Or it could just be a timing difference where we basically have a system where we record the revenue as basically we have an invoicing process, and possibly the invoicing happens before we do the shipping of the goods or something like that. And in that case, again, we would record the sale. It's possible for a sale to have been recorded before the goods are shipped or the service is done. And if in that case, of course, that's a problem because we shouldn't be recording revenue until the work is done in accordance with the revenue recognition principle. So this is going to be our kind of cutoff testing right there. We're going to try to say, look, these ones that are close to the cutoff generally, the question is, did we do the work in that time period? And the work isn't just going to be sending out the invoice. The work is typically shipping the goods or doing the services under the revenue recognition principle. And then we have the revenue transaction related to the completeness assertion. The large concern is that inventory is shipped or services are done and no revenue is recorded. So it's possible in this case that we have some type of shipment. The shipment actually happened, but the revenue wasn't recorded. Now, again, we might not be as concerned with completeness as we would be with the occurrence transaction with regards to revenue, but we have the same kind of issue with the timing type of issue. It's possible that we have some kind of difference between the timing issue of the shipment and the billing process, in which case that we have some transaction that actually did occur, the work was done, and it wasn't recorded in the proper time period, usually going back to our cutoff type testing. The controls include numerical sequence of shipping documents and sales invoices, matching shipping documents with the sales invoice. So we should be having the sales invoice and the shipping document matched up, reconciling sales invoices to the daily sales reports, and maintaining and reviewing the open order file. Then we have the revenue transactions for authorization and accuracy. So we're considering the assertion authorization and accuracy. Possible misstatement due to improper authorization includes shipping inventory to or doing services for customers who do not have good credit risk or are not good credit risks, and making sales at unauthorized prices or terms. So obviously this first one is if we made sales to people that have bad credit, then it's possible that we're going to have an increase in the amount of bad debt, and that's going to be, of course, a concern. It could be possible that if we're purposely making sales, it could be a potential for fraud too. If their sales were being made to people who have no intention of paying, that didn't go through a credit check, that could be something that could be manipulated for fraud as well within an organization. So we want those credit checks in there. Typically, making sales at unauthorized prices or terms. So that would be a problem. Again, we can see that there could be some type of fraud involved in that if that was the case as well, right? If there's a situation, there's no checks involved and sales were going to be made at some type of unauthorized price, possibly lower prices, then that would be a concern. The existence of an authorized price list, so we should have an authorized price list and terms of trade, reduces the risk of inaccuracies. And the sales invoice should also be verified for mathematical accuracy, so we should be verifying the mathematical accuracy of the sales invoice before being sent to the customer. Revenue transactions for cutoff, so the assertion now being cutoff and classification. Sales can be recorded in the wrong accounting period if good controls are not in place. So we're thinking about basically the end of the time period, the beginning of the time period. We want to make sure that the sale is recorded in the proper time period being in accordance with revenue recognition. All shipping documents should be forwarded to the billing department. That's going to be the control. The use of a chart of accounts and good codes for recording transactions should provide enough assurance about the proper classification of revenue transactions. Then we have the assertions of presentation. Auditors' tests of controls regarding management's use of good chart of accounts, good codes for recording revenue transactions, and the financial reporting process, including the use of disclosure checklists, should provide adequate disclosure for presentation assertion. In this presentation, we will take a look at the testing of controls related to cash receipts transactions within the revenue process. Once again, we're going to go through our chart, which is going to show the assertion, possible misstatement, examples of the control, and then how the auditor would then attest them. This will be a bit tedious because I know this is going to be a long chart, and we'll read through it fairly quickly, but this is probably something that you're going to want to spend some time with because it really ties out the assertion that we have, the possible misstatement, the reason for the control that is put in place, which will help you to understand how to set up a system, why the system is put together the way the system is put together, and then our job as the auditor, which is to test that control, which is really good practice as well for understanding the system, because if we can find a way to test something, that means we have to first understand what the assertion is, the possible error, and the thing that's being put in place, and therefore how to test whether or not that thing has been put in place and is doing the job that it should be doing. So we'll go through these and then we'll take a look at a little bit more detail on some of the key components of them. So here's how it's going to work. We got first the assertion. We're considering the assertion. Possible misstatement is going to be cash recorded is not received or deposited. The control that we're going to put in place to safeguard against that, that's going to be something done by the company, remember. Our job as the auditors to test the control to see if they're in place. We have the segregation or separation of duties, one of our major types of controls, and then how are we going to test that from the auditor perspective, whether that control is in place and doing its job. Observation and evaluation of the good separation or segregation of duties. The next type of control we'll have with relation to occurrence is the use of a lockbox system. How are we going to test for that? We're going to inquiry of management about the lockbox policy. The next kind of control related to occurrence is monthly bank reconciliations, huge control over cash, of course, completed and independently reviewed. How are we going to check for that control to see if it's in place as the auditor? review of monthly bank reconciliations. It's going to be a standard procedure we'll have for evidence of independent review. Have they been double checked? Then we have the assertion of completeness. The problem related to completeness will be cash receipts stolen or lost before recording. So how are we going to guard off for that from the company perspective with regard to setting up internal control safeguards for them? Same control procedures as above. So we're going to do basically the same items as we talked about with relation to occurrence. And of course, we'll do the same testing with relation to it as well. We also have checks restrictively endorsed when received, and a daily cash list is done. So we've got the checks endorsed, right? The endorsement process, key component, and that's a key component given even on small companies as well, should probably have that control in place. Observation of the endorsement of the checks is the auditor procedure with relation to see if that is indeed in place. Daily cash receipts reconciled with posting to accounts receivable subsidiary ledger. That's the control. How do we test for that? Testing of the reconciliation of daily cash receipts with posting to accounts receivable subsidiary ledger. Then we have the control related to completeness. Customer statements prepared on a regular basis and complaints are handled independently. How do we check for that as the auditor, as an auditing procedure? Inquiry of client personnel about handling of monthly statements and examination of resolution of completeness. Then we have the assertion of authorization. So authorization, the problem related to authorization we expect to solve or reduce at least with the internal control. Cash discounts not properly taken. How can we put in an internal control related to that problem? Procedures specifying policies for cash discounts. We should have procedures related to the policy. How can we test for that internal control being in place as the auditor? Testing of sample cash receipt transactions for proper cash discounts. Then we have the assertion of accuracy, the possible misstatement with relation to accuracy, cash receipts recorded at incorrect amount. How can we as the company set up internal controls to guard against that problem? Daily remittance report reconciled to control listing of remittance advices. How could we test for that as the auditor? Review and testing of reconciliation. Then we have the internal control related to accuracy of monthly bank statement is reconciled and independently reviewed. So the bank statement reconciliation. How can we test for that? Examination of monthly reconciliation for that independent review. The next problem that could happen with relation to accuracy. Cash receipts incorrectly posted to cash receipts journal, accounts receivable, subsidiary ledger, and general ledger accounts. What is the control related to that? Daily remittance reports reconciled daily with posting to cash receipts journal and accounts receivable subsidiary ledger. Monthly cash receipts journal agree to the general ledger posting. How can we check for those items as the auditor? Review and testing of reconciliation. If there's an IT component, we'll take a look at that. Review of posting from cash receipts journal to the general ledger. Then the next internal control we can have with relation to accuracy would be account receivable subsidiary ledger is reconciled to the general ledger control account. Subsidiary ledger reconciled to the control ledger. How could we test for that as the auditor? Examination of the reconciliation of the accounts receivable subsidiary ledger to the general ledger control account. Then we have the next assertion of cutoff. That's those year-end cutoffs and the year-beginning cutoffs, the correct period in essence, related to cash. So the possible problem being cash receipts recorded in the wrong period. Then what are we going to do in terms of a control with relation to that? Use a control procedure to deposit cash daily. So we want to deposit cash daily in essence. How can we test for that as the auditor? Examination of cash receipts for daily deposit. Check if they're doing that. Assertion, next assertion, classification. Possible problem with relation to classification. Cash receipts recorded in the wrong financial statement account. The type of control for that, we're going to say, well, do they have a chart of accounts? With cash, not normally, the biggest problem for them to record cash to, the wrong account. But we want to have the chart of accounts. Example, test of controls, tracing of cash receipts from the listing to cash receipts journal for proper classification, review of cash receipts journal for unusual items. And then presentation, presentation would not normally be a relevant assertion for the cash receipts transaction. So that's going to be the next assertion, not typically applicable here. Now we're going to go through a few of these assertions in a bit more detail that are going to be most relevant to cash. So we got the cash receipts transactions, taking a look at the assertion of occurrence. The major problem, the major possible misstatement when dealing with occurrence assertion is that cash receipts are recorded but not deposited in the entity's bank account. So the major problem we're thinking about with occurrence, and again, remember, we're kind of thinking as the auditor, we're basically concerned with possibly the company overstating, say, the asset of cash. So we're concerned with the occurrence, meaning if we go from the balance sheet on cash and back to the actual transaction, the question is there something reported in cash that didn't actually happen? No transaction, no actual cash. Then we have the cash receipts and authorizations of discounts, and we're considering the assertion of completeness. A possible misstatement is that cash or checks are stolen or lost before being recorded in the cash receipts record. So that's and again, cash being very liquid, that's going to be one of the concerns in terms of an internal control. Good segregation of duties and lockbox systems are strong controls related to completeness. So we want to make sure that we have the separation of duties, the segregation of duties, and that will require that basically if there's going to be some type of theft involved, there would typically need to be two people at least involved that would be colluding in some way. Terms of trade generally include discount for payment within a specified period, the discount encouraging customers to pay on time. Controls in the accounting system and data analytics should ensure that management's policies concerning cash discounts are done. So we should have the policies in place, and then our job as the auditors to ensure that those are indeed in place. Cash transactions related to accuracy. It is possible for the wrong amount of cash to be recorded from the remittance advice. So if we have the remittance advice, that's the thing that's going to be coming back with, remember, if we get a bill or something like that, if we think about a bill that we have received, something like the utility bill, we typically tear off the little remittance advice, the little tab, we write a check, we send it back with the remittance advice. And then the remittance advice, it's possible for the wrong amount of cash to be recorded from the remittance advice into the system. That's what's going to be used to record it into the system. It is also possible that the receipt could be incorrectly processed during the data entry. To minimize these types of errors, daily remittance reports should be reconciled to control listings of the remittance advice. So we should have that reconciliation process. The use of monthly customer statements can also provide a check on posting to the correct customer account, making sure that we're actually posting this to the correct customer account. Cash receipts transactions, now we're thinking about the cutoff and classification assertion. Even if the entity uses a lockbox system or if cash is deposited daily in the bank, there is a small possibility of cash being recorded in the wrong accounting period. So note that our goal here is for cutoff is to make sure that the cash, we're talking about the cash transactions, are recorded in the proper period. How do you do that? Well, typically you want to make sure that you're making the deposits every day, recording the deposits every day, and therefore you're likely to have it in the correct period. But even if you do that, it is possible that we have some day lag or something happens, possibly a weekend or a holiday or something like that, and it's possible that we have a cutoff problem, in which case we record the cash in the wrong period. Now, again, normally that happens with weak controls being that you're holding on to cash and not recording it into the system or possibly not going to the bank and depositing it on a daily basis, but only doing that every so often. So the auditor generally does not need to have major concern about cash receipts being recorded in the wrong financial statement. So if these controls are put in place, it's usually not the biggest concern if we can verify that the controls in place of having a lockbox and the daily cash deposits. Sales returns and allowances, controls activities and tests of controls for sales returns and allowances. Sales returns and allowances is generally not a material amount in the financial statements. So depending on the industry we're in, maybe if you're in an industry, of course, where the sales returns are large, then it could be more of a problem. But oftentimes we're thinking about the sales returns as being not as material in relation to the sales components themselves. However, credit memorandum that are used to process sales returns may also be used to cover an unauthorized shipment of goods or conceal a misappropriation of cash. So in other words, this process can be misused for basically fraud within the system. Therefore, all credit memorandums should be properly authorized, and a credit for returned goods should be supported by a receiving document indicating that the goods have been returned. Relating the assessed level of control risk to substantive procedures. The auditor's testing of control for revenue processing impacts the detection risk and therefore the level of substantive procedures impacted by the controls. So obviously once we test, in other words, the controls as the auditor, then we're going to help us to set the detection risk, which will help us to determine how much substantive testing we will need to have. Now the accounts involved within this that we've taken a look at are, of course, the accounts receivable, the sales returns and allowances, allowance for doubtful accounts, cash, sales, bad debt expense involved in the types of accounts that we would have to make an assessment on as we're considering basically the revenue process in terms of the internal controls, and then using that information to some degree to consider the amount of substantive tests by setting the detection risk and then considering the substantive tests that would be needed. Some of those substantive tests could include substantive analytical procedures, and that's going to be the use of examine plausible relationships among revenue-related accounts. So whenever we think of those analytical procedures, remember those are the things I would consider being in the auditing office, and we don't need to be at the client's office, in other words, to be digging out invoices. We're typically using most of this type of analytical procedures, comparing ratios, and we can do that from the coziness of the auditing office. Tests of details focus on transactions, account balances, or disclosures. Tests of details focus on the ending balance for accounts receivable and related accounts as well as related disclosures. Substantive analytical procedures, these are ratios and comparisons can include. So we're talking about substantive analytical procedures. So the analytical type procedures, substantive type testing, usually considering those ratios, those comparisons. Those might include receivables turnover and days outstanding in accounts receivables. We have the aging categories on accounts receivable, so we'll take a look at that aging report. We have the bad debt expense as a percentage of revenue. That'll be a comparison that we can do in terms of the ratio analysis. Allowance for uncollectible accounts as a percentage of accounts receivable or credit sales, and large customer account balances compared to last period. In this presentation, we will take a look at substantive tests of transactions related to accounts receivable, allowance for uncollectible accounts, and bad debt expense. We're going to go through our table once again. The table will be a bit tedious to go through because it is a lot of information, but it's one of the more important items to get to because it does give us that information and that relationship in a very straightforward fashion. You might want to spend more time with the table on your own. We're going to read through it fairly quickly, and then we'll get through to more of these items in more depth. The item is going to list the assertion first. So this is going to be assertion about the classes of transactions. And then we're going to have the substantive test of transactions. So you'll recall that we've already done the tests of controls, the controls that were put in by management. We've tested those controls. We're thinking about now the substantive tests, the actual larger group of testings, the things that actually go out to the client possibly and be doing things like pulling invoices and reviewing things, the substantive type procedures. And we're going to vary the substantive type procedures, how many we do with regards to or in relation to what we set the detection risk, which will be based on our test of the controls and how much we can rely on them. So we're going to go through these assertions again, now considering substantive tests rather than tests of controls. First assertion, that being occurrence. The test related to it that we would do for auditors, substantive testing, now not testing controls, substantive testing, for a sample of sales transactions recorded in the sales journal, trace the sales invoices back to the customer order and shipping documents. If reliable data is maintained and controls are found to be effective, use audit data analytics to trace important data from the population of sale invoice to related customer orders and shipping documents. Then we're going to go to completeness, and we'll go through some of these important items in more depth after we go through this basic checklist format. Completeness is the next assertion. Completeness substantive test related to it. tracing of a sample of shipping documents to the details of the sales invoices and to the sales journal and customer accounts receivable subsidiary ledger. Then we have the assertion of authorization and accuracy, the auditor's test with relation to that assertion, comparison of prices and terms on a sample of sales invoices with authorized price list and terms of trade. Then we have the assertion of cutoff, that year-end cutoff, year-beginning cutoff timing issues, the substantive tests related to it, comparison of the dates on a sample of sales invoices with the dates of shipment and with the dates they were recorded in the sales journal. Then we have the assertion of classification, the substantive test related to it, examine a sample of sales invoices for proper classification into revenue accounts. Then we have the assertion of presentation, and we have the substantive test of review disclosure checklist and related disclosures for relevance and completeness. Then we have the assertion of existence, and we have the substantive test of confirmation of selected accounts receivable, performance of alternative procedures for accounts receivable confirmation exceptions and non-responses. Then we have the assertion of rights and obligations. And we have the tests then, this would be to something like accounts receivable, review of bank confirmation for any liens on the receivables. We're really questioning here whether or not they sold the receivables, which doesn't happen all the time, but it could be a case where basically the accounts receivable are sold. Inquiry of management, review of any loan agreements, and review of board director minutes for any indication that the accounts receivable have been sold. Then we have the assertion of completeness, the substantive procedure related to it, obtaining of an aged accounts receivable and agreeing total to the general ledger control accounts, review result of testing and completeness assertion for assessing control risk, trace shipping documents into sales journal and to accounts receivable subsidiary ledger if this testing was not performed as a test of controls. Notice that we may have done some of these items within the test of controls. We're going to design our audit so that if we can do some tests within the controls testing, that would also be something that we can count towards our evidence in the substantive testing. We will do so, and we're going to try to do as little work as possible in order to achieve the assertion level that we need to achieve. We want to work efficiently, in other words. Accuracy, valuation, and allocation is the next assertion. Examination of the results of confirmations of selected accounts receivable, examination of adequacy of the allowance for uncollectible accounts. The next assertion is classification, the test or the substantive test related to it, review accounts receivable accounts to ensure that different types of receivables are properly classified. Last assertion we have is presentation. Presentation, the substantive test related to it, review disclosure checklist and related disclosures for relevance and completeness. Read the financial statements and evaluate that disclosures are relevant and understandable. We're going to go through some of these concepts in more depth now. You might want to take a look at and just review this table as they're all in a nice short spot here as we go forward. So now we're going to consider once again completeness, the assertion of completeness, substantive testing related to it. Auditor's number one issue should be whether all accounts receivable have been included in the accounts receivable subsidiary ledger and general ledger accounts receivable account. In order to test for that, reconciliation of the aged accounts receivable ledger to the general ledger account should detect omission of accounts receivable from either the subsidiary ledger or the general ledger. In other words, when we think about the general ledger, remember we're thinking about the main account on, say, the balance sheet, the general ledger account for accounts receivable representing an asset, something that is owed to the company by customers. That will be broken out in detail within the general ledger by date, but we also want to break it out by customer. So we'll have a customer subsidiary ledger breaking out the detail of that general ledger by customer as opposed to by date. We want to make sure that that subsidiary ledger, which is broken out then by customer, ties out to the general ledger. If that's the case, then we're going to say that those two things tie out and we can rely on basically the subsidiary ledger. Then our goal might be to try to confirm that the subsidiary ledger by customer are actually all the customer accounts receivables on it are valid. We might do some testing with relation to those items, such as something like confirmations. Then we're going to consider the cutoff. So remember, when we think of the assertion of cutoff, we're thinking about something like at the end of the year, the timing difference that happens at the end of the year. The cutoff is to determine if all revenue transactions and related accounts receivables are recorded in the proper period. So if it's a year-end type of financial statements, we're going to test a few shipping documents just prior to year-end. Why? We're going to test the shipping documents because if they sell inventory, the shipping documents are going to be when the actual job was done. That's when they did what they're supposed to do, and therefore when they should be recording revenue in accordance with revenue recognition. So we're going to check the shipping documents to see if they have been recorded in the proper time period. So we're going to check a few shipping documents before year end and see if they recorded the sales related to them in the proper time period, which would be before the year end, and then test a few shipping documents just after year end and test to see that they were recorded in the proper time period. And it's quite possible, what we're kind of more concerned with possibly, if the company was trying to look good, they might try to pull these over here, right? They might try to increase the sales by saying these items were actually shipped in the next year, but they're going to try to pull them in if there was some type of fraud happening, or it could just be some type of timing difference in terms of the recording policy as to some timing differences. Existence and rights and obligations. The assertion of existence and rights and obligation. Existence is a very important assertion for accounts receivable because auditors want assurance that the account balance is not overstated through inclusion of fictitious customer accounts or amounts. So again, we're concerned about the customer, the client trying to overstate accounts receivable being an asset. So we want to make sure that if they have something in accounts receivable, the easiest thing a customer can do to look good, and that would be wrong, a fraud that we're concerned about as the auditor, would be to basically record a fictitious sales, crediting sales, debiting accounts receivable, no cash was received or anything, but we have the asset going up and sales going up. And so that's going to be existence. So it's at the end point. Did it actually happen? Should that receivable be there? Is there a right for that asset to be on the books? So confirmation is the primary audit tool used for testing this assertion. Confirmations meaning accounts receivable confirmations, checking with the actual customers. Auditors need to determine that all accounts receivables are owned by the entity. So one, we're going to send out the confirmations. That's what we're going to do in terms of the receivable for the customers, and we can actually send out confirmations to the customers and verify with them, at least a sample of them, that the accounts receivable that they actually do owe the company as of that date, and therefore have some validation that the accounts receivable are recorded properly. Auditors need to determine that all accounts receivables are owned by the entity. So that means that they could sell the receivables. This doesn't happen all the time, but you can actually sell the receivables, in which case the receivables would not technically be owned by the company in that case, and that would be, something we need to obviously know as well. The receivables as an asset should be owned by the company. So normally this is not a problem. For most time, the receivables are the receivables of the company. However, in some cases, accounts receivable may be sold or factored, it's called, with or without resources. So if you hear something like they factored the accounts receivable in a test question or in practice, then basically you could think of them as selling the receivable and possibly getting some type of portion. In other words, someone else would be doing the job of the collection of the receivable and possibly giving the company some type of portion rather than the company expecting to get the full receivable from collection. Accuracy, valuation, and allocation. Accounts receivable should be shown on the balance sheet at the net realizable value. So net realizable value, gross amount less the allowance for doubtful accounts. So you'll recall, of course, accounts receivable is going to be how much is owed to the company by the customers. We're going to estimate how much of that is uncollectible, or the company should, and they should then be recording the allowance for doubtful account and then show on the balance sheet the net amount. In other words, we're concerned, we don't want to have happen that the company overstates their accounts receivable by not estimating the allowance for doubtful account and reporting basically the entire accounts receivable, when in fact there may be some amount, and maybe a material amount, that is considered to be uncollectible and reasonably measurable. So the auditor must confirm that the allowance for doubtful accounts amount is reasonable. So we have to somehow confirm that the amount that they think is estimated to be uncollectible and reported as a decrease in the accounts receivable for the net accounts receivable is valid. To do this, the auditor prepares an aged accounts receivable and discusses results with the credit manager. So one way we value the accounts receivable, there's two methods you'll recall to recording the accounts receivable. We can use the sales number to try to record the allowance, and we can use an aging method. And they both should result in the same end product, but one focuses on the income statement, the other focuses on the balance sheet. In essence, as the auditor, however, when we're trying to assess the accuracy of the balance sheet item with regards to the net receivables, we want to consider that side. And the way you do that is you take a look at the receivables, break them up by the aging, how old are they, and then come up with some determination as to how much you think is going to be collectible, or discuss with the company, given the aging, given the industry, given past circumstances and past trends, what you would think would be collectible given how old the receivables are. Then a comparison with last year's results is examined. Obviously, part of this process is to examine across industries. We can also examine across prior history. If we have a similar business going on for some time, we have some idea of what the allowance should be. Classification. The primary issue related to presentation, disclosure, and classification are, and so now we're considering the assertion of classification, and we're concerned with identifying and reclassifying any material credit balance contained in accounts receivable. So it's possible, depending on how the bookkeeping system is set up, to have credit balances in the accounts receivable. This could be set up in some way. For example, if customers have deposits, if they make a deposit before they then pay in the future. So if they're going to purchase something large, for example, some accounting systems may actually record the deposit from the customer as a negative receivable, and then once they get the goods and give it to the customer, then they're gonna complete their duty and they'll net out that negative receivable. Why would a company do this? Because they should be recording a deposit as opposed to a negative receivable, which would be a liability or unearned revenue or something like that. They might do this, however, in an accounting system because the accounting system will group together that deposit from the customer to the invoice later really easily if you put it in there as a negative receivable. So therefore, the accounting system, the software, some companies will have a system to group everything in receivables, even deposits, which could result in negative receivables, which would need to be reclassified as adjusting entries at the end of the year, taking it out of the negative receivable and putting it on the books as a liability in order to adjust for that. So what we'll do is we'll take a look at the receivables. We'll see if they have any kind of deposits or negative receivables that should be removed and put in place as a liability as opposed to a negative receivable. Segregating short-term and long-term receivables. So we're concerned about the collectability of the receivables, whether they should be in the current short-term receivables or if we have some receivables that should be classified as long-term as opposed to current. Making sure the different types of receivables are properly classified. We want to make sure that if we have different types of receivables that they're classified in the proper classification. Then we have the assertion of presentation. Auditor must make sure that necessary disclosures are done. Accounting firms generally use some type of financial statement reporting checklist to ensure that all necessary disclosures are made for each account. So when we consider the presentation, we'll have some type of checklist typically, and there's different types of companies that make basically checklists, and we can have checklists that might be geared specifically towards certain industries as well. That could be specific or size of the industry or in size of the company, and that will help the auditor to go through that process. Accounts receivable confirmation process. So this is going to be the confirmation process for the accounts receivable. Confirmation is a form of audit evidence. So when we think of the confirmations, we're trying to confirm that the accounts receivable on the books have occurred on the books. And so we're going to be checking with the customers in some type of confirmation for those receivables. It is a direct written response from third parties about the accounts receivable. Confirmation is a good source of evidence about the existence of accounts receivable. So we're saying accounts receivables on the books, we're concerned about whether it exists or not. That's one of the major concerns we have. We're going to send out direct checks to the client for confirmation. the confirmation process should be controlled by the auditor, not by the company. The thing you want to keep in mind with the confirmations is they will be done directly by the auditor. So the auditor, looking at how much is owed to the company that they are auditing by third party, by customers, will then send out the letters, the confirmations, to the customers, not on the company letterhead or anything, saying exactly what they're doing. We are auditing the company, and we want to confirm this balance is owed to the company. This is for the benefit of the company. We want to confirm this balance here. Now note, as you do this, if you were a customer of a company and you receive this letter, you may not respond to it. So note that the receivables may not have a large response rate from the customers. But what we don't want to do is have it go through the customer. So it's not going to be on customer letterhead. The company's not going to be sending it out. The auditor sending it is straight out to the company. The customer then returning it to the audit firm, not to the company. So if you have any test questions or if you're thinking about the actual practice, that's how it's going to be set up. The goal is to take the company out of the mix and go straight to the third party. So the letter needs to be sent from the auditor to the third party customer and then sent back from the customer to the third party, not to the company. Omitting confirmations when accounts receivable balance is immaterial. So in other words, we might not do the confirmation process if the accounts receivable balance is small or immaterial. External confirmation would be ineffective. So if we determine for whatever reason that an external confirmation to do the confirmation process is not effective or efficient, then maybe we would omit that process possibly. Auditors assess level of risk of material misstatement at the relevant assertion level is low. Also, the other plan's substantive procedures address the assessed risk. So if we have the level of risk low and we have other substantive procedures that address this issue, these are types of factors that may result in us not needing or omitting the process of the confirmation type process. Factors that affect the reliability of accounts receivable confirmations. So we're going to go through the reliability of the confirmation process. So again, and this is a major issue with accounts receivable. We usually, if accounts receivable are significant, we'll have to go through this confirmation process. It seems kind of straightforward, but there's a lot of little details to it that could cause us problems. So first we have the types of confirmations request. So the types could include a positive confirmation or a negative confirmation. We'll get into more detail about a positive and negative confirmation shortly. But that's going to be one of the things that are going to be one of the kind of wrinkles within accounts receivable that we need to consider when we set up the confirmation process. Prior experience with the client or small similar engagements. Factors include response rate. So again, these confirmations are going out to customers that are just not, they may not even do much business with the company per se. And they're supposed to take that and send it back to us, the auditor. We're not even the company. So we might get a low response rate, in other words, depending on the circumstances of this process. So we want to go through this process and we have to recognize the fact that we could have a fairly low response rate, or we may not, just depends on the customer and the circumstances. Accuracy of return confirmations, and there could be a lot of confusion with the confirmation process as well, because remember, we're basically checking the balance of the company to a third-party customer by sending a report to the customer as an auditor, not even as the company that they did business with, about a amount that was owed to the company as of the cutoff date, which was probably sometime in the past, right? So the customer is now looking at this thing saying, well, I don't owe them anymore, I paid them. But we're looking at the cutoff date as of the date of our audit here. So again, the person that receives this letter may not have any idea of what it is or a lot of incentive to return the letter. Misstatements identified. So we want to be able to, we have to take those into consideration, whatever those circumstances are when we do these confirmations. The intended response, for example, competence, knowledge, ability, and objectivity. So the intended respondent, are they competent? Are they knowledgeable? Do they have the ability of and objectivity to basically return this information? That goes in against some of the things that we just discussed here. Types of confirmations. So we can have a positive or negative confirmation. What's a positive confirmation? When we send out these letters to the customers to confirm the balance that they owe the company money, accounts receivable to the customer, something owed for the customer, so they owe the company money as of this date, ask the customer to identify whether they agree with the amount due to the client. A response is requested whether the customer agrees to the or disagrees with the balance. So we're going to say basically if it's a year-end date, we're going to say as of this year-end, our company records or the company records of the firm that we are auditing shows that you owe them this amount of time as of that point in time, and we would like a response whether or not you agree with that. We expect that that is true, and we would like you to send a response back confirming that yes, indeed, it is true. And if it's not true, we'd still like a response that you would respond back and say, no, that's false for whatever reason. A negative confirmation is going to be one where we ask the customers respond only when they disagree with the amount due to the client. So in this case, we're going to say, hey, here's the confirmation. As of this cutoff date shows that you owe the company this amount, and we would like a response, but only if you disagree. So we're only looking for the disagreement type of confirmation in that case. So negative confirmations are appropriate when the client has many small account balances and control risk is assessed low. So in other words, the negative confirmations are less evidence for us. Positive confirmations are more evidence for us, because a negative, if they don't send it back, you can imagine, well, if they don't send it back, how do I know that if they agree with it or not? They might have just thrown the letter in the trash. So the negative confirmation, we have to take that into account when we consider basically the types of clients we're dealing with, what the response rate will be and whatnot. So the negative confirmation is going to be easier to do, easier on the customer, easier for us, but it gives less assurance, and therefore we would only do a negative confirmation when the client has many small accounts possibly and the control risk is relatively low. Otherwise, we would do the positive confirmation requesting a response no matter what, whether they agree or not. Timing, the assertion of timing. Accounts receivable can be confirmed at an interim date or at year end. So we could, do some confirmation of accounts receivable in the interim and give us some evidence or assurance given these tests as well. Confirmation requests should be sent soon after the end of the accounting period to maximize the response rate. So if we send it soon after these confirmations, they're going to be more likely to get a response and less likely to have problems or errors with them. Confirmation procedures. So how are we going to do this exactly? This confirmation process. Auditor will mail the confirmation requests outside the entity's facilities. So we're not going to mail them from the entity's facilities, completely separate from the entity. That's the point. A record will be maintained of the confirmation mailed and those returned. So we will obviously track the confirmations that went out and those that were received. A second request may be necessary in some cases. What happens if we don't get the confirmations back? Well, if we don't have the evidence we need, then we might send out a second confirmation, and we might just set that up as practice, because again, the response rate could be low, so we might just plan we're going to send out second confirmations to try to get this information. For each exception received, the auditor will examine the reasons for the difference between the balance on the client's books and the balance indicated by the customer. So what do we do with the problem areas, the exceptions? We're going to examine for the reasons. It is common for exceptions to be a result of timing differences. These differences occur because of delays in recording transactions in either the client's or the customer's records. So there could be a difference in when they recorded the transactions. Also, just note again, the confirmations are going to be going out after the time period which the customer owed them money. So if we were to send out a letter saying, hey, did you owe this customer money as of 12/31, and it's sometime after the year end at this point in time, and they've already paid the bill, they may not look at the date because their main concern might just be, I don't owe them anything right now. I just sent them a bill. I sent them money already. So there could be a confirmation because of that. Again, that's kind of timing difference, but it could be a result of the recipient not reading the date as of when it was due. Alternative procedures. If auditor does not receive responses to positive confirmations, alternative audit procedures are generally used. So then we could, if we don't get what we need, the evidence we need to gather with the confirmation, we'll use alternative methods. Alternative procedures include examination of specific subsequent cash receipts. So then we could go basically to the cash receipts. We could say, hey, they owed money to the company as of 12/31. Let's take a look at the cash receipts and see if they got paid sometime right after 12/31. Because remember that as of the time we do the audit, it's not going to be the exact end of the year. It's going to be something, we're going to be doing the audit like in January, February, March. So we can check the receipts that happened in January and say, well, did they actually get paid in January? That would give us pretty good evidence that they owed money as of December. And then we can have the examination of the shipping document. We could say, well, that's another alternative procedure. We could say if it says that they owe them money, if the customer owed them money, and we look at that the inventory actually got shipped, well, that's it wouldn't be the case. You would think that the company would ship the inventory if they didn't make an actual sale, because the inventory went somewhere at least. So we would think the sale happened. And then examination of other client documentation to get our further audit evidence. Other receivables. Other types of receivables that are reported on the balance sheet can include receivables from officers and employees, receivables from related party notes receivable. Auditors are less concerned with satisfying the assertions for these receivables compared to accounts receivable generally. So these other receivables are usually less concerned than the accounts receivable. Accounts receivable is usually a much larger, balance or component for most companies. Each of these types of receivables can be confirmed and evaluated for collectability. The transactions that result in receivables from related parties will be examined to determine if they are at arm's length. So whenever we have a related party transactions, we do want to look into those related party transactions. For example, if we had the company that would making some type of sale or receivable that's related to a subsidiary of the company, related party, then we don't have the market conditions that will regulate whether they're at arm's length or the price is appropriate and those types of things. So we want to examine those related party types of transactions. Note receivable will also be confirmed and examined for repayment terms and whether interest income has been recognized as it should. So when we think about notes receivable, we have a longer term type of transactions. Typically, there should be some type of interest that's going to be involved in the notes receivable for it to be a proper type of transaction. If it's not, if there's no interest in the transaction, we would think that maybe it's a related party or something strange is going on, or maybe we need to impute or calculate or read into the interest component because it just needs to be broken out. Audit findings evaluation. After the auditor has completed the planned substantive procedures, the likely misstatement for accounts receivable is calculated. So once we've done the substantive procedures, we've done the internal controls, substantive procedures, now we can basically do the calculation related to the likely misstatement for accounts receivable. Likely misstatement is projected misstatement plus an allowance for sampling risk. Then if we consider the results, there's two things that can happen. We can have an aggregate misstatement that is less than the tolerable misstatement. If that's the case, we accept the account as fairly stated because the aggregate misstatement that we have come to is less than what we decided in the planning as tolerable, and therefore it's within the tolerable setting, and we accept the amount as fairly stated. Or the aggregate misstatement is greater than the tolerable misstatement. Well, then we have a problem. The account is not presented fairly. In this presentation, we will discuss auditing of the purchasing process. As we go through the purchasing process, we want to remember that we are going to be considering an accrual process. Considering the accrual process related to purchasing, we are considering the matching principle or the expense recognition principle on an accrual basis. The accounts that are going to be involved are going to be things such as expenses, definition of expenses, keeping in mind the matching principle, the accrual principle of matching as we consider the purchasing process. The expenses, outflows, or other forms of using up assets or incurring liabilities from delivering or producing inventory, doing services, or carrying out the activities that constitute the entity's ongoing major or central operations. Let's go through that one more time. Expenses are going to be the outflows or other forms of using up assets or incurring liabilities. Now, of course, consider that second piece is often forgotten because when we think about expenses, we usually think about paying cash for them. Although it is quite common for us to purchase them for something else, commonly to purchase on credit or accounts payable for a business. From delivering or producing inventory, doing services, or carrying out other activities that constitute the entity's ongoing major or central operations. In other words, we are consuming these assets in some way in order to achieve the business goal, generally being the recognition of revenue, carrying out our business functions that would typically go towards that objective. Then liabilities, definition of the liabilities will be probable future outflow of economic benefits as a result of present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So let's go through that one more time. A probable future outflow. So the liability represents an outflow in the future of economic benefits. So economic benefits in the future as a result of present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. And that's going to be a key component. Note that when we think about liabilities, most of the time they're going to be fairly straightforward. We could say, hey, something happened in the past, transaction happened in the past, resulting in some economic value that should be paid out sometime in the future. There can be some confusion, however, when we start to think about liabilities for things that possibly could have happened in the past and things that might happen in the future, such as a litigation type of process would have a result of litigation about something that happened in the past, but the litigation process won't be completed until sometime in the future, and therefore we're going to have some question as to whether or not something in the past is going to result in a liability in the future. So just note that, I also note just with budgeting processes, when we start thinking about the future, we could think about any type of thing that we can plan into the future, and people get those things confused with liabilities. For example, if we were to say that we're going to pay for insurance in the future and start to budget out and say, well, I know I'm going to pay insurance in the future. Next year, I'm going to pay the same amount of insurance. Some people can get confused. We could start to think, well, that should be a liability now because I know I'm going to pay it. And therefore, I should just put it on the books as a liability of what I'm going to pay sometime in the future. Well, no. Why? Because they haven't provided anything in the past that's going to result in that liability. So although we're pretty darn sure that we're going to pay for it in the future because we're going to need it in the future, and from a budgeting standpoint, we will have it, we're not going to put it on the books as a liability because it had to be a result of something that has actually happened in the past, which results in the future economic payment of some kind or future economic obligation. So expense liability recognition, we're going to be including things like the product costs, and we have period costs. So these are going to be the types of groupings of costs we're going to need to be considering as we go through the purchasing process, and we're going to have to go through the cycle as we think about this, meaning the purchasing cycle, and we're going to be dealing with that with regards to the breaking out of costs between the product costs and the period costs. So with the purchasing process, then we have to think about the purchasing process because, of course, when we audit purchasing, we need to know what the purchasing process is. We need to know what the inherent risk is of that purchasing process. We need to know what management has put in place in terms of the internal controls. We need to know if we can rely on those internal controls and then be able to test the substantive testings with relation to the purchasing process to see if the financial statements are reported materially accurately as they should be, as we will issue an opinion on. So the purchasing process generally begins with the purchase request generated by the user department. So we're going to have a purchasing request. We could think of a large type of organization. Remember that smaller organizations may have less of this process, but some of these type of checks should be in place no matter the size of an organization. If you have a large organization, we're going to have more verifications and checks within the purchasing process. If you have a smaller organization, we will still have some internal controls, but possibly not as many because we don't have that major thing which is necessary for that to happen, and that's going to be the amount of personnel to have the separation of duties that are required. The purchase department prepares a purchase order and is sent to the vendor. So now once the purchasing department's involved, they're going to say, okay, that's fine. We're going to prepare the purchase order. Now the purchase order is that documentation that's going to be sent to the vendor. It's not going to be something that is going to include a payment. So the purchase order, you'll recall, bit confusing of a documentation here. And when we think about it from financial accounting positions in terms of financial transactions, a lot of times people don't have a good idea of what a purchase order is because, one, we don't concentrate on forms a lot of times when we think about financial transactions, when we're concentrated on debits and credits, which is one reason audit is a useful thing to go through. Two, there is no financial transaction with relation to the purchase order, which is unusual. Most transactions or most forms that we think about within the accounting department or process will have a related journal entry, accounts affected, two accounts, one going, debits and credits will be happening. But here that's not the case because this is just going to be a request. It's also different than what we would typically think of when we purchase something, say online at Amazon or something. Because when we purchase something online or have a request for something that we want to purchase, we typically pay for it, at least with a credit card at that point in time. Purchase order, no payment happening, and there's no inventory happening, therefore no financial transaction, although we will be tracking the purchase order. So just keep that in mind as we go through and think about how we're going to put up this system or put the system together and then audit it. When the goods are received or the service is rendered, a liability is recorded. So then we can imagine if we sent out a request, let's say we're sending the request to the vendor for inventory. Let's say we're buying inventory from China or something. We're buying our cups from China for our inventory or something like that. They're going to ship it then to us with the bill because remember, we didn't pay the company in China at the point in time we sent the purchase order. We just said we would like the inventory. We'll pay you when we get the inventory and we check it. So they're going to actually ship us the inventory without payment. And we're going to get it, and we're going to say, okay, here's the bill that they sent us along with the inventory. That's typically how we'll think of this purchasing process for large type of organizations. So then we have the goods, and of course, once we have the goods and the bill, then we can record the goods because we physically own them now, or they're in our possession. They are now our inventory, and we have the bill related to it, and we can record the bill because we have received the goods and therefore should be recognizing the inventory at that point in time. Lastly, the entity pays the vendor. Of course, after we enter the bill, we're going to pay the vendor, and that's going to be the end of the purchasing type of transaction. Typically, when we're thinking about the purchase of course, inventory in this type of purchasing process. So we got the purchase request, then we have the purchase order. The purchase request, remember, if we think about the forms that will be involved, is an internal form. So you have one department saying, hey, I need this thing, possibly, right? And then they're going to say, and then they're going to go to the purchasing department and say, would you basically order this thing? And then we have the receiving report and liability recorded. So once we have once we've received it, we will have the receiving report being the driving documentation and the liability recorded. And then we're actually going to, of course, write the check. These are going to be the forms involved. Internal form, purchase requisition from the department that needs something. Then we have the purchase order. That's going to be us sending it to the vendor. No actual financial transaction related to it. Then we have the receiving report and liability recorded. That's when we received the stuff that we ordered. And then, of course, we have the check, and that's going to be us with the final payment. Notice that we can look at this process and think about it in terms of an inventory for purchasing, basically inventory. We have a request and we need inventory. And we can also think about it as other types of purchasing processes as well, the typical kind of purchasing process that might be happening if a department needs something within that basically department. So we have both basically the product costs and then the period costs for the actual departments. Transaction types, we have the purchase transaction. The accounts that will be involved within the purchase transaction will be accounts payable, because we're typically going to be buying this stuff on account. Inventory, so we're often going to be thinking, and whenever we consider the purchasing transaction from an audit perspective, we're usually thinking about a company that has inventory, sells inventory. One reason is because that's going to be the more complicated type of transaction. If you don't have inventory, the purchasing department might be a little bit less complex, similar, but you can remove the inventory process and you're basically be dealing more with just the period type costs, the normal, purchasing costs if you're basically a service company. So similar type of transaction if you're buying inventory or not. Inventory, of course, usually adds a level of complexity because there's usually a lot of inventory, and purchasing becomes a very significant part of the operations if your job or your business design is to purchase and then sell the inventory. purchase or cost of goods sold, and then we have the various assets and expenses that will be involved. Then we have the cash disbursement transaction. The accounts involved in the cash disbursement transaction will, of course, be cash, then the accounts payable, reducing the accounts payable, and possibly cash discounts. Then we have the purchase returns transactions. This is something that, of course, is more complicated for most people because it's not something that's going to be a normal business transaction. In other words, whether we're in the company or if we learn this stuff in just financial accounting, we typically learn the purchasing transaction because that's a normal business transaction. Then we do the payment transaction, typically paying off the accounts payable. We basically tend to memorize that transaction. The purchase returns, not something that happens every day, not a standardized type of transaction, although the process will be somewhat standardized because we would expect some returns possibly depending on the type of business, meaning in this case, we made a purchase, say inventory, decided it wasn't up to par, wasn't up to standards for whatever reason, we return it. So within the return process, the best way to think about this return is, to me, the same way as like a credit memo type of process. The credit memo representing people returning inventory to us, which we sold, which in that case I would think about the sales transaction and then reversing it, and then to start out at least to consider the return process. Here we are returning the inventory to the vendor that we purchased. So we purchased the inventory. I would think about the purchasing process and then consider the return, and at least start with that as the starting point, and then think about any adjustments that need to be made for the transaction. So in this case, we're going to have the accounts that will be involved will be the purchase returns and allowances, purchase allowances, the accounts payable, and other assets and expense type accounts. Now we're going to discuss some documents and records within the purchasing process, and these are going to be very important because a lot of times in financial accounting, note that we go through and remember, we start to learn the transactions from the bottom up, from the building blocks, from the debits and credits. Oftentimes we don't spend as much time with the forms related to them, and therefore when we go into an accounting system, whether we be working in auditing or we be working within the accounting system, we don't have a good idea of the driving force or the driving kind of documents that are going to be driving the transactions within the accounting system. And therefore, audit is a good way for us to kind of learn those transactions, as well as just using accounting software, because most people that enter data into the system know how things are going to happen, not by debits and credits, but by the forms that drive those debits and credits. And so when we go in and request things, we need to know how the system's working, not in terms of simply debits and credits, but the forms that are driving those debits and credits, because that's what we're going to have to ask for. Those are the things that are going to be driving the system to record the transactions. We're going to have to see in the internal controls when those systems are good, when those systems have problems. So we have the purchase requisition. It's going to be a request to purchase goods and services. So this is an internal form, and you could think of one department basically requesting some type of goods and services or something like that. And it's internal. Nothing has happened in terms of financial transactions, but it's going to be an important internal control to make sure the purchasing process is going as it should. Then we have the purchase order. Includes a description, quantity, and quality of goods and services being purchased. Now, this is the form, the confusing form typically, that's going to go from us as the purchasing to the vendor. And again, it's different than what we would think of if we were purchasing something from Amazon, because there's no payment. We're actually going to request the vendor, somewhat like we're going to assume this company's in China is going to send us our inventory cups. We're going to request that they send them without getting any payment. And again, the only reason we could do that possibly is because if we have the volume of purchases, then we might be able to have the ability to be able to have the inventory actually shipped, be able to look at it and check it before the payment is being made, something we can't typically do if we're purchasing from something like Amazon. So therefore, the purchase order note is something that will not have a financial transaction, but it's important documentation going from us to the vendor that we will be purchasing from. Then we have the receiving report, records the receipt of the goods. So we can imagine China, the company in China sending us our inventory cups, sent them. Then we record the receiving report. We're imagining our warehouse creating the receiving report, which is going to be basically, we can actually count the inventory and make sure, and give us the physical count on the receiving report. Then we have the vendor invoice. That's going to be the bill from the vendor. So the vendor, we can, in our process here, we're imagining the invoice being possibly shipped to us along with the cups. So China sent us the cups that we're going to sell in our stores. They put the inventory or the bill in the cups because we didn't pay for it yet. They shipped it before we paid for it, which is nice. So we can count for it and say, looks good. Now we're going to pay for it at this point in time. And then the voucher basis for recording a vendor's invoice. So we'll use the voucher in order to record the invoice basically into our system. Then we got the voucher register or purchase journal. So the voucher register, or otherwise called the purchases journal, used to record vouchers for goods and services. Now note, as we consider the purchases journal, something like a purchases journal, we might go to a different accounting departments and ask for something like a purchases journal, and they might not call it exactly a purchases journal depending on the system that they're going to have. What do we want? We want something that used to record purchases, basically a list of purchases, transactions for goods and services. So that's what we're expecting. That's what we're looking for. So note that when we go to different types of companies that use different types of accounting systems, we're going to have to basically say, hey, we would like the purchases journal. And they may well say, well, I don't know what you're talking about. And then we could say, well, we need a type of reports that's going to list the purchases, transactions, whatever that report might be called, and then be able to tie that stuff out. So just note that as we think about this from an audit standpoint, financial accounting standpoint, and then convert that into accounting software standpoint, terms will not always be the same, and we might have to use some kind of filtering options and whatnot in order to get the reports that we are looking for. Accounts payable subsidiary ledger has amount owed to individual vendors. So the accounts payable, you'll recall, has the accounts payable on the books. We can think of it as a balance sheet account representing what we owe to, or what we owe to vendors, people outside third parties. Then we want to break that out not just by date, but we will also want to break that out by who we owe to, in other words, the vendors. Similar type of report that we would have for an accounts receivable, breaking the accounts receivable out by customer. We break the accounts payable out by vendor. Vendor statement represents the purchase activity with the vendor. Then we have the check or electronic funds transfer, EFT. That's going to be the payment for goods or services. Obviously, we may need to be considering the actual checks and looking at those forms, those driving documents, which will be an electronic fund transfer or the actual checks being represented. And then we have the cash disbursements journal or check register. Contains columns to record credits to cash and debits to accounts payable and cash disbursements. This is another one of those journals that we might ask for. We would like a cash disbursement journal, and they might say, I don't know what you're talking about there, because notice that this report, cash disbursement journal, and this report, a purchases journal, these are types of terms that we might often use if we were to basically build an accounting system by hand and be recording transactions in journals possibly, and then recording them periodically into the general ledger. But they're also useful types of reports that we would use in an automated system. In other words, we might be driving things with forms and documentations rather than us basically entering things into types of journals. But then that accounting software should still be making or be able to generate these types of journals because they're useful for us to go back and review the transactions. So these two journals then, these two names on these journals maybe, I believe, are derived from a point in time before we had more advanced accounting software systems where we would be using a purchases journal and a cash disbursements journal, because that would be simplifying the process for those types of transactions in more of a hand system as opposed to more of an automated system. So when we automated the system, of course, we still want these types of transactions as reports now. So now they're not really probably thought of by the auditors as journals so much as types of reports that are going to be reported that they can generate. So when we go to them and ask for them these things, then we're going to have to say, well, this is probably some type of report that we're going to need. What we basically need is the cash disbursements, which would basically be a representation of the checking account typically, and it's going to be the outflows. So you might have to go to the checking account and actually filter the transactions possibly by just having the checks or the outflows of the transactions and possibly filter the reports in some ways to get the type of report that what we're looking for here, which is, of course, contains columns to record the credits to cash. We want the cash to be decreasing, and then showing the other side debits to the other accounts, such as accounts payable and other cash disbursements. We basically want the check register for the cash decreasing, giving us the detail of the cash going down, as well as the other accounts affected, including accounts payable when it's being paid off, and whatever other accounts are involved as we pay or reduce cash. Now we'll take a look at the primary functions related to the purchasing process. We got the requisitioning function. So we talked about the forms, of course, with requisitioning. Now this is going to be, of course, the function, similar type of discussion here. Initiation and approval of requests for goods and services from authorized individuals. As we consider the internal controls, this will, of course, be very important because we want to make sure that within the purchasing department, with the companies approving the purchasing, the outflow of cash, therefore we need to have some approval process for that. And this is going to be the initiation and approval of requests for goods and services from authorized individuals. Then we have purchasing. The purchasing process is going to involve the approval of the purchase order. So remember, the purchase order is going to be the document that we're going to be sending to the vendor, actually requesting the vendor to provide us with the goods and service. We need an approval of the purchase order and proper allocation of the price, quantity, quality, and the vendor that's going to be on the purchase order and that's going to, you can imagine that's going to be another part of our internal controls, of course. And then we have receiving, receipt of correctly authorized goods and services. So that's going to be the process of us receiving. You're imagining the warehouse now receiving this information. And again, you can imagine in our controls, when we think about controls, this is going to be an important component because we want to tie all these out. Does the requisition tie out to the purchase order that was created? Does the receiving department, the receiving process, tie out to these items as well? And we can use different types of methods within the controls, as we'll discuss, to test that and to reduce possibly fraud within this process. Because, of course, if money's going out for purchasing stuff, you can imagine that would be an area where people could be imaginatory about having fraud, the company purchasing things that aren't appropriate for whatever reason. So then we have the invoice processing, vendor invoices processing for goods and services received, also processing of adjustments for allowance, discounts, and returns. So then we're going to have the actual process of the invoice, the invoice that we're receiving from the vendor. So we're going to actually, once we have the received goods, we will have, of course, the bill with it or the invoice to us for that, and then we have the vendor invoice processing portion at that time. Then, of course, we have the disbursement, the function of the disbursement of the payment to the vendor. That's going to be the actual cash or whatever payment form that will be decreasing. And then accounts payable, recording of all, because we have to record all these with regards to accounts payable, the vendor invoices, the cash disbursements, and the adjustments in individual vendor accounts, basically the subsidiary ledger that's going to be breaking out accounts payable by vendor. And then we have the general ledger. When we consider the general ledger function within this process, we have the accumulation, classification, and summarization of purchases, cash disbursements, and payables in the general ledger. And of course, the general ledger being our primary ledger, our primary listing of accounts that we need to make sure that we are recording properly as we go through all of these processes. Now we're going to go forward in future presentations and discuss how we can consider this process with regards to internal controls, how we can audit the internal controls, how we can then think about substantive tests. In this presentation, we will take a look at the segregation or separation of duties with regards to the purchasing process. Recalling that the separation or segregation of duties is one of the major primary internal controls. When we think about internal controls, we want to think separation, segregation of duties. That means that we're going to be taking this process in key components of the process. We will be separating duties, and in so doing, we'll provide some types of checks and balances to safeguard against problems within the process. Also recall that when we think about the internal controls and the separation or segregation of duties, we're thinking about the company's information in terms of the processing of the company data through the purchasing process, the internal controls then being set up by the company. These would be things that would be set up by the company in order to safeguard items within the company. We, as the auditor, of course, then being concerned with the internal controls, mainly as they would relate to the ability to make the financial statements more properly stated due to those internal controls. So internal controls related to the purchasing process. The purchasing function is segregated from the requisitioning and receiving function. Purchasing function is segregated or separated from the requisitioning and receiving functions. If one individual is responsible for the requisition, so we're going to request some item within the organization, and they're in charge of the purchasing, so they're going to actually go through the purchasing process with the vendor, and in charge of receiving, meaning we can imagine them in the warehouse now receiving the inventory. It's quite possible in that case, we're almost begging for it to happen, that fictitious purchase can be made. In other words, especially as the company gets larger, we're more concerned with this because we have types of individuals that are not possibly as closely knit, and therefore we need more internal controls in order to put safeguards in this type of process. In that kind of situation, you can imagine a person, if we put the person in the place and they're just seeing, they could just see that, oh, well, it's quite possible for this person then to have a requisition, request something, go through the purchasing process, and then receive the goods all in the same, by the same individual, for that individual to then have a fictitious purchase that they can make, and possibly resulting in a theft. So they could possibly basically approve something that's actually for them, maybe, that is going through the purchasing process of the company, of goods, and possibly payment for the unauthorized purchase. So we need the separation there. That should seem somewhat clear. Invoice processing function is segregated from the accounts payable. So the invoice processing, this is the invoice that's coming from the vendor to us, is segregated from the accounts payable, recording the actual activity in the accounts payable. So we are imagining usually when we're getting that invoice, that happens after we sent the purchase order. We typically receive the inventory. We're imagining us receiving the inventory with possibly the invoice or billing with the invoice that has been received. So if one individual is responsible for invoicing process and accounts payable function, purchase transactions can be processed at the wrong price. So it's possible for us then, because instead of having that separation of duties, to have the wrong price or terms, or a cash disbursement can be processed for goods not received. It would be possible to have a fictitious, basically, receipt then, when no goods were actually received, and still being able to record it in the accounts payable as if it was received, possibly resulting in overpayment of goods or theft of cash. And so again, you can imagine types of situations here where if somebody was in charge of those two functions, they could set up a process, work with vendors that were fictitious or something like that, and be able to basically commit some type of fraud. And whenever we think about these internal controls, you might be saying, well, that wouldn't happen. I know all these people. I trust all these people and whatnot. But just remember, as the company gets larger, we want to remove the ability for fraud to be happening. And we have to imagine then the fraud being taking place, put in the internal controls in that system. So it's often easiest for us to think about what's the type of thing that could result in fraud within this situation. Let's set up a system where that will be less likely. We don't even want to have the temptation of fraud being there if we could put in a simple safeguard or separation of duty in some key places in order to do that. It may also reduce error as well, given the fact that sometimes that results in a double checking as well. Disbursement function is segregated from the accounts payable function. So the disbursement of the actual cash now being segregated from the accounts payable, recording of that accounts payable, the reduction of what is owed to the vendor in the books. If one individual is responsible for the disbursement function and has access to the accounts payable records, unauthorized checks supported by fictitious documents can be issued. So we can imagine this happening. Again, fraud, you can imagine what would be the fraud scenario if someone had the ability to do both these things, basically the disbursement of the cash as well as recording the decrease in accounts repayable. You could see that we could imagine situations where cash could be sent out that was not correct. Unauthorized transactions can also be recorded, possibly resulting in theft of the entity's cash. And then we have the accounts payable function is segregated from the general ledger function. So when we're thinking about the accounts payable segregated from the general ledger, if one individual is responsible for the accounts payable records and the general ledger, that individual can cancel any falsification that would normally be detected by reconciling the subsidiary records with the general ledger control account. In other words, we're typically thinking of someone being involved or handling the accounts payable subsidiary ledger, typically broken out by vendor, and we need to agree that we're going to agree that with the general ledger, the account on the general ledger controlling account, they should agree. If we separate those two out, then we'll be able to reconcile those two, and if we have two people involved, we'll be able to have kind of a better check between those two reconciling. Whereas, of course, if we only have one person involved in both of those two items, then they can basically account for the reconciling. They can perform a falsification within the reconciliation and mask what would be caught within that checking process. Therefore, here's going to be a chart of our information. We got the purchase process functions, and then we've got the different areas: purchasing, receiving, accounts payable, cashier, and the IT. So the preparation and approval of the purchase order, that's going to be in purchasing. Then we have the receipt, counting, and inspection of purchase items. So the receipt and counting, that's going to be in receiving. So we're considering the warehouse now. That's separate from the purchasing, the preparation and approval of the order. We want to keep that separate from the receiving, you'll recall, the actual handling of the goods that we're imagining have been received in the warehouse. Then we have receipt of vendor invoices matching with the supporting document. So that's going to be in the accounts payable. So receiving is separate from the entering of the data, the accounts payable then. Then we have the checking of the account disbursements. So that's going to be in the accounts payable. Then we have the updating of accounts payable records, again, handled by accounts payable. Notice accounts payable can be a very key function depending on the size of an organization. Larger the organization is, accounts payable can be a very specialized field involving many folks within it. It also might have an IT component, internal IT department component. Creation of vendor checks. So that typically is going to be done through the IT department through the creation of the checks. Signing and mailing of the checks should be done separately. So notice the person creating the check is going to be separate from the person that is going to be, of course, signing the check. Now, also note that in smaller companies, we may not have all these separation of duties to be in place. But of course, the signing of the check, even if we're a sole proprietor, and we have other people that are basically helping us to, purchase what we need, working with us, then a bookkeeper and things like that, we would need then to probably separate out the signing of the check. That's one internal control. We don't want to just give the stamp or some kind of automated process possibly to somebody else there. Even if we trust the bookkeeper fairly well, we probably want to have at least the signing or approval process of the actual payment. So note, again, if smaller companies may have they will have lesser internal controls, will not be able to do the primary type of activities for a good control system because the primary activities include separation or segregation of duties. They won't have the personnel. However, they do want to have some of the key components for that separation. The signing of the checks by the owner possibly, and possibly doing the bank reconciliations process are some items that you may consider for smaller companies. Creation of voucher register, IT, and then we have the reconciliation of voucher register to the general ledger. So you'll notice that the IT is basically just that because the system is going to help us to basically create a voucher register. And then the reconciliation of voucher register to the general ledger, we have here in the accounts payable tying those two things out. In this presentation, we will discuss inherent risk and control risk as it relates to the purchasing process. So you'll recall we're in the auditing strategy. We're considering the purchasing process. We've gone through that purchasing process. Now we want to consider those risk factors. So recall that we want to consider within the auditing process the inherent risk, the control risk, and then use that to determine what we should set the detection risk to be, that then determining what we want to put in terms of substantive testing, or how much or how many substantive testings need to be put in place. So we'll recall then that when we think of inherent risk, we're thinking of those risks that are inherent to the organization. You want to think about it in this format. In the inherent risk, when we're thinking about inherent risk, we're trying to remove the internal controls and just say, what is the inherent risk, or how inherently risky is this process without the internal controls? That's just the inherent risk of the business model, the business setting, the standard functions that are going to be in place just within the process. So we want to think about whether the inherent risk is great or small. Then we think about the control risks. Those are the risks, those are the things, the controls that the management, the company, put in place to safeguard against those inherent risks. Those inherent risks the company is worried about that will be problems to the company, which we are worried about as auditors because they're going to affect whether or not the financial statements have been reported properly, because if there is a problem in these areas, there's probably even either an error or some type of fraud possibly which could make the financial statements not be reported well. So what we want to do then is take a look at the inherent risk, take a look at the control risk, then use that to see what we want to set detection risk to be, and then think about how much substantive testing we want to do of this process. So inherent risk assessment, industry-related factors will include, is supply of raw materials adequate? So notice that different industries might have different basically supply requirements for the raw materials. So if we're creating something, if we're creating say inventory, we might have a question about what the raw materials are and whether or not they're going to be basically adequate. Are they there? Are they something that we are able to get? In other words, if we only have a few suppliers, a few vendors of particular items that we need, that could be a problem within the purchasing cycle. If we have a lot of different vendors, if one vendor goes down and we could purchase from a lot of different vendors, then we don't have as much of a problem. For example, if we needed to purchase like a precious metal or something like that to go into our purchasing process, and there's only one company that has that precious metal, then that's more inherently risky to the organization than if we're purchasing something that's fairly common, like water or something like that. And you say, well, if one company goes down, that's who we mainly purchase from, our water, but we could probably go somewhere else, wouldn't have much of a difficulty there. So that's one kind of inherent risk factor with regards to the purchasing process. Who do we purchase from, and how specialized is that purchasing? How volatile are raw materials prices? So obviously when we think about our purchasing process, when we think about making inventory, we're thinking about what's going to be our profit margin. And we want to make sure that if we have a type of material that's going to vary a lot in terms of the costs of the material, that could be making it difficult for our purchasing process. It could cause problems, of course, making our purchasing process more inherently risky. If we're looking at types of raw materials that are fairly stable in terms of price, that's probably going to make our purchasing process less risky and more easy for us to manage through. If I could be very certain about what the estimated price will be, it's pretty constant throughout the whole process of our primary purchasing items, that makes it a lot easier for me to put in a process and for me to test it as well. If the price is very volatile, then it's a lot more difficult for us to put in a process that's going to make sure to safeguard against any errors that could happen, because they're not going to be as easily detectable given the fact of the volatility in the price of the things we're looking at. So misstatement fraud in prior audits is also going to be an inherent type risk factor, just part of the business that we are in. The purchase process is not usually difficult to audit and does not present continuous auditing issues. So in other words, this isn't a place that we would often expect that we would have a problem within the auditing process. However, the auditor's past experience in audits needs to be considered when assessing inherent risk. So we want to say what happened last year, what happened last time. If this is a continuing client like it normally is for most type of clients, then we could consider what happened last time and factor that in. We'll factor that in where in our formula in the inherent risk type of calculation. Then we have the purchase process internal controls. Now we want to consider what the internal controls are. Remember that these are set up by management, but they're something that we are going to rely on in the audit to some degree, and whether or not we rely on it, or the degree at which we rely on it, will depend on and help us to determine how much substantive testing we will then do. So primary steps in setting control risks for the purchasing process will include understand and document the purchasing process using a Reliance strategy. So we're going to document, the process that they go through. plan and perform tests of control on the purchasing transactions. So we want to say, hey, what's your purchasing process? Then we want to test the controls. Recall that we're going to do tests of controls because we're hoping to come up to a conclusion that we can rely on controls, and testing the controls, testing the checks and balances should take a lot less work in most cases than doing the substantive testing of testing all the transactions and testing the account balances. So we're hoping to do test of controls so that we can determine that we can rely on them to some degree, reducing the amount of detection, the amount of substantive testing we'll need to do. And then we'll set and document the control risk for the purchasing process. So that's going to be our ultimate goal for the control risk. We'll set the control risk, and those are the two factors that are kind of controlled by the company. Inherent risk by the business that they've chosen to be in, the process that they have set up for it, and control risk, meaning the controls that they have put in place in order to safeguard against the inherent risks. Purchasing process control risk information system. Auditor will obtain the information below for each major class of transaction in the purchasing process. So we're going to go through this process. We're going to obtain this information related to it. The initiation process for the purchase, cash disbursements, and purchase return transactions. So we want to know about then the initiation process, the cash disbursements, and the purchase return transactions, the accounting records, supporting documents, and accounts that are part of the purchase process, cash disbursement, and purchase returns. We want to get information related to that. The flow of each type of transaction from initiation to inclusion in the financial statement. So how does this flow through with regards to, one, the initiation all the way to the financial statements? Computer processing data should be included in this process. So note that, of course, the IT will be involved in this, and we may need IT professionals to help us look into the system to make sure that we can understand and be able to audit the system, give us the rights to basically go through and test the audit within the system and test different types of controls within it. The process used to estimate accrued liability. Purchasing process control risk assessment. After testing controls, the auditor will set the achieved level of control risk. So we're going to obviously test the controls, then we're going to set the control risk. If tests of control support the planned level of control risk, no modifications are necessary to planned detection risk. So if we don't have to make any modifications to the detection risk and we can move forward with everything as we planned, the auditor will process with the substantive procedures as planned, meaning we're going to say, okay, we're at the level of control that in the control risk that we had determined it to be. Therefore, we can move forward with the substantive tests as planned. When tests do not support planned control risk, so what happens if we test the controls and they are below what we expect them to be, the auditor lowers the level of planned detection risk. So remember, what we're talking about here with these, it's kind of easy to see what we're doing relationship-wise, but it can be difficult to know which direction these things are going if we were to be tested on it or to talk about these type of factors. So obviously, what we're doing is trying to rely on the controls. If we can rely on the controls, if they're good controls, then we're going to do less substantive testing. That's fairly obvious. But what does it mean to have the control? Or hopefully by now we've talked about it by now. So what if the control, what does it mean for the control risk factors? Well, control risk is the risk that the problems will not be detected by the internal controls that are set up. So therefore, if we cannot rely on the internal controls, the risks that the controls are weak are going to be higher. That means that we're going to increase the control risk because the controls are weak, they're not good. Therefore, we increase the risk factor. The control risk is going to be higher because the controls are not going to detect. And the detection risk, then, we're going to set at lower, because what we're trying to do is say the detection risk is going to be the risk that the audit test, the substantive test, the tests we're going to put in place are going to not catch the error. So, and that means we want to make that, then we want to do more substantive testing, which will lower the risk that our detection risk wouldn't detect the error. So we can't rely on the controls. Control risk goes up. We're going to increase control risk, and therefore we need to make detection risk to go down to make the overall thing basically balance out. So we're going to decrease the detection risk by doing more substantive testing. In this presentation, we will be discussing control activities and tests of controls related to the purchasing process. So remember, within the audit process, we're thinking of the purchasing process now, the purchasing cycle in essence. We've discussed what inherent risk, what control risk is. Now we're going to be thinking about the controls being set up in order to deal with the risk factors by the company, by the management, those checks and balance type of systems that are going to be put in place. We, of course, as the auditor, thinking about those controls that are in place as a factor that will then be used in our audit plan, considering the control risk and the inherent risk to help us decide the detection risk to decide how much substantive testing we want to do. So control activities and tests. So the tests of controls, of course, the tests of controls on us as the auditor for testing of the control activities that will be set up by the client, the management for the business in the purchasing process. So first we have occurrence. So that's the assertion of occurrence. So occurrence has purchase, cash disbursement transactions, and events that have been recorded or disclosed have actually occurred. So remember that what that means, of course, occurrence, we're usually thinking about the end product. We see the end financial statements, the accounts payable in essence, and other kind of related accounts that we're testing with relation to the purchasing process. And then we're going to go back and say, hey, has this transaction actually occurred? And such transactions and events relate to the entity. And of course, have they occurred, and they are transactions related to the entity as would be indicated by what is on the financial statement. Completeness, on the other hand, purchase and cash disbursement transactions and events that should have been recorded have been recorded. So now we're thinking about, is there anything that has occurred that isn't on the financial statement? Are the financial statements, in other words, complete? Has all the data been included? Here, we might be a little actually more concerned with completeness to some degree, because if there were purchases possibly that aren't recorded, that might mean that the liabilities, because if we're considering accounts payable a liability, we might be more concerned that it would be understated as opposed to overstated, and that would be having to do with not recording some type of liability on it. Related disclosures that should have been included in the financial statements have been included. And then we have authorization. That's going to be the assertion. Purchase and cash disbursement transactions and events have been authorized properly. So do we have the proper authorization? Then we have the accuracy assertion. So the assertion of accuracy with regards to the purchasing process, amounts and other data related to recorded purchase and cash disbursement transactions and events have been recorded correctly. Related disclosures have been appropriately measured and described. Then we have the cutoff assertion. You'll recall that's the end of the year cutoff date, the proper time period accrual accounting, considering the matching principle or expense recognition principle with regard to the purchasing process. And that's going to be purchase and cash disbursement transactions and events have been recorded in the proper accounting period. And then we have the assertion of classification. Classification, purchase and cash disbursement transactions and events have been recorded in the correct accounts. Then we have presentation. Purchase and cash disbursement transactions and events are correctly aggregated and disaggregated and clearly described. Related disclosures are relevant and understandable. So those are going to be the assertions within the purchasing process. Now we're going to be considering the tests of controls with relation to those assertions. So those are the assertions being made. We want to be able to test those controls. So now we have occurrence. How would we test for occurrence? We have observe proper segregation of duties. Recall that the separation or segregation of duties is going to be a major internal control. We want to be able to observe that those separation of duties, segregation of duties are in place. Test a sample of vouchers for the existence of an authorized purchase order and receiving report. So we can go through and we can test a sample of the vouchers and see if there is authorized purchase order and receiving report related to it. And clearly, if we then have a receiving report and a purchase order, and we've actually received it, we got the receiving report representing that we have received it, then we would think that it actually occurred. And remember, what we're looking for on occurrence is that it's on the end, and the end result is there. It's on the books, meaning it might be there in terms of inventory. And if we're concerned with basically the inventory, if it's actually been received, that being an asset, so we're going to be concerned with the asset that could be overstated, then we can take it back to the receiving report If it's been received, of course, then on the receiving report, then we would have more confidence that it has indeed occurred. If data is accessible, use audit data analytics to match the populations of vouchers to related purchase orders and receiving reports. Then we have completeness. So completeness, the testing of the assertion of completeness. Review procedures related to numerical sequence of purchase orders, receiving reports, and vouchers. So when we're thinking about completeness, we're thinking, hey, has a transaction happened that wasn't recorded in the system? The pre-numbered documentations help us to do that, because if they're pre-numbered, then if we could have a missing number within the pre-numbered sequence would be an indication that there had been something that had been done that hadn't been recorded. So that pre-numbering is actually a very important, basically, internal control, similar to the pre-numbering we would have basically on our checks. If we see a missing check number, then we have we're going to question that. We're going to say, hey, something's wrong. The pre-numbered systems and these other types of forms similar to that. Traced a sample of receiving reports to their invoice and vouchers. So notice now we're going basically the other way. We're tracing back the other way. We're going to go back. We're going to go to the receiving report. That's going to be, so we're imagining we're in the warehouse. We're going in the, we're getting the receiving report that represents that we've received the goods. And now we're going to trace them back to the invoice and the voucher, because now we're testing for completion, as opposed to us going from the end result, basically the balance sheet or the general ledger, and then going to the source document, which would be the receiving report, which would be the indication that the actual transaction happened that we would do for occurrence. So notice that, again, these two tests are tests that most people, if you were to ask them, yeah, you'd say that's an appropriate test. But a lot of people will get confused as to whether you apply the test to completeness or occurrence, which is a common test question. It's something we have to kind of keep straight when we think through the appropriate audit plan. And then we have to trace a sample of vouchers to the purchase journal, and we want to review the financial statement disclosure checklist. Then we have authorization, so that's the assertion, the tests related to it, examine purchase requisitions or purchase orders for correct approval, review client's competitive bidding procedure. So we're going to examine the purchase requisitions to see if we have that authorization and that approval process. Then we have the accuracy. How can we test for the assertion of accuracy? We can recompute the mathematical component of the vendor invoice. So we can go to the invoice. We can recompute for mathematical accuracy. We can agree information in the sample of vouchers for product, quantity, and price. So we can go into them and agree that information out with whatever sources that we can for the product, quantity, and price. And we can examine reconciliation of vouchers to daily accounts payable report. So we'll take a look at the actual vouchers and go to the daily accounts payable report, because we should be, of course, recording this stuff on a daily basis. Then we have the cutoff information. That's the end of the year cutoff assertion information. Basically, do we have this information recorded in the proper period? And so we have agree the dates on the receiving report with the dates on their vouchers. And we have the agree the dates on the vouchers with the dates they were recorded in the purchase journal. So let's take a look at that again. If we say we want to agree the dates on the receiving reports. Now the receiving reports, remember, are probably the reports that we're going to be using to verify when the inventory should actually be recorded. Because when we received it, we actually have the inventory at that point in time. Typically that happens at the same time that we get the bill. So under the expense recognition principle or the matching principle, you would think that the receiving report for many type of organizations would be that point in time that the work had been done. We had actually incurred the expense. We could then record the inventory and record the related payable at that point in time. So we want to agree the date we have the receiving report, which is the date we would want it on the books according to the matching accrual principle, with the dates on the vouchers. Now the voucher, might be something that the system uses to record that information. So when we put the information into the accounting system, it might be driven basically by the vouchers. So they should be, we want to compare those two dates and see if we have a timing issue as to when the information was recorded into the system and when the information was actually received, and it should be on the books when it was basically received under most circumstances. Agreed dates on the voucher with the dates they were recorded in the purchase journal. Now again, the voucher, the voucher would probably drive what's going to be recorded in the purchase journal. The purchase journal is what's actually going to be recorded in the accounting system. So again, we want to agree those dates out. We want to see if there's any lag, any difference within those dates, and we want to basically see that when should it be recorded. And notice we're usually considering it by the cutoff. If it's a 12/31 year end, sometime at the end of the year, we're trying to see, well, this is the time period that it should be on the books. When was it actually recorded into the system? And trying to determine if there's any kind of timing difference that would have happened with the cutoff testing. And then we have the classification, review purchase journals and general ledger to assess if reasonable, examine a sample of vouchers for correct classification. So we're going to get the purchase journal and recall that the purchase journal is going to give us basically a list of those purchasing transactions. It might be a report within the accounting system that may not be called, in essence, the purchase journal, depending on the accounting system we're going to use. We're going to examine those purchases and make sure that the classification is correct, meaning, did we put the purchases into the right account? And obviously the accounts payable would possibly be part of the purchases, and then the other side would be something like possibly inventory or possibly some other type of supplies or something like that within the proper classification. Then presentation, how can we test for that assertion? Review purchase journals and general ledger for correct aggregation and disaggregation of purchase transactions. Determine if disclosure is needed. Now we're going to take a look at the control activities and test cash disbursement transactions. So we're considering cash disbursement transactions. We're looking here at occurrence. So cash disbursement transactions within the purchasing process considering occurrence. The auditor will test for misstatement caused by a cash disbursement being recorded in the entity's record when no payment was made. So we're thinking here about occurrence, something that happened, cash disbursement that was recorded when no payment was made. The main control activity to prevent this misstatement include proper segregation of duties. So in order to prevent this, we would want the segregation of duties. Independent reconciliation. So we want an independent type of reconciliation process. So we'd have two individuals involved, people entering the data, and then the reconciliation being done by someone else, so that if there is a problem or something wasn't recorded properly, it would be picked up by another individual as opposed to something that could be altered within the reconciliation process. Review of vendor statements and monthly bank reconciliations. So we should be doing, of course, the bank reconciliations. Anytime we deal with cash, the bank reconciliation process is going to be a key component involved. Cash disbursement transactions. Now we're going to think of the completeness assertion. Completeness assertion. Primary audit concern is that the cash disbursement is made but not recorded in the records. Of course, that's our primary concern, that the cash went out and it's not been recorded in the records. So how could we guard for that? In addition to the control tests for occurrence, so we're going to apply the same test, in other words, as we saw for the assertion of occurrence, the auditor should also account for numerical sequence of checks and reconcile the daily cash disbursements with postings to the accounts payable subsidiary records. Now we'll go through assertion, again related to cash disbursement transactions. Good segregation of duties decreases the likelihood that unauthorized cash disbursements are made. Again, major control that we would have in place, we should have in place, that we hope as auditors that management has in place, is good separation or segregation of duties. The person who approves a purchase should not have direct access to the cash disbursement. So the approval process should be separate from the cash disbursement process. Now we're considering accuracy with regards to cash disbursement transactions. One of the primary audit concerns is that the payment amount is recorded incorrectly. So we want to make sure that the payment amounts are recorded correctly with regards to accuracy. To detect this error, entity personnel should reconcile the total of the checks and if we have the electronic fund transfers, the EFTs, issued each day with daily cash disbursements reports. So we want to have a daily cash disbursement reports, and we want to be able to check those off with the checks and electronic funds transfers. Obviously, we want to think about the bank reconciliation process with regards to accuracy as well. Then we have the assertion of cutoff relating to cash disbursement transactions. We have tests of controls will include reviewing the reconciliation of cash disbursements with postings to the cash disbursement journal and accounts payable subsidiary ledger. Auditor will also test cash disbursements before and after year end to make sure the transactions are recorded in the proper period. So really with the cutoff, remember, of course, we're considering those year-end types of transactions. So oftentimes we'll be testing transactions that happen with relation to cash close to the end of the year. We'll be doing some audit testing basically on those transactions that are happening fairly close to the end of the year and just after the year. And recall when we do cutoff testing that although we're testing for the year end, let's say 12/31, December 31st, clearly we're doing the audit sometime after that. It's probably not going to take at least February and possibly March before we get the audit done, possibly. And that means that we have, at least another month or at least a half a month, even if we're really fast, that we can go in and test the cash transactions after the year end is over. So that's part of the testing that we'll typically do for cutoff testing. Cash disbursement transaction classification. Auditors worried that cash disbursements may be charged to the wrong general ledger account. So it's possible we have the wrong general ledger account charged to. The use of a chart of accounts and independent approval and review of the account code on the voucher should provide sufficient control for this. So that's going to be classification. Now we're thinking about purchase return transactions. So internal controls. Now we're considering their transactions of purchase return transactions. Generally, the number and amount of purchase returns is not material. So notice we're thinking about returns process here, not people returning inventory to us that we sold, but the returns that we have to our vendors. Normally, hopefully the companies we're working with have good vendors. We have good relationships with them, and we're not having a lot of returns to the vendor. We're not purchasing stuff, whether it be inventory or something else, and then saying this isn't what we want and returning it. So normally, that's not going to be a substantial part of the process. It won't be material and therefore won't be a large concern for the audit process. Often the auditor does not test controls related to purchase returns for this reason. However, substantive analytical procedures are used to test reasonableness of the amount. So we might not do the test of controls because we're going to say, hey, it's not a material component. There's not a lot of purchase returns possibly. However, on the substantive side of things, since we're not doing the test of controls, we will do some substantive testing, and that substantive testing will at least be with regard to the reasonableness of it. We'll use some ratio analysis and consider the reasonableness of the purchase return transactions. Now, the assessed level of control risk and how that applies to or relates with the substantive procedures. If the results of the test of control support the planned level of control risk, then auditor will conduct substantive procedures at the planned level. So in other words, if we test the test of controls, we've got our audit plan set up, and the test of controls meet what our expectations were, we'll move forward, we'll do the expected substantive procedures that we had planned to do. If the results did not support the planned level of control risk, then we're going to have to, auditor reduces the detection risk. So what's going to happen then, because we've already set up the plan, we're at this point in time, we've said we're going to test controls. If they meet our planned level of control risk, then we're going to move forward with the substantive testing which we have planned. However, if the test of controls do not meet, we test the controls, they don't meet the level that we wanted, then the audit's going to reduce the detection risk. Now again, we want to consider this relationship. Remember that when we think about this relationship, it's easy to think that, well, if we rely on controls, or it gets easier, we start to comprehend at least, that if we rely on controls, then we're going to do less substantive testing. If we don't rely on controls, we do more. However, it can be a little confusing to think of the direction of these ratios. So remember, if we're talking about internal controls risk, we're thinking about the risk that the internal controls will not detect an error. So if we can set the internal control risk low, we think the internal controls are strong, and therefore we'll do less substantive testing. In this case, if we think the internal controls are weak, we set the internal control risk high because we don't think it's sufficient to catch the error. It's more risky, so we set the internal control risk high. And then the detection risk, which represents the risk that the the substantive testing mainly, will not catch an error. That detection risk, which we're going to set and determine how much substantive testing we're going to want to do, if we can rely on controls, we're going to set the detection risk actually high, meaning we're going to do less testing. So it's going to be more possible for something to not be caught in the substantive testing because we're relying on the controls. However, in the case where the control risks are not something that we can rely on, then we're going to set the detection risk low, and the result of us setting the detection risk low is that we have to do more substantive testing. So in this case, if we can't rely on controls, we're going to set the detection risk low, and we're going to increase the level, therefore, of substantive testing with relation to meet that lower threshold of detection risk. In this presentation, we will take a look at the auditing process for auditing accounts payable, focusing in on accrued expenses. Accrued expenses. So here's going to be our assertions that we're focusing in on. Existence being the first assertion. Accounts payable and accrued expenses are valid liabilities. So that's what we're thinking about in terms of existence. Are they valid? Rights and obligations with regard to accrued expenses. Accounts payable and accrued expenses are obligations of the entity, so we want to be able to say that they are for the entity, these accrued expenses. Completeness, the assertion of completeness. All accounts payable and accrued expenses have been recorded. All related disclosures that should have been included in the financial statements have been included. Then we have accuracy, valuation, and allocation as the assertion. Accounts payable and accrued expenses are included in the financial statements at correct amounts. Any valuation or allocation adjustments have been recorded. Related disclosures have been measured and described. Then we have the assertion of classification. All accounts payable and accrued expenses are recorded in the correct account. Then the assertion of presentation. Accounts payable and accrued expenses are correctly aggregated or disaggregated and clearly described. Related disclosures are relevant and understandable. Now we're going to discuss the substantive analytical procedures. So substantive analytical procedures. So we're on the substantive procedures, but these are those analytical ones, the ones that we can do in the office, the comparison, the auditor's office, I would consider, the comparison, the ratio analysis type of activities. So we can compare the payables turnover and days outstanding in accounts payable to the previous years and industry data. The possible misstatement we would detect under or overstatement of liabilities and expenses. The substantive analytical procedure then we can do compare current year balances in accounts payable and accruals with the prior year's balances. Obviously, this will be a common procedure we'll do. We'll compare the current year to the prior year, that what we're going to detect under or over statement of liabilities and expenditures. So any kind of unusual activity from year-over-year comparison is something we might look into. Then the next substantive analytical procedure, compare amounts owed to individual vendors in the current year's accounts payable listing to amounts owed in prior years. What we might detect under or over statement of liabilities and expenses. Next substantive analytical procedure, compare purchase returns and allowances as a percentage of revenue or cost of sales to prior years and industry data. Possible misstatement to detect under or overstatement of purchase returns. Next substantive analytical procedure, predict accrued interest expense based on loan terms and the outstanding balance. Possible misstatement to detect understatement of accrued interest. In this presentation, we will take a look at tests of details transactions related to the accounts payable cycle. So the accounts payable cycle, test of details transactions, looking at the assertion of completeness, assertion of completion. The auditor should conduct a search of unrecorded liabilities that include the following. So completeness, of course, being that assertion that we want to make sure that everything that should have been recorded is recorded. In other words, are the end results done in the financial statements? Is everything on the financial statements? Are they complete? In other words, are there transactions that have happened that are not reflected in the financial statements in the end result? So how do we test for this? Inquire management about control activities designed to identify unrecorded liabilities and accruals at the end of the accounting period. The controls would be part of the closing process. Vouch large dollar items from the purchases journal and cash disbursements journal for a period of time after year end. Now remember, what we have here is after year end because we're doing the audit as of let's say 12/31. The year end, let's say, is 12/31. Of course, we are doing the audit at some point after that point in time. So if we're testing something, we can actually take a look at some of the transactions that happened after the year has closed and use them as part of our testing process. Examine the data on each receiving report of vendor invoice to see if the liability relates to the current audit period. So we're going to take the information and we're going to look at the data that should be used in order to determine when something should be recorded. In this case, that being the receiving report. Why? Because the receiving report is usually going to be that item, if we're talking about purchases, that we actually received the item. So we want to see if that's the point in time that the item was actually put on the books. Was it put on the books in the correct time period? It should be put on the books in accordance with the receiving reports. We want to see what's the triggering factor as to when the item is going to be put on the books in the accounting system, and then basically double check those. And we can do that by looking at some of the transactions after the end of the time period and checking to see if it has indeed been recorded at the time period it should have, that being the time period the receiving report happened. We want to examine files of unmatched purchase orders, receiving reports, and vendor invoices for any unrecorded liabilities. Next assertion related to test of details of transactions is existence. With existence, auditors' primary worry is whether the recorded liabilities are valid obligations of the entity. So the recorded liability on the books, are they valid liabilities of the entity? Now, again, you would think that with regards to liabilities, they wouldn't overstate the liabilities, but that's basically what we're testing for with regards to existence, because you would think if they were overstating liabilities, they wouldn't typically do that intentionally. It might be an error possibly to overstate the liabilities, but you would think that you wouldn't intentionally overstate the liabilities usually, because that would make you look worse. The only time that might happen generally is if there's something for tax reasons or something like that, but typically we would think that if there was going to be some type of intentional misstatement, they would usually be trying to look better, not worse. Auditors should vouch a sample of items on the listing of accounts payable to the supporting documentation. So we're going to take the information from the end result, then existence we're talking about here, and then we're going to vouch it back to the source documentation. And that'll help us to be able to see if the end result, what's on the books, actually happened. So we're going to take the end result and then go back to the past. Next, we have the assertion with relation to the test of details of the cutoff. So recall that the cutoff is typically going to be that year-end type of information. Are things properly recorded in the proper time period? Auditor will try to determine if all purchase transactions are recorded in the correct period. For most audits, the purchase cutoff line up with the entity's physical inventory count. So we're going to basically line this up when we're going to do it with the physical inventory count. And that will typically happen somewhere close to basically the year end, so that we can check that the physical inventory, what's on the books, as we go out and check the physical inventory is indeed present at that point in time. Proper cutoff should also be determined for purchase return transactions, so we also want to consider the cutoff with regards to purchase returns. Next, we'll take a look at test of details transactions with regards to rights and obligations, the assertion of rights and obligations. The risk is small related to this assertion because entities generally do not have an incentive to record liabilities that are not obligations of the entity. So usually when we're considering the rights and obligations with regards to liabilities, again, the assertion, normally the company wouldn't try to look worse most of the time, and therefore it's not an assertion that's as high of a priority with regards to liabilities typically. Next, we're going to take a look at the assertion of accuracy, valuation, and allocation. Accounts payable should be recorded at either the gross amount of the invoice or net of the cash disbursement amount. Valuation of accruals depends on the type and nature of the accrued expenses. Most accruals are fairly easy to value. Next, we'll take a look at the assertion of classification. The primary issues with regards to classifications with the test of details of transactions are: find and reclassify any material debits contained in accounts payable. So we're going to go through the accounts payable, the detail of accounts payable. If there are debit balances in the accounts payable balances, then it shouldn't be the case that we should have a debit balance in accounts payable. Something kind of funny possibly happened at that point in time, and we'd want to remove any debit balances in the accounts payable. Now, there could be a debit balance if there is some kind of policy. So, for example, if we purchase something and we typically put like a down payment on the purchase of something before we receive it, it could be possible that the system then has been set up that we put that into a negative payable, meaning we would kind of have a negative payable to the vendor. Why would we do that? Because the accounting system makes it a little bit easier to do. It could make it a little bit easier to track by vendor what is owed to the vendor, instead of putting it into basically an advanced payment. So instead of putting it into an asset, in other words, of an advance payment before we receive the goods, whether it be inventory or some other type of asset, we put it in as a negative liability because it's going to match up once we received the goods that we're going to receive, and the system will make it a little bit easier for us to do that with regards to the matching up process of the vendors. So if that is the case, and we would probably want to inquire to the organization to see if that's going to be something they do within their normal policy. We may well have debit balances in the accounts payable accounts, and then we're just going to reclassify them from negative balances of a liability to asset balances. And then we have separate short-term and long-term payables. We want to make sure that we're separating out the short-term and the long-term payables. Make sure that different types of payables are properly classified. So if we have different types of classifications of payables, we want to make sure that they are in those proper classifications. Next, we're going to take a look at the assertion of presentation. There are two disclosure items of primary importance for accounts payable and accrued expenses with regards to presentation. Auditor needs to make sure that all related party purchase transactions have been identified. So remember, whenever we have this related party transactions, we could think of a related party such as a subsidiary or something like that. Then we have issues because we're concerned that there's not an arm's length transaction. We don't have market forces to help us determine that the transaction is at basically market prices. Therefore, we want to identify those for sure and look into those types of transactions. If material, the related party purchase transactions should be disclosed. So if the related party purchase transactions are material component, we want to disclose those because, again, that relationship kind of makes those transactions a bit suspect in terms of whether their market validity of those types of transactions. The other primary concern is purchase commitments. When the entity has entered into a formal long-term purchase contracts, proper disclosure of the terms of the contract should be provided as a footnote. So when we have long-term basically contracts, we want to make sure that we're clear on what the commitment is in the contract. If we have a very complex contract and we're dealing with something that's going to be material, that's a problem. We want to know exactly where we stand in terms of the long-term obligations of a contract. Now we're going to take a look at accounts payable confirmations. Now, when you think of confirmations, you're thinking about a third-party verification, and normally, if you hear confirmation, the first thing that pops into your mind is probably accounts receivable confirmations. That's where we are most likely to do confirmations. That and the bank, we'll send confirmations to the bank. We'll send confirmations to accounts receivable most of the time, some of the customers, to confirm the balances owed to the entity by customers. Accounts payable, we can do the same thing, but it's usually not as necessary a process. So we're almost definitely going to do it for the cash, some type of confirmation. We're probably going to do it for accounts payable, at least to some degree, depending on the entity we're doing. And then accounts payable, we may do it, but it's a lesser degree of likelihood that we'll do confirmations, meaning we're going to send confirmations out basically to the vendors now that owe the company. That the company owes money to. The company that we are auditing owes money to the vendors. So they're going to be used less often than accounts receivable confirmations, partially because auditor is able to examine externally created source documents related to accounts payable. So notice in accounts payable, we have other type of source documents that are not generated from inside the organization, as opposed to accounts payable. When we're looking at the things that generated the accounts payable, the source documents are generated by the company. So that's going to be less reliable type of information. If we just look at the invoice, that's going to be less reliable information. With regards to accounts payable, we're looking at bills and things that are going to be given from outside of the organization, and therefore they are more reliable, and possibly then we can rely less on things like confirmation. When confirmations are used, they are usually positive and are generally blank confirmations. In other words, notice what we're not doing here. We're not saying, hey, here is the balance, and you tell us basically yes or no on it, or we're not even saying here's the balance and don't send it back if you don't agree with it, which would be a negative confirmation. We're having a positive confirmation saying, hey, we would like you to send it back either way, and they don't really have the option because we're going to send it blank, meaning we're not going to say here's the balance and do you agree with it or not. We're going to say, we feel that this company that we are auditing owes you this much money as of this date, or owes you money as of this date. Would you confirm the balance? We're not going to give the balance. We're going to give it blank. They're going to show us the balance as of that date. Now, notice that a lot of times when we think about these confirmations from the accounts receivable side of things, notice the person that receives it, if you're talking about receivable confirmations, the person that receives it is owing the company that we're confirming the money. And therefore, they have less incentive to be kind of cooperative there. They might see the thing and say and not want to deal with it, or say that I don't owe the company money at this point in time. However, if you're dealing with a vendor, typically that means that the company that we are auditing owes them money. So if we ask them, do we owe you money, they're more likely to know exactly what that is and maybe have incentive to look it up and check it out and send it back to us. So they might be more likely and more incentivized to actually to have a higher rate of return of the confirmations, in other words, to accounts payable people, because they're the people that the company that we're auditing owe money to, and we're asking them how much money the company that we are auditing owe them. And so they might be more likely to take it back. Now, also remember, all the rules with the confirmations are pretty much, the same here. We, the auditor, are doing the confirmation. We're not going to do it on the company letterhead. We're doing it outside of the company. We're going to send them directly to the vendors, and then the vendor's going to send them directly back to us, the audit firm, not to the company. So we're keeping the company out of it. The vendor is asked to provide the balance owed by the entity. So then we have the audit findings. Identified misstatements will be aggregated. So we're going to take the misstatements, we're going to aggregate them. We're going to have the projected misstatement is then compared to the tolerable misstatement. So the projected misstatement that we get from our findings, we compare to the tolerable misstatement, the level of misstatement that that would be acceptable, that we're going to basically accept. And then if the projected misstatement is less than the tolerable misstatement, the auditor has evidence that the account is fairly presented. So then we're going to say, okay, if it's less, fairly presented. However, if the projected misstatement is greater than the tolerable misstatement, the auditor will conclude that the account is not fairly presented. So if it's greater than the tolerable misstatement, then of course we'd have to conclude it's not fairly stated. In this presentation, we will take a look at the auditing process related to payroll and human resources. As we go through this, note that from a material misstatement type standpoint, we're typically most concerned with payroll here, but of course payroll is closely linked to the process within large organizations of human resources, and human resources has many other things involved that do concern us, including laws related to payroll. Obviously, the ones that are most concerning to us are the things that affect the financial statements, and that includes the withholding of payroll taxes. But there's other things that could include the internal controls as well, including the hiring and firing process of the employees of the personnel. We'll start off talking about the human resources process. So what is the human resources process? Of course, our goal in the audit process is to understand the process, to see what the inherent risks are in the process, to see what management has put in place in terms of internal controls in order to deal with those inherent risks, and then see if we can rely on those internal controls or not, designing then our control tests and our substantive tests related to human resources specifically, or more specifically, normally related to payroll type activities, those that have an effect on the financial statements. So the human resources process begins with the putting into place solid policies related to the hiring, training, evaluation, counseling, promoting, compensating, and taking remedial action for employees. Again, these are all, of course, very important within the controls of the organization. So from that standpoint, we're concerned with many of these types of items, but obviously the compensation area is going to have a direct effect in terms of a material factor on the financial statements. So that's where we'll spend a lot of our time. The primary issue involves, of course, the payroll transactions. So the payroll transactions. Now, when we process the payroll transactions, we will be dealing with the payroll expense as well as the related liabilities, those liabilities with regards to withholdings for things like FIT, federal income tax, Social Security, Medicare, transactions. So when we think about the transactions related to payroll, human resources, primary transactions processed through payroll and human resources are, of course, the payments of the employees. That's what we're going to be primarily concerned with. Those will be directly impacting the financial statements, those things that we, of course, are giving an opinion on. Accrual and payment of payroll-related liabilities, such as Social Security and unemployment taxes. This is going to be the most confusing type of thing within the payroll process, of course, when we think about whether or not it's reasonably stated. The confusing component with regards to payroll is the recording in the process of withholding payroll taxes and then paying the payroll taxes. So just in terms of like the complication of a type of transaction and the process of the transaction, payroll can be quite complicated because if you think about the journal entries involved, they're actually pretty involved journal entries, and they're going to be, you can think about the journal entries as a lump sum for payroll for all employees, and you can also break it out by the detailed checks. So payroll can be actually a quite confusing kind of factor that we look into, especially also when you're talking about different areas and different locations, as well as different kind of payroll types, compensation formats for different parts of the company and possibly different areas of the country or countries. So transaction types and accounts. So we have the payroll transactions. Payroll transactions can include, of course, cash. It could include inventory. For example, we might be paying somebody in a production type process and therefore their payroll being part of the cost of the inventory. We could have direct and indirect labor expense accounts. So when we think about direct labor and indirect labor, those usually are relating to types of industries that are making inventory. So if we're in a service company, we probably may not have the direct or indirect. Even if we're in a merchandising, buying and selling inventory, may not have direct or indirect as big of a factor. However, if we're making the inventory, then we might have direct and indirect inventory that we have to consider how to apply those out to direct or indirect payroll, that we would have to consider how to apply them into the basic cost of the inventory. And then we can have other related liabilities and expense accounts. And then on the accrued payroll liabilities transactions, we could be considering or involving cash, and then other accruals such as payroll taxes and pension costs within the accrual process for payroll. Documentation, the documents that will be involved within payroll, and of course there's going to be a lot of them because payroll is one of those things that are growing in terms of types of regulations of what needs to be included within the payroll process. So the documentation within the payroll process, we have employee records including wage rate or salary. We have the W-4 form and other document authorization forms. You'll recall that the W-4 form is the form that they're going to fill out typically when they're first hired. So that's what the employee's going to provide that information that we need or the employer needs in order to get everything set up, including what's their social security number and where's their address, where they located, as well as withholding type of information to see so the company can then calculate how much should be withheld. So this is a very important document for the setting up and processing of the employee in terms of the wages they will receive and the payroll taxes that will be taken from them. And then we have the timesheets. So timesheets, documentation, payroll check or direct deposit. Obviously, this is going to be an important type of documentation. You'll recall on the payroll checks that we have to actually record out on the payroll checks the information that has been withheld. So within the payroll checks, we can't just give a check. Even if it's a direct deposit, we need to give in some format what the gross pay was, what the withholdings were, what the net pay that was actually received was in some format to the employees. And that can give us information as the auditor as well. Payroll register, so we want to make sure we have the overall payroll register, payroll master file, the payroll master file changes reports when there's any changes to it, the periodic payroll reports, so any kind of the periodic type of reporting that we're going to need, other tax reports and forms. So note that the payroll tax forms are going to typically be done at least quarterly. We'll have quarterly 941 type forms that kind of summarize that information up. We'll have the yearly 940 form. Those are going to be types of payroll forms that we can use. And then, of course, we'll have the year-end type forms, which will be the W-2s and the W-3. Primary functions, human resources. The human resources function is the authorization of hiring, firing, wage rate, and salary changes, salaries, and payroll deductions. So that's basically the human resources process. Supervision, so the function of supervision, review and approval of employees' attendance and time, monitoring of employee scheduling, productivity, and payroll cost changes. Then we have the timekeeping function, processing of employees' attendance and time coding of account distributions. And of course, as we think of these functions, when we're thinking of the auditing process, our goal is to think of these functions, think of what weaknesses could be involved in them, and then what controls has the company put in place to possibly account for those weaknesses or compensate for those weaknesses. And then how can we as the auditor test those controls to see if they are in place and whether they are functioning, and how can we do substantive tests with relation to these functions as well. So as we go through the documentation and the functions, we're basically keeping our whole process in mind here, and that is that we're going to be testing internal controls on these functions, on these forms, seeing how they're going to be put in place and used, and then see how much substantive testing we need to do in order to give an opinion on the payroll process. Payroll processing, computation of gross pay, deductions, and net pay, recording summarization of payments, and verification of account distribution. Then we have the disbursements function, payment of employees, compensation, and benefits. And finally, we have the general ledger function, accumulation, classification, summarization of payroll in the general ledger. So now we want to consider the segregation of duties. And recall that this is going to be one of our major internal controls. This is the thing that whenever you think of internal controls, you want to think of basically segregation of duties, separation of duties. And the goal here is to have in the key components that could result in people more easily, say, having some kind of theft or fraud related item. We want to have two people involved or some kind of separation so that that can only take place if there was some type of colluding with the individuals involved. So we're going to have over here the functions, and then we're going to have the departments involved in them, operating, supporting human resources, timekeeping, payroll, IT, and the treasurer. So the initiation of wage and salary, that's going to be by operating and supporting. Then we have the initiation of employee hiring and firing. That's also going to be involving the operating and supporting activities. We have the approval of wage or salary adjustments. So the approval of the adjustments then done separately here, human resources. Then we have the updating of personal records, also human resources. Updating of payroll records, also human resources. Approval of time and job classification. So the approval process done by the operating and supporting. Review of time data and payroll distribution, that done by timekeeping. Then we have the preparation of payroll records. That's going to be done by the payroll process, as well as supporting by the IT if necessary to process the payroll. Typically, it will be in some format. Preparation and signing of payroll checks. That's going to be in IT. Because it could be done in an automated, basically, process, possibly, in the signing of the checks in a large organization, especially if it's a direct deposit type of situation. Distribution of payroll checks. That's going to be done separately now, treasurer handling the payroll checks at this point. And then update general ledger for payroll activity, updating the general ledger separate from the person that's handing or handling the checks. That's going to be the IT. And then we have the comparison of monthly department payroll expense to the budget done by the operating or supporting. And then we have the calculation of recording of payroll taxes done by payroll process. Okay, so what's the inherent risk of payroll? You'll recall as we go through the payroll, as we go through the human resources, our goal from the audit process is to think of inherent risk, to think of control risk, and then to think of what we're going to set detection risk to be, which is basically how much substantive testing we're going to do. In other words, how risky is the process just in general? What's the controls that have been put in place by management? And then what do we need to do, or how much substantive testing do we need to do in that case, given those factors? So the inherent risk, I would think of inherent risk as something like just inherently risky. It's just risky in and of itself. So if you removed the internal controls from the payroll process, how inherently risky would it be? We need to set the inherent risk. Then we need to think about those internal controls on how effective they would be to catch any problems related to the inherent riskiness. Then we'll think about our substantive testing as the auditor to pick up any other kind of problems that may be in place. So inherent risk. The auditor should consider the effect of economic conditions on payroll costs, the supply of skilled workers, and the frequency of employee turnover. So once again, When considering the inherent risk, the auditor should consider the effect of economic conditions on the payroll costs, the supply of skilled workers, and the frequency of turnover. The auditor should be familiar with any existing labor contracts and the effect of regulations. So we could have, labor contracts that are currently in place. If we have unions involved in the type of organization that we're dealing with, then of course the long-term labor contracts are something that we want to have in consideration and could increase riskiness in terms of whether there's volatility in those contracts or not, and how those contracts are set up. The inherent risk of non-officers of the company is generally low. So when we're thinking about non-officers, we're going to see the inherent risk, we're going to set it as lower. Now, of course, if we take all the non-officers and add them together, it could be a material factor. But the fact is that any one individual that is a non-officer is more likely to be able to freely come and go into the organization and not be an inherent risk factor in and of themselves. But of course, the inherent risk of the officers in the company may not be low because of the ability to take advantage of their high position. So if we think about the officers, then of course the fact that they have more influence and can take advantage of the influence that they have within that position could make them more of an inherent risk within the process. So inherent risk assessment. Understand and document the payroll and human resources management process based on a Reliance strategy. Then we want to plan and perform tests of controls on the payroll transactions. So we're going to understand and document the payroll process and human resources. So we want to, of course, think about how it's going to be put together, and then plan and perform the tests of controls. So then we think about those tests of controls, and then we are going to set and document the control risk for the payroll and human resource management process. Once we have, of course, the inherent risk and the control risk, then we can think about the detection risk, and that's going to be the risk that's going to be associated with how much substantive testing we are going to do. In this presentation, we will consider control activities and tests of controls related to payroll and human resources, noting that when we consider the tests of controls from the auditing perspective, we want to get an idea of the payroll and human resources process. Then we want to consider what the control activities are, those control activities that are put in place by management. Once we have the inherent risk and the control activities, then we want to test those controls, and the more that we can rely on those controls, the less we have to do then on the substantive testing, actually testing the transactions themselves. Now we're going to go through our assertions related to payrolls. Think about the weaknesses within the payroll process, what the controls are, and what the auditor would be most concerned about, starting with the assertion of occurrence of payroll transactions. So the auditor needs assurance that payments for payroll are being made to valid employees for time worked. So let's consider that again in a little bit more detail. The auditor needs assurance that payments for the payroll are being made. So obviously we want to know that the payments are actually happening, being made to valid employees. So that's going to be a key factor. Of course, one of the concerns we might have within the payroll process is there's somehow payroll payments being made, but not to valid employees. That's going to be a consideration for time worked. So of course, not only do they need to be valid employees, they need to be valid employees that did work and therefore are being compensated for the work being done. And again, you can imagine if you were going to set up some kind of problem or some kind of fraud set up in the payroll processes, then the paying of someone who is not an employee or paying someone who is an employee but didn't actually work are two kind of areas where you could see potential problems happening. Controls should be in place to make sure no payments are made to fictitious employees. So obviously we want to make sure that, again, no payments going out that are to fictitious employees, and payments to employees are stopped once the employee is terminated. And that could be a common type of problem. Again, if you're thinking about how would someone fraudulate the payroll process, well, maybe they would consider, maybe they could take advantage of a control not being in place when someone is terminated and somehow keep basically the employee as if they're on the books and the payroll still going to someone that has been terminated. So again, we want to make sure, of course, that when someone has been terminated, payroll has been stopped and those controls in place to make sure that that is indeed the case. Then we have the assertion of authorization of payroll transactions. The business should have controls for, with related to the assertion of authorization, hiring and terminating employees, setting pay rates, making withholdings, awarding benefits, and issuing payroll checks. So again, we're thinking about authorization. If you were considering how would someone cause problems in the payroll department, possibly they're having authorization that wouldn't be in place for these types of things, right? The hiring and terminating of employees, who's going to be the personnel that's going to be involved. There needs to be proper authorization process to go through that process. The setting of the pay rates, so who's going to be involved within the setting of the pay rates, of course, who's going to authorize the setting of the pay rates, that's going to be a key component as well. The making of the withholdings, want to make sure the withholdings have been done properly, including federal income tax, Social Security, Medicare, and then the awarding of benefits. So any kind of benefits that are going to be put in place, they could be very significant, these benefits. We want to make sure that there is authorization related to the benefit process and who gets awarded those benefits in accordance with the decision-making process. And then, of course, the issuing of the actual payroll checks. Then we have the assertion of accuracy of payroll transaction. So we want the accuracy of payroll transaction. Primary issue is that the employee's gross pay and payroll deductions are determined correctly. Now, accuracy, note that within payroll can be a bit complicated now these days because unlike other transactions where you basically just pay, it's a two journal entry, 2 account type transaction. Of course, normally when you pay the utility bill, cash goes down and the expense goes up, right? You debit the expense and you credit cash. When you do payroll, now we have all these withholdings and laws that are put in place, and it can be a bit complex to consider these different laws. We have federal income tax, Social Security, Medicare, just on the federal level in the U.S. Then we could have state taxes. We could have other types of items that need to be withheld. Those withholdings need to be properly calculated and taken out of each individual check. So it's not just the factor that it's complicated in general, but it's the factor, the detail that needs to be put in place, that this proper withholdings need to be done on an employee by employee level. Also, there could be a great number of variations in terms of, how many states or state taxes, if we're in multiple different states, and different types of compensation, if we're salaried employees, if they're hourly employees, and if they have any kind of other items that are going to be involved. And then you put in the factor of benefits that will be involved, other types of benefits, retirement plans. Then you can see the payroll transactions actually get quite complex. So when we think about the accuracy, we want to basically go through and make sure that the calculations of all these type of items are tying out correctly. And we can use various basically techniques to consider the accuracy of the payroll process. Classification, the assertion of classification of payroll transactions. In the event that the payroll expense is charged to the wrong account, the financial statements would be misstated. So it could be misstated if we charge the payroll expense to the wrong account. Payroll expenses need to be properly classified between direct and indirect labor, inventory, and cost of goods sold. Now note, obviously, if we're in a service company and the payroll is all basically payroll, we might be breaking it out between officers or salaried employees and non-salaried employees, such as that, and the mischaracterization or classification is concerning, but not too complicated. If, however, we are in the production process, we make things, then the payroll might be not only allocated to an expense, but things like inventory. It might be in the production process and not be expensed until we sell the inventory in the format of cost of goods sold. Then we need to consider, when we process the payroll, direct labor, indirect labor, those things that would be included in part of the production process. And that can be really confusing to people that don't, deal with the production process a lot, because then the payroll, this can get kind of messy because we would expect to see it as an expense, but it's not going to be an expense typically. If we're allocating that payroll to the production process, it's going to be allocated to inventory, and we're going to have to make sure that the proper allocation is put in place, classifying these employees in the proper classification, and then recording these different types of expenses as should be happening, meaning, obviously period costs. People that work in the office would be having payroll expenses. People that work on the production of inventory would either be directly working on the inventory or indirectly working on it. And therefore, in one way or another, it should be included in the cost of the inventory, the asset, and then expensed in the format of cost of goods sold. And then we have the assertion of presentation of payroll transactions. So presentation, tests of controls around management's use of the chart of accounts, correct codes for recording payroll transactions, and the financial reporting process that includes the use of a disclosure checklist. If the results of the test of control support the planned level of control risk, so after we test the controls then, if the results of the test of control support the planned level of control risk, so we set the plan level, we did the test of controls, our tests of controls then support our planned level, then the auditor conducts substantive procedures and payroll-related accounts at the assessed level. So again, we plan for it, we set the control risk, and then we already planned what we're going to do from that point in time. If the results of the test of control support what we had planned, the auditor conducts the substantive tests. The next step, we go to the substantive testing, the actual kind of more detailed type of testing, and we've got to go actually dig in, go out to the customer and or the client or the company as the auditor and start digging into documentation and whatnot. That's the substantive testing. The next procedure, and payroll-related accounts, we're gonna go and test them at the assertion level. However, if the rates do not support the level of control risk, so we test the controls and we say that it's not in what we expected the planned level to be, then the nature and extent of substantive testing must be increased. And again, it's easy for us to kind of think about that, or it should be getting more easy to kind of think about the relationship in terms of controls and substantive testing, in that if the controls are strong, we can do less substantive testing because we're relying on it. If the controls are weak, then we have to do more substantive testing because we can't rely on it. You also want to think of it in terms of the risk factors, though, because that can be a little bit more confusing. So remember, we're thinking inherent risk, control risk. We're going to use those risks to determine how we're going to set the detection risk. And the detection risk is going to be related to the substantive testing, how much basically how much substantive testing do we need to do. So usually if we're thinking about the control risk, then the control risk, if we say the control risk is good, we can rely on the controls, then the control risk, the risk that the controls set up by management to detect a material misstatement, the risk that a misstatement is there that's not going to be caught by the controls that were set up by management. If the controls are good, then we're going to say the control risk is low because the controls are good. The controls are good, therefore the control risk is low. And that means that we are going to do, as the auditor, possibly less substantive testing because the control risk is low because the controls are strong. And therefore, we're going to set the detection risk as high, meaning the detection risk, the risk that we as the auditor don't catch a material misstatement with basically substantive testing, you can think of, is high because we set it high because we're depending on the internal controls and therefore we're doing less substantive testing. If on the other hand, we're saying that the controls are weak, we can't depend on the controls, then we're going to set the control risk as high, meaning it's a high risk that the controls being set up by management are not going to detect a material misstatement. And therefore, we as the auditor are going to set the detection risk, the risk that we in our audit substantive testing will not catch the material misstatement. We're going to set that as low, meaning if we set the detection risk as low, that means that our audit procedures have to be the thing that's going to catch the material misstatement. We need to do more of them. We're going to do more audit procedures, more substantive testing.